CEO, but also Broadcom, certainly in our minds. Broadcom not able to reassure the market sufficiently around its prospects. This chip maker, of course, ASML, makes the stuff that makes the chips. So we will keep an eye on the whole tech sector, but ASML is one part of that. Standard Chartered, that stock was up in the Hong Kong session after Goldman Sachs upgraded the stock to a buy, citing improving profitability and the chance it will raise its return guidance. Guy?
Okay, here we go. Time for the European market open. We're expecting circa 0.5% in terms of the upside for Europe. That's largely a legacy of what we saw yesterday in the United States. And as anticipated, we are certainly seeing that move. The Euro Stoxx 600 is up by 0.5%. And now drops, actually, a little bit off the back of that. So I wonder what's just open to maybe take some of that out. We're only up now by 0.1%. We were expecting a little bit more. So I'm curious to dig into the details as to why that has happened. We are dealing with a little bit of a holdover from the United States yesterday. So, Anna, what are we seeing?
Yeah, in terms of the individual markets, the FTSE is up by 0.3%. The CAC 40 is up by 0.2. The ZDAX is not yet open, so there's nothing particularly untoward happening there. In terms of the sectors that we have in focus, we've got travel and leisure is the best performing sector, and that's for the second day in a row. It was actually some of the travel stocks, Carnival, for example, that was moving higher yesterday. Today, I see Lottomatica is up, so that's a slightly different story. Technology is the second best performing sector, so that does not have Broadcom written all over it. Prosus is up by 1.7%. Perhaps that has something to do with the gains that we saw through the Asia session, because that was really strong, and they, of course, hold Tencent stock. And so MSCI Asia Pacific was up by over 1%. So maybe we're just getting that read across.
Tech is up in Europe, so that's interesting. ASML is the biggest points gainer. It's up by 1.31%. You've got SAP also rising too. Some of the other names like Schneider Electric is up by 0.6%. Where the heavy lifting seems to be coming through this morning, though, is in the banking sector, which is interesting. So we've talked about this UBS story. UBS is up by nearly 3% this morning and is the second biggest points gainer in terms of what we're seeing on the Stoxx 600. But HSBC is also higher. BNP Paribas is also tracking higher as well. So the big heavyweight banks are doing some of the big heavyweight lifting.
And Standard Chartered, sticking with that theme, also higher on the back of that upgrade. Quite a lot of upgrades and downgrades coming through this morning. So perhaps there's quite a lot of impact from some of that broker activity. Let's widen the conversation. Speak to Christian Muller-Glissman, who joins us this Friday morning, Head of Asset Allocation Research over at Goldman Sachs. Christian, very nice to see you. It feels like it's been a sort of busy, slightly disconnected week. Next week looks really busy. To pick up on Guy's question in the first hour, how much are you trying to put 2025 to one side and focus on 2026, or are there still plenty of risks on the horizon in the very near term?
Well, I mean, the year is close to the end. I think it's the NFP. Everybody's watching the NFP. I think the Fed meeting turned out to be somewhat hawkish on the surface, but the assessment of the labor market was somewhat more dovish than what we actually had, where I think there was a lot of downward revision of the actual pace of job growth for the year. So that was really kind of a very good outcome for the market to work with going into year end. But I think now we need to actually see that NFP print and kind of understand how to start into 2026. But I would say that we're getting very close to ending the year on a very high note.
Yes, on a high note. Yes, indeed. I mean, touching new highs on US stocks and on global stocks. And so sticking with the stocks theme, actually, I wanted to ask you about how you interpret some of the sector performance. Just yesterday's session, which is a bit of a niche sort of time period to pick, but I thought it was interesting. Valerie was talking about this earlier. We saw a lot of cyclical stocks doing pretty well, and that was enough to sustain the stock market to a new high, even though some of the AI names and tech we're in retreat. Does this tell us something about how stocks globally are, I don't know, ready to do without the AI training wheels, or what does it tell us?
I think we're definitely dealing with a new regime coming into 2026, where I think this year was all about AI capex, boosting the corporate sector, keeping growth optimism supported, but a bit narrow. And at the same time, you had a weak labor market, a K-shape, which actually allowed the Fed to be dovish. So it was kind of Goldilocks-ish, but not the usual Goldilocks, where you have growth picking up, kind of economic growth picking up with inflation going down. Inflation was actually quite sticky, if not picking up. So I think going into next year, it looks much more old school Goldilocks, where you essentially have growth picking up, you have the big beautiful bill, you have German fiscal spend ramping up, you have Japan fiscal spend ramping up, but you also have disinflation in the pipe. You will still have a weak housing market, you have a weak labor market, you have the tariff impacts coming out of the inflation picture, and we're actually quite bearish on oil. So suddenly you actually get much more of a traditional kind of Goldilocks, and possibly that kind of widens the leadership a bit. There's more broadening out. And I think this is what the market is focused on, like a proper cyclical kind of impulse coming through the economy. And there's always the potential, especially if the Fed is a bit easy, that it kind of really accelerates, that you get proper releveraging and restructuring. And I think this is what the market is betting on right now.
Can I get too far? Like, the valuations are already pretty high.
Yeah.
You punch them a little bit higher. Are we getting into this kind of story where actually you could accelerate the economy too fast? You do get that inflation story coming back. How finely balanced is that kind of? We can see a good economy, but it's an economy that doesn't yet deliver inflation.
Yeah, no, it's a very good point. Like, normally the best accelerations are early cycle, mid cycle, but we are a bit late cycle. Like, unemployment rates are low, profit margins are high. Yeah. We obviously have risk premia and that are compressed. Yeah. So you're absolutely right. Like, too much is not great. You have a speed limit that the economy and valuations are giving you for equity returns. But obviously we have AI, and I think there is a certain element of jobless growth, productivity.
That's what Powell's betting on.
Yeah, and I think it's right. I think you see it already in the last few months, where the economy has done really well, the corporate sector has done really well with the weak labor market. Yeah. As long as that continues, that's important. But also really important, you need to keep the inflation anchored. And I think it's not going to be that difficult, because you have these negative tariff impacts, at least initially, coming through. So inflation should normalize.
Okay. That doesn't sound like an environment, though, where I need a lot of rate cuts. The market clearly is highly sensitive to rate cuts. Do you think the Fed could be done? Do you think the ECB's done? Is the Bank of England done? Is the BOJ going to be hiking? Are other central banks going to be hiking? What does that rate trajectory look like next year? Because stocks have been really sensitive to this story.
So what I always think is, like, equity investors, they don't really care if you get 1 or 2 cuts from here, but they care if the Fed will cut when needed. And I think that's definitely the case. Yeah. So if there is something going wrong in the economy, the Fed has a lot of room to cut, and I think a lot of inclination to cut. And the other question is if they will hike. And I would say that for the Fed, the bar to hike is still very, very high, considering that weak labor market.
What about the bar just to leave things as they are? How high is the possibility we get no rate cuts or no rate hikes in 2026? And how does the equity market deal with a no rate cut, no rate hike kind of scenario?
It always depends on the interaction. Why is that? Is it because growth is better? We know equities can deal with rates going up and with possibly the Fed not cutting, as long as the growth picture is good. But I think it's really dependent on the narrative at that time. Are they not cutting because inflation is picking up a bit? Are they not cutting because they're worried about financial conditions being too easy? We had this in the past, where the Fed was actually saying what's going on in equities, what's going on in financial conditions is worrying them. That would not be good, obviously, because then you start to go from a Fed put to actually being short the Fed call, if that makes sense. But I would say that if the growth picture, which is always the most important driver of equities, is good next year, the market can deal with a slightly more hawkish Fed. It can deal with slightly higher rates. But I would say one thing that's important is the Fed is not the only central bank out there. Like, the Fed is at the margin currently still one of the most dovish central banks. You have Canada, New Zealand, Australia, where the market is pricing hikes next year. You have the ECB, of course, at the cusp of pricing a bit more of a hike, and quite some hawkish commentary recently. So I think the first half of the year, I think will be a bit more growth rate tango. That's what I call it. Like growth goes a bit too much up, that pushes up rates, which then weighs on growth. So you go back again, both of them go down, and that means you get a bit more volatility, like less Goldilocks-ish in terms of anchoring volatility, but the path, in our view, is still up.
Okay, so we have a growth rates tango, but we do have old school Goldilocks for next year then, Christian. So if we get old school Goldilocks, you want to be overweight US stocks. I think that's what your stance is for next year. But how do you protect? What kind of protection do you need? And what is the best protection if you're a little nervous about the US overweight?
Yeah, no, I think what we've been arguing a lot is regional diversification. So you're absolutely right. The US equity market has a lot of tailwinds. It has tailwinds from a big, beautiful bill. Also, the AI theme, to some extent, is still going, even though it's changing. It's changing from AI capex to maybe a bit more AI adoption, maybe a bit more AI applications. So you want to possibly diversify the AI theme in itself. I think we still like regional diversification. We actually overweight Asia, and we like EM, but Asia certainly has a lot of optionalities, both on the currency and the equity side. So to us, there's a lot of export competition from China, which is worth diversifying for Europe. There's AI competition for the US, which is worth diversifying via China. And we do actually think the Chinese currency is 30% undervalued. So we like Asia, but I think what we are very focused on going into 2026 is actually style diversification. So we like styles like quality, we like styles like low volatility, which have really done terribly in the last 2 to 3 years. And not to forget, the 3-year rolling Sharpe ratio on the S&P 500 is reaching the highest levels in 125 years. Yeah. So as you can, it's crazy, like, because you came out of 2022, and that actually means that quality styles that usually do better when the Sharpe ratio is lower, they might actually be a bit more valuable in the portfolio. And the last thing is, of course, we need to look at duration and duration proxies and safety. So we think the bond market in the first half, as we discussed, will potentially be a bit of a drag on the portfolio as the market reprices that kind of growth environment. But we do still see value selectively in duration. We've been overweight gilts, which are currently decoupling economically and have decoupled a lot on the central bank side for some time. So we're overweight gilts, and we still like gold. I think gold will remain a quite interesting asset next year, considering all the fiscal dimensions of that growth.
What's your biggest risk for 26?
We discussed it already. I'm very worried about inflation potentially picking up, giving us some...
Where does that come from? What will be the genesis of that inflation?
Well, you know, like, in very simple terms, when you're late cycle and you're accelerating, you're often running out of stuff. You know, you run out of labor, you run out of resources, especially if there's supply disruptions. So we're watching very carefully copper, because if you ramp up a bit more economically, you can support a lot of these cyclical commodities. We're actually not that bullish on copper because you had these supply disruptions boosting the price. So we do actually think the supply will help copper stay range bound. We're bearish on oil. If anything, the Russia-Ukraine deal could push down oil a bit, but we have to watch all these places where we can run out of stuff. Labor, another question, a big concern is the disconnect in the labor market between open jobs and people actually searching for jobs. Like, there's a lot of college unemployment pickup right now, but the jobs that are open are car mechanics, people that put the glass into the buildings. Like, this is not what a college graduate wants to do. So you could actually see, as the US economy accelerates in a more traditional way, bottlenecks in the labor market. So we're watching all of that. And the last thing I'm very worried about is, of course, the AI ecosystem still. We know there's a lot of money that's been put on the table that needs to essentially come back in some shape or form. So we need to monitor depreciation, we need to monitor trends for AI capex demand, if that makes sense, because you need to really now adopt and you need to make the applications and you need to make money. And I think this next year could be a bit of a show me year for the AI ecosystem.
So Goldilocks is still wary of the bears. There's still bears out there. Just
I think so.
Goldilocks needs to, keep an eye on what is going on. Be alert. Don't just focus on the porridge. Christian, great to see you. Thank you very much indeed. Have a very happy holiday. CMG, Christian Muller-Glissman, Head of Asset Allocation Research over at Goldman Sachs. Core 6 looks like this. Defence stocks on the front foot, which is interesting in light of what is happening in Ukraine. ASML, though, is leading the charge. We've got tech up which is interesting, again, in the light as well, with what is happening surrounding the Broadcom story. Let's figure out what is happening in the banking story, though. Louise Min has the details.
Yes, UBS is a big focus this morning. Shares ticking higher, the welcome news of Swiss lawmakers coming up with a compromise in terms of their capital requirements. So ticking higher, almost up 5% for UBS this morning. And then moving on to athleisure, a very different sector, but another one that we're focusing on in Europe. Potential ripple through story. Oh, sorry, firstly, we'll speak about Standard Chartered. They've been upgraded to a buy from Goldman, boosting that stock. This also happened in Hong Kong, so it's, you know, the same kind of reaction in the UK market, up over 2.5% for Standard Chartered. Next up is athleisure, as I mentioned before. Potential ripple through from Lululemon, positive news overnight. They boosted their full-year outlook. A new CEO, potentially some innovation there. So we're looking at Adidas, Puma, JD, all taking higher, potentially on the back of that. Fraser's slightly down over 2% there. So we'll be keeping an eye on that through the day. And then finally, we're looking at Lufthansa, the airline. They are higher into the green, up over 5%. And that's after they've been raised to a buy. One of the few buys for the stock, so being taken positively by the market. So another one we'll be keeping an eye on through the day.
Louise, thank you very much. Bloomberg's Louise Moon with some of those stocks that are moving this morning. So European equity markets, they're not looking too bad today, making some modest gains. US futures flat in the S&P, Nasdaq futures down 0.1%. More on the markets when we come back. We'll also dive into that UBS story that Louise was talking about. Swiss lawmakers have proposed a compromise in the debate over the future of UBS and how it secures its self-sufficient capital to comply with Swiss regulations. More on that next. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
18 minutes into the equity market session this Friday, and we are certainly picking up with the legacy of what we saw yesterday in the United States and pushing higher. We're up by, let's call it circa 0.5%. We're now fully open. We've got the kind of numbers we were anticipating from Europe this morning. What is interesting is that tech is certainly doing a lot of the heavy lifting, but the banks are also having a fairly serious impact on what we are seeing this morning. One of those banks, and the standout one maybe this morning, is UBS. The stock is pushing higher. A group of centre-right Swiss lawmakers apparently proposing a compromise in the debate over UBS's capital. What they're proposing basically is that UBS will be able to use convertible bonds to meet its capital requirements. So you use, rather than kind of the super elevated stuff, you'd use AT1s, which are a bit cheaper but still give you the same kind of capital lift that maybe the Swiss government is looking for. Steve Ahrens joins us now to talk about what is being proposed here. So basically, you have to get to the same level, but you can use cheaper AT1s to get there, seems to be the compromise, Steve.
That's the compromise solution that they're proposing. That's right. AT1s are a kind of junior debt that's cheaper for banks than equity, so it would make the whole thing a bit more feasible for UBS. And they've actually reacted and said, oh, okay, we're looking at this, and it's going in the right direction. So a positive signal even from UBS on this one.
Right, yeah, so that takes me to my next question, which is, this is coming from the politicians. Does it sound like something that UBS would accept? It sounds as if they're being quite positive about it, and certainly the market is quite positive. UBS shares then Steve up by 4.5%, rising by 4.5% on the back of this proposal.
That's right. I mean, the capital reforms in Switzerland, just think about it. They're threatening to impose as much as $26 billion in new capital requirements on UBS, and that would definitely impact payouts to investors. So they have been worried about this scenario for a very long time, and right now there's a lot of tailwind building for UBS that this will be watered down, and we won't end up at the $26 billion. We'll end up somewhere below it. That's the indication, and investors are piling into that bet now.
Steve, even though, would this still leave UBS at a competitive disadvantage? That's the whole kind of shtick here, that basically UBS feels that it would be at a competitive disadvantage because it operates at a global basis. Even if it was able to deliver the capital compromise using AT1s, would it still be at a disadvantage versus other kind of big global banks with which it competes?
The answer is yes. But, so yes, absolutely. I mean, new capital requirements that would only be imposed on UBS would definitely create a disadvantage for them, right? I mean, it would be the only bank that's facing this. But now that the prospect is actually declining a little, they've already thought about how to mitigate all of this. So the impact is less than what they thought it will be, and that's actually giving them tailwind right now.
Steve, thank you very much. Bloomberg's Stephen Ahrens with the ins and outs of that UBS capital requirements story. Certainly one we'll continue to follow as that stock back at levels we've seen in 2008. Far from 2006 levels, but back to 2008 levels for sure. Let's have a quick look at another sector that is on the move a little bit this morning. We've had some news flow surrounding management over in the United States, over at Lululemon specifically. So Adidas is up a little, Puma is up a little, JD Sports up less, but we are seeing a bit of a movement higher. Lululemon shares rallied in extended trading after the athleisure and yoga wear maker boosted its full-year outlook and announced that its CEO, Calvin McDonald, would step down. This after a prolonged period of sluggish growth. So let's talk about this sector and much beyond. Joining us now, Bloomberg opinion columnist Andrea Felsted with thoughts on athleisure. Andrea, so how much of the investment? Yeah, we all do. How much of this is all about the athleisure market then, and what Lululemon has been saying?
I think it's probably a bit about the CEO and a bit about the athleisure market. I mean, I think generally the market is a bit under pressure because fashion trends haven't been on its side. We've had a switch from leggings to wider pants, which other people have been doing better than Lululemon. Also, at the same time, we've got this whole revival of denim, which is a competitor to athleisure. Plus, I wrote this morning about the Ralph Lauren Christmas. I mean, the two are kind of linked because you've got this preppy return to sophisticated casual dressing, this quarter zip craze. That's all competition with fleeces, track jackets. So
yes,
the two are kind of linked together.
Your piece had me looking all sorts of fashion trends up this morning on my work Google profile. It's going to look like I was shopping. I was not. I was researching Andrea Felsted's piece.
Honestly.
Yes, honestly. It might be the 12th of December.
The quarter zip thing concerns me.
No, really?
No, I can't. I've got a lot of quarter zips. Believe you me, being fashionable is not necessarily high on my list of because everybody's going to be wearing them. There'll be competition for the quarter zip. In terms of kind of what we are looking at the moment, how does put consumer confidence next? What does that kind of going smarter thing tell me about consumer confidence?
I think it reflects a bit about back to the office. We're all going back to the office now.
I don't think we ever left, but okay.
Yeah, exactly. Plus, maybe a little bit of worry about the jobs market. You want to give your best. Yeah, give the best impression. So, fashion often takes its inspiration not just from what we wear, but how we feel. Another reason why Ralph Lauren Christmas was changing. When times are tough, we tend to, take comfort in the holidays, the traditions of the past. So it's all kind of linked, really.
Yeah, I was looking up that as well. There was a lot in those images. It's an assault on the senses at sort of 5 in the morning, Andrea. I'm going back to Lululemon because competition in the athleisure market. I mean, where does that leave them? Because they're not the cheapest in that space, and lots of other retailers have offerings.
It's a really competitive market. So you've got the Alo, Fiore, who are squarely in Lululemon's space. You've got Nike Skims, which after a delay seems to be doing well. But it's not just the premium brands. The high street's doing athleisure really well. You've got Inditex has got this Oysho chain which does a good job. You've got
H&M has
H&M. Primark does a great job in the States. Old Navy's doing really well on its kind of more athletic wear. So you can find the look whatever your budget.
What's next in the kind of if we're smartening up because we're more worried, what comes next? Dare I say ties? We're not going to go too far here.
I'm not sure, but we have definitely we are still seeing kind of corporate wear on the catwalks. Tailoring. It's still a strong look. I think denim doesn't seem to be peaking yet. You often find things like
denim hasn't peaked.
I don't think denim has quite peaked. I've been expecting it to peak, but it still seems strong. You often find things like cord come after denim. We're seeing a lot of velvet. I mean, that's more for party. But I think there's more to run on the sophisticated, casual, more dressing up side.
Okay. Andrea, thank you very much. Andrea Felsted, always a pleasure to see Andrea in the studio, especially on a Friday, and especially on a Friday before Christmas, where I feel this is a segment that you can take into your weekend and learn from. Not you personally, Guy.
I've never been ahead of the curve in my entire life, but the quarter zip thing is well, yeah.
Stop the clocks.
I'm going to harsh, but probably fair.
Too mean? Sorry.
No, I think it's probably reasonably accurate. Maria de Mertzis is going to be joining us shortly. We're going to talk about what is happening in Europe, the politics story front and centre in terms of Ukraine. We've got a busy week coming up next week. The ECB is going to be on deck as well. Lots of factors that we need to fold into our conversation with Maria. That is up next. This is Bloomberg.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is the opening trade, 30 minutes into today's session. Let's have a look at where we are trading this Friday morning. Up by around 0.6%. Seems to be the made moon in the markets when it comes to the major continental European markets, the DAX and the CAC, both up by that kind of measure. The FTSE 100 not far behind. So overall, a pretty decent session for Europe. Euro Stoxx 50 joining the global party and taking out those records. So it's taken out another record. We last touched this in November, I think, and now we've taken out another one. So a strong story for European stocks following a strong story in Asia and strength in the US session. So we're pricing all of that global narrative in. Broadcom, though, could weigh on US stocks as we go towards the US session, Guy. Might spoil the party a little bit. I like the talk of parties, though. Good way of looking at things. Let's talk a little bit about what is happening at the party, within the party, what's going on in the party. Who's having a good time and who's not having a good time at the party this morning? Well, there's 458 up, so definitely those in favour of the party are winning this morning. 460 up, 126 down. Volume is also good, so the party's rocking. That is the narrative that we're getting. In terms of those that are enjoying it this morning, UBS is having a great time. That stock is up by 4.42% on this capital story that we were talking about just a moment ago. Lufthansa has been upgraded at Kepler. It's joining the party. ASML, on the back of Tom McKenzie's interview, is also enjoying the party, up by 0.9%. Sitting in the corner, not having quite such a good time. Let's talk about those stocks. Magnum Ice Cream, ironically, is actually not having a particularly good time this morning, down by 2.23%, reasonably spun out. It is off. And actually, there's a bit of a theme this morning, because the drink stocks, actually, interestingly enough, are also softer. Continuing the party theme. You've got also the likes of Nestle and Unilever softening up as well. So that kind of consumer-facing story, be it the high end or the low end, be it in the spirits or the deodorant kind of end of the market, that's where the weakness in some ways is in Europe this morning. I had another one, but Valerie Teitel made me take it out and said that I had to focus on also there's weakness in the pharma space this morning. The pharmaceuticals are also not having a good time at the party, and AstraZeneca is down by 0.8%. Well, maybe that fits. I mean, it's a pretty strange party. Let's put it that way. Let's get an update then, Guy, on some of the other stories we're focused on this morning. Data released this morning shows the UK economy shrank again in October, making it a fourth straight month without growth, as activity was blunted in the run-up to the autumn budget. The pound briefly edged lower after the data, while traders slightly increased bets on Bank of England rate cuts over the next year. The BOE's next rate decision is, of course, on Thursday. That's next week. Disney shares closed higher in the United States after the company announced it's licensing some of its iconic characters to OpenAI for use on the startup's video platform. Disney has also agreed to take a $1 billion stake in the startup. While the deal covers some of the firm's most or more famous characters, it does not include talent likenesses or any voices. And Donald Trump said the United States would be willing to help Ukraine as part of a security agreement to end the war with Russia. The comments came after his spokeswoman described the U.S. president as, quote, extremely frustrated with both sides of this war. This as Ukrainian President Zelensky floats the prospect of a referendum on handing over the Donbass to Russia.
Okay, let's continue that conversation and talk about what happens next. EU finance ministers meeting in Brussels today. The bloc appears to be getting set to approve a deal that would let these frozen Russian assets be used to support Ukraine. Emergency powers are potentially being put in place. We're going to get around Hungary. We're going to find out a way of dealing with that. But the risks for Europe appear to be significant, and they have been laid out in rather sort of cold fashion by the NATO Secretary General Mark Rutte. A stark warning coming from him on the need to get ready for the possibility of all-out war with Russia.
Conflict is at our door. Russia has brought war back to Europe, and we must be prepared for the scale of war our grandparents and great-grandparents endured. Imagine it, a conflict reaching every home, every workplace. Destruction, mass mobilization, millions displaced.
Well, that's a cheery outlook for Europe as we kind of think about what could come next. But that worst-case scenario increasingly being kind of modelled out and mapped out by many European leaders. Our chief Europe correspondent, Oliver Crook, joins us now at the European Council in Brussels. It kind of reinforces the idea that we need to get a peace deal. We need to get this conflict in Europe sorted, though it doesn't ultimately kind of take out the Russian threat. Where are we now in terms of that process and the latest comments? Fold them in from President Trump.
Yeah, let's deal with the American side of this first, the comments from Donald Trump. I mean, the first reflection that he's grown very impatient and he'd like to see something done immediately. He likes warp speed diplomacy. That is not something terribly new. I think there were two things that were new that we heard from Trump yesterday. First, it was the president speaking openly about security guarantees for Ukraine. We've talked a lot in the abstract about security guarantees for Ukraine. We don't know what form they would take, how much of it would be assured by the Europeans, how much of it would be assured by the United States. And this is one of the first times that we have Donald Trump openly talking about it and saying that he is willing to contribute in some manner or another to those security guarantees. We should say he did not sort of elaborate on what kind of security guarantees they would be, but it's at least an acknowledgement from the President of the United States that it's something that the U.S. is willing to do. The second thing we're looking forward to is this weekend when there is a high-level European leaders meeting about Ukraine that will involve the Ukrainian delegation. We understand that they would like the United States to participate. That being said, Trump says he will really only send a delegation to participate in those talks if he feels that they're going to be their progress is going to be made, that they're not talks for the sake of talks, meetings for the sake of meetings, which is one of the great frustrations for the president.
And thinking about how we get to some kind of resolution, some kind of peace in Ukraine, Ollie, what has President Zelensky been suggesting around the Donbass? He's talking about voting on elements of handover to Russia. Talk us through the detail there.
So this is a really interesting approach by President Zelensky, and I think it's rooted in the fundamental premise that has led his foreign diplomacy with the United States ever since the catastrophic meeting in the Oval Office back in February, which is basically this initial premise, that there are no bad ideas out of Washington, D.C., no matter how confrontational they appear, no matter how difficult they are for the Ukrainians to agree with, he will always work with it and try to use the momentum of those ideas in order to get it to a place that is helpful to Ukraine. We've seen that twice this week already. The first was on this question of holding elections in Ukraine. Zelensky said that basically if the United States could assure security for those elections and Europe, they could assure the situation and the conditions for safety in Ukraine for elections, he would hold elections in the next 60 to 90 days. So basically going with the American initiative, and one of the critiques that Trump has said that basically it's no longer democratic, and he's called Zelensky a dictator in the past, he sort of finds a way to abate that criticism while also bringing this vote potentially to the Ukrainian people. The second thing is bringing a referendum on whether or not to surrender territory effectively in these trade negotiations or these peace negotiations with Russia and putting that to the Ukrainian people. That is, again, clever for two reasons. One, it takes the initiative out of Zelensky's hands. If the Ukrainian people, after they have voted, say we are willing to endure more war, that is not Zelensky sort of providing any kind of impediment to the peace process. And the second thing, of course, what it does is it puts on full display that Ukraine is a democratic nation in very sharp contrast to its opposition to Russia.
Let's talk about frozen Russian assets. Are we about to take them out of the deep freeze?
So that is the sort of big question here, Guy, and I think that, there is a lot of positive momentum. There's a lot of positive noise from a number of European leaders over the last couple of days. There are still some hurdles. What we're expecting today from the Europeans here is to basically use emergency powers to circumvent Hungary and Slovakia in order to get these frozen Russian assets on ice, basically indefinitely. This would basically prevent this from being every time a unanimous vote, one of qualified majority. That's obviously contentious for a number of reasons, but that is a prerequisite to being able to use these Russian assets indefinitely, and that is basically what we expect to happen today. What then gets kicked into next week is whether or not they're actually going to seize these assets meaningfully and monetize them, and frankly, we don't have the answer to that yet. Despite all the positive rhetoric we've heard from a number of European leaders, we still have not heard from the Belgians that they are 100% satisfied with the assurances that the EU are giving right now. So that is what we're going to be watching for. That is what we're going to be listening to finance ministers as they walk in here for the rest of the day. And going into next week, I think that this is absolutely critical for Europe. This is the frozen Russian assets, and the 90 billion euros that would go to funding Ukraine is the only meaningful thing that the Europeans can contribute to this peace process. It's their only piece of leverage in these negotiations. If they fail to do so, they will be faced with the reality of European leaders talking about the importance for 4 years of supporting Ukraine and basically failing to do so on the only thing they can contribute right now.
Ollie, thanks very much. Bloomberg's Oliver Crook in Brussels. Let's continue this conversation. Joining us now for more on Europe from a slightly more economic perspective, but picking up on some of these themes, is Maria de Mersis, leader of Europe's Economy, Strategy and Finance Centre at the Conference Board. Maria, really nice to have you with us. We want to talk about the ECB a little bit. I know you've got some interesting things to say also about confidence amongst business leaders, or lack of it, so we'll get to that shortly. But we were just hearing there about these conversations on Russian assets and what Europe can do there. Do you understand why this is such a stumbling block for Belgium? I understand fully that a lot of the assets are in Belgium, but why does it seem so difficult to craft something legally that can reassure them that they won't be on their own if there were to be some pushback from using them to secure a loan to Ukraine?
It really has to do with the fact that the assets reside in Belgium. And if there were to be a legal process started from Russia, and I actually say there will be one, then there will be a legal costing involved with all of this. And of course, there will be an issue of risks for what happens to the assets themselves, who pays them back. And this is what Belgium worries about, given that it is that will be the frontline country that will have to answer that question. What Belgium is asking for is a mutualization of risk. It is asking its European partners not to have to deal with this issue alone, to have to deal with this collectively as European Union. That's all it's asking. It's very reasonable, and I think that we will find a solution to that.
Yes, and there has been talk about that being fine. I've certainly heard European leaders saying that they will try and craft something. So we'll look to next week maybe to see if that comes to pass. Is there risk in this for the European banking system, and then as a link to that, the European fiscal authorities, European governments? Is there risk if Ukraine does not pay back the money, for example?
There are always risks, but we're talking about 210 billion. So these are substantive amounts, but they're not catastrophic in terms of how big they are in the European Union, what they represent in terms of proportions. I think there are risks, but if you put the whole fiscal side of the European Union, meaning the governments behind it, I just don't think that will be a systemic problem either for the banks or for the fiscal authorities. It is a risk. There is nothing without risk, but it is contained if the European Union throws its collective back on it.
Maria, if there was a peace deal, what would it mean for the European economy? Is it possible at this point to get a clear idea?
It's quite far off, I think, but if you were to dream of what that would look like, they would have to think about ways of reconstructing Ukraine. First, safety Ukraine, who provides the safety, and then after that is reconstruction. I don't think we know what that would look like, but I would imagine the US will have a big deal, a big role to play there, and I'm hoping also that the EU will have a big role to play there, also in view of Ukraine becoming closer to the EU with the future membership of the Ukraine, if not this decade, maybe the next.
Okay, let's talk more kind of near term and what is happening next within Europe. When do you think the first ECB rate hike is going to come? Are we going to see it in 2026 or is it a 2027 story?
It depends on how the risks are evolving. For all intents and purposes, inflation in the euro area is now exactly what it needs to be. It wobbles a little bit on one side and the other. We saw in the last month an upside on the inflation, which was a little unexpected, but nothing to cause any hurry. And therefore, the forecasts that are also very much on the target are not raising any concerns. I just don't know what the balance of risk would look like, depending also on what the situation of war will look like in 2026. The prospect of peace is very helpful, but it's not guaranteed at this moment. I think if we were to have a rate hike, it would be close at the end of 2026 and not early 2026.
Okay, so that's the ECB next week. Maria, you have been thinking about the climate for business in Europe, which of course links us into the ECB. You do regular surveys of CEOs and their confidence. And you talk about how the view from CEOs you've been talking to is that the Draghi reforms are not advancing fast enough. Now, we've heard from one CEO, one CFO this morning, who have both talked about Europe falling behind. This was ASML on chip manufacturer. This was Schneider Electric on data center rollouts. Is there any kind of momentum building to move faster on those Draghi reforms?
Yes, I think unfortunately, the issue of the war has really sidetracked all of this conversation. That's very, very unfortunate. We need to make progress, parallel progress on economic reform and on security. And that is actually, I think, what is holding us back. Indeed, what we hear from the CEOs is that although their confidence has increased by comparison to 6 months ago, they're still in negative territory. And they're telling us that they feel a lot more confident about areas outside the EU than inside the EU. And that includes both the US and China, which is really unfortunate. They also do see that the progress made on the Draghi report lags behind, and they actually blame the countries for this. They think it is member states that need to coordinate better, and they're advanced on the reforms. So in that respect, the news that are coming are not so good in terms of how fast we are moving in improving the competitiveness agenda. And I hope that this helps concentrate the minds in Brussels and in member states in kind of making better progress in that respect.
Maria, you talk to a lot of people in Brussels, you talk to a lot of people around Europe. Do you see any prospect of the UK joining a customs union with the EU? Do you see any prospect of single market access? This debate is beginning to start in the UK in earnest, it feels. And I'm wondering what you think it looks like from the other side of the fence.
I think you'd have to put it low in the priority list at the moment. There's so many other issues that need to be fixed. But where I do believe there will be progress is on defense. And that, of course, has got single market aspects to it as well. But that's what we need to make progress on. Find a way of allowing the UK to participate in defense projects in Europe. That will be the first step. And once this is established and will also serve our preparedness efforts, then we can think about how to make closer ties with the US. But as you can imagine, for the moment, there's so many other issues that are crucial for the EU, and they're exactly the first priority right now.
Got to bring someone to the party. Maria, thank you very much indeed. Maria de Mertzis, leader of Europe's Economy, Strategy and Finance Centre at the Conference Board. Thank you very much indeed. Staying with the UK, coming up has to do UK's soft GDP reading for October. Giving the Bank of England more room to cut next week, we'll discuss the latest when it comes to the UK economy, and we will do so next. This is Bloomberg.
cidade estava sitiada.
Isso ao começo eu também não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner. I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back to the opening trades. We are currently 50 minutes into a European session of higher stocks is what you wanted for Christmas. We certainly have that today. New highs for European stocks by some measures, global stocks, US stocks. That's been the story of the past 24 hours. Maybe things get a little trickier from here with those Broadcom negative sentiments coming through from that earnings story. But let's think about next week and see what that has in store, because it's going to be busy. And so we thought it was worth getting a head start on what to look out for. Tuesday, US non-farm payrolls, UK labour data as well. UK CPI on Wednesday, Bank of England decision, ECB decision, both of those fall on Thursday, and then US CPI also on Thursday, and a BOJ decision as well. I mean, not much then, Guy. Not much happening.
No, but in some ways it's good. Because there is this danger in December that nothing happens.
That is dangerous.
And from our point of view, that makes life very, very difficult.
This might keep more people paying attention, a bit more volume in markets, perhaps.
And something for us to talk about.
Yes, that also helps.
Which is also
we
useful.
still have 2 hours to fill, so yes. Now, the UK economy disappointed again by contracting in October, a fourth straight month without growth. Traders have slightly increased bets on Bank of England rate cuts over the next year. For more, let's bring in our colleague Dan Hansen, Chief UK Economist for Bloomberg Economics. Dan, good morning. Happy Friday to you. And not a happy Friday when it comes to these GDP figures. And this is many months now of negative prints. What's happening?
Yeah, morning. It's not a pretty picture, is it, for the UK at the moment? I mean, I think when you look at this data, particularly just the October data and actually the September data as well, there are a couple of one-offs in there. We had the closure of the Jaguar Land Rover factory. It came back online in October, but it's ramping up production. It ramped up production slowly. That permeated through the wider economy as well, which is why we had some extra additional weakness in October. And of course, the other thing we've had is the uncertainty about what was going to happen with the budget. And you imagine that the November data could potentially be impacted by that as well. So you've got these one-offs, but I'd also highlight a couple of sort of what I would call more longer-term structural issues that are impacting the UK, the most significant of which is around the consumer. If you look at the behaviour of the consumer in the UK, which is obviously consumers are the biggest spenders, 60% of GDP, they're very cautious. And I think that's one of the issues the UK is facing. We've got these one-offs that are impacting the data, and every month we seem to have a one-off reason to explain why GDP fell. But actually, you've got these longer-term issues as well that are keeping a lid on demand.
Dan, in a moment, Anna's going to ask you a question about what the Bank of England's going to do next week. I'm assuming she will. It's the kind of end of this process. We've got a load of data that we need to focus on next week. CPI looks like it's going to be one of the standout stories. It still looks sticky. Headline numbers still north of 3%. You've got core numbers that are still very elevated as well. in terms of what we should look for in those numbers, there doesn't seem to be much improvement at the moment. We still have sticky inflation in the UK. Is there any sign that that problem is going away anytime soon?
I think there are a couple of things next week. So you're right on the CPI. I mean, we think, you know, at the moment it's at 3.6. We think it'll probably come down to 3.5. Stay around that level in December for the December prints as well. Moving into the first quarter, we do think you'll get closer to 3%. And then actually the big moment for CPI and UK CPI, at least on a headline basis, is going to be April. Because we had in the budget this news that a lot of the policies would weigh on CPI inflation. And I think you're going to get a pretty big drop in the April data, back closer, not quite to 2%, but somewhere a little bit above 2%. I think the interesting story is what's going to happen on underlying basis. And that next week, at least thinking about the data next week, look at the labour market data. Unemployment's probably going to go up again. Wage growth is going to slow, probably below 4%. And that's going to be a good news story for underlying inflation. It's just going to take a lot longer to come down, though. And I think if you're thinking about...
Dan, just very briefly then, you are expecting the BOE to cut next week, right?
Yes, we are.
Okay, we'll have the rest of that answer next week because we have plenty of time to talk about the UK. Dan Hansen, Chief UK Economist for Bloomberg Economics. There's much more working goes into that, I'm sure. Shall we talk to Val?
Yeah, what are you looking at next week?
The delayed November data that's going to be published, both CPI and non-farm payrolls. There's a lot of confusing details in both of these prints. They're both going to be essentially double prints. So let's start with non-farm payrolls. We aren't going to get the unemployment rate for October, so we're only going to get that one for November. But Bloomberg Economics sees that there's a risk that this could be quite elevated, near 4.6 to 4.7%, so a decent tick up. And that's around whether the furloughed workers around the government shutdown answered the survey correctly. In past shutdowns, they actually haven't. It's led to some blip in the unemployment rate. The other thing to watch is the CPI print that we do get on Thursday. A lot of distortion could be at play here. We are going to get a few components from October, from the month of the shutdown. We're going to get the full slate from November, but Powell really talked about this at the press conference. He said, be wary of this November data. It could be distorted. I think he was more talking about CPI when it comes to this, because some of these components in CPI aren't collected every month. So you miss a month and you happen to maybe get a hot month or a cool month, it could distort the data for months to come. So keep an eye out for that. Bloomberg Economics expects October and November to show 0.3% core CPI inflation.
Okay, before that, we have a weekend to enjoy. I had a brief look at what's coming up this weekend on our sort of, thinking about the weekend graphic, and there's barely any sport. I mean, granted, there's a darts championship, but that involves a lot of fancy dress.
It's very marginal.
Yes,
darts
exactly.
sport.
So I looked at this and thought, this does not have Guy Johnson written all over it. I don't know what on earth are you going to do all weekend,
there are downhill races.
There we
Skiing.
are. That's the answer.
There you go.
Find other sport.
Yes, there's always sport. Of course there's sport. There's all kinds of things going on. Don't dismiss the darts. Anyway, great weekend coming up. We've got plenty to think about going into next week. Normally you'd be out Christmas shopping, but I feel you've got to gen up. Next week's going to be huge. Bank of Japan, ECB.
Thank you. You're setting me homework.
Oh, yes.
Thank you very much. Gifts, Christmas gifts from Guy Johnson.
Yeah.
That is it for the opening trade. The Pulse is up next. European equity markets enjoying this rebound this morning. US futures a little more mixed. This is Bloomberg.
Know how the market day started.
Find out how it finishes.
public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
UBS shares jump as Swiss lawmakers float a compromise to help it meet higher capital requirements. Nvidia rival Broadcom disappoints with a sales outlook that fails to meet expectations and a non-existent AI revenue forecast for next year. President Trump says he would be willing to help with security guarantees for Ukraine, as President Zelensky says a deal on conceding land could be put to a vote. Let's get a check on the markets then. Risk on in terms of the global moves that we're seeing. We saw a strong session over in Asia. US futures very modest though after notching a fresh record high yesterday. So that's in the context of course of the gains that came through. S&P E-minis then essentially flat, looking for the next catalyst. A lot of data coming through of course stateside next week. The US 10-year at 4.16. Treasuries largely unchanged. Investors of course had absorbed earlier this week that decision by the Fed to cut interest rates. It's much murkier though when it comes to the picture for 2026. The pound at 133 in focus, a little softer today. GDP data for the month of October contracting once again and below the economists' expectations. 0.1%, a challenge for the Chancellor, of course, on the growth picture for the UK. Copper at fresh record highs, just below 11,900, currently 11,830 on copper. Tight supplies and a threat of potential tariffs shifting copper into the US market. Currently, though, down 0.4%, having broken through that fresh record high. We'll get a view on copper later through the show. Let's take a look at the European map as well. The breakout in terms of financial services with UBS leading the charge and driving that sector to near the top of the list. On the flip side, healthcare and personal care, two of the sectors that are showing a little bit of weakness in the session today. But again, broadly risk on. Over in France, the CAC Grant gaining 0.6%. Over in Germany, gains of 0.5. Here in the UK, despite that growth picture challenge, up 0.4% on the FTSE 100. And a strong session over in Spain as well. Gains of around 0.8%. Let's look at Broadcom then. It's the question of the future guide into 2026 for the maker of these AI chips, the ASICs that compete with NVIDIA's GPUs. They have customers, including OpenAI, including Meta. They beat in terms of the earnings and the look ahead to the future quarter, but it's into 2026 and not clear, giving a clear guidance. And the margin question that remains in focus for Broadcom, that stock called lower by 4.1%, down pre-market 4.1% so far. So that's another stock to watch as a gauge, of course, around AI sentiment. Let's get to all the details and the conversations of the show, starting right now.
newsmakers and market movers. This is The Pulse.
Good morning. Welcome to The Pulse. I'm Tom McKenzie in London. UBS, one of the biggest gainers on the Stock 600 today after a group of centre-right Swiss lawmakers proposed a compromise on its capital requirements. It centres on allowing the bank to use more convertible bonds to meet its higher future requirement. Joining us now is Bloomberg's Laura Noonan with the details. How far then, Laura, does this go to address the fears that UBS will have to raise a lot more capital?
So I would say, Tom, it is certainly positive news because what it indicates is that the Swiss government, having started at this very, what UBS would call an extreme proposal, $26 billion of high-quality extra capital, is now moderating its position. So the detail of what we learned yesterday was that a big part of that proposal is about the backing for foreign units. They wanted $23 billion. Now they're saying now the proposal is that half of that could be met through AT1, which is a cheaper form. And to give you a sense of the cost, AT1 can cost between 6 to 8 or 9%. Equity costs around 10%, so it could be cheaper for them to do that bit. What I would say is there's a very long way to go in this. So this is positive from a signalling perspective, but still you're talking about a lot of extra capital, and this is far from done.
And well, to that point, Laura, and of course Sergio Ermotti, the CEO, has been outspoken on this question. Will this be enough, do you think, to address UBS's own concerns about these increased capital requirements? Will they accept this?
So we're not yet at the point where they have something to accept. So it's going to be probably towards around September 2026 where we have a final proposal, which then has to be trashed out a little bit further. So we're not yet at the stage of them saying, okay, this is enough for us to stop exploring ways to mitigate the impact of this. This is certainly does indicate that things are moving in the right direction. If you think of the range of options UBS has from here, I think this does chime with their hope that we would get to a place where there's a compromise and they don't have to do anything drastic like moving the headquarters out of Switzerland or like having to separate their bank. So we are a way away from them looking at this saying, okay, can we live with this? Are we definitely going to keep our current business in the current place it's in? But it definitely makes it more likely that we will have a less extreme solution from UBS in terms of fundamentally changing the shape of their business.
Okay, and the stock is up just shy of 4% right now. Bloomberg's Laura Noonan, thank you very much with the details on the UBS capital requirement story, a story that will continue to evolve, of course. To the tech space right now, Broadcom shares falling, as we mentioned, after its sales outlook for AI revenue failed to meet investors' pretty sky-high expectations, quite honestly. The company has a backlog of $73 billion, 73 in AI product orders that will be shipped over the next 6 quarters. But in a conference call with analysts, the CEO said he could not give a revenue forecast for 2026.
It's hard for me to pinpoint what 26 is going to look like precisely. So I'd rather not give you guys any guidance, and that's why we don't give you guidance, but we do give it for Q1.
Meanwhile, President Trump says the US is willing to contribute assistance to Ukraine as part of a security agreement to end the war with Russia. But he continued to express frustration with the pace of talks. This as Volodymyr Zelensky floated the prospect of allowing Ukrainians to vote on handing the Donbass region to Russia. Bloomberg's chief Europe correspondent, Oliver Crook, who followed this for us, of course, is at the European Council in Brussels today and joins me now. Talk us through what we heard from the US President, Ollie, and to what extent it moves this whole process forward or not.
Well, the parts about his impatience probably don't move the process forward any more than they already have been. The sort of urgency that he's sort of producing, saying that he wants a deal by Christmas, that's not terribly new. But we have seen the Americans bring a lot of pressure to bear on both sides of this in order to get everybody to the table. What we did hear from President Trump, which was relatively new, was an open talk about security guarantees for the Ukrainians that the United States would participate in some form or another. It is not something that Trump tends to talk a lot about. It's something that's obviously absolutely key for the Ukrainians. He did not elaborate any further in saying what those security guarantees could actually include, but I think the Ukrainians and the Europeans would consider it progress that he's openly talking about it. He also talked about potentially sending an American delegation to talks in Europe over the weekend, but he said that he would only do so if he thought that meaningful progress would be made and that he wouldn't basically waste his time for meetings just for their own sake. I think the most interesting thing, Tom, that we got over the last sort of 48 hours, though, is from Volodymyr Zelensky, the president of Ukraine, who has now basically been trying to adapt his strategy since February to basically this concept that nothing out of Washington, D.C. is a bad idea. So even when you get something very, very controversial, like wanting to hold elections in Ukraine during the war, Volodymyr Zelensky says, fine, no problem. We will do it in 60 to 90 days if the United States can secure the territory, can secure the conditions within Ukraine to hold those elections. So something that the Trump administration has criticized Zelensky for, he is now using the momentum of the Trump administration in favor of trying to get those security guarantees. The second thing, Tom, is the one that you mentioned there, is a referendum potentially on handing over part of the Donbass to the Russians in any kind of peace agreement. This is something that Zelensky has been very reticent to agree to. This is something that he's basically refused, but putting it up to a vote to the population of Ukraine, one, basically makes it a democratic choice for the Ukrainians. If they say no, it's not Zelensky saying no, so the Trump administration can't really blame him. And it also puts on display that Ukraine is a democracy. So this is a sort of really clever way to use some of that pressure in his own favor and actually try to advance the peace negotiations.
And Ollie, EU ministers are meeting today. How close are we to finally freeing up those frozen Russian assets? There's been a lot of push and pull on this, with of course Belgium at the centre. This is needed, desperately needed for Ukraine. Is there any progress on that front?
So I'd say there are two kind of major hurdles. The first is this question of keeping the Russian assets frozen. That requires unanimity and is always a big song and dance with the Hungarians and the Slovaks whenever there's a vote for it. Now what the European is doing is going to enlist emergency powers. They likely are going to do that today to basically freeze the assets indefinitely by circumventing the total majority and going to a qualified majority. It's a bit of in the weeds kind of baseball for the Europeans, but it's actually a very meaningful step, and it's something that's obviously going to upset the Hungarians pretty substantially. That is expected today. That brings us to next week, which is the issue of Belgium. They still have not stated unequivocally that they are happy with the reassurances that the Europeans have provided. We still have not got that clarity. That being said, Tom, we are getting increasingly positive signals from other European leaders, so hopefully it's something they'll be able to pull the trigger on next week. If they fail to do so, this of course would add another humiliation to the Europeans and their ability to exert geopolitical influence on the global stage.
Bloomberg's chief Europe correspondent Oliver Crook in Brussels. Thank you. Now, as we look ahead to 2026 and investors explore areas offering some of the biggest opportunities, our next guest says a durable theme throughout next year lies within emerging markets. Joining me now is Luis Ordóñez, head of global macro research at JP Morgan. Luis, thank you so much for coming to the studio this Friday morning. Let's start then with your outlook. We'll get to the EM space, and part of that ties into your call around the dollar. But let's start on your broad outlook for the global macro economy. And on a day when we're seeing record highs again for global stocks, you look ahead to 2026, how constructive are you on the backdrop, the economic backdrop globally?
We have to be constructive because we think that this resilience of growth that we have seen globally in 2025 is probably going to continue to 2026, with growth in the US remaining around 2%, EU around 1.5%, China between 4 and 5%, EM as a whole, excluding China, 3.3%, staying flat. It is quite lopsided. We know that a lot of that relates to these, massive investments in AI-related data centers and the like. But so be it. The headline is being kept quite healthy, and that is, I think, what is explaining the market reaction.
Yeah, and indeed, and we have to factor in stimulus as well. Stimulus from the US in the form of the so-called One Big Beautiful Bill, the tax cuts from the US administration, which really kick into gear next year.
Yes.
Potentially support as well from China, maybe not as much as some in the markets had hoped for, but some continued support given the challenges in the real estate sector. What is the multiplier effect of that additional support coming through from the US and China next year?
For sure, it's part of the equation. So for the U.S., we have seen the consumer that even though inflation there's been an uptick in inflation, you have not seen really, and there's been a decline in a hit to consumer confidence. You have not seen a big drop in consumption in the U.S., partly potentially helped by the wealth effect, having markets at the highs, right? And you mentioned China. China has now this pattern that the first half of the year is strong, the second half of the year is weaker. The Chinese react by announcing more fiscal stimulus that does help the first half of the following year, right? So now we have very strong growth in the first half of 2026 penciled in for China and weaker second half. It is possible. Overall, we have 4.4% growth in China for next year, down from close to 5 this year. But they can certainly announce more fiscal stimulus, so they may come to the rescue once again.
On trade and on China, a line just crossed on the Bloomberg terminal in the last few minutes saying that China plans to impose export licenses on some steel products from January the 1st. We don't have the details yet as to what those products are, but it's a reminder of global trade frictions that continue to be there. Yes, Europe has weathered that quite well. There's been surprising resilience. Is that a story that we can put to bed for 2026, or is it a risk that rears its head again?
I think it will raise its head again. I mean, I travel a lot for work, and I can tell you around the world, be it India, be it Brazil, Turkey, Colombia, everyone is complaining about all these cheap exports coming from China, competing with the local manufacturing. We have seen overnight in Mexico announcing some tariffs on Chinese imports, right? And I think that, we have to see probably more reactions here in Europe and around the world. It's very tricky for countries that do export a lot to China to impose tariffs and put restrictions. But I think that the pressure, that deflationary pressure that is generating around the world, maybe it's a good thing for controlling inflation, but it's hitting manufacturing sectors around the world. And there's going to be potentially a political pressure on governments to do something about it.
So what does that deflationary pressure then mean for central banks? We have a Bloomberg survey today suggesting that most economists actually expect the next move from the ECB to be a hike, not a cut. Not in the immediate future, a couple of years out. But if we get this deflationary impulse from China coming through substantially, does that mean that, in fact, we have to rethink how far central banks have to go on rates?
Well, potentially, but I would say, though, that is going to, the deflationary pressures, at least for the developed world, is probably going to limit the need to hike. What you're alluding, right? In the case of EM, it will allow central banks that are still keeping high rates to potentially cut, and that is one of the arguments for being positive in EM local markets that we can discuss in a minute. So I think that deflationary pressures coming from China are real, and they're going to continue to at least provide in many places a benign contention of inflationary pressures.
So unpack that call then, because you're constructive. In fact, you say you're overweight emerging markets versus developed markets for next year. Yeah. Why? Part of that is down to rates.
Part of that is down to rates, because we still have, the inflation issues that we're discussing is mostly actually concentrated in the U.S., right? And that is partly because of the pass-through from all these tariffs onto consumer prices, right? It hasn't been as high as we feared, but it is there, and it probably will continue, right? Our economies have a peak of inflation in the U.S. around 3.2, 3.4, sometime during the course of 2026, right? So exceeding we're at 2.9 right now, give or take. But in EM, we have seen a deflationary trend, which is probably going to continue, and that is going to be allowing EM central banks, at least those that either haven't cut so far too much or haven't even started cutting, I'm putting a country like Brazil there, to start cutting during the course of 2026. So I think that one of the ingredients of why we're constructive for EM is that, we have inflation contained, is still well behaved. We have central banks working in the direction of cutting rates. Of course, the Fed, we're expecting one last cut late January. It now remains to be seen, given the messages from the FOMC this week. But we still bake that into the positive view for EM local markets.
And when we think about the US then, you touched on the Fed, and they've touched on it, they talked about it, the FOMC was the AI spend, which you mentioned as well. Does the spending momentum on AI infrastructure continue into 2026 or start to moderate?
We think that it still continues. So our team has done a bottoms-up analysis of how much CapEx related to AI there is in the pipeline. They come up with a number which is amazing, $5.3 trillion of pipeline between now and the end of the decade, basically the next 5 years. So you're talking about give or take around $1 trillion per year. Yeah. The U.S. economy is $30 trillion, right, nominal GDP. So you can tell that this is huge stimulus that is going to keep, I think, growth at a very decent pace. We can discuss about, how much the market has already priced it in, and there's all this talk about it potentially bubble dynamics building up. But the reality is that with this strong pipeline, it is unlikely that this is going to reverse or come to a sudden stop just yet in 2026. I think that we need to start worrying about that. I don't know if it's 28, 29, but certainly not next year.
If you're looking for a hedge, you favor gold, $5,000. What gets gold to $5,000 per troy ounce?
Well, you have a continuation of a factor that is a well-known one, which is EM central banks, DMEM, around the world diversifying away from the dollar, geopolitical reasons, risk management, geopolitical uncertainty, you name it, is driving that. But beyond that, you're seeing that asset managers around the world are also, jumping into the trade, buying more gold through ETFs. We see a lot more demand for physical gold as well. And the one thing that has really moved the needle this year is that in February, China allowed its massive life insurance companies to invest up to 1% of their AUM in gold. They're probably, it's only a fraction that has already happened this year. There's a lot more coming up. So we think that 5,000 is in the offing by the end of 2026. Okay. And we can certainly see 6,000, I don't know if 2028, 2029. So that's the pattern.
Wow, okay. 6,000 is a target further out. Lewis, thank you very much indeed. Lewis Organis, Head of Global Macro Research at JP Morgan, favouring EM over DM for 2026 in terms of equity markets, with that view in gold, 5,000 by the end of 2026 per troy ounce. Coming up, China's exports continue to go from strength to strength, the point that Lewis was making, of course. Can Europe do anything to slow the threat? We're going to discuss that next. This is Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Beirut, and this is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Astonishing day for U.S. technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's Jobs Day, and Bloomberg has the report under surveillance.
How do we understand whether inflation is the bigger problem or whether it's the labor market?
That is a key question, and it's going to be challenging.
Tuesday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
We've actually seen the most layoff announcements since 2009.
The weakening is happening, but the overall structure is pretty sound.
The November Jobs Report, Tuesday on Bloomberg.
Welcome back to The Pulse. China's exports are posing a greater threat to Europe's economy, with French President Emmanuel Macron calling the trade imbalance unbearable and European Commission President Ursula von der Leyen saying the EU's ties with China have reached an inflection point. This comes as data this week showed its trade surplus with the EU, China's trade surplus with the EU, widened to $300 billion. Joining me now is Alicia Garcia-Herrero, Chief APAC Economist at Natixis. Alicia always has a keen eye on the trade imbalance question. Alicia, we have been talking about the trade imbalance vis-à-vis China and its partners in Europe, but also the US, other parts of the world, for many a year. What changes? What is different now? Why is the risk more stark?
I
think what is different is that the same number, $1 trillion, which we already had last year, is becoming more unbearable following Macron's words, because we don't really know how structural this is. So, you know, we could have told, well, you know, post-COVID or, you know, you name it, a lot of reasons related to cyclical. But by now, we cannot say that. I think by now, what we really need to know is how much is productivity differential, so basically China becoming more productive, more innovative, moving up the ladder, and how much is, and this is the IMF view, we just heard it, actually external competitiveness based on a weak RMB, stubbornly weak RMB, and price differentials, i.e. China pushing deflation, slashing prices to export its way out compared to, you know, normal inflation trends in Europe, let alone the US. So, you know, that is the key. Because if it's the latter, instruments can be thought through. The US already has currency manipulation instruments. Europe doesn't have any. So is that the way to go? But before we need to know, because maybe we're missing the target. Maybe it's just productivity gains from China. Then we should just speed up our innovation and move without caring about that now, just focus on ourselves. But if it is the latter, we need to focus on China. So that's why this question is really important.
Where do you land on that question, Alicia? I mean, can you not make the case that it's arguably a bit of both?
Yeah, it is a bit of both. And we are trying to figure out how much of it. But let me give you one number, which is quite striking. The Eurozone, so if we focus on Euro now, has actually lost 35% external competitiveness when you just look at the Euro development versus the RMB since 2020, and the producer price differential, which is much bigger than CPI, but that's the one that matters because that determines export prices. So, you know, in that regard, I actually think that the external competitiveness part is important. It's not all about China becoming amazingly able to compete on the front end, which is also true, but I wouldn't say it's everything. So in that regard, we need a response, if you ask me.
How do we weigh, how do policymakers, how do investors weigh the deflationary dividend, though, from that export impulse of China versus the trade tension risk?
Yeah. Well, we are a little bit tight on what we can do, not only because so much China is a big market for us. It used to be an amazing market for Germany. It isn't anymore. Exports fall at double digits. So, you know, if they fall a little bit more, that's not the end of the story. But the problem is our imports. We depend on China on a number of things at 100%, whether it's, you know, pharmaceuticals, some of course, rare earth, which is even more important. So the problem is, can China strangle our economy? And that's why I think we have to be very careful with the response. We have a toolkit, everybody knows, you know, anti-coercion instruments, you name it, but we can't use them because we indeed fear that coercion. Yes, so the weaponization of China's strategic dependencies that Europe has been building. So we actually can only respond on a coordinated manner. And the problem is the US is not there. So that's it. That's why we can't do much.
What? On the other side of this equation, Alicia, into 2026, for European companies exporting to the Chinese market, what is the domestic consumer strength going to look like next year?
I'm not counting on that, no matter, you know, the China Economic Work Conference that just finished, where again we have this first objective, domestic demand, but we heard that last year, we heard that 2023. So I'm not expecting much on that end for a very simple reason. If you take out net exports out of China's growth, China would be barely growing 3.5%. So, you know, what do? China cannot afford more imports because that reduces the contribution of external demand to growth. So no, don't expect too much on China from the import side. Yeah.
Alicia, thank you, as ever. Alicia Garcia Herrera, Chief APAC Economist at Natixis. Coming up, we're going to do a deep dive into the metal space, copper, oil, in focus. Stay with us. This is Bloomberg.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg. Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning. Welcome to The Pulse. Happy Friday, everyone. I'm Tom Mackenzie in London. These are your top stories. UBS shares jump as Swiss lawmakers float a compromise to help it meet higher capital requirements. NVIDIA rival Broadcom disappoints with a sales outlook that fails to meet expectations and a non-existent AI revenue forecast for next year. President Trump says he would be willing to help with security guarantees for Ukraine, as President Zelensky says a deal on conceding land could be put to a vote. Let's get to the commodities space now. We'll bring you some analysis. A pretty interesting time when it comes to oil, gold and copper. Talking of copper, hitting a fresh record on fears of tightening global supplies, the industrial metal now on course for its third weekly gain. A little softer in the session today, but the run-up clearly has been there, breaking through those fresh record highs, closing in on $12,000 per tonne. Let's bring in Michael Haig, Head of FIC and Commodities Research at SocGen CIB. Michael, good morning. Let's start on the copper story. Is it looking overstretched at this point?
I don't think so. I mean, there's a lot of things that are going in support of the demand side. You just mentioned the supply where we've had some constraints, but if you think about the demand, we've had the traditional demand, we've got green transition demand, but you have to add on top of that data centers, stockpiling, defense spending. There's lots of things that are going on that could create even more of a deficit in the copper market.
That's interesting because the bears in the copper space, and many of them have been washed out at this point, but the side of that view that I've heard is that the foundations are not there, that a lot of this is around a bet on tariffs in the US. You've seen all those shipments into the US market on expectations that Trump may put some tariff in, and that's distorting the market. The fundamentals are not supporting the upside. You disagree with that? Do the drivers that we're seeing now, push back on that maybe, and then explain what you see as the drivers into 2026 for this industrial metal?
So with the tariffs that are going to be renewed again or revisited in the middle of 2026, obviously that causes jitters. You get these dislocations around the world, copper being moved from one place to another. So that's not really kind of changing the fundamentals. That's just distorting premium. Okay. But it kind of goes in the whole stockpiling argument. So when I talk about stockpiling, I'm talking about countries that are worried about critical materials and that type of stockpiling. What you're talking about there with the tariffs is stockpiling in a different location because of a fear of tariffs being imposed. But it's kind of within the same bucket. So you add in the stockpiling, which is countries presumably thinking, oh, we need to supply more of our domestic industries with critical materials and let's stockpile that. That could be 400,000 tons a year right there. And then you add on defense spending, 200,000 tons. Data centers, maybe 400,000 tons. Now, these are extremes.
Yes.
All of that's not going to happen. But we've got a 300,000 ton deficit in copper. So if you added on those three things that I just said there, you'd have about a 1 million ton deficit. That's not going to happen, but that will be the biggest deficit we've seen in a very, very long time.
So the miners are adjusting to this. Where could additional supply come from?
Well, it can't in the short term because, you know, these mines take 5-10 years to come online. So this is part of the problem. But of course, that's why you need higher prices to incentivize more production to come online. So it will resolve itself, but it's choppy as it does it.
Oil has been under pressure, $61 right now, so up 0.2%. There's all sorts of factors playing into it. Venezuela has been the key story of the week, of course. As you look into 2026, what are you targeting around oil?
Down towards 50 by the end of the year. I mean, I think pretty much the whole consensus is that we're massively oversupplied. The thing that's been holding oil up is Chinese SPR buying, which nobody really factored in the extent that they've been doing that. You know, anywhere between 500,000 and 1 million tons a day, barrels a day of oil demand coming from SPR, which is roughly...
So those are the sovereign reserves, China's sovereign reserves, and that's putting a floor under prices?
SPR and commercial reserves.
Okay.
So this is energy security that is putting the bid under the oil price. But what they're buying on a daily basis, which isn't real demand, is roughly equal to what the demand growth is going to be next year. So that's what's keeping oil up. Now, when that stops, when they fill up, that's when the party's over for oil and it drops down towards...
And they stop next year?
That's the expectation. I mean, they're building more and more SPR storage facilities, but the expectation is it ends sometimes next year. Originally, we thought it would be March, but I think it goes beyond that.
The Saudis respond to $50 a barrel on Brent.
Do they respond?
I mean, they're going to respond, surely. The OPEC Plus are going to have to take more barrels off the market.
This is our expectation is by April, when their pause ends, they're going to have to cut. That's my opinion.
So OPEC Plus cuts in April, from April?
Yeah, because what happens is as oil drops in the first part of next year, US shale really takes a hit.
Yeah.
That's what the Saudis want. They want to see that finished, and then they'll cut to restore prices.
Okay, they want to take out US shale. They're giving Trump the lower oil prices he wants, but at the cost of his beloved shale industry as well. There's the conundrum.
Trump wants the consumers better off next year, midterm elections, so...
He'll take the hit to US shale.
He'll take the hit to US shale.
4,300. Look at that, 4,300 now per troy ounce for gold. So up 0.7% in the session today. You see $5,000, as did our previous guest on the show, by the end of 2026.
Yep.
What are the factors that get us there?
Well, central bank buying, obviously, ETF buying. The one side that we haven't talked about, that people haven't talked about, is jewelry demand. That's the only normal market right now, in the sense that as prices go up, people buy less jewelry. So,
are we seeing that now?
Yes, so the elasticity is normal. In other words, prices up, demand down.
Yes.
The elasticities, if you want to get technical here, on central bank buying and ETFs, you would expect them to be also negative. As prices go up, they stop buying, but they don't. So it's all broken. But the reason is because they're the reason that prices go up. So there's this causal linkage. So as they buy more, prices go up. So it appears that the elasticity is broken and they buy more when prices go up. But that's really what's going on.
You didn't talk about Fed rate cut expectations.
That's important too.
That is important. But if we don't get the kind of dovish moves from the Fed, the picture in 2026 after the FOMC decision this week looks very murky indeed.
Yeah.
Fine, we may have a new dovish Fed head, but we've seen the reaction from some of the regional Fed governors, more hawkish.
Yep.
If we get one more cut next year, does that derail the picture for gold? Does that
Our expectation is 2 cuts.
Okay. Do you need 2 cuts to get to 5,000?
No. I think this is all very secondary to the gold market. I think all the attention is on uncertainty, which is what drives ETF flows, and central bank buying, which will pick up again, I think, throughout this winter, because you do get seasonal lulls in central bank buying throughout the summer and into October, so it should start to pick up.
Okay, Michael Haig, thank you very much indeed. We did the tour, starting with copper, oil at $50 a barrel on Brent by the end of 2026, gold at $5,000 per troy ounce by the end of next year, and copper has further to run.
It does.
What level can copper get to before we wrap this up?
Well, we thought it was going to be 12,000 next year when it was 10 grand in September. We're already there. So our next leg up is 12,500.
I suppose 2,500, that would be 12,500 on copper by the end of 2026.
Yep.
Michael, fantastic. Thank you very much indeed. Michael Haig, Head of FIC and Commodities Research at SocGen CIB. Let's get back to the tech story right now, because the chief executive of ASML has told me that Europe needs to do more to attract semiconductor companies if it's to have any hope of catching up in the AI race. ASML is Europe's most valuable company, producing the machines that make the chips designed by companies like NVIDIA. I spoke exclusively with Christophe Fouquet at the company's headquarters in the Netherlands.
If you look at the overall AI ecosystem in Europe, it's very weak in any way you look at it. And, you know, today there could be a debate about will the US or China win the AI race. I think it's clear who is losing it today. It's Europe. Europe is behind. And it's true with semiconductor, right? If you look at semiconductor, basically take our shipment. The shipment of our system to Europe today is maybe 1 or 2% of our total business. And that's been the case for the last 10 years. So there is no buildup of semiconductor manufacturing in Europe, not advanced, not mature. Why is that? Is because there is also no consumption of semiconductor in Europe. Most of the consumption, as I said, of advanced chips are in the US because the company that develop the AI chips are not here. So Europe is behind, and to catch up, Europe has to create the condition basically to attract this entire ecosystem back to Europe. And that's a major task, to be honest.
Because we have the engineers, we have the researchers, we have ASML.
Yeah.
But Europe does not own the chip space.
Well, we have the engineers, we have the researcher. I would say we have the market. I think the European market is a great market.
The ASML CEO, Christophe Fouquet, speaking to me for the latest episode of Bloomberg Tech Europe. You're going to be able to watch the full episode on the program's YouTube channel. You can find it on Bloomberg.com as well. Now, Bulgaria faces a fresh wave of political turmoil just weeks before the country joins the euro. After steep protests over rampant corruption, the country's prime minister has stepped down after less than a year running a minority government. Joining me now from Sofia is Bloomberg's Slav Okov. Slav, talk us through the situation, how it escalated to the point where the prime minister felt the need to resign.
Hello. First, it's good to know that the political crisis is not something new to Bulgaria. It has faced 7 elections since 2021, which is making it pretty much unique. What is new is that this time the perception of corruption and state capture has triggered the biggest street demonstrations in many years. Now, the tipping point was a proposed budget for next year, which was increasing spending and some taxes. And to many protesters, that actually means that this increased spending only allows the ruling class to increase its control over public institutions, particularly the police and the security sector. So it's a way of the government to control more of the public sector this way. So it started with a budget bill, but essentially those protests were protests against corruption and for rule of law, a problem which is not new to Bulgaria. And eventually they reached the point at which the government decided that the most wise way is to resign.
Yeah. So talk us through the significance of the resignation then, and what it could mean in terms of how Brussels is looking at this as we approach that deadline around joining the euro.
Now, the first thing to keep in mind is this is not going to threaten Bulgaria's euro adoption in any way. So this is pretty much a technical process for which the country has been preparing for quite a while, and it's going to enter the eurozone smoothly, regardless of whether this is with the regular government or an interim government that could eventually step in maybe in a month or so. So in that sense, Bulgaria is not threatened of not joining the eurozone, and also Bulgaria itself is probably not the Eurozone's biggest problem, considering the fact that it's a country with very low debt levels and very low deficits, something that is not typical for many countries inside the Eurozone itself. That said, Bulgaria's tale is probably a cautionary tale for the EU's plans for enlargement in the future, considering the fact that the EU may have helped people in the country become richer, but it hasn't helped resolve the old problem with rule of law, which people are protesting against.
Okay, Bloomberg's Slav Okov, thank you. An important update, of course, from Sofia out of the Bulgarian political situation as that country, of course, heads to the adoption of the euro. Now, back to technology. The head of Microsoft's AI unit says he is keeping a close eye on the growing number of circular deals being made by AI companies and their backers. The investments, notably involving NVIDIA and OpenAI, have raised concerns from some investors. Microsoft, of course, has a significant stake in OpenAI. Mustafa Suleiman, who co-founded AI lab DeepMind before joining Microsoft, spoke to Bloomberg's Michelle Hussein about the agreements.
obviously, customers and providers have often invested in one another, and provides good stimulus to get us going. But it's something to watch. I'm definitely watching it carefully, and I think others are too. So, I think that getting the balance right is very important. We have to deliver in the next few years. I mean, every team now is building incredibly large, very powerful computers, and we're taking a huge bet that we're going to be able to convert this into true intelligence. And if we do, then I think the world is going to look very, very different. I mean, we will have abundant intelligence on tap, and I think people still underrate how phenomenal that is.
Well, you can listen to the full conversation between Michelle Hussain and Microsoft's Mustafa Suleyman. Just search the Michelle Hussain Show wherever you get your podcasts. Now, from Pop Mart's Labubus to Shein, we're switching tack here. Temu and Luckin, Chinese labels are now global consumer favourites and cultural flag bearers. Bloomberg Originals has been looking at how geopolitics is now reshaping the rise of China's soft power.
Shoes, phones, windows to alternate realities. Many of our favourite products are made in China, but designed elsewhere. Well, that narrative's beginning to change a bit.
Pop Mart shares rise to a record as the CEO announces a new mini Labubu.
And the Game Award goes to Black Myth Wukong.
In the past, China was creating all these low-value products, and it's very hard to gain soft power from that. But as you move up the value chain, the natural byproduct is that your soft power also increases.
We will continue to actually see more of them penetrating into various overseas markets.
As the power of China in the global economy has increased, it's an opportunity for them to go and invest in these other markets, similar to the way that American companies probably did in post-war America.
Although no one's saying that's going to be smooth sailing.
A lot of the challenges for Chinese brands, especially in the U.S., depends a lot on the political uncertainties that have been unfolding under Donald Trump.
Some are locked out of whole markets, while others have invited a certain kind of rhetoric.
The Chinese government has that data.
So with Chinese brands seeming to win over global consumers, could they also help with something much less tangible?
What we're seeing now is an emergence of Chinese soft power into the rest of the world.
Well, subscribers can see that documentary in full right now on the terminal or at Bloomberg.com. It will also be available later on the Bloomberg Originals YouTube channel. Coming up, we will discuss the role of regulators in driving growth and innovation with Nike Trust from the UK FCA. That is next. This is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Welcome back to The Pulse. Now, former UK Prime Minister Theresa May has blamed social media for the rise of populism in a wide-ranging interview on Leaders with Francine Lacqua. May said that politicians are losing the ability to compromise, which she sees as central to governing.
I think it is easier for populism to rise in a world where there is social media. In the past, you'd have old Joe sitting on the end of the bar in the pub, muttering into his pint of beer, and nobody took any notice of him because his views were either too extreme or too silly or ridiculous. Now old Joe mutters on social media, and all the other old Joes around the world respond, and suddenly it becomes a worldview. And when you get algorithms pushing people towards the sort of thing they want to see and have looked at and heard a lot, then it becomes much more difficult because people are not seeing the other arguments. And actually, in life, in politics, in government, very often you need to be able to mediate, to compromise. And in that absolutist world, that polarized world, compromise becomes a dirty word, and it isn't.
What do you think the new world order looks like?
Well, at the moment, I think what we need to make sure is that we don't just move into a world where power, strong men, and when people think about it, they will think about it as strong men, is the order of the day. And it's multilateral institutions that were set up in the 20th century. They need reform. They need to look at where we are today and how we can make sure that we can have that sense of the value of multilateral work and find structures in which to take that forward.
Well, the full interview is out now on the Bloomberg website, of course, and on the terminal. You can also watch it on Bloomberg TV at 5:30 p.m. here in the UK. Staying with the UK, the Financial Conduct Authority is planning to change rules to make it easier for Britons to invest their own money in the markets. The UK watchdog is looking to follow the government's lead in encouraging households to shift more cash savings into the financial markets. Joining me now is Nikkei Trost, Head of Wholesale Buy-Side Department at the FCA, the Financial Conduct Authority. Nikkei, thank you very much indeed for coming into the studio. So what is going to be needed practically to get people in the UK investing more of their cash into the markets? Does it require a cultural shift? And what are the practical steps that can be taken to get us closer to that point?
Yeah, one of the things we think is needed as part of that is that people need more support with their choices. And the package we announced yesterday on a measure called targeted support is really there to drive that. So at the moment, a regulated firm can help explain to you what different types of investments are or what an ISA is, all of those good things. But when it comes to saying, okay, now where do I invest? Actually, they stop short of that because then you're in the space of advice. And we're changing that.
You get that disclaimer. Up until yesterday, you get that disclaimer, don't you?
We cannot.
And when you're on the phone with them, they say, we can't give you advice.
And you might get really standardized information that's actually not very intuitive and not very engaging. We're changing all of that. So we're creating a new form of support where firms will be able to say, look, for someone like you, with your characteristics, having done a bit of information gathering on you, this is a good product to invest in. And also, we're changing how firms can talk to their customers. We've abolished the really formulaic rules that existed so far, and now you'll be able to communicate in a way that's good for the end consumer.
What would the proof points need to be for you to take a step back and say, okay, these changes have worked?
Yeah. So at the moment, there's a really high number of consumers sitting in cash and not even thinking about investing. And we've deliberately not said that number needs to change by X or Y, but we do want to see more engagement and we want to see more consumers thinking about their options.
There was a lot of focus, of course, in the run-up to the budget about what was going to change around ISAs and whether or not we get a UK ISA. So pushing people into investing more in UK equities. We didn't get that eventually. We got some changes around cash versus stocks, but not a UK-specific ISA. Do we need to get there eventually? Do you want to see more in terms of directing capital into UK-listed companies?
Well, I think tax and ISA changes, that's clearly a question for the government. But I think where our role in this is to really encourage a sustainable investment culture and a long-term sustainable investment culture.
Which parts, for you right now, when you look across the financial services industry in the UK, which parts are looking most ripe for reform?
Well, I think we think that in this space of support for retail consumers and supporting better investments, there is lots of room for changing how things are done. And I think we've set the foundations here, and now it's over to firms to do that. But we've also done quite a lot, and we will continue to do a lot next year to slim things down for wholesale markets. You know, the UK is a huge financial services centre, and we want that to continue. And part of that is ensuring that our regime is really streamlined so that it's easy to do business here.
Are you seeing resistance? Where are you facing the most resistance? There must be some pushback.
I think people worry about the trade-offs that we make around that. And, you know, our work on targeted support is a good example of that, because, you know, if you don't get advice that's fully tailored to you, but for groups of people, well, it might be not entirely perfect for you. But that's a trade-off we think we need to make, because if you're sitting in cash and you've got a 20-year investment horizon, you're also taking risk. You might not know about it, but you're also taking risk. So I think an important part, you asked me, the pushback is an important part of that, is having a really mature conversation about trade-offs and risks and how to think differently about risk.
How are you thinking about artificial intelligence when it comes to regulating around this? How front of mind for you and the team is AI, and how that may be incorporated into financial services in the future?
And we are doing lots of work with industries through our sandboxes, through our innovation hub, to try out how AI can help. We've got some very exciting developments in that area, but I think we will see how that will evolve.
Are there areas that you think, because we're talking here about regulating for growth, are there areas where you see there need to be more regulation to stem risk? I don't know if that's in the crypto space or elsewhere. Are there points of the financial services industry you're looking at right now where there's some red flags around the need for more guardrails?
I think one of the areas where we always think we need to consider where we might need more is around the question of data and really understanding where financial stability risk is. I think that's something where we just need to modernize how we do things.
We think about financial education. There's arguably, objectively, a lack of financial education in the schooling system here. A lot of people go to social media now. Young people are particularly TikTok. Some of that can be helpful. Some of that can tie into what you're trying to do, which is encouraging people to move at least some of their assets out of cash into higher performing assets if they have that long-term view. But there's also a lot of misinformation as well. Is that something the FCA is looking at?
Absolutely. It's something we spend a lot of time on. And I think in the context of targeted support and advice, it's one of the reasons why we think it's really important that it has a regulatory badge so people can trust the recommendations they get.
So you provide regulatory badges to influencers on TikTok, for example?
No, we provide authorization for firms that have applied.
Oh, for firms that do that.
That's very different. Okay. And, you know, in the influencer space, we've done a lot of work with influencers actually to ensure that we get to good outcomes, good information.
Okay. Nikkei, thank you very much indeed for coming in and talking through some of the changes that the FCA is working on. Nikkei Trost, head of the wholesale buy-side department at the Financial Conduct Authority. Up next, counting down to Bloomberg Brief, checking your futures for you stateside. You're down on the S&P E-minis by just over 0.1%. Nasdaq 100 futures off by 0.5. It's been a decent session in Asia and Europe. It seems the mood is changing as we lead into the US. The Brief is up next. This is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Stocks hitting records even as tech caution continues. That rotation trade ongoing with cyclicals getting a boost from the Fed's dovish cut. Meantime, Broadcom disappoints. Investors look for a bigger AI payoff. Plus, President Trump signals U.S. help with Ukraine security as President Zelensky floats a referendum on handing over territory to Russia. So let's take a look at those markets then. Futures pointed lower. We did have just small moves in the S&P and the NASDAQ 100 yesterday, but we did, in fact, hit records for the S&P and especially for the Russell 2000. So small caps really benefiting that rotation trade, as I said, ongoing. But let's take a look at the bond universe because I want to point to what's even more of a bull steepening. So you have the 30-year yield now up to 482, while the 2-year yield is at 353, the 10-year yield not going anywhere. But that 2s10 spread now is at 63 basis points, so that's a good 10, 12 basis points wider than it was right before the FOMC meeting. And just one other word on equities before we get to our individual movers. We have Goldman Sachs out now saying that we're going to see 10% to 12% EPS growth for stocks next year and the year after. And that adds to RBC, Oppenheimer, Deutsche Bank, so many banks that are looking for even more earnings per share growth. In Goldman's case, they're saying it's because of AI. Smaller companies are not seeing the effects yet. Bigger companies are seeing them for now. All right, let's get to those individual movers then. Over to London and to Valerie Teitel. Valerie.
Good morning, Vonnie. Happy Friday to you. Let's start with a check on Broadcom. Out with results that disappointed investors. We're seeing shares of Broadcom down 4.9% in pre-market trade. The amount of orders in backlog disappointed the market. And also the CEO on the conference call after earnings declined to give a 2026 revenue forecast. These things combined are igniting worries about margins, which has kept Broadcom shares under pressure this morning, down 5%. Next, let's move on to athleisure. Lululemon doing very well in the pre-market trade this morning. This is on the back of a beat and a raise for the athleisure company. The shares are up nearly 10%. They also announced that their CEO is stepping down in January. They have yet to announce who is going to replace him, perhaps, but a different strategy change with a new CEO is exciting the market. Remember, Lululemon has been suffering from a sales decline really since the peak of COVID of athleisure wear. Let's head over to Switzerland. Finally, let's check on UBS because shares are at a 17-year high. Vonnie, they're higher by 4.3%, one of the biggest gainers in the European session. And this is off the back of reporting that the Swiss regulator is going to allow UBS to use AT1 bonds instead of equity to meet capital requirements. And potentially this is paving the way out of a political standoff between UBS and the Swiss regulator as they try to tighten banking rules within Switzerland. Vonnie?
Valerie, thank you so much. That's Valerie Teitel there in London. And coming up in this hour, we're going to be speaking with Seema Shah of Principal Asset Management on the Fed's path in 2026. So let's turn to the broader market rally now with global stocks hitting records. Joining us now, cross-asset reporter Justina Lee. So Justina, in spite of everything, and even with all the fragility in the AI trade, we saw records yesterday, not just across the globe, but even in the United States.
Yeah, that's right. And I think we always end up using this word, but it kind of really is applicable here, which is like, you know, the Goldilocks trade, right? I think that what investors are thinking about right now is that on one hand, you kind of have still a pretty solid U.S. economic outlook. And we're kind of seeing that from the fact that the Fed actually upgraded their growth forecast for next year. And at the same time, I mean, you know, we still got that rate cut from the Fed. Investors are still pricing in about 2 more rate cuts coming next year. And inflation is still a concern, but I think the message that we got from the Fed this week was not particularly hawkish. So putting all of that together, you know, we always talk about the Santa rally, and I think this is exactly what we're kind of seeing right now.
It's going to be more of a Santa grind, though, right? Particularly when you see the sell-off in some of the final few equities that reported earnings. Now, some of them had huge run-ups this year, so maybe we should take that into account. But can we expect more of a rotation trade into the year-end?
Yeah, I think that's what's really interesting about the rally that we've been seeing, because we are seeing that rotation from some of the, you know, red-hot tech names that have already rallied this year into some of that laggards. And here I'm talking about, you know, small caps, value stocks. If we look at which stocks have been doing the best this week, it's actually, you know, financials, material stocks, and, you know, some energy names. And I think that's really interesting because usually those names do well when kind of the growth outlook is at the rosiest. And so, I mean, you might kind of ask the question of, I mean, does it really kind of, is this rotation really justified? But I think at the very least, it shows that people are kind of optimistic enough to kind of try to put their money into these laggards that might be seeing slightly lower valuations.
Now, Justina, we do have Deutsche Bank and Goldman Sachs also forecasting on the dollar out today, saying that it will resume its slide next year as the Fed keeps nudging down interest rates. What would that do for equities and for corporate earnings more broadly?
Yeah, and I think that kind of really depends on whether you're, you know, an exporter or an importer, right? Like if you're kind of maybe more dependent on overseas earning, then that could kind of translate into a very different earnings picture. And I think one interesting thing about these bank forecasts is that, you know, they're kind of resting their case on the fact that we're gonna see more U.S. rate cuts, and maybe that's gonna, you know, be rooted in more weakness in the U.S. growth. And so we're kind of seeing a bit of tension from that currency outlook, you know, with the outlook for U.S. stocks right now.
All right, Justina, thank you so much. That is Bloomberg's Justina Lee. Back to one of the stocks we're watching. Broadcom shares sliding in the pre-market as investors scrutinize the chipmaker's $73 billion backlog of AI product orders. That figure fell short of more bullish expectations. So let's have a listen.
It's hard for me to pinpoint what 26 is going to look like precisely. So I'd rather not give you guys any guidance, and that's why we don't give you guidance, but we do give it for Q1.
That was Broadcom CEO there, Hock Tan. Bloomberg Intelligence analyst Matt Bloxham joins us now for more. Matt, was it the number, the $73 billion, or was it the 6 quarters that it's going to take to roll this all out?
Yeah, I think it's a mixture thing, to be honest. I think it's definitely that, you know, a bit of frustration that they're not willing to kind of give a clearer guide on the 2026. No, well, to be honest, I don't think that's so surprising. It's not something we'd typically expect a company to give at this point, particularly in such a kind of fast-moving market. And I think, you know, the CEO there was trying to kind of give risk to the upside on that number, that $73 billion likely to grow, not shrink, but, you know, just not trying to kind of get a pin down on any particular number. And if you look at the Q1 guidance, actually, kind of improving revenue momentum, a doubling of their AI revenue year on year, and a better than expectations. I think the other issue that perhaps, kind of was a bit soft and disappointing for analysts and investors was the gross margin guide for Q1. So signaling about 100 basis point squeeze on gross margins as the product mix shifts more towards AI. I think they flagged that before, but I think that's kind of added to the uncertainty that people are trying to work out in their models about, A, how much revenue is going to grow, and B, what's the impact going to be on profitability.
And I mean, we really do have to take into account the run-up, right? 125% this year, and 2 weeks ago it had an 18% gain just on that week alone. But I do want to move to SoftBank because we have an exclusive Bloomberg scoop. Masayoshi Son is eyeing potential acquisitions, it seems, including data center operator Switch, to expand in AI. Now, we knew he had AI aspirations, but why is he interested in this part of the stack?
Yeah, I mean, obviously the data center operators are kind of at the kind of foundational level of the AI opportunity, and so maybe the kind of return on equity you can expect to get on those kind of assets is perhaps kind of at the more modest end of the range, but it's still very strong, and it's arguably kind of a lot more visible than kind of further up the stack. And so I think they're kind of perhaps making a play that you've kind of got that clearer business model and still a huge amount of growth opportunities to come. So there's probably always going to be a kind of imbalance between supply and demand of data center capacity, and they see that as an interesting opportunity to kind of build out the portfolio. And obviously, SoftBank's got a mix of assets across different parts of the kind of AI stack. Don't want to second guess what they're doing, but it would kind of maybe the kind of filling in a blank and balancing out that kind of portfolio of risk they've got.
What about this story, Matt, that China is considering spending as much as $70 billion to support its chip-making industry? Where is that in the context of, what companies spend, what countries spend? Is it a lot, and should we be concerned?
Yeah, hard to mean. Obviously, the US players are spending, $400 billion plus on AI investments. So, there is quite a contrast there, and I think certainly our own analysis in BI, suggests that generally speaking, the investment going to AI in China is lower, and that's not just because they're kind of being more cautious. It's structurally there's some differences there. But so I think the fact that $70 billion is being earmarked for that investment is, a clear sign that China is increasing its own efforts in this area and looking to kind of increase its independence from international markets. Obviously, we see these conflicting stories. NVIDIA is going to be allowed to sell its H200, more advanced chips into China. But I think that the rhetoric and the momentum from China recently is that it would rather kind of develop its homegrown technology than rely on US technology. So there's a huge number of markets internationally, think in particular like Asia, Africa, Latin America, where perhaps the geopolitical sensitivity isn't so high and they're not so influenced by the kind of US. And so they are big markets for China technology over the midterm to kind of sell into. And so I think that's where some of this investment is looking to support.
All right, Matt, thank you so much. Bloomberg Intelligence's Matt Bloxham there. President Trump, meanwhile, says the U.S. is willing to help Ukraine as part of a security agreement to end the war with Russia, while continuing to express frustration with the pace of talks. This as Ukraine's Volodymyr Zelensky floated the idea of a referendum on handing territory to Russia. Bloomberg's Oliver Crook joins me now with more. Ollie, what guarantees is Trump considering and under what circumstances? We know, for example, that there were promises made in the past, but Zelensky isn't willing to just, accept promises. He wants something written down and accepted by, maybe Congress even.
And the reason that he wants that is because those promises have been made in the past, Vonnie. We remember the Budapest memorandum that basically secured Ukrainian sovereignty back in 1994 when the Ukrainians surrendered their nuclear weapons, which would have been obviously a very effective deterrent against any invasion by the Russians. There were guarantees made by the Russians, the Americans, the UK, and a number of others who were party to that contract. And of course, those were not honored. So the president of Ukraine, Volodymyr Zelensky, would like to get a very clear idea of what the security security architecture would be promised to the Ukrainians in order to safeguard their sovereignty if they are able to get a peace deal negotiated. At the moment, we do not know what that architecture would look like. We do not know what President Trump is actually offering, but Mavani, I think it is significant that President Trump is talking openly about a U.S. role in those security guarantees. It's not something that Trump really discusses very publicly at all. It's something obviously that's been discussed behind closed doors, but this is the President of the United States acknowledging that this is something that he's willing to play a role in. So significant from the Ukrainian perspective and the European perspective. The Europeans would also like to have some more talks over the weekend that would involve a delegation from the United States. We heard from Donald Trump that they will only send a delegation if they feel that the talks are making progress, and these are not meetings just for the sake of having meetings, which is one of the frustrations the Trump administration has aired over the last couple of days. So we'll find out if they are going to send a delegation over the weekend to Brussels, and that's really the next diplomatic moment we're looking for over the next 48 hours.
All right, Ollie, we do have to leave it there, but thank you so much. That's Bloomberg's Oliver Crook. Now on to other top stories trending on the terminal this morning. UBS shares soaring, hitting a 17-year high after a group of influential Swiss lawmakers proposed watering down the capital requirements for the bank. The proposal would allow UBS to use junior debt, known as AT1 bonds, instead of equity to meet capital requirements. Lululemon shares rallied in extended trading after boosting its full-year outlook and announcing a $1 billion increase to its stock buyback program. But Lulu also said that CEO Cathal McDonald was stepping down at the end of January. It's still searching for a replacement. And the UK economy contracted again in October, underscoring fears that momentum stalled in the run-up to the budget. GDP fell 0.1% in October, following a contraction of the same size in September. Economists had been expecting 0.2% growth. Decline was driven by drops in services and in construction. Coming up, we hear from Uber CEO Dara Khosrowshahi on where he sees autonomous driving for the company next year. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
It's Jobs Day, and Bloomberg has the report under surveillance.
How do we understand whether inflation is the bigger problem or whether it's the labor market?
That is a key question, and it's going to be challenging.
Tuesday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
We've actually seen the most layoff announcements since 2009.
The weakening is happening, but the overall structure is pretty sound.
The November Jobs Report, Tuesday on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Autonomous vehicles are gradually making their way onto the streets of major cities. Uber has made hundreds of millions of dollars worth of investments to position itself as a key player in the market. Bloomberg Tech Asia co-host Annabelle Druller spoke with CEO Dara Khosrowshahi in an exclusive interview.
The APAC market, and in particular the North Asia markets as well, they are huge growth markets for us. And if you look, for example, in the rideshare business, over 30% of our global first trips coming into the category come from the APAC region. The area is growing very quickly, including taxi as well, which is actually one of our newest products on the platform. So for me, coming here, seeing the teams, meeting with local business people and regulators, and talking about how we can be part of the future growth of the region is really what my agenda is.
Early this year, you also put out a statement on the robo-taxi push as well.
Yes.
And so the Middle East and Asia were the markets for 2025 to launch. And we've seen, of course, that initial deployment in the Middle East already. What's happening on the Asia side?
Well, lots of discussions on the Asia side. I think what's really important is to set up a regulatory framework to go forward. For example, Hong Kong has various trials and pilots going on, and in many other markets, we're talking to regulators about how we can be a part of shaping rideshare and autonomous rideshare going forward. The technology is absolutely getting there. These are the robot driver doesn't get tired, doesn't get distracted, and we very much look forward to working with various authorities to introduce rideshare into the markets. We're now live in 4 markets now, as we speak, in the U.S. And in the Middle East. And I expect to be in 10-plus markets by next year. And we want those markets to be in the Asia-Pacific region as well.
Where then in Asia do you think is the most likely place?
We'll see. I think that certainly Japan has great potential. They
are behind on their regulation.
They are behind in their regulation, but I think that they also understand that with an aging population, there's a real need for transportation, not just in the large cities, but in the rural areas. And for example, I experienced that personally going to Kaga City, and where we have communal rideshare, and kind of took a rideshare trip and understood what the needs are there. So we're talking with various countries, regulatory authorities. I think Japan is going to be part of it. I certainly hope that Hong Kong is going to be a part of it. Australia, where we were just talking about, is a huge market for us. So we're having those dialogues, and I think that the picture will shape up over the next 2 years because the technology is definitely getting there.
What do you make then for India in particular? Because, of course, your big competitor there is Rapido, and they've been very successful with a slightly different operating model, but including going down into lower tier or smaller tier cities. How do you also stay competitive there? And does that sparser geography strategy also fit for India?
Yeah, very much so. So with India, really, the fastest growing part of the Indian market is two-wheelers and three-wheelers. And the business model is different, actually. It's not a commission model, but it's actually a subscription model as well. Rapido is a real upstart there, but over the past months, we've been pushing back against them. And India continues to be a hugely promising market for us. So we're very happy about the recent results that we're seeing.
And that was our exclusive interview with Uber CEO Dara Khosrowshahi speaking with Bloomberg Tech Asia co-host Annabelle Druller. Coming up, Trump ups the pressure on Venezuela. U.S. issues new sanctions targeting Maduro's family and the oil sector. A look at what's making headlines in your front page news. This is Bloomberg.
phone is, what's great about it is it's a well-developed gaming ecosystem, right? So it, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is, social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are gonna like unleash this with a bunch of creators, and they're gonna go figure out stuff that we didn't even imagine that they can do with that interactivity.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Time now for your front page news. First up, on the New York Times. The U.S. issuing new sanctions targeting Venezuela's leader, Nicolas Maduro, and his family. The administration is also seeking legal authority to seize oil from the Skipper. That's the tanker U.S. forces seized Wednesday. The Times says the moves represent a new front in President Trump's campaign to destabilize Maduro's regime. Next up, the Washington Post reporting that President Trump is expected to push dramatically loosening federal restrictions on marijuana. An executive order would direct agencies to reclassify marijuana as a Schedule III drug, similar to some prescription painkillers. The Post reports the move wouldn't legalize or decriminalize marijuana, but it would ease barriers to research and boost the bottom lines of legal businesses. And finally, on the Wall Street Journal's front page, Renaissance Technologies considering adjusting its trading models after 2 of its quantitative hedge funds suffered their worst months ever in October. The funds, which manage nearly $20 billion, use machine learning and algorithms to bet on and against thousands of stocks. The Journal says they weren't prepared for recent unusual moves in shares of some small companies, including meme stocks. All right, let's take a quick look at the macro picture now as we head into the second day post-FOMC. S&P futures pointed lower, but this after we hit a record yesterday, the 10-year yield at 4.16. Coming up, we're going to be speaking with Seema Shah of Principal Asset Management. This is Bloomberg.
Such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Stocks hit records, even as tech caution remains. The rotation trade continuing with cyclicals getting a boost from the Fed's dovish cut. Meantime, Broadcom disappoints. Investors looking for a bigger AI payoff. Plus, President Trump signals U.S. help with Ukraine's security. This as President Zelensky floats a referendum on handing over territory to Russia. So S&P futures pointed lower then, just fractionally, and this after we hit a record yesterday. Global stocks hitting a record, but particularly the S&P and the Russell, which is pointed higher again for Russell 2000 futures today. Now, tech may be taking the brunt of it because we obviously saw a little bit of a sell-off. The Nasdaq 100 was down 0.3% yesterday. Futures pointing to a decline today. A rocky couple of days. But we have a new call from Goldman strategists based on that trade. The team expecting 12% EPS growth for next year and 10% EPS growth for 2027, crediting AI productivity gains. They say AI adoption is really only being seen by large companies now and eventually will also be seen by small companies. Let's move to bonds because we're still seeing that steepener trade. We have the 2-year yield really unchanged at 353.68, but that 30-year yield is going higher and higher, up another 2 basis points now to 482. In fact, let's look at the 2's 10 spread. Now, this isn't the 2's 30 spread, but at least you'll see how the 2's 10 spread has been going higher. Well, that is just in the last few hours, but basically it's moved up about 10 basis points in the last week. Let's go to some individual movers now for some stocks to watch. Here's Valerie Titel. Valerie.
Good morning, Vonnie. Let's start with a check on Broadcom. As you mentioned, some disappointing results after the bell yesterday. We're seeing shares of Broadcom down nearly 5% in pre-market trade. This is all in the back of their order backlog not being as juicy as the market had hoped. The CEO saying it's around $73 billion over the next 6 quarters. I think the market wanted to hear a higher number than that. He also failed to give 2026 guidance on the earnings call with investors yesterday, and this is just igniting some previous concerns about Broadcom that the market had about margin compression headed into next year. So shares of Broadcom on a back foot, dragging down the Nasdaq with it today. Let's move over to the retail sector. Lululemon, a beat and a raise for the athleisure wear maker. The stock is up 9.4%. They also announced that their CEO is going to be stepping down at the end of January. Now, they have yet to announce his successor, Vonnie, but I think this is exciting the market, the prospect of a new CEO and perhaps a strategy change for Lululemon, who has been suffering from multiple years of sales declines. Lastly, I want to head over to Switzerland and talk about UBS. And this is one of the biggest, best performers across Europe today. UBS shares up 4%. And this comes after the Swiss regulator has told UBS they can use AT1 bonds instead of equity to meet capital requirements. And this is perhaps paving a way out of the political standoff between UBS and the Swiss regulator, who's been wanting to tighten banking regulations of late. Bonnie?
All right, Valerie, thank you so much. That's Valerie Teitel there. Seema Shah of Principal Asset Management says 2026 presents a paradox. She writes this: innovation is fueling optimism, but market fragility and late cycle risks are rising. For investors, that means managing concentration and policy risks across an evolving global landscape will be essential. Seema Shah is Chief Global Strategist at Principal Asset Management, and she joins us now. So, Seema, how do investors begin to do that at the beginning of a year where it looks like there's only going to be one more cut, but really we have no idea because the next data we get doesn't come until next week?
Hi, yes, I think for next year, I think it's key for investors to try and take a bigger, broader macro picture. We are expecting further Fed cuts, maybe one, maybe two for next year. But importantly, that's still against a backdrop of fairly constructive economic growth. We're expecting to see some fiscal stimulus coming through in Q1, which should help consumer spending. We're expecting the continuation of AI capex as a real pillar for economic growth. And so although there may be a bit of a labour market slowdown, it's not something that we would be worried that it's going to turn into something recessionary. So that does construct a very kind of a positive economic outlook for next year. The thing is, it has to be balanced alongside some of the concerns around the AI bubble, concerns around how these companies are going to continue to deliver. So it becomes increasingly important in terms of how people position, in terms of trying to identify some of those winners and losers, and also think about what are the regional opportunities around the world.
If you've been avoiding the AI trade until now, do you then just decide that you're not going to participate, Seema, or are there still opportunities there?
So we are still positive about the broader AI trade. We continue to believe that this is a key factor of productivity gains over the coming years, decades even. But increasingly, it depends on which company you're starting to look at. So we would suggest that investors, you should have some exposure to AI, whether that's in the US or potentially in Asia, where some of the valuations are a little bit more attractive. But it also is important to think about what are the other companies which are going to benefit from having adopted AI over the next year or so. So we've obviously seen the tech companies do incredibly well in the last couple of years. But now it's almost the round for other companies. So financials, healthcare, retail, these are the areas which I think can start to see those benefits, so see some gains. So in a way, investors, if they don't already have exposure to AI, they can get exposure to AI productivity gains by looking at alternative sectors as well.
Exactly, and I think that's the point that the Goldman Sachs strategists were making earlier as well, that you're going to see this percolate through the economy. So do you bet on companies now that might benefit from it? I mean, we saw Lululemon rise 10% today. That could be just a unique story, but we have been seeing, as you say, retailers rise. Where do you look to get some benefit?
I mean, I think that any sector is going to have some kind of exposure to AI. So it really does become a case of looking through each company and what their plans are. But generally speaking, if you're looking across healthcare, manufacturing, even if you're looking at agriculture, there are so many opportunities and benefits that could come as companies think more and more about it. And as Goldman had said, it's typically the large companies so far that are benefiting, but we can expect to see that spreading across to small businesses. We do a number of surveys across a large number of small business clients, and they are talking increasingly about AI adoption and are expecting to see very significant productivity gains, which they think will actually be very positive from a wage outlook as well as a job hiring outlook. So I think there's a lot to come, which is quite a positive story. It does become a little bit about valuations, and as I said, companies and investors becoming quite selective about which companies they want to have exposure to.
So when you say next year will be a year of paradox, Seema, what exactly do you mean?
So I think, as I said, look, the constructive outlook from a macro side, combined with the AI productivity gains that we're expecting to see spreading across the economy is key. But at the same time, we have seen a bit of the narrative shift in terms of concerns around an AI bubble, where we would expect that each quarter, each earnings season, there are concerns, questions from investors about AI and how these companies are going to be delivering on some of that return on investment. So we're expecting volatility and noise. And so as investors try and look through 2026, maybe trying to look beyond some of those typical AI names and thinking about where are the areas where we could see some additional upside against slightly more attractive valuations. So that year of paradox becomes one where selectivity, dispersion, diversification is an increasingly important narrative.
What about the bond market, Seema? We've seen this huge, bull steepener trade in the last couple of days. Might next week's data change all of that, or do we just see more of this?
Well, it's been a really interesting dynamic in terms of the bond market. And I think coinciding with some of that rally you've seen in cyclicals and small cap. And I think what we're seeing is we're not worried about inflation expectations taking off, but you are seeing slightly more positive growth estimates coming through. Some of that triggered, I think, by Chair Powell's slightly more optimistic take on the economy. It's only more optimistic than many people were expecting. Now, of course, as you said, next week we're going to be seeing a lot of economic data. In fact, over the next 4 weeks, we'll be seeing a lot of the data that we had been missing over the last month or two coming through. So there is a chance that some of the economic concerns start to creep in, and as a result, you could see some of the steepening of the yield curve reversing. You could see some of the small cap financials sort of value rally lose a little bit of shine. But certainly, looking through to 2026 overall, as I said before, we do have a constructive outlook. So we do think that a lot of these companies that maybe haven't done so well this year could start to see those gains spreading, this broadening out of the rally as we proceed into 2026.
Now, would you be interested in the bonds of any of those companies at all? Or what is your take on what we saw, with Oracle bonds, for example, literally almost being priced as if Oracle was about to default on them?
Yeah, we don't necessarily think this is evidence of an AI bubble, but it is, I think, reflective of the fact that investors are wanting to see, why are you investing in AI capex? What are you, when are you expecting to see those productivity gains coming through? So again, this is a question of selectivity and investors wanting to see delivery of some of the hopes that are coming through. Generally speaking, for credit markets, we are quite positive. We have exposure to investment grade. We have exposure to high yield at this time because of that constructive outlook. Emerging market as well. So I think there's a lot of opportunities around there. It just goes down to looking at the company specifics, their balance sheets, and what they're expecting to do with AI, and of course, coinciding that with valuation concerns.
All right, Seema, thank you so much for joining us this morning. That is Seema Shah of Principal Asset Management. Now to other top stories trending on the terminal this morning. UBS shares soaring, hitting a 17-year high after a group of influential Swiss lawmakers proposed watering down the capital requirements for the bank. The proposal would allow UBS to use junior debt, known as AT1 bonds, instead of equity to meet capital requirements. China is considering incentives worth as much as $70 billion to support its chip-making industry. Sources say details of those incentives, exact amounts, and target companies are still getting worked out. The plan underscores Beijing's resolve to reduce its reliance on foreign chip makers. And the UK economy contracted again in October, underscoring fears that momentum was curbed in the run-up to the budget. GDP fell 0.1% in October, following a contraction of the same size in September. Economists had been expecting 0.2% growth. The decline was driven by falls in services and in construction. Coming up, Lululemon forecasts higher profit on strong demand, while the board hunts for its next CEO. That's next. This is Bloomberg.
Technology is embedded in every aspect of our lives.
and laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. That's a good-looking trophy.
1-1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. President Trump says the U.S. is willing to help Ukraine with security guarantees to end the war with Russia, but expressed frustration at both sides over the pace of peace talks. Bloomberg Government's Jonathan Tamari joins me now. Jonathan, he's expressing frustration, but it's more with Ukraine for not just giving up Donbass, right?
Yeah, and this has been his posture throughout most of these talks, is that mostly he thinks Ukraine should just give in, that they're in the weaker position, the weaker country, and that they should give up territory to Russia to end this war. And obviously that's a very difficult thing for Ukraine, and it's been a huge sticking point throughout and remains one.
So what happens next then? I mean, will Ukraine have this actual referendum, and is there the possibility that, land might actually get put into a demilitarized zone or handed over even?
I mean, that is one recent development that is significant, is that Zelensky is suggesting that there's at least a possibility of this happening, whereas earlier this was something he was so firmly opposed to. So it does appear at least possible. Whether it actually happens, I think we're waiting to see. As you know, there's been so many swings in these negotiations, and I think a lot also depends on what continues to happen on the battlefield, where Russia has been making gains. And that has certainly strengthened Vladimir Putin's position and put Ukraine in a tougher spot.
Well, speaking of swings, if we move to India, Trump and India's Prime Minister had an actual conversation. Does this mean we might be beginning to get close to resetting ties after that 50% levy in August?
It kind of depends on who you listen to a little bit. This is the fourth call between them that we know about. Indian officials are saying they're hopeful something can get done in maybe the first quarter of next year. Trump is maybe being a little bit more skeptical, a little bit less optimistic. So they're not quite that close to a deal yet. It doesn't seem like, even on the most optimistic timeline, even though the two leaders are trying to keep momentum going.
All right, let's move to domestic politics now. And obviously the Affordable Care Act subsidies, they're set to expire, and senators fully expect that talks will continue past the credit's end. In fact, we actually have the House rebels telling voters, we tried. They've sent the healthcare bill without the ACA fix, according to Axios, just in the last few hours. That's the House GOP. What happens next in this morass, Jonathan?
It is certainly a morass. So next week, the House says they're going to put up, House Republicans say they're going to put up a number of healthcare bills that do not deal with the Affordable Care Act. They hate that law for the most part, aside from a small handful of them. Those bills are not they may pass the House, but they're not going anywhere in the Senate. There are a number of senators and House members who want to extend these, but it's going to get more difficult once we get to the end of the year. People are going to start paying these higher premiums, and the politics get tougher. Democrats might be very reluctant to sign on to anything that bails Republicans out of what Democrats see as a Republican-created problem. So, and as you know, we get into an election year next year, so that adds to it more tension. So the talks will continue, but I think throughout I've been pessimistic that they'll reach a deal. I still think it's a long shot that they will.
All right, Jonathan, thank you so much. Jonathan Tamari there of Bloomberg Government. Broadcom shares sliding in the pre-market as investors scrutinize the chipmaker's $73 billion backlog of AI product orders. That figure fell short of more bullish expectations.
It's hard for me to pinpoint what 26 is going to look like precisely. So I'd rather not give you guys any guidance, and that's why we don't give you guidance, but we do give it for Q1.
Hock Tan there, Broadcom CEO on the conference call. Bloomberg intelligence analyst Matt Bloxham joins us now with more. So, I mean, it's had a fantastic year, a fantastic few weeks, really, Matt. Mm-hmm. Is this just investors saying, okay, you know, keep doing what you're doing, but we're just going to take a little money off the table?
Yeah, I think that's a fair assessment. And, the context is that this company's had a kind of great run in its share price. And, I think some disappointment there. And one of the analysts was trying to put them on the spot and say, we think revenues for AI is going to be about $50 billion next year. Does that sound about right based on that $73 billion order backlog? And that's what he didn't really want to be drawn on. I think on balance, they're expecting the momentum to be better than that. But, this is a market that's moving incredibly quickly with lots of moving parts. So I think, rightly so, they're being kind of cautious and not wanting to kind of hold themselves to kind of any particular number. I think there was an issue there, though, also about kind of gross margin squeeze. They're talking about in Q1 about 100 basis point squeeze on gross margins, and that's because the AI products have higher costs in them, and that was a bit of a disappointment for investors. The company's saying they can offset that with their operating costs, but certainly in the tech space, investors never react well to a kind of gross margin squeeze.
Matt, that's it now. That's the quarter done, really, for all of the AI companies. I mean, will investors take down their expectations now for next quarter, or does this cycle continue where investors are expecting more and more and more margins to be greater, orders to be greater, ease of financing to be greater?
Yeah. I think as we get back to work in January, investors are going to be looking for more data points about how enterprises are deploying AI into their businesses, what the return on investment is, to kind of see that momentum of what I'd call real demand coming through, not, big hyperscalers spending money with NVIDIA and spending money between themselves, but actually money coming into that system from corporates saying, actually, we see a really strong role for AI on our businesses, and we're going to increase our budgets to deliver that. And that starts to give you more certainty about the 2027-28 outlook, and, that things like the OpenAI $1 trillion plus investment starts to make sense. I think that's what investors are going to be looking for next year.
All right, Matt, thank you so much. That is Bloomberg Intelligence's Matt Bloxham. Lululemon shares climbing after boosting its full-year EPS guidance on strong holiday demand. It also said Calvin McDonald will step down in January with no successor yet. Bloomberg Opinion retail columnist Andrea Felsted joins us now. Andrea, how unusual is this that a CEO steps down, but there is no replacement nor a plan for a replacement? I mean, I'm not sure there's even an interview process ongoing, is there?
No, it's just they're starting looking now. I mean, it's clear Lululemon really needed a change. It hasn't been working. Did really well out of the athleisure boom during the pandemic and post-pandemic. Since that has happened, fashion trends have worked against it. We've gone from leggings to wider legs. Denim's having a moment. We're all back in the office now. We're smartening up, not sort of, around the house in track pants. That's all sort of worked against Lululemon, and they probably haven't reacted as quickly and effectively as they could have done.
And I presume there's somebody out there that can help them turn the tide, is there?
I think it's a very difficult task. I think it's a long list. I think the main thing is really to work on the product. I mean, we saw with Adidas, they had a very tough time after the Yeezy debacle, but their CEO, Bjorn Golden, he's amazing with product. He's got a real flair for product, and that's really helped them turn their fortunes around. So Lululemon really needs someone that can get to grips with that core range, make it trendier, make it able to withstand the pressure from rivals. And also, I've long thought that there's a whole category waiting for Lululemon to attack, and that's we're back in the office, but we haven't given up the need for comfort. And Lululemon's got great skills in fit, in fabric. So why not create office clothes that are comfortable? And it's had a stab at doing this, but it's been a bit, not very impressive. So it really could, really need someone to get to grips with this range and, entice its customers back and give them a reason to shop.
Andrea, I think you should be on that list of names for potential CEO successor, because that sounds like a good plan to me. That is Bloomberg opinion columnist Andrea Felstad. And do check out her latest column about the Ralph Lauren Christmas as well and why it's marketing gold. It's a fantastic column. Coming up, we're going to get you set up for your trading day, a big day of Fed Speak. This is Bloomberg.
Coming to you live from Kuala Lumpur, the whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Now a look at what's ahead today. It is a day of Fed Speak. We have Philly Fed President Anna Paulson, Cleveland's Beth Hammock, and Chicago's Austin Goolsbee. They'll all be speaking between now and 10 a.m. We get Rent the Runway earnings. That's before the bell. And we're set to get the NASDAQ 100 annual reconstitution announcement, so that might cause some waves. Let's take a look at some pre-market movers. Broadcom continuing its slide that started after hours yesterday after its sales outlook for the AI market failed to meet investor expectations. Lululemon up almost 10% after its profit forecast, but also The CEO stepping down. A new one is going to have to come in. And Tilray, among cannabis stocks surging. It has a new product line out, but it also coincided with President Trump expected to direct agencies to reclassify marijuana as a less dangerous drug. Let's take a look at your macro picture. Day 2 post FOMC and before next week's data. That's it for Bloomberg Brief.
You don't think the court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court that aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up to them in the news whenever and wherever it happens. I'm Chevrian in Seoul, and this is Bloomberg.
Mag 7 hasn't been the monolith that it had been the last couple of years.
Tech companies have healthy balance sheets, but on the margin, they're getting worse rather than better.
More cash flows generated in Mag 7 than the rest of the S&P.
There is a lot going on into next year, which is why I think we're positive, but I think there may be some volatility.
There's a 30% chance that you get a full-on bubble next year.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome to Bloomberg Surveillance on this Friday. Stocks poised for their third straight week of gains, climbing to all-time highs yesterday as hopes for that Santa rally take hold. Investors looking beyond just big tech as they see Fed rate cuts helping to fuel broader economic strength. Now the focus turns to next week, a dump of much-awaited data with the November payrolls report, retail sales, and CPI on deck. David Gura pulled the short straw once again. I'm so glad to have you in the seat. David, to me, this is going to be a real question. How much does the economy rise to the occasion of the strength implied by some of the recent equity gains?
Yeah, we're on the heels of this Federal Reserve meeting where the Fed chair was very forthright about the fact that he didn't have the data that he wanted to have going into this. He's kind of fumbling through this in the way that he can, only because we have all this backlog of data. We haven't even known when it's going to be released. So this is a pivotal moment, I think, to get confirmation of the very rosy growth forecast that we got at that meeting just a couple of days ago.
And whether we can see the sustained rotation.
Yes.
We're seeing it, again this morning, this idea that even if you have big tech underperforming and you have some of the biggest names in the index declining significantly, you still can eke out gains, highlights how much people are turning their eyes elsewhere and how much people can look past the pain of potentially overestimating some of the gains from artificial intelligence.
There we go. So we move from Oracle to Broadcom. Less agita surrounding those earnings releases, I think, although funny that the company performed very well by many measures, and yet there is this open question of what's the timing? We talked a lot about that yesterday. When does Wall Street need to see the proof in the pudding? He was unable to answer that, even though, again, sales figures, revenue all rosier than I think a lot of people expected.
And I think ongoing, the question is going to be, are some of these tech companies not delivering on very high expectations, or is this an issue of investors looking for any excuse to sell and potentially some bright shoots for people who want to get bullish in the sector? Because guess what? This is not a full-blown bubble if everyone is so skeptical and keeps on talking about bubbles.
There you go. And we did talk a lot about bubbles, made the hand motions yesterday over again. But yeah, I think consensus is we're not there yet, but there are some signs here that are worrisome for a lot of folks.
Right now, what we're seeing in markets just taking a little bit of heft out of the rally that we saw yesterday, closing at all-time highs, dipping just about 0.1% on the S&P. You're seeing a little bit of yields rising on the long end, the rally into the front end continuing, yield curve steepening, getting to the widest in the 2-10 spread going back to April around the Liberation Day discussion. And, after seeing some dollar weakness and the expectation that next year you could see ongoing dollar depreciation, right now, just around that 117 mark on the euro dollar. Coming up this hour, Peter Shear of Academy Securities with stocks trying to end the week at fresh record highs. Jason Bazinet of Citi as Disney makes a $1 billion investment in OpenAI, and Karen Mana of Federated Hermes with historic AI deals reshaping the debt market. So begin this hour with stocks steady as the focus shifts from the Fed to the data. Peter Shear of Academy Securities writing, now we can watch the data and let the countdown to the Santa rally begin. And you put a little smiley emoji, and there is a real question here. Is this ultimately a market that wants to go up and is going to go up because there is a dearth of other information to really prevent it from doing otherwise?
Yeah, and I think you're seeing it, the Russell 2000 is doing very well. I think there's still questions surrounding, the big tech, the AI story, but you're seeing the equal weight S&P 500 do better, Russell 2000. I think it's helpful that the Fed is buying some T-bills up to $40 billion a month. So you're seeing all that. I think, the Oracle earnings yesterday kind of spooked the market a little bit. And I think that's maybe the one susceptibility is there's a lot more questions around the AI data center, but if rates are coming down, I think we're going to get rate cuts faster than market's pricing. That should be really good for small caps and the broad economy.
How much better are you feeling about big tech, given the fact that you've seen such a lack of enthusiasm following some of these earnings?
I think there's still questions about valuations there. The one thing that's, I think, coming up in every conversation we have is more and more questions about the electricity bottleneck. How are we going to run some of these things if we can't produce the electricity? So I think, again, we're going to see a lot of investment into electricity next year. That's going to be a story. I still think that come the next election, electricity and electricity costs are going to be an election issue.
Peter, how much do you look at a company like Broadcom or Oracle as a proxy for this nascent industry as a whole?
Yeah, there's kind of that collection. You're looking at what they're doing. You're also trying to figure out how, again, the Disney announcement yesterday, how are stocks reacting to this? And, it feels that we've kind of gone through this period where if you raise your hand, say anything AI, your stock shoots higher. Now there's a lot of questions. People are trying to figure out where's this going to work? How's it actually going to work? And, again, going to be somewhat facetious. If you spend $50 million and you hire 10 fewer people, how much were you paying those people? Maybe you shouldn't have done that. So I think the AI story is growing. We're seeing the use, but now it's kind of, there's a little bit more question. Are you spending it? Are you getting value? How do you want to use it going forward?
Lisa mentioned the high expectations that we've had for a lot of these companies. Is this a moment to recalibrate or rethink what those expectations are? So I look at a company like Oracle, I look at a company like Broadcom. There's been a lot of happy talk. It has performed very well quarter after quarter after quarter. Now we're at a point where maybe we just can't reach those expectations that have been in place for so long.
Right, it gets much more difficult. So again, one of the trades we've liked is you are either underweight QQQ or the NASDAQ 100, and you're overweight either the S&P 500 equal weight or the Russell 2000. I think that's where the performance is going to come as we realize all these other companies who are benefiting from AI, they should trade maybe at better multiples. The businesses here, and you're starting to see rates come down again, which helps a lot of those companies much more than it helps, I think, the big companies.
We're kind of walking a tightrope, though. I remember just a couple of months ago, people saying that if the AI trade doesn't work, it's going to bring down everything, because ultimately, the entire market and economy has been propped up by AI hopes and dreams. Why has that changed in terms of a narrative so substantially?
Well, I think we're still seeing the investing going on in that part. So the spend is still there. So I think if that spend really drops, that's where you start really getting in trouble. Then we start questioning, okay, where's this economy head? And I'm definitely not quite sanguine about the economy. I think there are some risks there. I think the jobs data, I think a lot of companies are actually going to budget less spending next year. I think it's going to start flowing through the economy where you slowly see the uptick in tariffs, right? As this tariff revenue keeps coming in slowly but surely, 240, 250, 300 billion, that's when you start feeling the impact on that. I think the job market's a little bit sketchy. What I did, of all the data I saw this week, I still look at the JOLTS quit very, very closely. To me, that's the closest we get to crowdsourcing. We're back to levels in the quits rate, I think it was 1.8 or something. It goes back to 2015. People aren't comfortable leaving their jobs. That tells you everyone knows the job market's a little bit sketchier than maybe the data shows.
I'm so glad you went there. Next week, we get the November jobs report, which of course is delayed, and a lot of people, and Marie in particular, was really annoyed that we didn't get it before the Fed meeting. And we seem to get indication from Fed Chair Jay Powell that there is this weakness in the labor market that you're talking about. How pivotal is that report to highlight that things aren't falling off a cliff? Yes, the Fed's going to cut rates, but that the economy is actually still hanging in there.
Well, I hope it's pivotal and shows that we're not falling off the cliff. I think there's a risk that this data comes in much weaker than we're expecting, and that's kind of this wake-up call. Okay, we've all been talking about this jobless recovery, and yeah, the data center spend's been driving a lot of the economy. Where are the jobs? Who's getting the jobs? Where are they coming? You know, again, everything I talk to, and probably near and dear to my heart, you know, kids graduating college, the job market looks very bleak right there compared to what it's been a few years ago. So I think we might be starting to get the data that really starts confirming, whoa, something's not quite working. And I think everything's been a little bit tolerant. Let's see how these things play out. Let's see how the trade deals play out. Let's see. Now we're at that proof is in the pudding. And I'm a little bit nervous that the jobs data is going to show this is not working the way we hoped it would be.
How are you thinking about Fed timing and insurance? I think Claire Jones of the FT asked a question a lot of us had going into that meeting, which is, why do this cut now? Why not wait till January when we would have the data that we're talking around, because we haven't had? Why not wait into January? Did he give you a satisfactory answer then in that press conference?
You know, I think the ultimate reason is they are concerned about jobs, and there's just enough out there, I think, on the jobs data, and not just official data. I think it's anecdotally, right? There's no one I'm hearing talking about, oh, there's some great underlying strength, and, you know, it was kind of weird. They did raise the GDP forecast, but again, they didn't seem to, you know, accompany that with a big job growth. So I think that's why they did it, and honestly, I think you're going to see a lot of pressure. I think the market is going to get to 3% on Fed funds way faster. I think we get there by the summer, and the market's not pricing in 2 cuts next year until September. I think Powell will have to cave. I think we're going to have to move, and this is going to be an aggressive cycle where we've been maybe a little bit tight too long, too dependent on allowing that AI spend to maybe cloud or cover up that there is an underlying weaker economy going on.
Curious if you noticed something that I did during that press conference, which was the Fed chair very willing to engage with AI in a way that he hadn't been able to before. So there were a number of colloquies with Howard Schneider and Neil Irwin, Steve Leisman. They asked about AI, how much he's thinking about it. And he was pretty optimistic. You know, he talked about the prospects of AI spend continuing here at a moment when we are, candidly, kind of wondering about how long that's likely to persist. What did you make of that, his kind of recognition of the fact that this is going to be rather seismic going forward?
I think it's good. I think it all makes sense. Again, we are going to continue to use AI. People are going to refine how they use AI. They're going to.
He admitted he uses it, which I thought was interesting.
I think, you know, I've used it multiple different ways. You know, if I'm on Twitter, I tend to use Grok. If I'm on my desktop, I tend to use ChatGPT or something like that. So I think it's an important part. But again, I think we also see some of the limitations. And I'm still at this concern that we're basically paying 2030 prices for 2025 technology. And so it's not quite where we want it to be. And people are going to be a little bit more thoughtful on their spend. And I keep coming back to whether it's with the DATs or the digital asset treasury companies, you know, when there's this, you raise your hand, you raise free money, it's going to continue. As soon as you start really questioning, are we getting the value, and what are the limitations? Again, I keep thinking that it's going to be electricity and power generation is the limitation. People are going to have to think twice. That's where it's going to stall out a little bit.
David, I'm so glad that Peter talked about this, the idea of are we getting the value? I think about ChatGPT. I look up medical problems. With Grok, I say, is this real? And that's what everybody does. Is this real?
Your doctor is thrilled
I mean,
that you're doing this.
So it's sort of at a certain point, you could either go to the Merck manual or you
Yes.
could actually just not have digital manufacturing of concepts, and then all of a sudden you clarify those two issues. I mean, are we actually solving some of the issues that people think will create the productivity boom that's being priced into the market?
I've heard skeptics say you can take out a calculator and do 2 + 2 is 4. If you do it through ChatGPT, it's going to take, I don't know how much more energy to do that than it would with my little solar-powered calculator. But this is a real issue. I think people are kind of, I think it's emblematic of the fact that we're trying to fumble through this, figuring out sort of what the best use case is. We're doing that individually, you with your medical interests or whatever, and you know, but just
Why do I have a pain in
more
my
broadly.
shoulder?
But then there's this whole enterprise facet of this as well, which is I think companies are still embracing this largely, but in a kind of blind way, not knowing how it's going to be applicable to what they're doing.
Yeah, and I again half jokingly say I think in some cases if they just asked their employees who've been there 3 or 4 years what they should do, they'd probably get a really good answer. Maybe we should go back to empowering our employees too. Like people know the situation, and some of this feels a little bit like a crutch. And again, there's going to be useful parts of it. I think the limitation is how much data you have, how useful is your data. You got to plug it into there, so people are using it. I think it's makes people slightly more productive. I don't think it's kind of this be all and end all that ultimately it should get to. Right, it's going to do more and more. It's going to get better and better. I just don't see the technology quite at that level, and when I try and use it, it's great until you realize, oh, it hallucinated a ticker symbol, and now I'm like, now what else do I have to check? What else do I really need to go? And also, it's how do you learn if you kind of rely on it for too much? So.
Yeah, I will say, my kids say, look, I don't know how good it is if it didn't get me an A on the paper. Just saying. Peter Shear of Academy Securities is going to be sticking with us for the hour. We're going to get into geopolitics and a whole host of other stories coming up. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, good morning. China is investing in its homegrown chip business, preparing as much as $70 billion in chip sector incentives. The program aiming to reduce China's reliance on foreign chip makers and support local companies such as Huawei and Cambricon Technologies. President Trump signing an executive order to go after state-level regulation of artificial intelligence. Trump saying the industry shouldn't have to navigate a patchwork of AI rules. The order directs the Attorney General to set up an AI litigation task force to sue over state laws that are inconsistent with the White House policy. Lululemon shares rallying in the pre-market. The company announcing that CEO Calvin McDonald is stepping down at the end of January as the company works to reignite growth. The CFO and Chief Commercial Officer will serve as interim co-CEOs while the company searches for a replacement. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, pushing for peace.
To make elections possible, there must be a security component. And America can help with this the most.
We would help with security because it's, I think, a necessary factor in getting it done.
Bloomberg's Tyler Kendall and Oliver Cook both joining us next to get the latest. This is Bloomberg Surveillance.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Looking at trying to get another day of gains after what we've seen for the past week, which is potentially a third straight weekly gain. Yesterday, we saw all-time highs. Today, taking heat out of that, S&P futures lower by 0.1%. The underperformance at NASDAQ in the tech-focused sectors down 0.5%. Check out the Russell 2000. This has been the outperformer. It continues to be today. This has been the rotation, up 0.4%, absolutely surging, with a whole host of contributors as you have a yield curve steepening, as you have this optimism about Fed rate cuts, and frankly, as people look to more underpriced sectors within the broader equity space. Right now, if you take a look at 2s, 10s, and 30s, that is where you're getting the yield curve steepening. That is where you're getting the action that's driving some of the heat in particularly bank stocks, but in the broader sort of rest of the market. 2-year yields lower, just a touch, 3.53%, but higher across the board. 30-year yields back up to 4.82%. You're seeing the steepest 2s, 10s gap going back to mid-April. Under surveillance this morning, pushing for peace.
We can try to hold elections. Ukraine is not hiding from democracy, but to make elections possible, there must be a security component, and America can help with this the most.
We would help with security because it's, I think, a necessary factor in getting it done. We'll be attending the meeting on Saturday in Europe if we think there's a good chance, and we don't want to waste a lot of time.
Here's the latest. Ukrainian President Volodymyr Zelensky floating the prospect of conceding territory to Russia. President Trump mentioning U.S. security guarantees without specifying details. Our team coverage starts right now with Bloomberg's Tyler Kendall in Washington and Oliver Crook in Brussels. Ollie, I want to start with you. What do you expect from these meetings? Where is this lining up in terms of where Europe is and what Ukraine is expecting from the United States?
So what we understand is the last draft that was sort of edited by the Europeans and the Ukrainians is still resting with the United States for their evaluation. They, of course, will give an opinion on that. And then there is this meeting over the weekend at the high level of Europeans. And as you heard there from President Trump, still evaluating whether or not the American delegation will participate in those talks. As we know, the Trump administration has been fairly impatient about the speed at which the Europeans are moving, saying he doesn't want to attend talks just for the sake of talking, meetings just for the sake of meetings. But I do think it's significant that President Trump is talking openly about security guarantees, obviously a fundamental part of these negotiations, but not something that President Trump tends to talk that openly about, though he did not detail what they would actually include. I would say that the most interesting thing, though, that we've seen over the last 48 hours or so is this sort of geopolitical judo that Zelensky is playing, using the momentum of ideas that are quite hostile towards Ukraine from the United States, holding elections, also this idea of conceding territory and saying, listen, we are willing to do these things. We will say there are no bad ideas coming out of Washington, D.C., but if we hold elections, we need security guarantees. We will hold them in 60 to 90 days if you can guarantee the conditions for security for holding that election. So Zelensky, in that way, providing what the United States would like to see, but getting something in return. And the same thing with this idea of a referendum over territory. This is obviously the most contentious part of this peace proposal, surrendering additional territory to the Russians. If Zelensky can say, hey, listen, we're bringing this to the vote, to the population, one of the most emotional issues that we can possibly think of, and it's the Ukrainian population that will decide. A, it takes out all the wind from the sails of those who call him a dictator and say this is non-democratic, and B, it shows in very sharp contrast what a democracy looks like versus Russia.
As Volodymyr Zelensky plays diplomatic jiu-jitsu, Tyler, there is this question in the United States where President Trump sits on this. He said mixed messages. On one hand, expressing a lot of frustration with how long this process is taking, trying to get this done by Thanksgiving. It went past that deadline. On the other hand, he talked about potentially providing security guarantees. Do we have any insight into which way he's leaning?
Right, Lisa, I mean, at this point, it's always been shifting as you're outlining here. But of course, as Oliver just outlined, security guarantees have long been one of those key sticking points. And we really have seen the White House's position on this evolve. You'll recall for months we heard from U.S. officials that the guarantees were really only going to be implicit guarantees because the U.S. would have a vested economic interest in the future of Ukraine after inking that critical minerals deal earlier this week. In the months since, though, it has shifted with the U.S. committing to air support and intelligence sharing. But we know that Ukraine really wants to see the U.S. go further, perhaps even something that mirrors NATO's Article 5 mutual defense clause. But again, it is unclear at this point exactly what the U.S. will commit to because there has been this mounting frustration. Now, as Oliver also mentioned, it's unclear right now if the U.S. is going to send a delegation to those talks over the weekend, despite urging from European allies that President Trump himself should be there. But we should mention that the Ukrainian President Zelensky did have a meeting with some high-ranking U.S. officials earlier this week, including Secretary of State Marco Rubio and Special Envoy Steve Witkoff. And in the wake of that meeting, the U.S. has been really pressing our European allies to press Ukraine to accept the peace proposal that the U.S. has put on the table. Because, Lisa, you mentioned shifting deadlines. Ukrainian President Zelensky said yesterday it was, of course, no longer Thanksgiving. We're past that, but that the U.S. has made absolutely clear it wants a clearer picture on what Ukraine will accept by now Christmas Day.
Ollie, one thing I'm wondering about, are you hearing anything about Europe's plan for Russia's frozen reserves? I think there's been some pressure on them to try and seize that. That could be a potential shift in the talks. Are you hearing anything, how they're leaning towards on that?
Yeah, so I'm standing right now at the European Council where European finance ministers are entering their second day of meetings, and this is one of the big issues they've been grilled about for the last couple of days, and I spoke with a couple finance ministers yesterday on this very subject. So we should say there are two main hurdles. One is the question that to freeze these assets, you need to roll them over every 6 months. That takes unanimity of every single European state to vote on. The Europeans are now changing that rule so that they can go by a so-called qualified majority, meaning they can ice out Hungary and Slovakia, who have been these sort of people who go against the consensus in Europe, in order to freeze those assets indefinitely. That is one of the key steps to getting those assets to the Ukrainians. The second step is the question of Belgium. They want to have financial guarantees. Most of that money is held in Belgium. They don't want to be on the hook if they get sued by Russia or this war ends for 140 billion euros. The first hurdle has been cleared. Now the second hurdle is what they're trying to deal with. We have not yet heard guarantees from the Belgians to say that they're comfortable with the reinsurances that they've got. That being said, we are starting to get from European leaders a lot more optimism that they'll be able to come to a deal on this next week when European leaders meet in this very building. I should just say that this is, I have to say, the last point of leverage that European leaders can really bring to the negotiating table in the last moments of these peace talks. A failure to do so would be yet another humiliation, I think, for European leaders in a year that has been fairly rich in humiliations and geopolitics for the Europeans.
Oliver Crook, Tyler Kendall, both of you, thank you so much for your reporting. Peter Scheer, you just asked this question about the reserves. This has been one of the points of leverage. This has also been one of these sort of Hail Mary approaches for Europe to get some funding into Ukraine. From a market's perspective, why is this so crucial, right? What are the implications here?
I think if they don't do this, Zelensky's going to get forced into a peace deal with Russia, not on good terms. I think Europe's going to lose out on a lot of this. So I think this is really the only lever that Europe can pull is get this money. It might switch the narrative with President Trump, too, where they go, hey, we can actually now afford to buy better equipment from you, more equipment. Will you sell it to us? And I think it's the only way to put any pressure back on Putin. And it's the first time I think they're coming close to doing it. Again, Europe cannot do enough militarily. They don't have the military to support Ukraine in the right way. That's the only step they could do. And it's the only thing that I think puts any pressure on Putin to come to the table in better terms than he's currently willing to do.
Oliver mentioning a moment ago the specter of Russia perhaps suing Euroclear, that happening according to Bloomberg News this morning, just a few hours ago, that suit being filed by Russia. Peter, I'm curious, as you watch all this unfold, your sense of the U.S. strategy here. So we have the president kind of going with that this could be an email strategy toward these meetings. He'll show up if there's something tangible that could be gained from them. But you know, we've seen this evolution, the kind of diminution of this 28-point plan down to a 20-point plan. Your sense of sort of who is running point here and what the U.S.'s goals are here going forward as these talks unfold?
You know, I think the U.S. wants to give a lot of preference to U.S. corporations in the rebuilding of it.
It's business-based.
They want peace. Yeah. And if you look at the original 28-point plan, right, Russia was going to contribute a bunch of those reserves to projects that the U.S. would get 50% of. The one thing I do know from people in this administration, the president was very frustrated with the rebuilding of Iraq, where he felt the U.S. companies weren't given enough of a head start to really benefit from this. So if we get some sort of deal and it's driven by the U.S., look for U.S. companies to have a really good head start in the rebuilding of Russia and Ukraine, 2 to 5 years, I think. And when we're looking at that, we think something's coming through. The only lever power that Europe can pull is this reserves. We are going to see this rebuilding in places I think that are going to become really interesting. Poland, which has already become a hub. And we're also hearing more and more companies are going to base themselves in Romania. Romania has actually done a very good job where the borders are. It will allow companies to operate in both Russia and Ukraine as part of this rebuilding, but on safer territory. So I think that's where this is all headed. It is somewhat transactional, and it's really, I think, in Europe's hand to either get these reserves, change the narrative, or it's going to get pushed into some sort of peace deal so we can do the business.
In Europe's hands, but a very funny phenomenon here is we see that gulf between Brussels and Washington, Europe, and the United States growing wider and wider. Just curious to me, Lisa, as I watch all of this unfold, sort of where this lies in the broader strategy. We see the national security strategy. You're being very much alone from the U.S. in so many ways right now.
Yeah, and how much some of the geopolitical alliances are shifting and where Europe ends up in some of these, which is the reason why they're grasping at the last straw of leverage that they potentially could have. Right now, we're looking at markets churning as we see all of this. Peter Scheer of Academy Securities will be sticking with us. Coming up, we've got Jason Bazinet of Citi as Disney takes $1 billion stake in OpenAI. It is deal season. It is mergers and tie-ups and all sorts of strange alliances. Plus, Yahira Anand with your morning movers. Shares of Lulu higher after announcing a CEO shakeup. What kind of feeling is it when you leave as a CEO and the shares are up 9.5%? This is Bloomberg.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Taking a little heat out of the rally that we saw, get stocks to record highs to close yesterday. Right now, just off about 0.1% on the S&P. The underperformance continues to be in the big tech space, with NASDAQ lower by almost 0.6%. The outperformance once again in the small caps. Russell 2000 futures up 0.3%. The Y is very much in the bond space, very much on the heels of the Fed meeting, where there was a rate cut, the third consecutive one. in addition to expectations for additional ones next year and in 2027. The front end lower, 3.53%. The long end higher, 10-year yields 4.17%. 30-year yields back up to 4.82%, leading to this yield curve steepening. And I do want to point to silver. Silver has actually been on a complete tear, has gone hyperbolic. We've seen parabolic, I should say, has more than doubled this year, has been surging of late. I asked ChatGPT why. It said persistent supply shortages, exploding industrial demand, investor and safe haven, weaker U.S. dollar monetary expectations, and silver FOMO. Do you have silver FOMO, Peter Scheer?
Not really. It does seem like it was a poor man's gold at one point, and people who missed the gold rally bought into silver and now have been rewarded more so. So it doesn't always happen. But again, it gives me optimism for the Russell 2000 and things like that, where the stocks that have been left behind, maybe they get that opportunity to really grow.
Maybe silver's going to be the bright spot for smaller companies around the world. 3 hours away from the cash open, here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We have a leadership shakeup at the top at Lululemon, and shares are surging nearly 10%. The company saying that CEO Calvin McDonald will step down at the end of January after more than a year of underperformance, and no word yet on who the successor will be. But the leadership change comes as Lululemon posted solid results, even saying that the holiday season is off to an encouraging start. Meanwhile, moving on to furniture retailer RH, previously known as Restoration Hardware, its shares are rising 3.7% as it shows rare momentum in a sector hit hard by tariffs and a sluggish housing market. Third quarter revenue rose at 9%, outpacing rivals. And this is a company whose CEO, of course, has not been shy about calling out tariffs. Remember, earlier this year during an earnings call, he shouted an expletive when he saw the stock plunging due to President Trump's new tariffs. And we end over in Switzerland. UBS shares are rising 2.5% after influential Swiss lawmakers came out with a proposal watering down stricter capital requirements in a move that could spare UBS from $26 billion in capital demands that the government has been pushing. This is something that has been hanging over UBS for about a year now since they first started discussing this. So a bit of relief this morning, Lisa.
Thank you so much, Yahira. On our radar this morning, President Donald Trump threatening land strikes in Venezuela following the seizure of an oil supertanker. The U.S. Treasury Department also sanctioning 6 vessels and 3 members of President Nicolas Maduro's family. A real sense that things are heating up in an area, and a pretty controversial move, David.
Yeah, and the specter still looming large is what's going to happen on land. And Peter Scheer, President Trump talking about this in comments yesterday, that there's still the prospect of the U.S. taking action on land. And to Lisa's very good point here, we just see things progressing down this path. I think what's indefinite or not understandable at this time is sort of where it all ends.
Not sure where it ends, but I think there is a very strict timeline on this. You don't put an aircraft carrier in that region. It's not that effective. It's very costly. There is pressure to use it or kind of lose it. So I think there's going to be a lot of pressure on Maduro. We're going to see this escalate till there's some sort of resolution. And I think it's a matter of weeks, not even months.
Yeah, which is going to be an ongoing question about how much this links into both Russia and China negotiations with the United States. We've got more on that coming up next hour. Meanwhile, China considering a package of chip sector incentives worth as much as $70 billion. People familiar with the matter telling Bloomberg the program would aim to reduce China's reliance on foreign chip makers such as NVIDIA. So here's the question. Would you prefer it to be government financed, or would you prefer it to be private sector financed? Because it seems like China's taking the public sector approach, and the U.S., David, is taking very much the private sector.
Well, this dovetails so nicely with the conversation we've been having about is this a bubble or not? Are we seeing a lot of frothiness here? And as you've pointed out many times, I think what's key here is China's approach is so different. And so you have companies here in the U.S. doing what I think we would expect them to do, which is compete against one another in an environment where there is scarcity. Companies can't make enough of these chips, enough of these products. I think this is certainly likely to sort of make that even starker in relief.
Yeah.
Yeah, one thing we're watching very closely at Academy is there signs that China's allowing the entrepreneurial spirit to flourish again, right? If it's a government-mandated thing and they tell everyone what to do, there's a decent chance it doesn't work out well. If DeepSeek wasn't a one-off, but kind of a sign that, hey, you engineers, go figure things out, that's when we're in a little bit of trouble. It almost goes back to the days, right, when Alibaba rose and you had Jack Ma, and China allowed these kind of big success stories, then they clamped down on those people and kind of made it very government-controlled again. That, to me, is going to be the swing. If it's entrepreneurial, it's going to be more dangerous. dangerous.
So hold on a second. This is actually a really important point. Are you saying that this is more government controlled in terms of how they're trying to support the chip sector in China? That actually is less of a threat, you think, and less potentially of an opportunity from an investment
Yeah,
standpoint.
what tends to happen in those countries when the PRC, right, no one wants to upset the boss, so even if they make mistakes, it keeps going down, down, down before they finally realize that. So that, to me, if it's really government directed, not as dangerous. If they're giving this money and encouraging, hey, go figure it out, try and beat the U.S. and do what you want, that's when it becomes more dangerous, I think.
Which is the reason why a lot of people are looking at the chip sector very closely. Broadcom yesterday sliding after the chip maker's sales outlook for the AI market failed to meet lofty expectations. The company's CEO warning margins are tightening while holding off on a forecast for annual AI revenue, calling the figure a moving target. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, how big of a disappointment was this, actually? I mean, they beat pretty much across the board. They came out, he said, I don't want to be pinned down. Someone tried to pin him down, and then the stocks fell. Can you give your take on this?
Yeah, look, 90 days back, they told us, they will be adding 2 new customers that are ramping up. We learned yesterday one of them is Anthropic. But the disappointing part was even Anthropic is using Google TPUs designed as the basis for their own chips. So, I mean, essentially, Broadcom's biggest customer is Google. It's almost 90% of their AI revenues. And even going forward, like Anthropic being a new customer is also using Google design. So the concentration here is immense in terms of just relying on one vendor, Google TPU designs. That is your primary customer. And OpenAI, even though they have talked about 10 gigawatts of power that they want to add, and they could be a new customer, but the timeline on that is further out. And that's where I think the market is not sure about the backlog and when it will materialize from other vendors outside of Google.
Mandeep Singh of Bloomberg Intelligence, thank you so much. I'm sure we'll be following up with you next week. Sticking with AI and the application of it, Disney inking $1 billion stake in OpenAI and licensing more than 200 of its characters to the startup. Jason Bazinet of Citi writing, we suspect Disney views the use of its IP as a free form of marketing. The use of these characters should help sustain and potentially build long-term brand value. Jason has a buy rating on shares of Disney with a $145 price target. Those shares are up 0.4% in pre-market trading. Jason joins us now. Jason, thank you so much for being with us. I thought this was a fascinating move on the part of Disney. It kind of goes to the heart of the anxiety for content creators. Is AI going to be a partner? Is it going to be a cannibal? Is it going to make you obsolete? What do you take from this approach from Disney?
Well, there's part of this deal we like, Lisa, and part that we don't. The part that we like is we'd rather see a commercial deal than litigation. And so we like the idea that they've inked something. We think Disney is going to get some cash for the use of its IP. And we like the idea that the use case has been ring-fenced. These animated characters, short-form video, that makes a ton of sense. The part I don't like is the $1 billion investment.
And explain why. I have another question, but let me tease that out of here a little bit. Why are you so down on this investment, which I think some could argue is sort of them, solidifying a stake here in a company that has had more than buzz over the last couple of years, and a lot of people are thinking it's kind of the future of tech more broadly?
Well, Disney has, first of all, I've never had an investor tell me that they invest in Disney because they have an astute venture capital arm. It's just not what investors care about that are Disney shareholders. The reason I think that is Disney tends to have a propensity to invest its capital at sort of the peak of the mania. And so I could go back to, the InfoSeek investments that they made in the 90s that never went anywhere. A bunch of video game developers, when video games were growing very quickly, they shut all those down. A couple of years ago, they invested in Epic Games. I think it was $1.5 billion investment. We'll see where that goes, but that was at the height of the metaverse. And now we have the height of AI, and we see $1 billion equity investment. So, maybe this works out really well for Disney, but call me a bit skeptical.
Pour one out for InfoSeek. Haven't thought of that company in a long time. But let's get back to the use case here, Jason, because I am very curious about this. It strikes me maybe we're closer to Anne-Marie and John being out, and Mickey will be sitting at the table with Lisa or Steamboat Willie or Donald Duck. But I want to ask about Sora, because my sense of Sora, this product that OpenAI has made, is that it hasn't gotten a lot of widespread adoption or interest. There's that kind of flash at the beginning when my Twitter feed was just filled with these kind of insane 10-second videos that people were making, I think, just to showcase or show off the technology that OpenAI had made. But I don't get the sense it has a lot of cultural currency now. And I'm curious, just sort of when you think about the way in which OpenAI is going to use this, do you have a sort of satisfactory answer from the company, a sense of sort of how much this is going to be used for PR or marketing employees, you say, or just used more generally?
Well, I don't know. It's all very much TBD. I would say that I had a number of investors ping me yesterday and say that they believe that OpenAI is sort of de-emphasizing Sora. And I would agree with you. It doesn't have a huge amount of cultural currency. I think we're still in the early days of sort of consumer adoption and embracing of all of these tools. So TBD, but I don't think it's going to be a bad thing. And, we've had a number of other companies in our coverage universe that have licensed their IP and received checks that are, on the magnitude of $50 million a year. That's a mix of sort of a fixed payment and a usage-based payment.
Jason, if I were an actor in Hollywood, would I be excited about this deal or worried about this deal?
Well, I would say that you are, I guess, excited at one level, and that there's nothing in here that sort of allows OpenAI to use the likeness of actors or actresses. But at another level, it doesn't answer the threshold question, because this is an easier deal for Disney to do because it has so many animated characters, the 200 or so that you referred to. And so I think there's still an outstanding question of how these AI tools are going to be used for the bulk of the IP that exists in Hollywood.
Jason Bazinet of Citigroup, thank you so much for this. And honestly, I ask that because this has been deeply existential for so many different content creators. How much is Netflix is going to possibly do it, but how much is OpenAI going to cannibalize from the creative process?
Just relieved personally, you're not thinking about moving to LA to be an actress.
It's okay. I think I have enough on my plate. I am curious, though, from your perspective, Peter, how much you're seeing some of these deals and tie-ups is a good thing, and people trying to get ahead of any kind of innovation, and how much do you expect more of this in 2026?
As the guest pointed out, Bazinet said, it's kind of weird that there's this investment tied to it. Why is there always seems to be, we're going to use it, but there's also an investment in part of it? It seems slightly awkward to me.
Well, maybe it's something trying to get ahead of what could potentially whipsaw their shares, and they want to be a part of it. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. Ukrainian President Volodymyr Zelensky floating the idea of allowing Ukrainians to vote on whether to hand the Donbas region to Russia. He says the Ukrainian people must have a say on the matter, whether in the form of an election or a referendum. Ukrainian territory is at the center of ongoing discussions as negotiators inch toward a potential agreement to end the war. Terraform Labs co-founder Do Kwon has been sentenced to 15 years in prison for fraud tied to the $40 billion collapse of the Terra USD stablecoin back in 2022. A New York judge handed down the verdict, saying the fraud was, quote, on an epic generational scale and caused significant monetary harm. The 34-year-old still faces fraud charges in his native South Korea. Apple losing an appeals court ruling in its long-running App Store fight with Epic Games. The court upholding a finding that Apple violated California law with anti-competitive conduct. The tech giant did win a chance to argue for charging developers on transactions made outside of the App Store. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, AI stretching corporate credit.
The concern around the debt loads of these companies is quite rational. The fear bubble, as reflected by the credit default swap market, may pop.
Concern versus fear bubble. Karen Mana of Federated Hermes joins us next. This is Bloomberg Surveillance.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a little ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now these 2 fingers, top of the bottom, make the sushi shape the more beautiful. 3. Then, I'm not, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Beirut, and this is Bloomberg.
Taking some of the froth out of yesterday's rally, we did see all-time highs at yesterday's close. Today, we're pulling back just a touch, led by the tech sector once again, as people do raise questions about just how high valuations are. Down 0.2% now on S&P futures, climbing lower as the session grows older. That dollar weakness turns a little bit to dollar strength, although still at 117 on the euro-dollar cross. The 10-year yields higher by about a basis point at 4.17% rounded up, continuing to climb, even though you see the front end continue to rally. Those silver prices up 1.3%, silver on an absolute tear to a new record high. Under surveillance this morning, AI stretching corporate credit.
The concern around the debt loads of these companies is quite rational. If you think back to the late 1990s, the concern was just a random throwing money at everything, everywhere, without revenues. We think it might actually be more the sense that the fear bubble, as reflected by the credit default swap market, may pop.
Here's the latest. Credit concerns resurfacing after a measure of Oracle's credit risk spiked to a 16-year high. Karen Manna of Federated Hermes writing, more supply next year will restore value as winners and losers emerge. Spreads may appear wider, but an increased sensitivity to valuation will be a positive for active investors. Karen joins us now. Karen, that is a beautiful way of saying that we could sell off. I mean, essentially, you're talking about the opportunities that could get created with things that go down in price and have yields go up. I mean, what kind of sell-off are you looking for?
Good morning, and thank you for having me on, Lisa. I think not described so much as a sell-off, but truly an opportunity. Spreads, which is how we measure the risk of corporate bond issuance relative to that risk-free rate or U.S. Treasury, have been historically tight, providing few opportunities for the active manager to apply our use of credit analysis and to discern value. We at Federated Hermes continue to be extraordinarily sensitive to that value. So as the broader investor community seems to look more closely at these issuances and to question, is it too much, too fast? We think that they will take that more careful look to all names that are issuing, even outside the AI industry, and just will have more opportunity as spreads are more dispersed. So not so much a sell-off as just a broader dispersion in the spreads that folks are looking for when they enter the corporate bond market.
Karen, in anticipation of that, are you holding more liquid assets to try to be able to capitalize on those opportunities?
We are. Liquidity is a very key theme for me, particularly in this market. As we enter the close of the year, Lisa, we are pretty defensively positioned as we have been. We are underweight still on corporate credit, and that is investment grade and non-investment grade. We are underweight to EM, as that market has really come in quite nicely, and we've met our thesis there. Overall, we are constructive on all of these markets, including mortgage-backed securities, where we sit at a neutral position relative to the relevant benchmark. So that puts us in a position where, as we close out the year and we enter into next year, that we can take advantage of the opportunities that the market might present.
That'd be awesome. It'd be nice to be able to talk about credit as something exciting again. It's been such a boring couple of years. How do you see the interplay between public credit and private credit? Is it helpful, harmful, competitive? How do you see that playing out next year?
I really think it's all of those things, and that's a wonderful way to frame that question. So with the private markets taking on the headlines, they've been in the headlines, and we've heard it described as perhaps there's some cockroaches or a little bit more work to do in the market, but it has made it highly competitive. For those in the non-investment grade market, or colloquially referred to often as high yield, that has led to fewer deals in the public high yield market. So when you see less issuance and greater demand, that causes tighter spreads. So now, with folks really questioning private credit, what is going on? And the true difference between that private market is in the name. You don't know what is going on deal to deal because you don't have that public market to price. You simply don't have the mechanism so that you're marking to market every day. So there's recently been shock and awe in the headlines because names and issuers in that space are talked about only in the past tense after they've been marked to zero. Well, they tend to end up in that realm. It's either priced at full or 100 or not going to pay you back at zero. So we think that there's going to be greater discernment there, and that folks will look to the public markets as a way to invest in a more liquid part of that credit portion of the market.
That makes a lot of sense. And the one thing, we're hearing so much about the AI, the data center, the credit needs there. Where else do you see credit needs? Is there going to be a lot of issuance for electricity generation or other sectors, or is it still going to be very concentrated?
Precisely. It's going to seem initially that it is those AI hyperscalers that are issuing. But when you build out a campus, and these are exceptionally large data centers, you do need the utility support, you need all of the industrial mechanisms that come into play. So we think that we will see issuance across the realm most definitely. And that takes us to the notion of affordability, which is one that the administration and the politicians have really started to emphasize as we enter this back half of the year, which leads us into an all-important midterm election cycle. So we think that affordability for the consumer as we look at electricity will be a paramount feature as we go forward. M&A is also picking up, which is a critical part for private equity and all equity markets, but we will see that lead to more issuance in the new year. That issuance tends to be a little bit different. As we digest that in the corporate bond market, it tends to be larger in size, but often gives us a full yield curve effect, where they'll issue all the way from 2s, 5s, 10s, and out the curve in order to structure the deal appropriately.
Karen, can I bring us back to the Fed meeting of earlier this week and get your thoughts on the Fed's balance sheet? We see that roll-off continue. You mentioned mortgage-backed securities just a few moments ago. We had this announcement from the Fed chair about this QE, I think we put in quotation fingers earlier in the week, and I think Jeff Rosenberg referred to it as QE confusion. How are you thinking about the role that the Fed is playing in the debt markets right now as we see it embarking on this kind of new tack, as all the while it's still trying to get rid of a lot of what it bought here in the last few years?
Yes, I think the broad theme there is that once you start to use your balance sheet to support or enhance the market, it's very, very difficult to get it precisely correct as you attempt to wind it down, and you likely are going to be in that game for an extended amount of time. So they had told us that they were stopping the balance sheet runoff, and it was a little bit earlier than anticipated, but we have seen signs of minor strain in the funding markets. So it's welcome that they are coming in to support particularly the most liquid instruments that support the very important money market industry. And they seem to be doing so in the right way and at the right size right now. So very, very important part of the Fed's work, and something that we were really looking to glean more information from the Fed's statement and from the press conference after.
Karen Manna of Federated Hermes, thank you so much for your time. Have a wonderful weekend. Peter, do you also see next year as a year of spread widening and potential opportunity or potential risk?
Yeah, I think it's going to be a really good opportunity for the credit markets. The little bit of spread widening we've had so far might continue, and you're starting to see value, right? Now you can look at an Oracle and sell CDS and actually get paid if you think this is going to return. I think that's good. It's healthy. I think it's going to be a big year of issuance, and I do think we're going to see this development of what we've been calling production for security and ProSec. I had to mention at least one.
Of course, you did great.
JP Morgan's investing heavily in this. They're hiring to grow that. I think that's going to continue. I think that's going to lead to a lot. And this electricity bottleneck is going to become a big story. And the need to make our own commodities, process and refine them, I think that's going to be a huge amount of growth. And it's going to be a really interesting year for the debt markets.
Just 10 seconds, yes or no, are you selling protection in Oracle bonds?
I would be, yes.
All right, that's fascinating, the whole idea of a fear bubble in Oracle CDS. Peter Scheer of Academy Securities, thank you so much for being with us this morning. Coming up next, Priya Misra of JP Morgan Asset Management, Jeanette Lowe of Strategas, Liz Ann Saunders of Charles Schwab, and Yelena Shalyetova of the Conference Board. You're watching Bloomberg Surveillance on this Friday morning. Good morning.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, news, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
The Fed is not going to solve the labor market.
This concern that the Fed has about the weakness in the labor market, I think it's a bit overdone.
The Fed is well aware of the fact that inflation remains a very sizable problem.
There's certainly a risk here that you could see inflation that's a bit more sticky.
Economic surprises keeps us in this scenario.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance with stocks poised for their third straight week of gains, climbing to all-time highs yesterday at the close as hopes for a Santa rally take hold. Investors looking beyond just big tech as they see Fed rate cuts helping to fuel broader economic strength. Now, the proof is in the pudding. A question from the economic data that we get over the next week. Of course, we get jobs data on Tuesday. We get retail sales, and then on Wednesday, we get CPI data. It is delayed. But David Gura, it is important given some of the expectations baked into market values.
Yeah, I think there's still a lot of concern about potential cracks in the labor market. We heard those remarks from the Fed chair earlier this week about the potential for there being undercounting in the jobs numbers, overcounting rather in the jobs numbers. And I think just these numbers are ones that policymakers, economists, all of us have been waiting for in this strange moment of ambiguity because of the government shutdown.
And the idea that any kind of Fed rate cutting cycle could support this broadening out is predicated on the idea that a rate cutting cycle comes with greater productivity and ongoing strength in the economy. This is a contradiction should there be either not enough strength in the economy based on some of these numbers or potentially some sort of inflationary push that we might see in the CPI.
We did have a Fed chair who seemed increasingly confident in productivity, though. He talked a lot about that during that press conference. And so we have that, the Fed story, and then, of course, the AI story percolating as well with Oracle and Broadcom. Again, the growing investor dissatisfaction with the fact that these companies can't really give a definite timetable on when we're going to see the investment kind of what's buffeting AI manifesting itself in something tangible when it comes to actual AI.
My takeaway from this week is that people feel really good that tech is selling off because it means that potentially this is not a bubble or quite as bubblicious as it might be, and that people are using some discretion. That seems to be my takeaway from this past week.
Glad that you used the term bubblicious, but yeah, I think you're right. We're seeing the market functioning perhaps as it should or close to it.
Right now we're seeing markets just dipping after yesterday's all-time highs, led by that tech sector with that froth coming out of the system. Perhaps down 0.2% on S&P futures, climbing lower throughout the morning. A bit of dollar strength resurgence, although really it has been a story of dollar weakness throughout the week. 117 on the euro-dollar cross. 10-year yields inflecting higher more than a basis point now to 4.17%. Crude just a little bit lower, but a real question here about whether that yield curve steepening is going to be a good thing or a problem for this market. Coming up this hour, Priya Misra of JP Morgan looking ahead to 2026, Jeanette Lowe of Strategas on escalating tensions in Venezuela, and Yelena Shulyetyeva of the Conference Board on the health of the U.S. consumer. We begin this hour with stocks just really taking out some of the heat after the S&P notched a new closing high. Priya Misra of JP Morgan writing, risk assets are priced for perfection. 2026 will be a show me for the corporate sector in terms of AI-led productivity. Priya joins us now. I love having you on the show. Thank you so much for being here. So, Priya, is this kind of a moment that you're happy to see the sell-off, the skepticism in markets surrounding big tech?
So I heard you and I said, okay, that's interesting. I don't know if I would celebrate the tech sell-off, but I think it is a time when, you know, what was this year or maybe a year and a half was about AI capex. And we've seen the investments, we've seen the valuations in these companies. It needs to broaden out. We have to find these use cases. Is that the next 6 months, 12 months, 18 months? That's a harder question. But I think over the next year or two, we're going to see the rest of the corporate sector say, here's how we're using AI. I mean, we're all investing in AI. JP Morgan's investing a lot in AI. How are we seeing that productivity? What does that mean for the labor market? I think these are all big questions. I think when we talk about the K-shaped corporate sector, the largest companies are the ones investing the most. I think we are going to now look at, okay, how is it helping your margins? Is that how you keep margins high, despite the fact that we have tariffs, for example? So I think we'll be looking a lot more at the broadening out of AI usage. I still think the growth has been fairly lopsided this year. It's been AI-led. So it's not just important for the equity market. I think it's also important for the economy if you see that productivity broaden out to just, this is all about AI CapEx.
You could say, we were all invested in AI, including Fed Chair Jay Powell. We'll get to that, the idea of the increase in productivity that he really indicated yesterday, or I should say on Wednesday. From a corporate credit perspective, though, are you seeing the same type of skepticism that you're seeing in equities markets when it comes to investors willing to lend to some of the AI giants for this build-out?
So I think, you look at fundamentals. I think the fundamentals are still very solid. The companies, the AI-related debt issuance has happened mostly from companies that have the cash flow. That actually, if you look at leverage in those companies, it's not high. They'll very likely pay you back. But then you look at valuations and you look at how much more supply is coming next year, and you take a step back and say, okay, maybe I don't need to buy it at these tight levels. So we're not seeing the credit market en masse saying that, well, you call the debt people to the party and we're going to end the party. It's just to say, well, am I getting paid enough for that, for taking that credit risk? So I think there's some hesitation in that AI-related debt, but it's just a question of valuation. You widen out spreads in the new issue concession market, we'll be in buying. So I don't think there's some big fear. There's just a question of, you got to pay me a little bit more in terms of compensation.
How are you feeling about this moment? So we're talking about Broadcom, talking about Oracle, seeing those results, Fed chairman talking about AI more than he has in meetings past. Where are we in this story? What has this week told us about the AI story as a whole?
I think it's, they talk about the person of the year or something, the word of the year or the acronym of the year is AI. I mean, and I think we're in that transition period where the companies have invested, some much more than others, and now we're waiting to see that use case. I think for the economy as well, there are structural positives of the economy, and I think that should not be, that's not all AI. AI is a big part of that structural positive. The other big positive is company balance sheets. The average company balance sheet looks strong. The average household balance sheet looks very strong. There's that K-shape in both corporate sector and household sector. But I think the fact that the Fed chair is talking about it, and not just productivity, what does it mean for the labor market? I think this is where, should the Fed have cut this week? Absolutely. You look at the labor data, we've never seen this rise in the unemployment rate this much without a recession, without resulting in a recession. They have to be concerned about that. And so you can be really positive on AI and still be concerned about the labor market. Why aren't new college graduates getting as many jobs as they were before? So I think we're in a period of transition, and we have to figure out all of the impacts and sort of, it's a system that has to make sense overall. I think we're in that figuring out process. I think the easy part, though, not that this year felt easy at all, but the easy part may be done. The Fed's done their normalization, their risk management approach. And now it's a bit of a show me for the labor market as well. Do companies that feel good and see the productivity, do they hire? I think that's the big question.
Is it a catalytic moment to look more broadly or invest more broadly? So again, the narrative has been, so much has been confined to these 7 stocks, so much has been confined to these hyperscalers, this particular sector. Is this the moment in which people begin to look more seriously at some of the other sectors and companies that you've been alluding to here, and Lisa pointing out in the last hour, what we've seen in small caps, what we've seen in the Russell 2000 over the last week? An indication to you that that's finally happening, that this catalytic event has happened and people are investing more broadly?
I think the investment is there. I mean, we're seeing it across the board, not just in the AI, and particularly the large cap companies are investing. Whether they're seeing the returns, I think that's where we do want to see that for us to have a lot of faith in the broadening out. But I will highlight, given valuations, it makes sense for people to say, look, AI might be absolutely transformational for the way business is done a few years from now. It can absolutely increase productivity, but who are the winners? I think given valuations, you might want to diversify who you think might end up winning. And the GPU-TPU fight is ongoing. I don't think anybody knows who the winners are going to be. So I think being diversified, I'm a fixed income person, so I'm going to talk about fixed income playing a role in portfolios. With equity valuations where they are, look at what bonds have done. They don't sound very exciting, but the ag is up 7% this year. Anytime there'll be this wobble, oh, we didn't see enough of that AI earnings, and there's an equity market correction, you'll see bonds work. It's happened this year. I think it's going to continue to happen. So I would say, thinking about the portfolio, your portfolio as a whole, and looking at earnings, looking at all the fundamentals, but making sure you're diversified, you have income somewhere. I think that's the role that bonds play as well. So I'm going to put a plug there for bonds.
Well, I mean, this is a plug that a lot of people are making, especially if they think that maybe people are overstating the economic growth. And if the Fed is cutting for the wrong reason, not necessarily the right reason, is that kind of where you sit, that you think that the Fed is going to have to cut a lot more, and you kind of reject the yield curve steepening in a way and think people are overestimating how much growth can really continue?
So, you can have growth, but you need not have the job growth. Remember the jobless recovery in the early 2000s? I sort of wonder about that. If you're going to get this big productivity boom, if every other company is deciding to invest in AI, do they cut back on hiring? Because of all the razor focus, sharp, everyone's looking at margins. If I don't want my margins to compress, maybe I'm going to keep hiring low. I am concerned about the labor market. I mean, we're looking at bottom-up, top-down analysis, and the one thing that doesn't make sense is why is the labor market this weak? And it could be the productivity boom that everyone's expecting, and so I don't need to hire. And so, to your question about the Fed, I think they still have a couple of cuts. Exactly, I know Chair Powell said we're in the realm of neutral. There are only 4 Fed officials who think that neutral is above 3.5, which is where we are now. So I do think they're going to cut. We see 2 states of the world. One where they cut gradually, maybe 1 this year, 1 next year, 2 this, next year, to try and get to that neutral if inflation starts getting closer to that 2%. And then there's the scenario where now the labor market continues to weaken, and you can still have okay growth and an unemployment rate at 5%. That's concerning. That's that non-linear weakening in the labor market typically precedes a recession. Then I think you see this Fed, irrespective of the Fed chair, I think they're all unified on this point. If the labor market is clearly weak, the Fed's cutting a lot more than what's priced in or what's in the dot plot.
Which is a reason why on Tuesday it's going to be really interesting. The unemployment rate, does it rise to 4.5%, 4.6%? Because then January, very much in play. Priya Misra of JP Morgan is going to be with us for the rest of the hour, I'm so pleased to say. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Bonnie Quinn. Bonnie.
Lisa, thank you. Shares of Broadcom trading lower in the pre-market after the chipmaker's sales outlook for the AI market failed to meet investors' lofty expectations. The company's CEO says it has a backlog of $73 billion in AI product orders that will be shipped over the next 6 quarters, which he described as a minimum. Sources telling us here at Bloomberg that SoftBank is studying potential acquisitions, including data center operator Switch. SoftBank has held discussions with Switch, and its leadership have sought a valuation of around $50 billion, including debt, some people said. An acquisition of Switch would help SoftBank's Masayoshi Son control a key bottleneck to AI development. Rivian is unveiling its own AI chip designed to replace NVIDIA's. The automaker announcing it will equip its upcoming R2 sport utility vehicles with Rivian chips and a new LiDAR sensor. The company's CEO telling Bloomberg the move is part of a broader push to enhance automated driving features. And that is your Bloomberg Brief. Lisa.
Thank you so much, Bonnie. Up next, pressure building on Venezuela.
They've treated us badly, and I guess now we're not treating them so good. If you look at the drug traffic by sea is down 92%. And we'll start that on land, too. It's going to be starting on land pretty soon.
Jeanette Lowe of Strategas joins us as we question, is this about drugs? Is this about geopolitics? Is this about oil? A lot of questions swirling around this move. Right now, stocks lower ahead of the open. This is Bloomberg Surveillance.
politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
We're coming to you live from Kuala Lumpur. The whole world is here.
APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
On a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It has been so much of the rotation trade, and it just builds on that this morning. Yes, you're seeing the S&P lower. Yes, you're seeing futures on the NASDAQ down by 0.6%. On the Russell 2000, continuing to see gains up to 0.1% in futures ahead of the open. As you do see that shift in that expectation for Fed rate cuts, 2s, 10s, and 30s, you can see that bid into the front end of the yield curve. Really will key off of what we see on Tuesday from the November jobs report. Do we see the weakness potentially giving some credence to a January rate cut, 3.54%, essentially flat, a sell-off at the longer end? And a question around, does this indicate strength or does this indicate global selling off? Does this indicate an opportunity? Either way, 30-year yields back at 4.83%, and 10-year yields climbing back toward that 420 mark, 417. Under surveillance this morning, pressure building on Venezuela.
They've treated us badly, and I guess now we're not treating them so good. If you look at the drug traffic by sea is down 92%. And nobody can figure out who the 8% is, because I have no idea. Anybody getting involved in that right now is not doing well. And we'll start that on land, too. It's going to be starting on land pretty soon.
Here's the latest. The U.S. upping pressure on Venezuela, as well as Nicolas Maduro. President Trump threatening land strikes on the country following the seizure of an oil supertanker off its coast. Bloomberg's Tyler Kendall joins us now. Tyler, can you give us the latest and just give us a sense of how much the tension has ratcheted up over the past couple of weeks?
Yeah, hey Lisa, good morning. Well, it's fractured up in a really significant way. And in fact, we have new reporting out today from Bloomberg News that people familiar saying that this week marks an entire new phase of the United States strategy against Venezuela as the Treasury Department moves to sanction an additional 6 oil companies and close associates of Nicolas Maduro. People familiar are saying that this is all designed to deny Maduro oil revenue in a bid to get him to relinquish power. Now, of course, we have to keep in mind the context here. About 80% of Venezuela's export revenues come from oil. New data is showing us that the country has exported about 750,000 barrels on average per day when it comes to oil. So this is a really significant way that the U.S. is now shifting its strategy to keep pressure on Maduro. Now, of course, we saw earlier this week the seizure of this massive oil tanker. That was the first time that the U.S. had seized a foreign oil tanker since 2014. But as you mentioned, this could continue to escalate. Our analysts at Bloomberg Economics say that on the high end of the escalation scale would, of course, be some sort of land strike. The understanding is if the U.S. were to do that, it would very likely target cartel infrastructure in the country, because this administration has repeatedly justified its actions by saying that this is all about going after those alleged drug traffickers and getting illicit narcotics into the U.S., trying to stem that flow. Lisa, there's a lot of different threads that we could pull on here, but I will point out one important one that we should keep our eyes on, which is that in recent days we have seen Nicolas Maduro reach out to other world leaders. Just yesterday, he held a phone call with Russian President Vladimir Putin.
Tyler, I had a quick question around the ACA subsidies. So both bills failed yesterday, and they're running out of time. I mean, December 15th is that deadline. Do you think anything can happen last minute this weekend? And if not, is it like a January, by the end of Jan, you do think that they'll come to some sort of compromise?
Well, we did hear from Senate Majority Leader John Thune yesterday after those votes had failed, saying that Republicans are willing to negotiate on something. But at this point, we only have 1 week left in the legislative session, which really means that we are careening towards the end of the year and likely will see those Affordable Care Act premium tax subsidies expire, and millions of Americans will ultimately see their payments go up. But it is important to look at the actual plan that did fail from Republicans, because that very likely could give us some clues as to where this is headed. It appears that they're going to coalesce around some sort of plan to create these health savings accounts, with the idea that Americans would be encouraged to switch plans that have lower premiums but higher deductibles, the idea being that they'll have more money in their HSAs to pay for higher out-of-pocket costs. This is much more in line with what the White House would like to see when it comes to this debate. To your question on what the next deadline is, of course, we know that the government shutdown, there is a potential for another government shutdown at the end of January 30th. So that is the next date that we have our eyes on for some sort of compromise potentially to be attached.
Tyler Kendall of Bloomberg, thank you so much. Sometimes it feels like playing whack-a-mole in Washington, D.C., which raises questions about what motivations, how are they connected. Jeanette Lowe of Strategas joining us now for more. And I want to see if there is some sort of way of connecting the domestic and the international. This question of what the motivation is. How much are some of the incursions over in Venezuela due to domestic concerns about drug use, about trying to create alliances to lower prices, and how much has to do with the geopolitics of Russia and China?
Absolutely. So thank you for having me on. I think there are a lot of pieces here. The Trump administration obviously is focused on several things, and one of those is obviously focusing on America, focusing on the people of America, and the drug issue has been one of those main concerns. So I think that what we're kind of looking at in terms of all the pieces coming together right now is you have kind of the tariff risk and things of that nature that was a big part of 2025 ending. It seems like Trump is now kind of trying to clear out the brush a little bit with regards to Ukraine, with regards to Venezuela, so that way as we move into 2026, this is much more about fiscal stimulus, monetary policy, easing, you have deregulation coming, and then at the same time you have potential more investment opportunities if there's an end to the Ukraine war. I do think that it's interesting that we've always had this kind of Venezuela-Ukraine piece coming at the same time. We had this when Trump was really pushing for the Ukraine deal ahead of Thanksgiving. You had seen a lot of increased pressure on Venezuela at that time. You're seeing a very similar dynamic this time. And definitely one of the things is this could be a little bit of an interplay between Russia and Venezuela with regards to Ukraine. Also, definitely there is a big piece for Trump about clearing out some of the negative influences within the Western Hemisphere. You kind of saw that as a big focus of the national security strategy that was released last week, where he really wants to focus on the Western Hemisphere and kind of making it more secure and more secure for U.S. interests. So going after drugs, going after malign influences that are within the hemisphere, and then kind of trying to shore up economic opportunities as well. I think that's a big part of this focus.
Jeanette, count me among the confused, and I'm going to posit that a lot of Americans might be as they watch all this unfold in Venezuela. Maybe look at that national security strategy you mentioned just a moment ago. Look, a lot of these drugs weren't the kind of drugs the president's been talking about. They might not even been destined for the United States. We've talked in recent weeks about the president's lack of messaging on affordability. He's dismissed that. There's kind of an impetus here for him to do more to kind of make the case for his economic policies. We've been talking over the course of the week about the fiscal benefits that can come into effect here in the new year. When it comes to foreign policy, how much is lacking in terms of this administration explaining to the American people why it's doing what it's doing? That could be in Ukraine and Europe more broadly, it could be in Venezuela. Help me understand that in the crucible of this national security strategy. Is there a coherent sense of what that strategy is right now? It does seem kind of scattershot.
It's something that many administrations actually have some difficulty kind of tying the pieces of foreign policy to domestic politics and giving very clear messages to the American people about what they are trying to do. And that is why you sometimes see a lot of frustration among individuals thinking about what is the administration doing and are they more focused on U.S. interests or global interests. But obviously Trump has been focused on the border. He's been focused on the drug trade. That's obviously why you saw the fentanyl tariffs. And so I think that now he's also focused focused on, we're watching him kind of trying to get rid of Chinese and Russian influence within the Western Hemisphere. Now, that's not obviously going to be easy to explain to the American people, but if you can get rid of some of the cartel activities that actually can boost economic security within those countries, that means there's actually less of a migration problem, that there's less of a drug problem. That's also obviously beneficial, and that's something that he's been very focused on within his term here. So I think there's just a lot of pieces that do make it difficult. He's also trying to end, obviously, these wars to try to focus on rebuilding. Obviously, Ukraine, there's been a geopolitical risk premium in oil prices. That's obviously been another concern of his, but it's also now about creating new investment opportunities for U.S. businesses in Russia and in Ukraine. So I think that is also some of it. But there's obviously going to be this disconnect that it's always a little bit more difficult for the administration to explain to voters what is actually going on with some of their foreign policy moves.
Jeanette, really quickly, on affordability, do you expect tariff dividends or expect some sort of stimulus checks from the tariff revenues as we head into the midterms?
So what we're really focused on going into early 2026 is you had from the One Big Beautiful Bill, you had a significant amount of fiscal policy coming out, which is going to come out in the form of tax refunds. So this is kind of the SALT deduction that got increased. It's a higher child tax credit. It's the no tax on tips, no tax on overtime. So there's actually $150 billion of fiscal stimulus that's going to come out in tax refund season. So February through April. We think the administration is quite focused on the fact that that is quite sizable. You also have a lot of business tax credits that are going to come out in next year. Obviously, some of companies have already taken advantage of that in the current, in the last fiscal year, but that will probably accelerate into the next fiscal year. So there's already a lot of stimulus coming. So at the moment, we don't really see the need for there to be these tariff refunds. Obviously, that can change. The affordability issue is kind of an issue there, but I think that that's something that we don't see on the horizon yet, but you have all these other tax refunds coming instead.
Jeanette Lowe of Strategas, thank you. So maybe rebates in another name. Coming up, Liz Ann Saunders of Charles Schwab on macro instability. Plus, Yahaira Anand with your morning movers. Stocks of cannabis producers moving higher as President Donald Trump pushes for reclassification. I feel like this is a very drug-heavy morning. From New York, this is Bloomberg Surveillance.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
The focus right now very much is on the rotation trade, and you could see that this morning in futures trading. You could see the S&P lower, you could see the NASDAQ underperforming, that big tech pushback continuing, although less than earlier this morning, down 0.5%. And then the Russell 2000 futures up 0.2% on this expectation of a broadening out. The Y can be found in 2s, 10s, and 30s. There has been this bid into the front end of the yield curve. Yes, the Fed cut rates for the third consecutive time, 175 basis points since last September, but there also is a focus going forward that they are opening the door to further rate cuts should the jobs number on Tuesday come in poorly enough. You can see, though, on the long end, a bit of a sell-off, a steepening throughout the curve, 4.83% on the 30-year after the auction that we saw yesterday. And if you want to be worried about the debasement of the dollar, if you want to be worried about the build-out of the infrastructure, if you want to be worried about the commodity space, take a look at silver. The hoarding continues. What you could see is a parabolic move throughout the year. The increase is more than double, 122% gains on the precious metal to a new all-time high. 2 hours away from the cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. A leadership shakeup over at Lululemon, sending shares surging more than nearly 9% in the pre-market. The company saying that CEO Calvin McDonald will step down at the end of January after more than a year of underperformance. And we're getting fresh comments from founder Chip Wilson, who is also one of the company's largest shareholders. He slammed the board for letting value slip under McDonald and saying that only under his pressure did the board act. So now he is calling for fresh, independent directors to lead the search for the next CEO. Meanwhile, we are seeing cannabis stocks surging in the pre-market. Take a look at Tilray. Those shares are up 28% on our reporting that President Trump is preparing to reclassify marijuana as a less dangerous drug, potentially changing it from the highest risk tier to a lower one. It's a shift that could make it easier to buy and sell cannabis. It could ease the tax burden for these companies and unlock banking services, which is one of the sector's biggest roadblocks. And we end over in Switzerland with UBS shares. We're seeing those up 1.7% after influential Swiss lawmakers proposed watering down stricter capital rules in a move that could spare UBS from $26 billion in capital demands that the government has been pushing. Lisa?
Thank you so much, Yahaira. On our radar this morning, senior European officials gearing up to meet in Paris on Saturday to discuss ending the Russia-Ukraine war. The Trump administration saying it's, quote, still up in the air on whether the U.S. would attend. Meanwhile, Broadcom shares sliding in the pre-market after its sales outlook failed to meet expectations. Those shares lower by 5.9%. This despite beating earnings estimates in its fourth quarter. Investor concerns rising on how and when the company will get an AI payoff. And I do wonder, David, I mean, is this just because the shares have risen so much? Is this because expectations are so high? Is this because ultimately people are looking for an excuse to sell?
I think it might be the latter, but I go back to what we were talking about with Peter Cheer last hour, which is kind of the recalibration of expectations for these companies. So I think they have been set very high. And I should say many of these companies have met those expectations quarter after quarter after quarter. So I think it's a moment when there is just kind of a reconsideration taking place of sort of what is happening here, where it's going, and what's going to kind of be the result of it in the end.
Yeah, and how much is really predicated on the idea of credit markets remaining open? And this sort of is a real question when it comes to Fed rate cuts. How much is that going to continue to fuel some of this push into funding the AI hopes and dreams? And how much is this really going to be the cautionary tale as there is more discretion that plays out in the credit markets in 2026?
So I think the Fed's done the easy part. They've removed a large part of restriction. I'm actually watching the RMP, which is not QE, the reserve management purchases. I think that is not QE at all. They're not buying the long end. But what the Fed is doing is they're keeping the plumbing going. You know, they're letting SOFR. There was stress in that funding market. They, I think, came in earlier than most people expected to say, look, year end, tax date. These are dates when that plumbing can have an issue, and that has a very quick impact on the credit market. I think the Fed's saying, look, we're removing tail risks here. So that is positive for credit. But again, we're going to see how much supply comes in. Do earnings hold up? Does leverage pick up? So far, we're not that concerned about leverage picking up that much, but that could change next year.
I love how Jay Powell says, look, this is plumbing, this is boring, don't pay attention. And everyone says, it's QE, let's party. Meanwhile, the White House urging consumers to buy American-made.
We want products made right here in America. Maybe you'll pay $1 or $2 more, but you will get better quality and you'll be supporting your fellow Americans by buying American.
The comments coming after President Trump once again questioned the number of dolls shoppers should buy. A new AP poll says roughly half of Americans believe it's harder than usual to afford holiday gifts this year, which ultimately, David's going to be the question about retail sales that we get next week. How much is really inflated by prices, not necessarily ticket sales?
Yeah, and part of this broader question just about the health of the consumer, and we've had conversations about sort of what's been manifest in the retail sales figures we've gotten, the earnings results that we've gotten from retailers. We see the continued resilience of a lot of consumers, but we still see this functional K-shaped economy where there are those who are unable to play or purchase, buy homes, buy gifts to the extent they might have in years past. This dolls thing, I think, is something that's continuing to dog this administration as they struggle to kind of talk about affordability, which is such a real concern for some large swath of the population.
And it's the reason why a lot of people are looking at the midterm elections and potential stimulus that could come ahead of that, as Priya was talking about in just the last 30 minutes. Turning to markets, global stocks pushing into record territory after the Federal Reserve's latest interest rate cut. Lizanne Saunders of Charles Schwab remaining cautious into 2026, saying we believe the macro environment will continue to be unstable, but stocks can likely churn higher given a firmer earnings backdrop. Lizanne joins us now. And Lizanne, this is what a lot of people are saying. Just watch the earnings. Show me the money. And the companies can do that, and then you'll start to see gains. Just how do you think it's going to play out in terms of a tale of two halves, a tale of rotations, et cetera?
Well, you know, we've been talking a lot and writing a lot about the K-shaped nature of this cycle. It's become a bit ubiquitous. But I think one place where you're actually already starting to see convergence is in the earnings growth rates of the tech, AI, mega cap tech, you know, different cohorts, their earnings progress. So if you look at any of those cohorts, a year and a half ago, you were running at year-over-year earnings growth rates of about 50%, but those have been decelerating maybe into the 20% range, where the other part of the market is actually seeing accelerating rate of earnings growth. So I'm a big believer in the old adage about, you know, better or worse can often matter more than good or bad. And I think it's the trajectory of earnings that is one of the reasons why we've seen some dislocations within these prior leadership areas, only 2 of the Mag 7 outperforming the S&P, and opportunities that are being found outside of those prior leadership names.
Lizanne, we've been paying a lot of attention to sentiment data, in part because we just haven't had the hard data as a result of this government shutdown. But you and Kevin Gordon have coined a new word here. It's the vibe-pression. You're worrying about a vibe-pression. And I wonder if you kind of spell out how much of it, what it is, first of all, and then how much of a worry it is for you as we move ahead here to 2026.
I think, you know, it used to be talked about just in the context of soft economic data versus hard economic data. So soft data would be the survey-based data, and that's where you're still showing incredibly dour outlooks. You look at Michigan's consumer sentiment kind of plumbing at cycle lows here. At the same time, as part of the conference board's index, their consumer confidence index, and they have different cohorts that represent the survey respondents. Conference Board tends to skew a little bit wealthier, but Conference Board has a question about expectations for stock prices. That's absolutely through the roof. UMich has a question about expectations for the unemployment rate. That's through the roof. That is one of the ultimate difference to this vibe-pression, or the way we used to think of it as much weaker soft data relative to hard data. You probably see a little bit of convergence in 2026, and by convergence, probably moves in both directions.
I'm curious, when you think about dispersion, where you see things kind of moving here in 2026. So if we're not going to be wagging our chins about the Magnificent Seven and the hyperscalers in 2026 to the degree which we have in 2025, where do you see that conversation moving in the year ahead?
So I think as it relates to AI, the story is certainly not in the rearview mirror, but I think there's maybe an increasing focus even beyond data centers, which was the more recent surge area relative to the hyperscalers and the original picks and shovels companies. I think the shift is more toward the adopters, the effective adopters, not just in a very general sense, but actually starting to get meat put on the bones in terms of impact on productivity, what it means for labor costs, can it help improve profit margins. So I think that may be one of the newer themes that develops within AI, is that adopter theme. But you're also seeing broader participation in other segments of the market, healthcare having some of the best breadth right now. Now, we would also caution against simplistic, monolithic, sector-based investing, because there's a lot of dispersion within sectors, and that's where we think you want to apply that factor-based analysis, at least as an add-on to sector-based analysis. And the factors that we're focused on right now, to use an old school acronym, are very GARP-like. So you don't want to sacrifice growth just for value. You want to look for value, but you want to have those growth characteristics as well.
Lizanne, is bad news good news for stocks? I mean, ahead of next week, meaning if you get weak economic data, well, then the Fed's going to cut a lot more, maybe do real QE, and so equities can look through it? Or you think either the rotation trade or actually equity valuations are at risk if the unemployment rate keeps rising?
Maybe marginally bad is okay from a Fed reaction function perspective, but really bad news, especially in the labor market, regardless of what that means for the trajectory of monetary policy, I think is bad news, particularly given that the support for this economy, consumer spending resilience, that has largely been a function of not just health in the labor market, but confidence about the labor market. You start to see weaker than expected numbers to a significant degree. That feeds not just back into the consumption channels, but very quickly back into the confidence channels.
So, Lizanne, are you buying the idea of a jobless recovery? Can we see that in 2026 fueling the rotation, or is that kind of implausible given what you just said?
Well, if you look at the ADP data, all of the job growth has been concentrated recently in larger companies, companies with 500 employees or more. Anything below that is really where you're seeing the compression. You see that divide in terms of corporate profits, too. Very strong S&P profits, 13, 14%, yet NIPA-based version of profits, national income and product accounts, which is millions of companies, public companies, private companies. First half of the year, we don't have the third quarter data yet, was actually in slight negative territory, and that's being reflected in the labor market as well. So that's where I do think the bifurcations persist. I think the net is it looks just sluggish, but I think you have to fine-tooth comb it in terms of size of company in particular.
Everything is K-shaped in 2025 and possibly 2026. Lizanne Saunders of Charles Schwab, thank you so much, as always, for being with us. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Bonnie Quinn. Bonnie.
Lisa, thank you. The U.S. Senate rejecting Democratic plans to extend the Obamacare subsidies by another 3 years. The chamber also rejecting a Republican plan to partially replace the enhanced subsidies. The failed votes raising the likelihood that premiums will double on average for nearly 22 million Americans at the end of this year. President Trump is expected to push for dramatically loosening federal restrictions on marijuana. The Washington Post is reporting an executive order would direct agencies to reclassify marijuana as a Schedule III drug, similar to some prescription painkillers. The move wouldn't legalize nor decriminalize marijuana, but it would ease barriers to research and boost the bottom lines of legal businesses. Uber says it expects to offer robo-taxi services in more than 10 markets by the end of next year. CEO Dara Khosrowshahi told us that possible new markets include Hong Kong and Japan, as it holds discussions with regulators. Earlier this year, Uber and Baidu announced plans to launch robo-taxis on the ride-sharing platform in several markets outside the US and mainland China. And that is your Bloomberg Brief, Lisa.
Thank you so much, Bonnie. I was thinking a lot about robotaxis this morning. Have either of you ever taken a robotaxi?
No, I'm waiting for them.
Well, I'm waiting for them too. I'm excited for them, but who's going to clean them? I'm just thinking it could be a good job opportunity for somebody. I mean, you have to imagine.
Be a humanoid robot cleaner.
But, I mean, I'm just thinking, you know, that's sort of the job opportunity that comes from AI. You think so? I don't know.
I'm waiting for self-cleaning homes too.
Oh, I think so. Self-folding clothes. Oh, yeah. I think I would love it. Up next, an uneven consumer.
Consumer has been extraordinarily engaged. It's going to vary depending on the income cohort. It's a big part of the narrative that it's not even. It never is even, frankly.
Yelena Shulyetyeva of the Conference Board joining us next as we take stock of the consumer, especially in light of some recent sentiment surveys expressing some concern. This is Bloomberg Surveillance.
What's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and the downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to like unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest. And this is Bloomberg.
Inquiring minds wanted to know about the cleanliness of robotaxis, and we got some, evidently. David Gurrow has been doing extensive research, and right now we're seeing that there is a good cleaning system, even for special incidents.
Yeah, well, you've got human oversight. They're looking at the cars, automated systems in the cars as well. And I note here, NBC News reporting a woman gave birth in a Waymo in San Francisco on the way to the hospital 2 days ago. Had the baby mother and kid are doing fine.
But
it's a whole new world, Lisa.
But she might have.
You've taken me down a path I didn't expect to go down on this Friday morning.
She might have had to pay an extra fee for cleaning. Right now, we're looking at a market that is churning. You're seeing that bifurcation continue, where you see the large caps do more poorly than the small caps. S&P futures lower by 0.2%. A bit of a sell-off in the bond space, particularly on the long end. The 10-year yields climbing back toward that 4.2%, 4.18% rounded up. And you do see silver climbing to an all-time high, with crude fluctuating. Under surveillance this morning, an uneven consumer.
Consumer has been extraordinarily engaged. You are still seeing the embrace of discretionary spending in addition to the necessities. So it's consumers that, you know, again, it's going to vary depending on the income cohort. It's a big part of the narrative that it's not even. It never is even, frankly. But you have consumer spending that is still running at a healthy clip.
Here's the latest. Shoppers gearing up for what is expected to be a record-breaking holiday season, despite consumer confidence tumbling to its lowest levels going back to April. Joining us now is Yelena Shulyetyeva of the Conference Board. Yelena, could you give us some color around the retail sales data that we're going to be getting next week, as well as this holiday shopping season? Is it wonderful? Is this people looking for deals and being picky and just sort of back-ending some of their purchases to try to get the best bang for their buck?
I think so. I think the latest, earnings results are telling us that consumers are shifting towards value and essentials. And, clubs and value retailers doing great means that consumers are really concerned about what is going on in terms of prices, and they are really shifting towards those savings. So I think we are looking at a healthy holiday season, but not necessarily the best one. So I think, probably the results of the Thanksgiving holiday were a little bit overstating the health of the consumer.
Yelena, great to see you. And I'd love for you to put into context for us where we are in the capacity that companies have, their willingness to absorb costs because of these tariffs. I might posit that maybe this holiday Christmas season is kind of the last gasp for them to do this before maybe in the new year we begin to see some of that trickling down to consumers. Am I right in anticipating that might be the case? Sort of, what's the status of that, sort of their willingness to do that?
Yeah, thanks, David. Thanks for the question. I think you're right. I think holidays is probably going to be okay, but our modeling at the Conference Board shows that the bulk of the tariffs impact will be evident in the beginning of 2026. So Q1, Q2. And that is where we see the biggest softening in consumer demand, actually. So I think despite the fact that, the news cycle kind of moved away from tariffs a little bit in recent months, consumers are still feeling the burden. They're still feeling prices are elevated, and they are shifting their spending patterns. Actually, at the Conference Board, we survey consumers by different types of income. So it's the whole spectrum of income groups that we reach out to. And what I see in our consumer confidence data is a broad-based decline in income expectations. I see a broad-based decline in consumer confidence over the course of 2025. This is the time to kind of like look back at the year and assess what happened. And there was a 24-point decline in consumer confidence over the course of 2025. Consumers making more than $125,000 a year, the decline in their confidence was also sizable, something like minus 17 points.
I'm still having a hard time kind of squaring the sentiment data with the hard data, what we're seeing in terms of people, yes, out there spending money. I kind of imagine Santa Claus filling his sack with gritted teeth. He's doing it, but maybe he's not feeling good about the prices that he's paying. Is that reflective of what we're seeing here? And what do you make of that seeming disconnect between, again, the hard data and the sentiment data that you watch so closely?
I think it's the timing issue. And to a certain degree, we did see some softening in consumer spending, the actual data in September already, right? So look at the personal income and spending report for that month. Obviously, it's very stale, but that shows that, there was some softening in spending on non-durable goods, for example, right? And as things are getting more and more expensive. I think we do see that we'll get another piece of evidence next week when retail sales data comes out. I think it's not a collapse. It's somewhat softer growth in consumer spending. But obviously, a big risk is the labor market. So what happens to the labor market going into 2026 will matter the most for the pace of consumer spending.
Yelena, good to see you. So the labor differential, which you're highlighting, I think is key here, where people feel if you have a job, you're okay because layoffs are not picking up. But do you think housing affordability is another reason why consumer sentiment is that weak? Because I'm trying to see, do the 175 basis points of rate cuts, do they help housing affordability? Like, do you think these rate cuts can actually improve consumer sentiment, or we continue to see this disconnect and sort of wait for that timing to play out?
Hi, Priya. Yeah, I think that, you're referring to the level of interest rates. And even if interest rates continue to edge lower in terms of mortgage rates, that could improve affordability. But the big part of the affordability calculation is prices. And prices are still elevated. Well, maybe they're growing at a slower pace, but they're still growing. So you have that $1 million house, and it's now $1,005,000. So it's still very unaffordable to a lot of people out there. Maybe at the margin it could help, but I think we just need continued growth in real wages going forward. As Chair Powell mentioned earlier this week, to kind of outgrow from, the economy needs to grow into that kind of state where consumers will be able to afford a little bit more and, be happy again about how they are faring.
Can't they all just be happy again? Yelena Shalyacheva of the Conference Board. You're sighing, but you're out here with Santa filling his sack with gritted teeth. Incredible poetry over here on this morning. Priya, I am curious from your perspective how much you're seeing a consumer that could surprise to the upside. I mean, do you see this idea of stimulus potentially supporting and putting something else in Santa's sack?
I struggle with stimulus. I mean, we are going to get some from the One Big Beautiful Bill. I think we have to see how much of that has already been spent. Meaning, do people expect that refund? And I'm going to spend in the holiday season, and then we have a hangover in the first and second month of next year. So let's see that. I see that K-shaped consumer. So if you have wealth, equities have done great, fixed income has done well, and so the balance sheet of the upper income consumer has done fine, and they're able to afford things as well. It's the lower part of the K. And so a lot of this rests on, does that broaden out the lower part of the K? Does that continue to widen? And that's going to depend on the labor market. The WARN numbers have picked up. So companies are saying they're planning to lay off people. Now, if they all get absorbed, that's great, but the hiring numbers are not that good. So we're still a little cautious here.
Yeah, I think a lot of people are watching some of these numbers very closely, in particular Tuesday's labor market report. Priya Misra, thank you so much for being with us this morning. Really appreciate it. Priya Misra of JP Morgan. Coming up next, Darryl Cronk of Wells Fargo, former White House Chief Information Officer Teresa Payton, Becky Frankowitz of the Manpower Group, and Eric Cantor of Moelis & Company. From New York, this is Bloomberg Surveillance.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal, with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Mag 7 hasn't been the monolith that it had been the last couple of years.
Tech companies, healthy balance sheets, but on the margin, they're getting worse rather than better.
More cash flows generated in Mag 7 than the rest of the S&P.
There is a lot going on into next year, which is why I think we're positive, but I think there may be some volatility.
There's a 30% chance that you get a full-on bubble next year.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks pulling back after hitting another record high on Fed rate cutting expectations, with questions mounting about how far big tech can really go. Questions after Broadcom earnings, questions after even Oracle. Now we're going to be looking at all of the data coming out in the upcoming week, including the November jobs report, as well as, of course, retail sales and CPI. A real question here as we get some commentary from a number of the Fed members.
Yeah, a busy week for them. Opining, we heard from the Fed chairman. Now we're hearing from other members of the committee, regional bank presidents as well, about how they see the economy, the prospects for it going forward here. You mentioned that data, a lot of it delayed. Some of these deadlines are now indefinite. Just an open question, I think, of how effective it is in telling us about the state of the economy today. Obviously, always backward looking, but now increasingly so, and I think that kind of flummoxes them a little bit more.
Yeah, we're getting commentary this morning from Austin Goolsbee, who was one of the 3 dissenters. He dissented to not have any kind of rate cut. He said that he felt it more prudent to wait for more information, talking about how a lot of the business people and consumers that they have spoken to in his district talk about prices, the sort of cost concerns that we think about. I remain optimistic that interest rates can come down a significant amount over the next year. As I've reiterated for months, my unease is about too heavily front-loading rate cuts and just assuming that inflation will be transitory. How much is the T word still hovering over this for FOMC?
A lot of popular fascination about Austin Goolsbee as a dissenter in that last decision. Here we see him kind of reiterating what he said all along. He is an adherent to the data. He likes to talk about the data, wants to see more data. That's been something we've heard from him over the course of the last few months, just the eagerness to have more of it. So not surprised there, but certainly interesting, again, to think about the move that he made there, advocating for a pause here until we get I think the big data number from next week, of course, the jobs number from the Labor Department.
On the other side, we're getting Anna Paulson, the Philadelphia Fed president, coming out and explaining why she did opt to cut rates, saying that she is still more concerned about the labor market than inflation. Next week, we get a read on that information. Next week, we get, of course, the jobs report from November on Tuesday. We also get retail sales, and then on Wednesday, CPI. So both sides of this equation, albeit with some dated measure, the idea that this should have come out already before this meeting, and yet here we are because of the government shutdown. Watch this space, especially given some of what's been priced in terms of rate cuts for next year. Meanwhile, in markets, yesterday we did see all-time highs. Today, pulling back just a touch, although really as the session grows older, you can't keep a good market down. This is very much for you, Steve Chiavarone, down just now 0.1% on the S&P. Yields just slightly higher, now crossing that 418 threshold on 10-year yields. Yield curve steepening, taking hold after the Fed cut rates, and you are seeing ongoing dollar weakness throughout the week, but today marginally strength at 117 on the euro-dollar cross. Coming up this hour, Daryl Kroc of Wells Fargo as stocks trade near all-time highs. Former White House CIO Teresa Payton as Disney is officially entering the AI era. Hello, Mickey Mouse. And former House Majority Leader Eric Counter on the Fed's path ahead for interest rates. We begin this hour with stocks looking to end the week on a high note, possibly. Daryl Kroc of Wells Fargo writing, "We believe the next 12 months will favor U.S. equities. Trade, tariff, and longer-term inflation concerns could result in equity buying opportunities." Daryl joins us now. Daryl, thank you so much for being with us.
My pleasure, Lisa.
So before we get into 2026, what do you make of this week in terms of the Fed meeting, in terms of the rhetoric we're hearing this morning, and the sort of push-pull that we need more information before the Fed can more aggressively lean in any direction or give any kind of guidance?
Yeah, I think, well, so Austin's comment this morning about significant rate cuts into next year doesn't match with how the vote came in last week, obviously. We still think, I mean, if you look at their dot plots, right, they have one cut in for next year. It's probably too light, to be candid, right? You're going to get a new Fed chair in mid-May, right, who all signs indicate is going to be dovish, right? We think there's probably at least 2 cuts into next year. And you're seeing that in the bond market. The bond market doesn't believe the Fed's SEP dot plots. It's saying, if you look out on Fed funds futures, that by December of next year, there'll be 53 basis points reduction in Fed funds, which is 2 cuts, basically. I think you could build more of that in there, particularly if you see that consumer weaken, which you've talked about all morning, the labor market deterioration. I think the November jobs report next week is not going to be very pretty, right, from a headline number.
So this goes to Priya Misra's question, right? Are rate cuts a good thing if they're coming on the heels of weakness in the labor market? Are they a good thing for risk assets? How do you take that?
They have been a good thing for risk assets. We saw that reaction on Wednesday, obviously. It's interesting. I think what's changing in risk assets, if you get below the surface, is it's more of a, it's about cyclicals, but it's more about industrial cyclicals than it has been about consumer cyclicals. For the longest time, you know, in the last several years, consumer discretionary has done extraordinarily well, along with tech and comm services and all that stuff. Now you're really seeing industrials take off. You're seeing financials take off. You're seeing, of course, utilities continue to take off and participate. So 2026, I think, ends up being more about kind of like an industrial cyclical play than maybe a consumer cyclical play, as the consumer still struggles with a bad labor market, poor confidence levels, and you know they're going to get the boost from the big tax cuts coming in the first quarter of this year. Most people don't realize that the tax cut number is going to be up 50% year over year. It was $300 billion last year. It looks like it's going to be north of $500 billion this year. So it's material, and history tells you the consumer will spend. They spend $1.17 of every dollar they get back in a refund, historically, if you go back and look at the data.
We see that disconnect between the street and the SEP, as you mentioned. I think a lot of kind of concern or curiosity about what this Fed looks like come May, when Fed Chair Jerome Powell steps aside, either to become a governor, remain a governor, or do something else entirely. He wouldn't say which. We did have this news overnight, the Fed confirming 11 of the 12 regional bank presidents. There's one retirement there. But certainly, I think for those who are worried about Fed independence, a positive step forward here. How much are you thinking about that, the change in personnel at the Fed? How much is that kind of coloring your sense of where things are headed? It does seem like there's a lot of ambiguity and unknowns going into this new year when it comes to monetary policy?
Yeah, I think we think that the Fed independence, concern, risk might be a little bit overplayed, especially now that you've got the Fed regional presidents, right? So you've got the 7 governors voting. You've got the New York Fed president who always votes, and then 4 rotating regional Fed presidents, which make up the mix of how the Fed votes at every meeting that they have. So not much turnover of the 7, right? The New York Fed looks to us like it stays where it is, and you get the normal rotation of the 4, but it's going to be the same 4, right, to your point of 11 of the 12 staying home. I think had you had more of a mix-up in those regional presidents, I think you'd have restarted that whole narrative about Fed independence and influence of the administration over the Fed and that type of thing. I think everybody breathed a little bit of a sigh of relief yesterday afternoon when that news came down, minus, Regional President Bostic, who had already announced his retirement.
I'm sure you were working on your outlook for 2026 for months. It's gone through edits, et cetera, et cetera. Has anything changed as a result of what's happened this week when you look at what we've seen from Oracle and Broadcom, the kind of agita surrounding the prospects for AI, the concerns about debt? Does it change the color of or your sense of what the year ahead looks like?
No, not at all. I mean, you're going to have moments in time when you get these big transformations like AI, where things overheat and then they walk themselves back. And so to us, that looks like a short-term kind of noise. We actually launched our outlook this last week, and the title of it is called Trend Lines Over Headlines, right? And that was a theme throughout 2025, right? Think of all the noise. Go back in 25, you had DeepSeek early in the year, right? Then we moved to Liberation Day in April, right? Then as we went through the summer, the U.S. comes in and bombs 3 Iranian nuclear facilities. We walk into the fall. Like, it's the old adage, there's an axiom on Wall Street that says, if you give an investor $1 million and perfect foresight, they will find a way to go broke, right, over a year, right? Because when you looked at those news events, you would not sit here at this moment in time and say, the S&P 500 is a stone's throw away of putting the third 20% return in the books consistently or consecutively at year end here. I mean, we're up basically 17.5%. I tack a 1.5% dividend on. I'm right there, right? Which on the back of 24 and 23, that's a great return, right? Notwithstanding all that noise and headlines. The trend lines are what we want to pay attention to, and that's, monetary stimulus, fiscal stimulus, deregulation, what we think is a CapEx super cycle, and the M&A world picking back up again. All those things have real materiality to them and play through the day-to-day noisy headlines.
Which is the reason why there are so many double-digit expectations for 2026 as well, which is actually fairly rare, right? I mean, but we got from this morning, we got Goldman Sachs strategists seeing a 7,600 price target. That's on the lower end with just a 10% gain. It just kind of highlights, does it make you worried that it's so consensus now, that we're going to just keep on grinding higher because of this trend line?
So people forget, if you spin the clock back to exactly this time last year, the consensus was that the U.S. economy would enter a recession in 2025. And in fact, the first quarter GDP was negative. It was down 0.5, 0.6%, right? And then we took off in the second quarter economically, right? But people were very differently positioned this time last year than they are today. Just this week, we started to see S&P 8,000 targets out there, Lisa, to your point, right? So the optimism and euphoria we've flipped the script from last year to this year. Consensus is rarely right? Let's just call it what it is, right? History proves you over and over again that the crowded consensus often isn't the right trade as you think about what's going to happen on a forward-looking basis and not a backward-looking basis, which too many of our PhD economists and everybody else are looking in the rearview mirror all the time instead of out on through the windshield.
Daryl Cronk, I'm so happy to say that you're going to be sticking with us for the hour. While we were speaking, there was some news that just crossed a Reuters scoop talking about NVIDIA potentially raising its H200 chip output due to demand. This was the big question earlier this week when President Trump signed off on NVIDIA's ability to sell the H200 chips to China. Would there be the demand? And really, this would suggest that the answer, which is yes.
This was just a huge open question. I mean, we can't understate that enough, have to underline that there's been this roiling debate, what should be exported to China, what shouldn't be. And there was that kind of coyness or strange moment on the earnings call with the CFO of NVIDIA where they said they're basically treating China as a zero item, line item on that. They weren't counting on this kind of investment. So we were all wondering, the company itself, I think, very much wondering sort of what that demand would be like. And we've certainly gotten mixed messages from China over these last few weeks. And then the news that we reported earlier this morning, there's going to be this new kind of subsidy or state focus from China on its chip industry as well. So a lot swirling around that over the course of this Friday morning.
China trying to put its thumb on the scale when it comes to its financing of domestic chips, while at the same time their companies
needing these chips from the
need
US.
the chips from the United States. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief from Vonnie Quinn. Vonnie.
Lisa, thank you. China also considering a package of chip sector incentives worth as much as $70 billion. Sources telling us here at Bloomberg the program would aim to reduce China's reliance on foreign chip makers such as NVIDIA. President Donald Trump is signing an executive order to go after state-level regulation of artificial intelligence. Trump saying the industry shouldn't have to navigate a patchwork of AI rules. The order directs the Attorney General to set up an AI litigation task force to sue over state laws that are inconsistent with White House policy. Lululemon shares rallying in the pre-market on news its CEO is stepping down. The company's founder is weighing in, writing, quote, "The company needs revitalization and an infusion of new skills to get back to being a product-first company." He's calling for new independent board of directors to lead the search for a new CEO. And that is your Bloomberg brief. Lisa.
Thank you so much, Vonnie. Up next, the morning calls, plus former White House CIO Teresa Payton as Disney enters a whole new world of AI. Who knew that we needed a GIF with Mickey Mouse talking to you personally about your laundry? That's next. This is Bloomberg Surveillance.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
There's part of this deal we like and part that we don't. The part that we like is we'd rather see a commercial deal than litigation. And so we like the idea that they've inked something. We think Disney is going to get some cash for the use of its IP. The part I don't like is the billion-dollar investments. Disney tends to have a propensity to invest its capital at sort of the peak of the mania.
That was Jason Bazinet of Citigroup on this discussion of Disney and its partnership with OpenAI. A real question about how you get involved in artificial intelligence as a content creator. Right now, big tech underperforming, but really you are seeing futures come back as the session grows older. S&P futures now barely down, less than 0.1%. You are still seeing, though, that sell-off in the yield space. 10-year yields close to that 4.18%. So a real question here heading into into next week about whether we do get supportive, robust data coming out of the U.S. economy. Time now for the morning calls. First up, Bank of America raising its price target on Lululemon to $220, viewing its leadership change as an opportunity for a fresh perspective. Those shares surging almost 10% in pre-market activity. Next up, J.P. Morgan upgrading Citi to overweight, expecting profitability to improve next year. And finally, TD Cowen raising its price target on Broadcom to $450, highlighting upside from its business with Anthropic. Those shares still lower, 6.2% ahead of the open after earnings yesterday were fine, but then they didn't necessarily give a guide that left people with a good flavor in their mouths. Sticking with AI, Disney licensing its characters to OpenAI and taking $1 billion stake in the startup. Former White House Chief Information Officer Teresa Payton writing, "This move makes clear the Gen AI era is here to stay, and when a company like Disney loosens its grip, it shows just how quickly AI is reshaping expectations." Teresa joins us now for more. Teresa, thank you so much for being with us. Let's start there. This idea of how do content creators grapple with the AI era? What have we learned from this transaction?
Yeah, this is very interesting, bold on Disney's part, also risky, because if this AI-generated content crosses the line, both creators and consumers are not going to blame the algorithm. They're going to blame Disney. But it really is an energizing time. It'll be very interesting to see where this goes. I hope and I see sort of early signs that content creators are protected in the initial stages of this deal. So it could be that actually content creators, if it gets executed the right way, may actually come out on top. But, you know, kind of the proof will be in the details as this rolls out.
And Teresa, we can get into whether this is the right partnership for Disney, the idea of this particular engine and exactly how people are going to be using it. But does it highlight to you something else that's taking place throughout Hollywood, throughout the creative realm, which is trying to figure out who to partner with so that you don't have to just be aggressively going after everybody. You can actually be working with them to make yourself more relevant.
Yeah, I love that you brought this up, because if I were advising Mr. Iger and Disney on this particular thing, I noticed that it's 3 years. That's too long. We don't know who the winners and losers are going to be in 3 years. And so I would have liked to see, and maybe it's in the contract details and we just aren't privy to it, I would have liked to have seen it could be up to 3 years. Maybe it's a 1 year horizon and then renewable after 1 year up to 3 years. But this does show how fast AI is reshaping all of our expectations and how urgently we need a couple of things. We need governance, we need AI ethics, we need safety standards and security standards, as well as protection of intellectual property. The creators are going to be the first to feel this the most, but businesses everywhere, consumers everywhere, you're going to see over time, we're going to have to think about what are the emerging standards as well as it relates to our intellectual property.
You opened the door with your, if I were advising Bob Iger, so I'm going to go there. And I'm very curious, when you look at the debut of Sora, it was like a mess of slop. The company got into a ton of trouble. There were the Martin Luther King Jr. videos and the like. This was really kind of something that blew up quickly, was kind of a cultural flash in the pan, and then kind of crashed cataclysmically at the end. Look, we're used to seeing Mickey Mouse play the role of Bob Cratchit with Scrooge McDuck, but when this moves into something else, you're going to need guardrails in place. And I'm just curious about your sense of the thoughtfulness that went into this deal, and both of these companies shared capacity to deal with this, to regulate this space, and sort of how that colors the deal as you look at it.
Yeah, I mean, Disney has been a leader in sort of thinking about how to do things differently, everything from animation to movies to theme parks to resort stays. So Disney definitely does put a lot of thought and time into how they think about this. I'm assuming the Imagineers are going to be all over this. But you bring up something really important, which is sort of this shared responsibility the two companies now have to the governance and guardrails. And I don't know that any company right now really understands the combination they're going to need to have for moderation of these different things that are posted on these online platforms. So it's going to have to be somewhat of a human-led, human precision around the content that's generated and making sure it doesn't violate the terms and conditions. we're not going to be able to leave the job up to AI to govern AI, because I think in the end, AI will decide, meh, it's probably okay. So I think you're right. There's a shared responsibility here. We need to underscore that, and hopefully they're going to have people all over this as far as those governance and guardrails, looking at content and being very assertive around taking down content that could damage the brand, be bad for public safety, and some of the other things that are sort of unintended negative consequences.
I'm going to sound like a huge skeptic here, but put this question under the what are we doing broader question. And that is, you have at the enterprise level, companies wondering about how AI is going to change the way they work, pouring a lot of money into this, maybe not knowing exactly what it's going to be like when it's put into effect. Here we have Disney doing this, and I'm just kind of curious how you react to the question of, like, is this it? I mean, is this kind of the radical change that AI is going to bring about, that, like, Lisa's going to be able to make a delightful 10-second video with Mickey Mouse or Donald Duck? What does it say just about our sense of where this technology is going versus sort of what we kind of recognize as we're able to do right now?
It's a great question. And, you know, this is an example of, you know, sort of that keep your friends close and your frenemies closer. I'm not sure how Disney is looking at all of the different AI content platforms, but we know they had a beef with Google that is under discussion, and now they placed a bet on OpenAI. So I think what we're seeing here is some early bets being placed. I don't know necessarily that this will be an ongoing sustaining relationship. We'll just have to see. But it is smart on Disney's part to lead the way, to say, well, we're going to place a bet on this. We're going to learn from this. We're going to pilot this type of partnership and relationship. I think, again, 3 years is too long. That's just my humble opinion here. But I think it's smart for them to place a bet. Hopefully, again, the Imagineers and the governance and guardrails that Disney can bring to bear and the discipline that Disney can bring to bear is going to result in something smart. I do think this will start a new wave of announcements like this. So I do expect to see other entertainment groups as well as other companies announcing big partnerships like this.
Former White House Chief Information Officer Teresa Payton, thank you so much for being with us. Daryl Cronk still with us here from Wells Fargo. From your perspective, is this a good deal?
I think it's actually a better deal than initially people thought, right? It's the classic boardroom/management strategy of partner and police at the same time. Partner with OpenAI, figure out where you're going to put, to Teresa's good points, the guardrail, and then police, what they considered to be kind of intellectual property theft or you know, illicit use that didn't have guardrails and was not codified in some way, right? So this allows them to say, look, we have a partnership with OpenAI. It's short form video. We have this cast of 200 characters, right? So it puts those tight guardrails on what that universe looks like. And then that way they can defend it in the corporate universe where people are using it in long form video or in other places, TV, where just there's no rules to the road type of thing.
We were talking about, is this a good thing or a bad thing for Hollywood actors, for scriptwriters? Yeah. And there is this issue of what is the precedent here after the strike that we saw last year in terms of AI-generated content? Do we have a clear sense of that, or does this just raise more questions than answers?
I think it's the latter. It's more questions than answers. I think that the actors and actresses will really question where's that line of demarcation between, you know, can you use my voiceover? Can you replicate it through AI? Do I have any, you know, contractual rights there? Am I getting paid for that and monetized in any way? So I think all that still has to be figured out, but you've got to take the first step of the partnership, and Disney had to establish the partnership. I completely agree with Teresa that this is going to unleash a fury of kind of other partnerships and considerations. Obviously, we see that already with what's happening with, you know, the Netflix, Warner Brothers, you know, Skydance, you know, saga, right? So the media world is really becoming kind of ground zero for a lot of those battles about what the future looks like and who's going to control it.
Yeah, which is to your point, are we going to be here, or is it going to be Donald Duck sitting here? And the question of what the labor market will look like and how it gets affected. You'll see. Tune in Monday. You never know. Coming up next, we'll talk about the labor market. Becky Frankowitz of Manpower Group on the impact of AI with respect to jobs. From New York, this is Bloomberg Surveillance.
Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities that allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
I should listen to Steve Shiveroin more often. Yesterday, futures were lower, and he said by the end of today, it's going to be higher. Well, right now, we're seeing futures that were substantially lower, and as the session grows older, less so. S&P futures down by 0.1%. You are seeing a little bit of reprisal for the dollar, although just. We've seen dollar weakening, 117 on the euro-dollar cross, and yields now crossing that 4.18% level on the 10-year, as you do see that yield curve steepening. Turning to the Federal Reserve, as we hear from multiple speakers today. Bloomberg's Michael McKee joins us now. We did hear some comments from Austin Goolsbee. Just curious about the reason behind some of these dissents.
Well, that's what we're getting, the explanations. It's become a tradition lately for Fed officials to explain as soon as the blackout lifts why they dissented, and the blackout has lifted. So we got a few minutes ago Austin Goolsbee's comments from the Chicago Fed saying basically people are telling him inflation worries them more than jobs. Goolsbee said almost all business people and consumers that we have spoken to in the district lately identify prices as the main concern. I remain optimistic that interest rates can come down a significant amount over the next year. As I have reiterated for months, my unease is about too heavily front-loading rate cuts and just assuming that inflation will be transitory. Now, just now we are getting breaking explanation from Jeffrey Schmidt from the Kansas City Fed, who also voted to hold rates steady. I continue to hear concerns about inflation. My conversations suggest we are at risk of moving away from a situation where, to quote former Chairman Alan Greenspan, inflation is so low and stable over time that it does not materially enter into the decisions of households and firms. So those are the dissenters, and we will be hearing from other Fed officials. We heard from Anna Paulson, who was not a voter this time. She's the new Philly Fed president, but she is going to be a voter next year. She says that labor market is more of a concern to her. But somebody else who has focused more on inflation, Beth Hammack of Cleveland, is also speaking in a little while, and we expect her to sound much more like Goolsbee and Schmidt. Makes it harder for anybody coming into the Fed to try to convince people to cut interest rates a lot, to have all these dissents. And we had another effort last night, or another move last night, that also would make it harder for the president to get his way. The Fed has now confirmed, reconfirmed all 11 of the 12 Fed regional presidents. This happens every 5 years. Bostic has, from Atlanta, has announced his retirement. That's why only 11 of the 12. Renewals would kind of foreclose a path to Fed control for Trump, because unless the Supreme Court says he can fire people at will, then he's not going to have a chance to replace Fed Bank presidents either.
Michael McKee, thank you so much for breaking that all down. Daryl Cronk of Wells Fargo is still with us. And Daryl, I'm curious your perspective. Which do you think is the bigger concern, inflation or the labor market?
I actually think the labor market is a bigger concern. I mean, so stay with me on the timeline here. If you go back a couple years, in 23, non-farm payrolls average for the entire calendar year, 220,000 a month, right? 24, 186,000. Year-to-date 25, at least of the data we have, 151,000. I think 26 non-farm payrolls probably average somewhere between 30 and 50,000 new jobs a month, right? Which is a material shift down, right? Yes, you're not seeing, you're getting this low hire or low fire environment that everybody talks about. But I think the growth of the labor market is really hitting a stall speed kind of point. Inflation to us looks like it's hanging out here kind of in the upper twos, right? It's not coming down to the Fed's target zone, and there's going to be kind of corresponding pressures. It's interesting because, I do think you're starting to see the early signs of AI having that disinflationary push, right? Which is important because when you start throwing all that stuff in the mix, right, about what's happened with price increases and immigration and tariffs, and that all should be inflationary, you have to ask the question, why is inflation not moving higher than it is?
Well, that's exactly what we want to stick on, this question of, are we seeing disinflation because people aren't getting hired? And this is what Howard Marks of Oak Tree Capital Management was warning about with the impacts of AI. Take a listen.
I'm not talking about investing or economics. I'm talking about society. And it's very worrying to me. If we can find a way to replace their income, I worry about purposelessness. And, we get so much from our jobs other than a paycheck. And you can't replace that stuff. So I worry for society.
Becky Frankowitz of staffing firm Manpower Group writing, AI is reshaping work, but not erasing it. Blue-collar demand remains stronger than white-collar, though this appears to be caution amid the evolving AI landscape rather than a long-term trend. Becky joins us now, and Becky, I'm so grateful that we get to speak with you because there is this real anxiety. You heard it there from Howard Marks. Will AI cannibalize from the labor market and leave people out of work? What's the early evidence showing?
Yeah, good morning, Lisa. We're seeing a labor market that I would say is definitely cooling. So I would agree with the gentleman from Wells Fargo. It is cooling, not collapsing. There are still pockets of growth in industries and jobs. And this widespread impact of AI that we read in the headlines is not yet realized, but we are seeing early signs.
So what are the early signs? Is it just idea of blue collar taking over for white collar? Is it the idea that companies are more reluctant to hire? Is it that productivity comes on the heels of smaller workforces?
Yeah, it's all of that, Lisa, and more. So let me give you the data. As we look at real-time data, I think you asked me 4 or 5 months ago the percent of job mentions that require AI. It was about 2% at the time. That held steady until the last 3 months. It's now 5% of mentions. And you might say, well, that's not that big. That big of move in 3 months in our economy is quite large in terms of in-demand AI jobs. The second impact I would note, again, an early sign, software developers have been the #2 job in most demand in our country since 2023. This year, it drops #3. When you think about that echelon of job demand, to see that drop also significant. And the final piece of evidence I would say is early indication is when we see the demand for college graduates start to decline. And so the number of jobs, the percent of jobs that do not require a college degree, entry-level jobs, has jumped 36% in the last year.
I hear the sobering comments from Howard Marks about what this means for society, and it does give me pause, especially when I think about the way that the Fed chair talked about AI and productivity during the course of the press conference following the meeting this week. He's willing to engage with it, but still I think acknowledges the fact that there is so much that we don't know about the effect this is going to have on the labor market. We've talked a lot about timing in the sense of when is the construction of data centers going to lead to advances in AI and what's that going to mean for work? How about when it comes to productivity? When you think about where we are and having a more holistic understanding of the impact this is going to have on the labor market, where are we? How much are we fumbling here with no real sense of what it's going to mean in real terms?
Yeah, so first, David, let me say I loved Howard's responses. I believe in work. It's the whole purpose of Manpower Group. We believe in meaningful and sustainable work. Work produces good societies, it produces good families. So I'm so grateful to hear someone from the capital market start talking about that. In terms of productivity, again, we are seeing the anticipation of AI. So if you ask me to step back and say, what are employers actually doing? Are they seeing the business cases? Not yet. They are stalling hiring in anticipation of what AI can do. I spend a lot of my time with CEOs and CHROs, heads of HR of companies around the world. In fact, I was with about 12 of them in the last week. And what I hear from them is the promise of productivity, but not yet the realization. But there's active work in almost every major company that I speak to understand the process changes that can be implemented to drive productivity. We're just not realizing that yet. It's anticipatory stall, not real reality stall.
Hey, Becky, great comments this morning. I'm curious, when we look at the labor market, much is made about the softness, the deterioration of the labor market. Where we do seem to see strength, at least from our standpoint, is in tech hiring, healthcare hiring, and maybe a little bit of hospitality. Are there other areas where you're seeing, so if we think about the whole labor market maybe sliding this way, but there's pockets of strength, where should people be thinking about those pockets of strength?
Yeah, so nice summary, by the way. Wells Fargo's well informed. I would say first, we're seeing for sure in healthcare, but there's a bit of nuance now in healthcare. Registered nurses, not a new topic. The new growth we're seeing, physical therapists, radiologists, there's some new pockets of growth in healthcare. Retail has been quite a surprise. Of course, we expect seasonal hiring. We have gotten that. It continues. But we're seeing frontline workers, cashiers, stockers, those are in demand. And in tech, you mentioned tech. You heard me speak to the software developer decline, but there are new jobs in tech that are up triple digits, almost 300% increase on a low base. Data scientists, people who know how to use machine learning. So we're seeing these pockets of growth, but I'll give you a surprise one. In times of transition, management is crucial. We are seeing growth in executive leadership demand. So the demand for managers and leaders who can help us transition through this time we're facing in the labor market. So those would be a couple of the pockets of growth that we're seeing.
Just quickly, Becky, how much are you starting to see entry-level work start to pick up as well? Because that's been a big concern.
Yeah, so I'm very concerned about college grads because we are seeing decline in the need for a degree in terms of demand. Entry-level work, it depends on the industry, Lisa. We're definitely seeing in food service, 8 of the top 10 hirers in our country today are food service or retail. So there are definitely on-ramps for those industries, and they are not requiring college degrees.
Becky Frankowitz of Manpower Group, thank you so much for being with us and for that gut check. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. NVIDIA shares rising in the pre-market amid reports that the chip giant is ramping up production of its H200 AI chips. Reuters is reporting that consideration comes from strong demand from Chinese clients after the sale of the chips was signed off upon by officials in both the US and China. Orders for the chips from China have exceeded NVIDIA's current output level, requiring the company to increase capacity. Uber is saying it expects to offer robo-taxi services in more than 10 markets by the end of next year. CEO Dara Khosrowshahi is telling Bloomberg News possible new markets include Hong Kong and Japan. Earlier this year, Uber and Baidu announced plans to launch robo-taxis on the ride-sharing platform in several markets outside the US and mainland China. The Education Department has added a, quote, earnings indicator to the free application for federal student aid. That will indicate any school where the average earnings of its graduates fall behind average earnings of high school graduates. Around 23% of colleges in the federal database classify as low earnings. And that is your Bloomberg Brief. Lisa.
Vonnie, thank you so much. Thank you for everything this morning. Daryl Cronk of Wells Fargo, thank you so much for being with us this morning. Always wonderful to get your thoughts.
Thank you.
Have a wonderful weekend. Up next, setting you up for the day ahead, plus former House Majority Leader Eric Cantor on the Fed's path ahead for interest rates. This is Bloomberg Surveillance.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
There's still questions surrounding, the big tech, the AI story, but you're seeing the equal weight S&P 500 do better, Russell 2000. I think it's helpful that the Fed is buying some T-bills up to $40 billion a month. So you're seeing all that. There's a lot more questions around the AI data center, but if rates are coming down, I think we're going to get rate cuts faster than the market's pricing. That should be really good for small caps and the broad economy.
That was Peter Shear of Academy Securities. As small caps continue to outperform, it's what we're seeing this morning. You are seeing the broader indices lower ahead of the open, down just about 1/10% on the S&P. You are seeing that bond sell-off continue on the long end, even though that front end has been pegged 4.18%. And you do see silver surging to new all-time highs, less than an hour away from the cash open. Here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. Broadcom's results had all the makings of a strong quarter with an earnings beat and a dividend boost, yet shares are falling more than 5.5% in the pre-market after its $73 billion AI backlog for the next 18 months fell short of the most bullish expectations on the street. CEO Hock Tan tried to soothe investors, calling it the minimum, yet it was not enough. Meanwhile, with social media driving this mindset that you can't wear the same thing twice because of photos, people are flocking to rent the runway. Shares are surging 25% after the company handily beat earnings estimates and said that it is sticking to its guidance for double-digit subscriber growth this year. And we end on Lululemon. Shares are rising more than 10.5% now in the pre-market. The company saying its CEO, Calvin McDonald, will step down at the end of January after more than a year of underperformance. And we heard from Chip Wilson, the founder, in the last hour, who's one of the company's biggest shareholders. He slammed the board for letting value slip under McDonald, and now he wants the CEO search to be led by fresh, independent directors. Lisa?
Thank you so much, Yahaira, and have a wonderful weekend. Meanwhile, stocks just hovering near those all-time highs heading into the opening bell as investors set their sights on growth possibilities in 2026. Former House Majority Leader Eric Cantor joins us now, currently of Moelis. And I want to start on the economy and all of these deals that we see going on. I mean, is this just an incredibly robust deals pipeline on the heels of a benign economy and wide open capital markets?
Yeah, Lisa, I think you're right. I mean, I know at Moelis, our bankers are really busy as we come into the very end of the year running through the tape. And so there's a lot of dialogue. We're in the business of advising on transactions. Transactions are a tool for companies to accelerate growth, to figure out how to better position, to gain efficiencies. And as you say, there are accommodative capital markets right now, too. And so we are seeing just a lot of dialogue, a lot of activity. and I think a general optimism as we come to the new year.
What's interesting is in markets right now, you're seeing a bit of skepticism, pushback. Broadcom, perfect example of that. We also saw that with Oracle. Debt investors are saying you need to pay up a little bit more. As vice chair of Moelis, are you seeing that pushback in any way, shape, or form, or are deals just coming out of the woodwork in ways that keep even your associates really busy?
Well, you know, I think if you look at the strategic sort of universe, I mean, they are and have always had a list of where they're heading in terms of targets and the kind of deals they want to do. And certainly in the sponsor world, there are other sort of forces at work, you know, the need to recycle capital, you know, assets that may need to go into a continuation fund. I mean, there are all types of different tools available for clients, investors, sponsors, strategics. And as you say, I think overall, the framework and the environment is more constructive now. Certainly Washington, when people look to the regulatory impact, we have sort of come out from under this very, very negative regulatory outlook that we had in the prior administration.
Talk a bit more about that. So when you're talking to executives about that regulatory environment, how would you describe it? I mean, we see some of these agencies where there's not a full panoply of commissioners, for instance. We heard it from the Treasury Secretary. Maybe there's going to be some new corporate tax policies coming here into effect in the coming weeks. How much of it is still inchoate or clear for you at this point, of where it's headed regulatorily?
You know, I think with this president and this administration, I think there is just sort of an acceptance that you're never really going to know for certain anything because of the way that, you know, the rapidity that things are about in Washington, the way that President Trump sort of approaches, you know, the power he's got and the position. Very unique. But I think on the whole, it's a much more constructive regulatory environment. And you just don't have this overhang that you had in the prior Biden administration where, you know, there was really an anti-business sentiment. And if you just remember, it's like eons ago, but with the likes of Lena Khan and Jonathan Cantor, they were sitting in these spots in the head of the antitrust regulators, and they really definitionally said, if you are bigger, that is bad, and therefore we're not really inclined to allow you to do it. Whereas this administration, it's not like it was under the Bush administration, but it's certainly much more constructive than they like to do deals.
As you've watched that parade of executives going through the Oval Office, some of whom are giving up equity stakes to the U.S. government, what are you thinking as a lifelong Republican, this kind of new breed of Trump Republicanism that involves, again, it's not dirigism, but it's sort of like the state is having a heavier hand in the way that these companies are being run.
You know, David, I still remain a limited government, free market, Republican and conservative. So it's obviously something very new to me to see that the government wants to take a stake in a business and or a toll if it's an export. That is something that is obviously, and I think for the majority of the members that are in the Congress now, it is something that's very new. But I do think it's much more in keeping with what President Trump is about and what his career's been about. It's all about deal making. And I think if you look at sort of the Intel situation and what happened there, it was more of a response to the disdain that the White House had for the CHIPS Act and just giving away monies and instead say, hey, we need to do something for the taxpayers. Now, where I have an issue is the governance rights. You know, that is, you know, it's not as if the federal government has not stepped in before. I mean, you and I were down there when the great financial crisis happened and we're a lot of bailouts. You look at the airline industry, you look at the GSEs. I mean, there's a lot of history, but the difference, before, there was always sort of a path and a known path to an exit. That's right. And now not so clear.
Well, this is sort of the concern, is that right now, if you're putting an emphasis on deal making, deregulation, and potentially jawboning the Fed to cut rates more aggressively at a time that the economy is still chugging along, at what point are you setting up the risk of that kind of scenario once again in 2027 or 2028?
Well, listen, I think this president has been very consistent in his message of growth, and he wants growth, and that is the way, and that is where sort of the more traditional sort of conservative Republican can come along. It has been taking stakes. It's really in these industries that are critical to the national security. It is about AI related. It is about the rare earths minerals. It is all about how do we go and continue to take the lead in these critical sectors vis-a-vis China and other bad actors.
How do you think this administration has done with respect to messaging around affordability? This is something that has been dogging the administration quite a bit. Now we're talking about dolls and Christmas presents, but there's this issue of people aren't feeling great, even though the economy is chugging around. What do you think? What do you think the Congress should be doing? How do you think the president should be messaging this?
Well, you know, it's interesting. After the off-year elections, one of which was in my state of Virginia, and the party didn't fare well, the president was fairly nimble, and 10 days later turning around and taking the steps he did in lifting the tariffs on 200 food items, and which directly impact people when they go into the grocery store to look to prepare for the holiday meals, including not just the things that we don't grow here, but like beef, right, and Brazilian beef. And there's a real inflationary pressure in the beef industry in this country, and I think the administration took the steps necessary to provide the relief. So I think you're going to see a lot more accommodation in terms of that as we head into the new year. And look, the president's also, this is something also very novel, David, back to your original point about the kinds of things this administration's doing. He's talking about a dividend from the tariffs. I mean, but that is something directly related to the issue, Lisa, that you bring up, and that is, how is a president supposed to bring down prices when we're in a free market?
Don't have a whole lot of time left, but I want to ask you about the prospect of the fiscal stimulus in the new year from the tax bill. I mean, the president talks about so much. Maybe he hasn't been focused enough sort of on the potential benefits of that for ordinary Americans. How do you see that playing out in the year ahead?
Look, what's going on with AI and with CapEx necessary to bring about this infrastructure, not just in the data center piece and all that, but on the power end of things. I mean, there is a tremendous tailwind we're going to experience from the ability to completely, write off the expense up front. So I do think, and I think most economists will say, there will be an uptick in terms of what that will do to increase people's willingness to go and put capital to work.
Vice Chair Eric Cantor of Moelis & Company, also the former House Majority Leader. Thank you so much for being with us this morning.
Happy holidays.
Have a wonderful weekend and happy holidays. Coming up on Monday, Cameron Dawson of New Edge Wealth, Sarah Hunt of Alpine Saxon Woods, Russ Kosterick of BlackRock, and Keith Lerner of Truist. A real focus on the data, David, next week.
Yes, looking ahead of those jobs data, I think highly anticipated. We'll see sort of how that changes our read of what happened at the Fed meeting this week.
Exactly. Is good news good news? Is bad news good news? How are we going to message a Fed rate cut that might come on the heels of some softness in the labor market? Right now, what you are seeing in markets is just a touch of softness after reaching all-time highs. Again, you can't keep a good market down. Look at that. We're almost to positive territory, and we are seeing yields climb on the long end, 4.18%. That does it for us. Have a wonderful weekend. This was Bloomberg Surveillance.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a ball. Put wasabi in the middle. Then my process 1 to 6. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now these 2 fingers, top of the bottom, make the sushi shape more beautiful. 3. Then, I'm not, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
We had an all-new record closing high yesterday. 30 minutes till the start of the cash trade today. I'm Matt Miller. Danny Berger is on assignment. Open interest starts right now. Coming up, a Santa Claus rally tries to take hold as global stocks eye records and the U.S. market sets its first all-time high in 6 weeks, as judged by the S&P. But caution in the tech sector remains as Broadcom falls short of lofty AI revenue expectations and a plan to water down UBS capital demands, or Swiss capital demands on UBS, sends those bank shares to a 17-year high. We're going to focus in on what's going on there. Stocks to watch today include Broadcom. As I said, it is down after its sales outlook for the AI market failed to meet heavy expectations. We have the shares right now down about 5.5%. It has a backlog of AI orders totaling only, I guess, $73 billion over the next 6 quarters. Lululemon is actually higher in the pre-market as it sees solid holiday demand and announced CEO Calvin McDonald will step down in January. That's probably more important to shareholders and why we see the stock up 10%, because they see a reset now as possible. Let's start off, though, with Broadcom and the AI trade. Bloomberg Tech Co.'s Ed Ludlow joins us from San Francisco. And Ed, it's interesting. On the one hand, the market is concerned about CapEx that's just exploding. On the other hand, they want to see the backlog and revenues at Broadcom higher.
The market always wants more, and it's more a piece of tangible, forward-looking data. So Broadcom offers custom chips. In the context of what's happening in AI and data centers, they are the IP and engineering partner on Google's TPU, for example. This figure, $73 billion AI-specific backlog, is over the next 6 quarters. And the narrative from the company to its investors was, this is a minimum number. But what the street was quite clearly looking for was the next step of that, which is we're very used to backlogs in the chip industry. Tell us in the next calendar year how much revenue you're actually going to get through, how much revenue you're actually going to book through that backlog. And it just wasn't enough. The stock down almost 6% in pre, but I think we make the obvious point, Matt, that this is a stock that's up almost 75% year to date going into it. And that's an important factor.
Ed, we also have news that China is going to put about $70 billion of the stimulus into its own chip development. Is that a big number? Because it does, not yet meet the CapEx of some of our individual megascalers for the year.
Yeah, that's certainly probably the right way to look at it. 70 billion as a basic minimum example is far beyond what the CHIPS Act provided for in terms of government backed funds for the chip sector in this country. China already has some vehicles and investment funds that are specifically semiconductor related. And, you know, what I would say is, you know, based on our reporting, $70 billion seems to be like an upper bound. You know, where they settle, it could be less than that, it could be near to it or more than that. The assumption is that it's Huawei and Cambricon that will benefit from these funds. But really, there's a lot we don't know. We don't know specifically which companies China hopes to support most, and sort of what the mechanism is here. You know, is this literally to support R&D, or, as has been the case in America, a great infrastructure build-out or capacity build-out? Those are two different things, right?
Ed, I look forward to your program today because there's a lot, as usual, for you to talk about. Bloomberg Tech co-host Ed Ludlow talking to us about Broadcom and what we see in terms of Chinese stimulus. Lululemon shares climbing after that company boosted its full-year EPS guidance on strong holiday demand, but maybe more importantly, Calvin McDonald, the CEO, will step down in January. Romaine Bostick, co-host of The Close, whom I would bet has never worn yoga pants, joins us now.
You would actually be wrong, believe it or not.
No.
Yeah, I went through a phase, let's just say.
All right, let's experimenting in college, I guess. Sure. Let's talk about why the reset is so important to investors. I mean, this stock is up 10% on the CEO exit.
Yeah, this is actually going to be one of the best days for the stock in months, probably going back to April. But just to put it into perspective, Chip McDonald took over in 2018, and he actually did a pretty phenomenal job in the early days. He took this from a company with less than $3 billion in annual sales to one with almost triple that today. The stock price soared like 50%. The problem is this company kind of peaked back in 2023. The stock is down 63% since then. Sales growth has basically been stagnant to down. In fact, they had double-digit comp sales growth pretty much through most of his tenure, but the last 7 quarters have all been in the single digits, Matt. And more importantly, not just in the single digits, but no real signs of improvement, despite some of the numbers that we got last night.
We actually were talking with Steven Yalof of Tanger, and, you know, Danny was like, I guess Lululemon's not so hot because they have these really high-end competitors, not Nike and Under Armour, but like expensive stuff, right?
Yeah.
And Yalof said, no, they're actually doing great.
Well, I think analysts would disagree, and several analysts have already basically put a lot of pressure.
At his outlet stores, let's be clear, at the outlet stores. Yeah.
But this has been part of the problem. You remember Lululemon was always, at least in the early days, considered a very high-end, premium type of brand, and there's been a lot of criticism that McDonald's maybe took it down a little bit too pedestrian. They created partnerships with Disney, putting Mickey Mouse logos on pants, putting NFL logos on some of the products as well, and a lot of people thought this was taking a little bit of the cachet out, and particularly at a time where you had sort of the Fiore and Alu and all these brands come in that sort of have now the same cachet that Lululemon once had maybe 10 years ago. And of course, Chip Wilson, the founder, who still is the largest individual shareholder, he has been just vicious. If you ever want to have some fun, go through his LinkedIn account. He's basically spent the last couple years just trolling management.
Dude, by the way, unrelated, I wonder what you think about using NFL logos, because for years, Breitling has been doing this, and it always seems to me that maybe it cheapens the brand a little bit, but obviously the NFL has such big cachet in America.
But that's the concern. But does it broaden out your reach? Sure, but at the same time, it also brings in a different customer that maybe doesn't want to necessarily pay, you know, $100+. The other issue too is they've had a lot of issues with regards to just fashion. McDonald's just recently finally hired a new creative director, but he's not going to really have time to bring that person in. But also remember, they had a couple missteps. Remember last year they had those breeze-through leggings that were apparently a little too breezy. And so a lot of women just decided they didn't want to wear them. They had the other one with the little V-shaped seam that was unfortunately very misplaced. So there were some huge missteps that they took on the fashion side that whoever the new CEO is, they're going to have to find a way to address. And we should point out, they do not have a new CEO.
All right, Romaine, great wrap-up. Look forward to your program today. Romaine Bostick anchors The Close, and he presided over an all-new record high yesterday on the S&P 500, more than 6,900, I believe, at The Close, 6,901. Let's turn to the broader market, because U.S. stocks, this morning they're drifting lower, but we are at such lofty heights. European equities are also hovering near all-time records. Strategists are betting on further gains before the year ends. Karen Georges of EcoFi Investments writes, quote, "Everyone is convincing themselves that there will be a Christmas rally, so it looks like there will be one, and to be honest, there's no negative catalyst visible until the end of the year." Joining us now is JP Barnard, Bloomberg Senior Market Strategist out of Frankfurt. So, JP, it does look like, even though, as you know, Romaine was on yesterday, they hit a record high again on the S&P, and of course, the President of the United States has been touting the Dow Jones Industrial Average. We could continue to climb into the holiday.
Yeah, absolutely. I mean, and I'm totally with that statement that there is no negative catalyst or no obvious negative catalyst on the horizon right now. Right now, we have moved through the Fed issue and kind of a little bit of the macro data. I mean, there's still more to come, but it looks all right. And what you're seeing with like stocks is that they take this to the heart. And I mean, the AI trade is still on pause for now for good reasons. But we're seeing a cyclical rotation, and stocks are really like embracing the idea of like there is no danger on the horizon right now. The economy is doing fine. The job market is doing fine. The Fed gave us kind of what we wanted, and from there, like I mean, like seasonality is on your side, and so I guess. From next week on, it could well be that we get that center rally as we have seen so often before.
JP, I don't know how much you're focused on the concentration risk. You know, in Europe, it's not the same thing that we have here in the U.S., but has there been a broadening out? It seems that big investors that we talk to have differing opinions on this.
Well, I guess it depends on how you want to look at and what's your starting point. Of course, I mean, like we still have a big concentration, and that's probably not going to go away unless, like, I don't know, Apple and all the Magnificent Seven will be cut in half, and that's not going to happen. I like to predict, but what we are seeing is that the market is like not so keen anymore to jump on everything that has AI on it. And that, of course, like automatically removes a little bit of the concentration. I mean, that trade is still big, and it's going to be big in 2026 for sure. But the thing is like that the market is now a little bit more focused, asks more nuanced questions, is focusing on like, okay, where does this trade actually make sense? Who is going to be the best bet on it? Who is going to make the best money? Who is fastest to implement all the AI ideas that are floating around? And I guess like we are not going to see that pure let's buy NVIDIA all the way up just because of we like it, but people are going to be a bit more nuanced going forward, and I guess that's automatically going to have a market that is more broad and that's not so one-sided as we have seen, quite frankly, over the last 3 years, actually.
JP, you know, American investors eyeing European outperformance with a little bit of envy. I mean, the DAX, where you're sitting, is up 23%. Here in the U.S., the S&P is only up 17%. But if you're a dollar investor, you're up 38% in Germany. You're up 46% on the IBEX in euros, 66% in dollars. Is that kind of outperformance set to repeat itself in 2026?
Probably, I guess so, because like the question is like when the Fed is really like moving with interest rates in one direction and the whole world is moving in the other direction, kind of, or at least hold steady, then this needs some wealth to explore itself into the market, and that usually is then the foreign currency market and the dollar. So I guess like most people are, or the consensus is that the dollar is probably going to have a hard time to really perform, and that means like it's going to be a better place for all the assets outside of the U.S. Will that lead to like an outperformance that we have seen this year? I'm not so sure about it because, like, I mean, Europe also, that's why I was shaking my head a little bit. It also has kind of a concentration problem a little bit. And we have seen like trades like defense doing really, really well. So Europe has to prove that it really has its place to be. But I guess like overall for investors, diversification is something that they want to have going forward the next 12 months. And that should usually help like all the markets outside of the US.
Yeah, I mean, the banks are a standout example. In Spain, you're up 66% in 1 year, but it's mostly the banks that are driving that. We're going to talk about that on the other side of this block. JP, thank you so much for joining us this morning out of Deutschland. Quick check on what's going on in futures here in New York. We're looking at really on the S&P, but we hit over 6,900 yesterday at the close. NASDAQ futures down about 0.4% as that AI trade comes into question again. Looking at some of the other movers on our radar this morning, Costco profits topped expectations as price-sensitive shoppers search for value. That place has been packed in Yonkers, I can say for sure. Restoration Hardware reported higher growth than rivals as the industry contends with tariffs and a sluggish housing market, but rich people still buy expensive furniture. And pot stocks jump on news that President Trump is expected to direct his administration to reclassify Mary J. as a less dangerous drug. Tilray also announced a new product line. Coming up, UBS jumping this morning as Swiss lawmakers pitch a watered-down version of proposed capital requirements. We'll talk about one of the most important bank employers in the world. This is Bloomberg Open Interest.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Let's get out of high interest. Look at what's making headlines around the world. President Trump is moving to shift marijuana into a less dangerous drug category, reclassifying it from the strict Schedule 1 category to a Schedule 3. The move signals a major shift in federal drug policy. Reclassification would make it easier to buy and sell cannabis and could ease tax burdens and some obstacles for companies and investors in the sector, but they still wouldn't be able to bank. You can see, well, you saw there, they were all up. Here they are again. For students filling out financial aid forms, also probably concerned about the legality of marijuana, some colleges might now come with a warning. The Education Department is adding a new earnings indicator to the FAFSA. When students file, some colleges will now show a red flag if their graduates earn less than other high school grads, with the cost of attending college reaching $100,000 a year in some places. More people are questioning the value of that higher education. And UBS shares are hitting a 17-year high after a group of influential Swiss lawmakers proposed watering down the capital requirements for the bank. The proposal would allow UBS to use junior debt, so-called AT1 bonds, instead of equity to meet the capital requirements. And to talk about this, I want to bring in our chief Wall Street correspondent, Sridhar Natarajan, joining me over here at the desk. Sri, this is an important story on so many levels, especially for our viewers and clients. But first of all, it means UBS probably won't move to New York, right?
So the lesson from that is perhaps playing hardball works. And we should remind our listeners and viewers as to why we're even talking about UBS in New York. Not that it has ever been floated as a serious proposal, but in the last few weeks and months, there has been a lot of murmurs and rumors and talks about UBS, senior ranking UBS executives talking to US officials, potentially relocating their headquarters out of Switzerland, which would be a big hit for Switzerland because UBS is the last remaining globally significant bank in the country, a country that is built on its banking system. What we have today is a group of influential Swiss lawmakers trying to find a compromise. And, you know, the details, there are some details here, but the details at this stage truly are not relevant because these will still be debated a year and a half down the line. We're talking about debates in 2027. But the idea is to make sure that they get to the negotiating table because up until now, the Swiss government was taking a very hardline stance, which would have meant that UBS would have had to set aside $26 billion in additional capital to meet their demands for a safer banking system. and UBS had been saying that would simply not be acceptable because it would make them uncompetitive.
By the way, UBS shares apparently rise to a 17-year high, and they have returned, well, they've tripled in the past 5 years, but they're not doing as well as Goldman Sachs over that period, not doing as well as Deutsche Bank over that period, not doing as well as HSBC, and I haven't even looked at the Spanish banks, which are killing it. What's going on with this insane bank rally, like all across the globe?
Well, you know what's happened this year is we've finally seen a big return in deal-making activity. You've seen that even as this has happened and people are worried about where the economy is headed, could there be a turn in the economy? When you look at the actual underlying numbers right now, the biggest banks are not that concerned. They're talking about a resilient economy. Their consumer banking operations are doing fine. And when you talk about the investment banking side of things, when you have so many deals in the pipelines, major deals, there is a flow-through effect into other parts of that investment banking business. It's not just fees from advising on the biggest deal. It's raising debts, it's issuing equity. And there is also obvious trading activity that you will get from all of this business that the investment bankers are bringing in. So right now, it is a good time to be a major bank that is globally significant.
Especially in Spain. I just looked up Santander. In the same period, over 5 years, they've returned, with reinvested dividends, 353%. Is there a bubble in bank stocks? Are we worried about the wrong bubble here?
Wow, we're now trying to find bubbles everywhere. Look, when you think about what has happened in some of the more exuberant parts of the market, it is very hard to look at the banking sector and talk about bubbles. And let's bring back the conversation to why we're even talking about the banks today. It's the strict capital demands. And there is this sense that in the last 15 years, regulators have acted in a way that has made the banking system safer. And that's why in the last year or two, more of the conversation is about what is happening in the non-banking system, and are there enough eyes on it, and are there enough guardrails placed out there? So, not saying that nothing could possibly go wrong with banks, but on the surface, there's no obvious sign that banks are in some sort of bubble territory.
I just put a smattering of the big ones here, and you can see JP Morgan is the worst performer among all of these big banks. If you can decipher the tickers, those are UBS, JP Morgan, Goldman Sachs, Deutsche Bank, HSBC, and Santander. Sri, great talking to you. It's a really important story for investors right now, and especially also for employees of UBS. Sridhar Natarajan covers global Wall Street for us. Check on futures ahead of the bell after a bang-up session yesterday. We're looking at a lackluster session coming into the start of this Friday, at least for S&P futures, really not moving there. You do see NASDAQ futures falling. When we come back, we'll talk with, I should say, the expected Santa Claus rally, maybe that we're already seeing with Ulrika Hoffman-Burchardi of UBS Global Wealth Management. This is Bloomberg Open Interest.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Goldman Sachs is the latest to boost its S&P 500 forecast. Strategists there see the benchmark hitting 7,600 in 2026, a nearly 10% upside from Thursday's record close. Those analysts cited AI adoption across industries, fewer tariff headwinds, and productivity gains. Let's bring in Ulrika Hoffman-Burchardi, CIO for the Americas and Global Head of Equities at UBS Global Wealth Management, which is obviously a very large wealth management. AUM must be tremendous. Business must be crushing it, especially with this new record, not just here, but around the world. Do you see us continuing higher from here?
Yeah, we actually think that this week is a little bit of an early read onto the two dynamics we think are going to shape 2026. One is supportive policy, and then an AI story that is now pivoting from CapEx to cash flow. And I think both of these dynamics support a broadening equity market, but also a higher equity market into next year.
Is the AI bubble concern not one that you share?
I think whether it's an AI bubble or whether valuations in those stocks are high, for me is largely definitional. The question really is about fundamentals. Valuations are never a cause for a stock market correction. They show you the amplitude of a potential correction if fundamentals disappoint. If we go back even to the 99, the heydays of the internet, we saw NASDAQ valuations peak in December 98, and yet the NASDAQ increased by another 100% after. So again, you need fundamentals to change. In 2000, there was the loosened profit warning, it was the Fed hiking rates, and it was also dot-com companies running out of cash. And I think none of these conditions are here right now.
All right, I'm gonna save the banks question because I have viewers writing in saying, hey, can this rally in European bank stocks last? US bank stocks have done very well as well, and it's, I think, a big part of maybe future growth. I'll ask you. Ulrika Hoffman-Burchardi is staying with us. Check on futures ahead of the opening bell. On the S&P, not a lot going on, but on the NASDAQ, because of Broadcom earnings, because of China stimulus, we're looking at a drop in futures of about 0.5% on this Friday morning. This is Bloomberg Open Interest.
Estava sitiada.
Nisso eu começo, eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on. Really, NASDAQ futures are where you want to pay most attention because we're seeing the biggest move there, down 0.6%. S&P futures are down a little bit, but you know, we had all new record highs on the big benchmark indexes. The S&P 500 closed over 6,900 yesterday, and so a loss of 0.2%, maybe not a huge deal. Chipotle, which has had a very tough time ringing the opening bell at the New York Stock Exchange, CMG, the ticker there, and it's really a huge part of the whole K-shaped economy narrative and whether or not you still want, I think they call them slush bowls, or someone in the control room, slop bowls, whether you're still into that or now you want a handheld sandwich again. We have Wealthfront ringing the opening bell at the NASDAQ marketplace, which is very cool because the CEO is going to come and join us in a little bit, and this is at least one of the companies that has really changed the money market industry, an irreversible shift for younger generations that are using it basically as a checking account these days, and just looking at more than $8 trillion now in money market funds. In terms of stocks to watch, Broadcom is one of the big weights on the NASDAQ. It'll be a big weight on the S&P as well, as this company has gotten ever bigger and done ever better. But now investors say not good enough when it comes out with its outlook for AI. The backlog was 73 billion. That's over 6 quarters. They said that's at the minimum, but investors want to see more. Lululemon is higher as it sees solid holiday demand. We heard that from Stephen Yaloff at Tanger, although that's an outlet store and maybe that's part of the problem. The CEO, Calvin McDonald, is going to step down in January. Investors may be worried he's brought it a little bit too mainstream, and they want to see a reset. So the shares are up almost 13% in the early trade. And we're back with Ulrika Hoffman-Burchardi of UBS Global Wealth Management. Ulrika, I wanted to talk to you about bank stocks. It's been a focus of ours the last couple days because they've outperformed by so much in Europe. They've done very well here in the U.S. as well. And how much of that is part of, the broadening out trade? It's not just these 7 hyperscalers or top 10 stocks that you want to buy, but you're getting into other things like finance.
Yeah, when we look at the macro, maybe just to step back, then we see this dual engine of both monetary and fiscal policy that's now coming together. We saw the Fed, of course, lowering rates by 25 basis points again. Not only that, but also adding liquidity by buying T-bills. And then we have the fiscal stimulus that in particular is going to apply for the first part of next year with the tax refunds, helping the consumer, but also the delayed spending from the government shutdown. So all cyclically very positive conditions for financials. And then you have on top of that more room for deregulation. You have also increased capital markets activity that we think is going to happen next year. So we like financials as a sector together with technology, but then also increasingly healthcare as a diversifier to both of these.
So you really do see a broadening out. It's not just these, top 10 biggest companies that are growing earnings at a double-digit clip. What do you expect from earnings for the whole market in 26?
For the whole market in 26, so first of all, our price target is 7,700, 305 earnings, and probably a broader distribution of earnings within the other sectors. Again, in particular, we think the AI trade may be broadening out within technology, but also across other sectors. We have seen this week 2 more data points where just CapEx or just backlog in orders for AI infrastructure are no longer sufficient to drive stock prices higher. So we think actually the value may now increasingly accrue in the application layer of AI. So those companies that are using AI to actually drive margins and increase cash flows. And we think financials and also healthcare both actually have the potential to use AI with their very unique and proprietary data sets.
In financials and healthcare, we hear a lot of optimism there. In software, there's so much pessimism. You know, that AI is, Howard Marks was out with a note a couple days ago saying that AI is going to replace software engineer or coders' jobs. I actually heard an interesting anecdote from Reid Hoffman yesterday. He was speaking at the Economic Club of New York. He said, you know, he thought radiologists were all going to lose their jobs because AI was so good at detecting cancers in screens. But it turns out that screenings just shot up like exponentially. So now we have an undersupply of radiologists. How do you think it's going to fall in terms of job killer versus production driver?
I mean, what we do see right now in the labor market, right, at least anecdotally, that the parts of the labor market that are weak are also the parts where actually AI captures most value. So software engineering, right, technology is relatively weak when it comes to the labor market. Then we also see areas of marketing, customer service being weak. So we don't have a full empirical study yet, but I think anecdotally, there seems to be some correlation. And actually that for us makes us more skeptical on the labor market going forward, maybe similar also to Fed Chair Powell's comment that we think the labor market may remain sluggish and the Fed actually may cut, we think, at least 1 more time in the first quarter, whereas the economy could potentially even accelerate in this environment. So a pretty unique setup if you think about it, and something that is, of course, very benign for the equity markets.
Is inflation a concern for you? We're going to talk to my editor-in-chief emeritus, Matt Winkler, at the end of this program. He has an op-ed out saying, look, the average consumer in America is paying an extra $1,000 at least because of tariff effects. Is that a concern for you, especially with a Fed that's cutting rates?
We don't think so. We actually think there are 3 disinflationary forces next year. First of all, we're going to anniversary the tariffs right in April. Then we also see the labor market still being weak, so wage inflation coming down. And then shelter inflation, of course, always has a lag, so that's still coming down. And even if the economy starts to accelerate again, shelter inflation could still stay low because of its lag. And then we see still wage inflation coming down because of potential AI replacement. So for us, that makes us actually on the inflation side relatively optimistic that inflation is staying contained. And also that gives, of course, the Fed more room to cut.
What do you think about the U.S. versus other markets? I was talking with J.P. Barnard, our reporter in Frankfurt earlier, about the incredible outperformance that we've seen, even if you take out the currency effects in Europe versus the U.S. Our investors are, you know, the high net worth individuals that put their money with you really still interested in broadening out and diversifying further?
No, I think this is a theme that we are continuing to watch. We do think because the U.S. economy, the largest economy in the world, is still very strong in economic growth, poised to accelerate next year, that will also be a good backdrop for global economic growth. And of course, we also see stimulus coming out of Europe. So we are broadly positive, not just in the U.S., but also in Europe and parts of Asia.
What are the big risks, Ulrike? I hate to ask you, this is my last question, you know, getting ready for Christmas, what are the things that keep you up at night?
So with valuation being as high as they are, I think there has to be more scrutiny on the risks. And typically the risks, in my view, lie where the capital is most extended, and that is AI, and it is also government debt to a large extent. So we watch those areas carefully. On AI in particular, we don't see any immediate warning signs. AI adoption is trending higher. AI spending plans are still there. But there are, of course, risks with this amount of CapEx that we're seeing. And then on the government side, of course, we have record deficit levels. We have record debt to GDP ratios. But again, if you look at the macro conditions that are most helpful in this environment, which is elevated but contained inflation, rates that are benign, and then economic growth, those are the conditions that historically, at least, have helped to contain the budget deficit.
Will rates stay benign, or are these spreads going to stay so tight?
For the time being, we think so.
All right, great having you in here. Really appreciate you joining us on set. Ulrika Hoffman-Burchardi there from UBS Global Wealth. Let's get a look at what's going on in the market. Almost 10 minutes into the session here, we do see the S&P down, but only 3 points. So honestly, not a lot of movement, especially if you consider yesterday we closed at 69.01, so an all-time high. Right now we're at 68.98, so just a stone's throw, obviously, away from that. In terms of the point additions, you're going to see, obviously, the biggest stocks here, but Tesla leading the pack there ahead of NVIDIA is one of the concerns this morning. Yesterday, it was Oracle and Apple, Netflix, and GE, Google, UNH. On the downside is where you see the earnings story coming through. So Broadcom is one of the concerns this morning. Yesterday, it was Oracle, and Oracle is down again today, but only by about 2%. By the way, yesterday, I think Larry Ellison lost yesterday $25 billion of personal wealth with the 11% drop in Oracle shares. Still, he's made an extra $95 billion this year, so don't cry for the big stakeholder in Oracle. In terms of the industry groups here on the day, we're looking at materials, consumer discretionary, real estate, and utilities doing the best, so it's kind of a defensive leadership here, but this is interesting that you have so many sectors up. In fact, Joe, did we reset this? So many sectors up, and yet, yeah, that's amazing. So almost all of the sectors up, 9 out of 11, and still it's IT and energy. These drops, as slight as they are, enough to drag down the broader index. Okay, it's only off by a fraction. Coming up, Broadcom shares slide as investors look for a bigger AI payoff. More on that earnings report and the state of the industry next with Mandeep. This is Bloomberg Open Interest.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Technology
technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Time now for our top call. Some of the analyst action in focus this morning. First up is Jefferies upgrading Lululemon after the wannabe upscale retailer boosted its outlook. I guess it's fair to say still pretty expensive stuff, and reported encouraging holiday trends. Lululemon is also shaking up leadership after a sluggish year, with its CEO planning to step down in January. You can see the shares up almost 13%. Next up is JP Morgan boosting its view on Citi. The analyst says Citigroup is set to benefit more than peers from a firm economy and stronger markets activity into the new year, and Citi shares are up a little more than a third of 1%. Finally, Guggenheim is upgrading Bristol Myers. The firm says the pharma giant is headed into a catalyst-packed 2026 with low expectations, rising royalties, and a sturdy dividend. Guggenheim sees the stock slump as a buying opportunity, and investors are doing that today to the tune of 3%. Broadcom shares in the red as its AI sales outlook disappoints. Joining us now to talk about this is Mandeep Singh, Bloomberg Intelligence Global Head of Technology Research. And Mandeep, I'll say the same thing to you that I said to Ed Ludlow. You know, on the one hand, we're scrutinizing these hyperscalers because we're worried that they're spending too much. On the other hand, a $73 billion backlog is not enough for us at Broadcom.
Yeah, I think in the case of Broadcom, if you parse through the backlog, it's all tied to Google TPUs. And that is where, you know, everyone is comparing what happened with the Apple exposure when it comes to the non-AI side of their semi revenue, too much dependence on Apple. And the same thing is happening here when even Anthropic added $20 billion of orders. They are using Google TPU design. So from that perspective, you know, the ecosystems are forming where it's pretty much a duopoly at this point of time. Either you're using NVIDIA or you're using Google TPU. And in the case of Broadcom, 90% of their AI revenue is tied to Google TPUs. So even though they talk about OpenAI as a potential new customer with up to 10 gigawatt capacity, it seems very unlikely that any of that backlog will translate into revenue before 2028 or 2029. And that's where I think the dependency is what's hurting their margin expectations. And that's why you see that sort of a stock reaction today.
You know, the Google TPUs sort of emerged as a threat potentially to NVIDIA's Blackwell chips and whatever's coming next. What does Broadcom have in terms of that kind of competition?
Well, so Broadcom really is working with Google, you know, to be their partner when it comes to designing their TPUs. They're providing certain components for the accelerator, and they are ultimately liaising with all the suppliers to get the chip made and manufactured by TSMC. But when it comes to other ramp-ups, like from Meta or, you know, some other customers that they had talked about in the past, it seems like those haven't really panned out in a big way. In fact, we have heard Meta may end up using Google TPUs as well. So there was a lot of chatter about 2 new customers up until the last quarter that may be ramping up at Broadcom. But it turns out one of them was Anthropic, and Anthropic in turn is using Google TPUs and not really designing their own chip. The only one that had talked about using their own chip was OpenAI, but it sounds like that effort is likely going to get pushed out to 2028, 2029 before they can ramp up significantly. So from that perspective, all of Broadcom's $30 billion plus in AI revenue is mostly tied to Google TPUs at this point of time.
All right, Mandeep, thanks so much for joining us. Mandeep Singh there of Bloomberg Intelligence talking to us about the chip wars and Don't miss, by the way, a conversation about AI policy with White House Special Advisor David Sachs. That's on Bloomberg Tech at 11:45. Will be, no doubt, a fascinating interview. And let's get a quick check on three stocks we've been watching all week. Warner Brothers is up about 14% this week. Netflix is down, well, this is the intraday move that you're looking at, but Netflix is down 4% over a week, and Paramount is actually gaining. We're keeping an eye on the race to buy Warner Brothers, and to clarify the deal terms, $5.8 billion will be paid by Netflix in the event that the deal does not pass regulatory muster. But if Warner Brothers were to choose, shareholders were to choose to go with Paramount, Netflix would get paid $2.8 billion by Warner Brothers. So it all comes down to who does the breaking up. Coming up, President Trump plans a push to reclassify marijuana as a less dangerous drug. We'll take a look at some ETFs that could shoot higher. Well, some that have done pretty well year to date. This is Bloomberg Open Interest.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Burden in Florence, Italy, and this is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on in stocks. 21 minutes after the bell, we see the S&P 500 down 0.25%. Reminder again, it did hit a record high at the close yesterday, 69.01, that level. The NASDAQ down almost 0.75% today, and the problem really is Broadcom earnings. We had a little bit of a rebound in NVIDIA shares, but they are now back in the red. Down only 0.1%, but it's a very heavy company, and Broadcom losing almost 1/10 of its value. Costco is off after earnings, only 1/3%, and we really do see encouraging signs for these big box stores that higher end consumers are moving down. Lululemon getting a huge boost as the CEO steps down, making way for a reset, and also Lululemon has a decent holiday sales forecast. And then here are, well, Tilray Brands, the weed company, I guess, out with a new lineup of products, up almost 30% today, and the Round Hill Cannabis ETF also up more than 30%. Let's talk about cannabis ETFs with analyst James Seyfert of Bloomberg Intelligence. James, clearly a report that President Trump wants to not decriminalize or declassify, but I guess reschedule marijuana as a Schedule 3 drug rather than Schedule 1 is helping these assets.
Yeah, 100%. I mean, the way to look at this, right, there's a whole host of marijuana or cannabis ETFs out there on the market, but there's like two that are really purely focused on the U.S. type of market. And that's MSOS and Weed, the roundtable one that you mentioned. And it's because, like, MSOS is a ticker that seems weird, but it's because it holds only multi-state operators, and it's because there's, you know, this patchwork of regulation in the U.S. For marijuana. It's legal in some states, it's illegal federally, and if you cross state lines, it's like you're in this gray area. So these stocks, these ETFs, while they're not going to be the most diversified exposure to the marijuana market, they give you exposure to the names that are most likely to pop on things like, you know, what you just mentioned, changing the scheduling and any sort of regulation here in the U.S. that could maybe open it up federally. So those names are going to pop the most. And Weed, specifically from Roundhill, it only holds 5 of those largest MSOs, multi-state operators.
All right, so we'll watch MSOS. They've had a decent year in terms of the gains that we see, especially now. Let's take a look at the decent year that ETFs have had. I mean, every year you and Eric and Athanasios are like, wow, our industry is just breaking new records across the board. This year is no different, and 2026 is also set to be a banger.
Yeah, I mean, so we had our ETFs in-depth event yesterday at our New York headquarters where you are right now. And it was a really successful event, but Eric gave a presentation to look at like what happened so far in 2025. And he basically titled it, "Is this as good as it gets?" Because every record that we look at, every factor, everything we look at is a new record. And it's not just like slightly eking out. It's beating records by 25 to 30% over prior years. And we're not even done with the year yet. So, I mean, we're nearing in on $1.4 trillion of inflows this year. We have record volume. We have record new ETFs. Vanguard is going to take in over $400 billion alone. That's a record for an issuer. The Vanguard S&P 500 ETF is taking in $130 billion. That's a record for a single ETF. I mean, I could keep going if you really want, but everything has been really good for the ETF industry here in the U.S.
Well, it makes sense because the kids just want to voo and chill, right? If you buy that tracker, I guess you're diversified to some extent and good to go. And there are more catalysts to come, right? For ETFs specifically, could we see investors buying them in their 401ks and their IRAs?
Yeah, I mean, possibly it could go more into the retirement market. As you mentioned, like who doesn't love an S&P tracker where you can get it for 3 basis points? It's virtually free and you're getting exposure to the U.S. large cap market, right? So that's what's happening. But it's also like we call them degens, the real heavy traders that like to trade on leverage. Lots of those products are coming to market and they're having a lot of success, which is part of why we had a record volume level this year. But yeah, as you mentioned, next year we just got approval for basically any mutual fund can add an ETF share class onto their mutual fund now from the SEC. They're approving these things for a lot of different issuers, so that's a tailwind that could happen. There's a whole bunch of other tailwinds. We're still seeing a lot of movement from legacy structures like the mutual fund moving into the ETF, and ETFs are just continuing to snowball. But one thing I do think is going to happen, we haven't seen a lot of liquidations. I would think that we're probably going to see a lot more liquidations next year because we just saw, as I mentioned, we're almost over 1,000 ETF launches alone in 2025. I mean, the numbers are getting crazy.
James, to be fair, they call themselves degenerates. They are smooth-brained apes, and they are crushing it. James Seyfert, thank you very much. Tune in to ETF IQ on Mondays at 12 p.m. New York time. Coming up, Cam Dawson joins us. She sees more room for stocks to run as more strategists turn bullish.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
CBS News on the Hour, sponsored by Eggland's Best.
I'm Deborah Rodriguez. We begin in Baltimore with a key figure in the Trump administration's immigration crackdown. Supporters cheered for Kilmar Garcia Abrego as he showed up for an appointment at an ICE office hours after a federal judge ordered him freed from federal custody, calling his long detention troubling and without lawful authority. Abrego Garcia spoke to the crowd through an interpreter.
I stand here today with my head held up high, and I will continue to fight and stand firm against all of the injustices this government has done upon me.
Minutes later, a federal judge ruled officials could not detain him again. Heavy rainfall has pushed rivers to record flood levels north of Seattle. More than 100,000 people have now been forced from their homes. Correspondent Carter Evans is in Mount Vernon.
Across western Washington, rivers rising to historic levels left people stranded on their roofs near the Canadian border. The Coast Guard flew in by helicopter to rescue them. At 10 feet above flood stage, the town of Hamilton was inundated with water, nearly reaching rooftops. More than a dozen rivers overflowing their banks have trapped residents in their homes, submerged vehicles, and forced road closure.
President Trump has signed an executive order putting the federal government in charge of crafting rules to regulate artificial intelligence.
Some states have already passed their own AI laws. The president says that patchwork of rules may turn off companies looking to invest in AI in the U.S.
If they had to get 50 different approvals from 50 different states, you can forget it.
David Sachs, who chairs the president's Council of Advisors on Science and Technology, says the administration will not challenge state laws regarding kids' safety and AI.
But we're going to push back on the most onerous examples of state regulations.
Some lawmakers on both sides of the aisle say the president's order infringes on states' rights. Michael Wallace, CBS News.
A measles outbreak is growing in the South. CBS's Jim Krasula.
More than 250 people, including students from 9 schools in the Spartanburg area of the upstate of South Carolina, are in quarantine because of a growing measles outbreak. A state health official says there's no signs the outbreak is slowing because of the area's, quote, lower than hoped for vaccination coverage.
Longtime leader of the Black Lives Matter movement in Oklahoma City has been indicted for fraud and money laundering. 52-year-old Sherry Dickerson posted a video to social media.
I don't even get it myself, but we gonna be all right, right? I'm okay.
Dickerson's accused of embezzling more than $3 million of the group's money to vacation in the Caribbean and purchase 6 properties in Oklahoma City. This is CBS News. An odds-defying comeback victory overseas.
41-year-old skier Lindsey Vonn on the downhill course at St. Moritz, Switzerland.
Look at the time! Lindsey Vonn now! He's absolutely flying! History in the making!
She won the World Cup downhill event, her first victory in nearly 8 years, and her first with titanium implants in her right knee. Vonn called it an amazing day. She was the 2010 Olympic gold medalist and looks to compete in 2 months at the Winter Games in Italy. Steve Kathan, CBS News.
New York Post is reporting a secret sale of Jeffrey Epstein's possessions has brought in more than $100,000, and there's more to come. A second round that began this week includes an antique Viennese desk the convicted pedophile kept inside his New York City home. Some descriptions on items do make mention of the previous ownership, others don't. City records show the limestone mansion's been gutted by the new owners. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube as well, so you can head over to youtube.com, search Bloomberg Podcast, and that's where you'll find the live feed there. Scarlett Fu is off today. She'll be back Monday. And Christine Aquino sitting in for Scarlett. Thank you so much, Christine. Appreciate that. For the next couple of hours, this is the Bloomberg Intelligence program. Coming up, we're going to check in with Ed Ludlow. He's a B-Tech co-anchor. A lot of tech news out there. I'm going to start with Broadcom. Shares trading down after investors saw we're looking for, I think, a bigger AI payoff. I don't know. The numbers look good to me, but we'll see. Poonam Goyal, senior U.S. e-commerce and retail analyst, she'll join us here, break down what's happening at Lululemon. They got a new CEO there. They need a little bit of a turnaround, is what I've been told there. Cam Dawson, CIO of New Edge Wealth. She's going to be in studio to give us her thoughts on these markets post-Fed. So a lot coming up in the next couple of hours. And right now, we kick it all off with a Bloomberg Business Flash with Lisa Mateo.
And this Bloomberg Business Flash brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more at ibkr.com/around-the-clock. Well, U.S. stocks, they held back once again by a retreat in tech shares a day after Oracle fell almost 11% and wiped out almost $25 billion from Larry Ellison's wealth. Shares of Broadcom, they are down more than 9.5%. That's after its sales outlook disappointed. The bar was really set high. We look at Oracle shares too. They're down about 3%. So we go to NASDAQ, down about 0.7%, 171 points. The S&P 500 falling 0.3%, but the level 6,873. The Dow up 0.2%, 48,815. Gold rising for a fourth day. Silver extending an all-time high. We have oil falling. The Bloomberg Dollar Spot Index, that is little change right now. Let's take you to earnings. We'll start with Costco, the nation's largest big box retailer. First quarter total revenue was in line with estimates, but I think investors were looking a little bit more. Costco shares down about 0.5%. Then you have furniture retailer RH, operates a restoration hardware chain, reported higher growth than its rivals like Wayfair and Lazy Boy. Its shares are up about 10%. And a pretty tough run for shares of Lululemon. They are now higher. Finally, yes, up 10%. Boosted its full year outlook, announced that CEO is stepping down at the end of January. That is your Bloomberg Business Flash. Christina Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. Christina Aquino sitting in for Scarlett Fu today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Market Drivers today is brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor to staff ratio. Small firm attentiveness, big advisor impact. Go to commonwealth.com to learn about their consultative support and technology. Let's take a look at what's happening in the marketplace today with stock movers. We do that today with Bloomberg's Emily Griffith. Emily, what are you looking at?
Okay, so I'm looking at shares of Lululemon, ticker Lulu, L-U-L-U, up 13% right now, the highest level since July after the company boosted its full year outlook. And they said that the CEO, Calvin McDonald, is going to be stepping down after a period of sluggish growth. So the stock had been down more than 50% through Thursday's close. We got the news late yesterday about the CEO stepping down, and now it's boosting the shares. And if you look at like a chart here of the comp store sales growth for Lululemon, it's been declining for at least the last 2 years. There's been rising competition in the athleisure space.
Yeah.
It's not just Lululemon anymore, which, you know, those leggings are very expensive.
That's what I heard. There are a lot of other legging brands.
Are you guys Lulu people?
No, not necessarily.
I will say this is not a, this is not a tout for Lululemon, but I will say all of the Lulu products that I have hold up really well.
That's what I hear.
Yeah.
So then you don't have to buy anymore. So maybe that's why they're not selling as many leggings, because the product
you get what you pay for.
Yeah, but there's just a lot of other athleisure companies out there. Athleta, which their parent company is Gap, Alo, Vuori, Amazon.
I mean,
it's tough out there.
I'm going to say like a year ago, Derek Jeter came in here because he was doing a partnership on the athleisure space with a guy from the Untucked shirt dude.
Mm-hmm.
And I go to Derek afterwards, why are you doing this, man? It's so competitive.
Yeah.
You're going to go up against Nike and all. Are you kidding me? I don't know. He's smarter than I am, I guess. We'll see how that goes. All right, what else you got for us?
Okay, so I'm also watching shares of Broadcom, ticker AVGO. It's down 9%, the biggest decline since April. Lisa Mateo was giving us the rundown, but I'll go through it again. The chip company's sales outlook for AI computing revenue missed expectations. The stock had run up quite a bit, so the expectations were quite high going into the earnings, and their CEO Hock Tan said just yesterday on a conference call with analysts, the company has a backlog of $73 billion in AI product orders that will be shipped over the next 6 quarters. That doesn't sound like a bad thing, but the number disappointed some investors here, that it wasn't quite enough. And people are very sensitive right now when it comes to companies are spending on AI. Are they actually generating a profit? And how quickly can they generate that profit? So anything that misses expectations, it feels like it really brings the stock down.
Yeah, sounds like Broadcom was really just the victim of really, really high expectations. So even if it did well, it's not good enough. All right, Emily, one more. You're looking at cannabis stocks today, which are soaring high.
Yes, they are soaring much higher. Tilray Brands is one of those cannabis companies. Ticker TLRY. It was up as much as 44% on an intraday basis. Now it's up about 26%. We have reporting out today that Trump is expected to direct his administration to reclassify marijuana as a less dangerous drug. This is big news because cannabis is currently labeled a Schedule 1 drug, up there with heroin and LSD. This means that it's categorized as having no medical use. And so Trump is pushing it back to reclassifying it as a Schedule 2 drug, which is seen in the industry as something that would boost sales and be good. But there was kind of news of this back in August that Trump said he was going to reclassify it. And there was a big move in the stocks, and then it kind of reversed. So we'll see if he actually makes this move and the stock gains hold.
All right, good for the gummy folks out there. Weed stocks, who would have thought? Emily Graffeo, thank you so much. We appreciate that. Emily Graffeo covers all the markets for Bloomberg News. And for more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen here. Technology continues to be on the forefront for this market. Some cross currents here. We've definitely seen some weakness, like you're seeing today. We got the Nasdaq off about 0.7%, while the Dow is up a little bit. We've seen that kind of trend over the last several days here. Is it kind of concerned, or just people, looking at the AI trade maybe in a little different light here? Ed Ludlow joins us here. He's a Bloomberg BTech co-host there. He's out in San Francisco. He's right smack in the middle of Silicon Valley. Ed, from your, just cruising around the valley here, what's the feeling about AI and the growth prospects and the ability to really impact companies' P&L? Is that anything changed?
Yeah, not much change. Broadcom as a case study is everything that we've seen throughout the year, which is at this point in a cycle, you want some tangible evidence that you're booking revenues directly from all this, the headline and hype. And the thing is that AI models are pieces of software. The software gets written, the code gets written in a data center, and in those data center there are chips. And it's a very material thing. It's in the real world. And the limiting factors right now are not the chip companies themselves. And so, Emily did a really great job to summarize kind of, I guess, what might be billed as investor fatigue or the market giving something back. But that's all they wanted to see was some revenue, some direct revenue from the AI offering that they have.
Yeah, and the fact that the CEO Hock Tan not necessarily wanting to commit to an annual AI revenue forecast, instead calling it a moving target, is that something that's adding to the concerns that we're seeing being reflected in the shares this morning?
Yes, a lack of a specific financial metric, which was revenue in the next calendar year and their next fiscal year. A $73 billion backlog is not a bad thing. But, Paul, maybe you jump in and tell us, in your illustrious career on the street, how much credit has a company ever been given for a backlog? Because, again, it's not material to the top line until you book it as revenue because the business is done.
Yeah, but, I guess the Anurag Ranas of the world of Bloomberg Intelligence, for a software company, that's typically really important here. So I was just wondering, it seems like, what's the 2026 theme you're looking out for in Silicon Valley in technology? Is it just a broadening case of AI, or something else you're looking for?
No, I mean, we will continue to study capital expenditures and whether there are enough chips to go into enough data centers. But the AI story is going to be a little bit about how AI shows up in the real world. The story of the last couple of years was training very large models and transitioning those into something useful. The first iteration of that being generative AI tools, right? I use ChatGPT every single day for a lot of things. I use Google Gemini, I use Anthropic's Claude, whatever. The next phase of that is agentic AI. Agentic AI being when you are in any given consumer app, the easiest way to understand it, say you are flying United Airlines and you use their chatbot, the next evolution of that chatbot's ability is some autonomy. Its ability to make a financial transaction, book you onto another flight without human intervention. And I think a lot of people see that coming next year. And from a compute standpoint, there is a big difference on the inference side, running AI models, particularly in the agentic context, and what that will require compute-wise versus what we've seen in the last few years, building data centers to train those models. That's the story of 2026, methinks.
Well, speaking of 2026, I mean, we still have a lot of strategists out there, Goldman Sachs included, saying that they still expect AI to drive fresh market records next year. But at the same time, like today, Broadcom's example showing us that you can be the victim of really high expectations. So how do those themes square up? And what does that mean for market sentiment moving forward, especially when it comes to the AI trade?
Yeah, there are so many different data sets that we're tracking, right? So in today's market, as in literally this morning, Broadcom is down a lot, and that's going to be weighing on the indexes, right? But this was a stock that was up 70% year to date, and it's no more complicated than that, so factor that in. Elsewhere, in the background, and this will continue to be a big theme, revenue growths are either there or they're not. But there are other worrying indicators like, for example, debt and free cash flow. Oracle is probably the best case study of that at the moment. Negative free cash flow deeper than expected, capital expenditures higher than expected, their debt piles more than 100 billion.
Right.
You've been through these cycles, Paul. People get worried about that? They often do, don't they?
They do. Ed, thanks so much for giving us a few minutes of your time. Really appreciate a lot of news flow coming out of your part of the world. We appreciate getting some of your time. Ed Ludlow, B-Tech co-host. He's out there in San Francisco, folks. He's right in the middle of Silicon Valley, right in front of all his sourcing out there in the Valley. So he and Caroline Hyde do a phenomenal job bringing the world of technology to Bloomberg. We'll have more coming up. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Having this Bloomberg Business Flash brought to you by Harvard Business School Executive Education, a world-class learning experience for aspiring and established change makers. Prepare for the next elevation for your organization and for yourself. Learn more at hbs.me/breakthrough. Well, looks like Broadcom slide highlighting AI investor impatience. Its shares are down more than 9.5%. NASDAQ leading the losses, down nearly 1%. The level of 23,375. We go to the S&P 500, down 0.5%, 6,865. And the Dow, not much movement there, up about 44 points, 48,747. The 2-year yield, 3.54%. That's little change. And the yield on the 10-year, 4.85%, and that's up about 4 basis points. We go to the Bloomberg Dollar Spot Index. That's up about 0.1%. And cannabis stocks, they are surging. That's after sources say President Trump looking to reclassify marijuana as a less dangerous drug. So we look at Tilray, and their shares are higher. They're up about 25%. And Village Farms, their shares up nearly 12%. Another sign of SoftBank's founder looking to expand into AI. Sources say the company looking into potential acquisitions, including data center operator Switch. And Reuters reporting NVIDIA has told Chinese clients it's evaluating adding production capacity for that powerful H200 AI chip after orders exceeded its current output level. That is your Bloomberg Business Flash. Christine and Paul.
Hi, Lisa Mateo. Thank you so much. We appreciate that. Christine Aquino sitting in for Scarlett Fu. I'm Paul Sweeney live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. I'm looking at Warner Brothers Discovery, right up close, just under $30 per share. I'm not sure what's pushing it, although I kind of think it might be some reporting from Charlie Gasparino over at Fox Biz and the New York Post. He says he's out with a report saying, or out with a tweet saying, Paramount Skydance is considering raising its takeover offer for Warner Brothers Discovery by much as 10%. I don't know. It just seems like there's going to be some higher prices coming here. So, again, Charlie Gasparino out with that quote I saw yesterday, or late last night, maybe. I'm not sure. That might be it. So, looks like there's more rounds to come here. We'll see. Let's talk about the retail space here. We heard from Lululemon. The stock surges. We had the CEO changing and maybe suggesting some new strategy there. Poonam Goyal. She's a senior U.S. e-commerce and retail analyst for Bloomberg Intelligence. She's based down there in Princeton. Poonam, what do you make of Lululemon? What did you learn in the earnings, and what do you expect to see from this change in the C-suite?
Yeah, so there's a few things. So earnings for the quarter showed strength, but the guidance was weaker, and the strength really came from outside of the U.S. So we're not surprised that China is strong. China has been a strong point for them for quite some time. The issue is still the U.S. domestic. The domestic business is weak and continues to be weak. And we think it's a function of just lack of differentiation, product innovation over the last few years. And the biggest news yesterday, quite frankly, was the announcement of Calvin McDonald stepping down as CEO and the search for a new CEO for next year. So I think investors are excited to see new strategy, new vision, to see who can run this ship back to sail, because Lululemon has lost ground in recent years.
You know, Poonam, yeah, it's interesting that you mentioned a lot of gains being ascribed to that leadership change at Lulu, right? But given all the other challenges of the company that you've just described, is this really going to be a material? How much does this leadership change? How much will it do to right the ship, as you say?
It's going to matter, but it's going to depend on who takes the top role here, right? We would like it to be a product-led executive, because we think product is key in retail. And the reason Lululemon has lagged behind and has lacked competition, especially the emerging upstart brands take some of its share, is because it hasn't stayed ahead as it once was in its product offerings. There's less differentiation, and the price points are comparable.
That's where I wanted to go, Poonam, because when I talk to people like in this studio about Lululemon, I hear the same thing. Good product, but boy, it's expensive. Is that an issue for them in terms of product placement?
I don't think it's an issue for them based on where they sit, because if you think about the Lululemon product portfolio and you compare it to a Viore or an Alo, they're quite similar. Now, if you compare it to an Aerie, which is a brand by American Eagle, yes, the price points are higher. But I don't think the price point is the issue here. I think the consumer wants to see more, right? The Align leggings have been around for so long, and I love them. I truly do. But I also like aloe, and it's just like, what are you giving me to make me like Lululemon so much more? And are you giving me innovation constantly to make me try the next new thing? I think that's the big gap here. They need to put innovation back on track, and they're trying, but it's just we won't really see much of that until next year. And then when we do get a new CEO, it'll be interesting to see the vision that they set forward.
I'm a big fan of Lululemon. Whoever invented the Lululemon thing.
You love the leggings?
Yes, you get an award, special presidential award in my mind. Poonam, thanks so much for joining us. Poonam Goyal, she's a senior retail analyst for Bloomberg Intelligence, giving us the latest there on Lululemon. All right, we got the Fed kind of did what it said it was going to do this. We've got the 25 basis point cut in rates. Folks were looking for what they were calling a, I guess, hawkish cut, which would be, all right, we'll give you the cut, but we're not going to give you much more. But I don't know. Chairman Powell's comments to me were kind of dovish. I don't know how to read it. But our next guest does. She's a pro. Cam Dawson, Chief Investment Officer, New Edge Wealth, joining us live here in our Bloomberg Interactive Broker Studio. So, Cam, what was your takeaway from Fed Day today on last Wednesday?
We think that they set themselves up to be able to deliver more cuts in 2026. If we think about the unemployment forecast that they had, they kept it at 4.4%, which would be the same as it is this year. And that suggests that it wouldn't take a lot of weakening in the labor market for them to say, hey, this is worse than what we thought, we can deliver cuts. They also, Powell did mention about this willingness to see inflation related to tariffs as one time, effectively saying that we're not going to use that dreaded T word, but we do think that we can look through some temporary near-term inflation, which all just suggests that there's still a bias or leaning towards cuts. We think the biggest question as we go into 2026 is, of course, who the new Fed chair is going to be, but most importantly, what is that new Fed chair's definition of neutral? Because right now, the median long-term dot in the dot plot is for a 3% neutral rate. But then Powell said we're pretty darn close to neutral. Myron's dot was all the way down to 2%, suggesting that his arguments for that neutral is lower today than it was in the past is being reflected in that dot.
Yeah, well, speaking of the dots, Cameron, I mean, very interesting, right? That we really only got, in terms of median, the expectation that there's going to be just one cut next year. But a lot of volatility in those dots, as you mentioned, right? The spread is probably one of the widest that we've seen in quite a long while. And of course, markets still expecting 2 cuts for next year. So how does this all square in terms of the rate path outlook for 2026?
Yeah, it's fascinating. If you look at that 2026 distribution of dots, you could drive a Mack truck through it. It's something that's never been before seen, so very wide of this divergence between people expecting no cuts to all the way down at the very low end of getting down to that 2%, which means that there still is a lot of uncertainty. And we think, of course, and this is going to sound trite, but it really does depend on how the data progresses. We think that most of those recalibration cuts getting closer to neutral by its current definition are likely already done. So it's a question of, where does the labor market break? If it is weaker, even a slight bit weaker than what we're experiencing today, then do expect more cuts. But then, of course, that will be very determinant of how the bond market reacts to this labor market weakening, which could put downward pressure on the long end.
The Fed has a 2.3% GDP forecast for 2026. Isn't that above the street?
It is, yeah.
Do we see that often, or what does that tell you?
Well, the street, it's really interesting. We wrote about it last week because you saw the street forecast get cut really materially through the aftermath or during Liberation Day and have been climbing ever back since. And it's one of the reasons why markets have been so strong. We have a very simple rule. If GDP forecasts are going up, so are likely stocks. But what's interesting is now you've gone back to right before where you started before Liberation Day, which is about 2%. Now, 2% is considered the long-term average rate of growth, which tells us that this is less about forecasters having confidence in where growth is going, but just using a plug and saying, 2%, because we don't quite know where things are going to break.
Yeah, very interesting, actually, Paul, bringing up that forecast because, as Paul, you mentioned earlier, that it seemed like Powell's own assessment during his press conference sounded a little bit more dovish, right? And so it seems like there's a lot of tension between the statement and the forecast, and of course, big question over who the next Fed chair is going to be. I mean, how does that play out in terms of what the Fed is going to be able to do? And, will they end up actually being more optimistic than the street into 2026?
Look, we think it's really simple in that you have to be careful what you wish for too many rate cuts, because rate cuts because you can are very, very different than rate cuts because you should. And if they are given a darn good reason to cut, then it means that 2% is likely the ultimate goal. But that has to be taken in the context of a world where equity valuations are near high, earnings estimates are incredibly robust, and credit spreads are very tight, which means that when you think about financial markets, they're not contemplating any kind of slowdown within the overall U.S. economy. So that could be a source of surprise. We think that bad news is bad news over the longer term period, even if bad news is considered to be good news in a short period of time, as people think that the Fed's going to put some punch back in the punch bowl.
All right, so that's the Fed. We're here mid-December. What's your early 2026 outlook look like these days?
Well, as you know, we ascribe to the Price is Right rules. So we publish in mid-January, which allows us to assess the outlooks of what happens on the street. I think it's very interesting. There's not one single strategist who is expecting a down year in 2026. And now you have the average 2026 price target finally above where the current S&P 500 level is. For a long time, analysts or strategists were much more skeptical of stocks. So you've certainly seen that move into a much more bullish stance. What's fascinating, though, is that we always say, watch what they do, not what they say. Even though strategists are very bullish, you're not necessarily seeing that bullish positioning in institutional positioning. Meaning, if you look at that Deutsche Bank survey, it's in the 60th percentile. We've gotten up much, much higher when stocks have been strong and analysts have big forecasts, times like 2028, 2018, 2021. So we're not at the point yet where positioning is so stretched that we're worried about sentiment, but that is a key watch item that we think we'll have as we go into 2026.
Yeah. What's your over-under on S&P 500 7,000? Before the end of the first quarter or beyond that?
Oh, man. Look, we're long-term investors, and we'll keep sticking to that. We think that we could still have a positioning chase into year-end, and so 7,000 is really not that far away, and you are still raising GDP and EPS forecasts. So as long as EPS forecasts are going up, we're in an environment where we think people are forced to chase this market, which suggests that we wouldn't rule out a touch of 7,000 before the end of the year. But of course, as we go into 26, this all creates a high bar. So just as we should be able to be optimistic and think about the upside, we also should be very aware that high bars do create more potential for volatility.
Cam Dawson, thank you so much. We appreciate it. Cam Dawson, she's the Chief Investment Officer, New Edge Wealth, joining us live here in our Bloomberg Interactive Broker Studio. We appreciate that. Again, the Fed delivering on its rate cut for now. And now the question is, if you look at the WIRP function on the Bloomberg Terminal, 1, maybe 2 rate cuts next year. That kind of seems to be where the market is. The S&P is minus 50 points right here. That's 0.7%. The Dow off 13 points, and the NASDAQ off 275 points, 1.2%. So weakening in the market over the last half hour. We're going to have more coming up. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
This Bloomberg Business Flash brought to you by Harvard Business School Executive Education, a world-class learning experience for aspiring and established change makers. Prepare for the next elevation for your organization and for yourself. Learn more at hbs.me/breakthrough. Well, tech age is falling. Shares of NVIDIA rival Broadcom down 10% after its sales outlook failed to meet those high expectations. We look at the NASDAQ down more than 1%, 273 points. The S&P 500 falling 0.6%. The Dow, little changed, up about 29 points at 48,734. The Bloomberg Dollar Spot Index, little movement there. The 2-year yield, 3.54%. That's little change. And the yield on the 10-year, 4.18%. And that's up about 2 basis points. Shares of UBS, they soared the highest intraday level since early 2008. A group of lawmakers proposed watering down the capital demands that Switzerland wants to impose on the bank. Its shares right now, they're up nearly 2%. Uber said it expects to offer robotaxi services in more than 10 markets by the end of next year. Its CEO is telling Bloomberg possible new locations include Hong Kong and Japan. Cookie maker Crumble could be living up to its name. Bloomberg reporting layoffs, chaotic operations, paper-thin margins may be leading to trouble for the company. And finally, Netflix turning a mall department store into an immersive playground. It's open Netflix House, a 100,000 square foot brand activation, movie theater, sports bar, retail outlet. It's all in the King of Prussia Mall in the Philadelphia suburbs. That is your Bloomberg Business Flash. Christina Paul.
Lisa Mateo, thank you so much. We appreciate that. Christina Aquino sitting in for Scarlett Fu. I'm Paul Sweeney, live here in our Bloomberg Interactive Broker studio in New York City, streaming live on YouTube as well. All right, here we go. Global demand for military weaponry surged in 2025 and should keep rising as the U.S. and its allies seek to strengthen strategic deterrence capabilities. That's according to our next guest, Wayne Sanders, Senior Defense Weapons Analyst for Bloomberg Intelligence. He's based down there in D.C. Wayne, it seems to be a good time to be in the arms business, the defense business. Give us an overview of what you're seeing in the space.
Yeah, absolutely. I mean, if you look at the threat environment around the world right now, I think that you're starting to see all the precursors that we've known and been witnessing over the last few years. But everything that Russia is doing right now in Ukraine, as it still goes on, has really pushed NATO to be able to start looking at domestic production capability within their own, as well as the national security strategy for the United States pulls away from NATO and Europe a little bit. You're starting to see a big push there in Europe to have to be able to grow their own. But that doesn't happen overnight. So you're seeing a skyrocket in capability. You've seen a lot of the stocks jump across Europe as it continues to gain for a lot of the defense primes that are in Europe. But you still see a lot of it coming back to the United States because you're still dealing with the largest and best capabilities in the world. And so the three main areas that you're seeing a lot of this is really in space defense, air defense, and hypersonics are the areas where you're going to see a lot of money in 2026 really being pushed forward for. And we're talking about over $1 trillion over a 5-year period in growth. $600 billion for space defense. That's part specifically for the military side, over the $3.5 trillion that the commercial space is expected to bring in by 2030. $300 billion in air defense, which is probably the #1 priority that you see a lot of countries right now buying up and trying to be able to do. And then hypersonics is starting to move away from just being prototypes and into procurement for about $80 to $100 billion over that same period of time.
Yeah, well, $1 trillion. That is a lot of money pouring into this space. Who do you think is kind of best positioned in terms of either specific companies or maybe sectors to really capitalize on this monetization that's going to be happening in the next few years?
Yeah, I would stick to the primes when it comes to a lot of these. You see Lockheed. Lockheed is probably the biggest one when it comes to hypersonics for sure. From air defense, they provide the PAC-3 interceptors as well as the THAAD system, the Terminal High Altitude Air Defense. And then RTX plays in with the radars that are capable to be able to do these pieces, as well as the Patriot system itself for the launchers come from RTX. A lot of Northrop Grumman plays into this as well, and General Dynamics. So you are seeing a lot of pushes for those types of capabilities. But you're also seeing it on the companies inside of Europe as well as they try and grow this capability. MBDA, Eurosam and others, Thales and BAE are going to be the ones that are providing, because there are a lot of the military integrators, if you will. There are a lot of the technology integrators for these capabilities too.
Wayne, what are hypersonics? That's a new one.
So hypersonics is anything that travels faster than Mach 5. So 5 times the speed of sound, you're talking about like 4,000 miles an hour. And so most of these hypersonic capabilities that right now exist, China and Russia have them. The U.S. is moving into that procurement piece. They've had a lot of successful tests for their capabilities as well. But one of the biggest pieces that makes the new modern hypersonics, if you will, is the fact that they're able to maneuver when they're actually traveling, which makes it very difficult for air defense systems to track them. If you look at old ICBM systems, right, your old nuclear, they come up, they have a very specific trajectory, and they know how to come down, which means air defense systems know how to actually intercept them in the air. It becomes very much, you need a lot more processing power, you need a lot better seekers on your interceptors in order to keep after something that's traveling at 5,000 miles an hour, and it's also moving along in some type of snake-like fashion as it approaches the target.
Yeah, now I want to talk a little bit about the space because I'm a little bit of a space geek. So in the report as well, you mentioned that companies like SpaceX, Blue Origin, a lot of developments there, especially as they're pushing really the commercial space technology here. How will that feed into the space aspect of your outlook, and particularly when it comes to military readiness and resilience?
No, absolutely. So Space Force themselves, the U.S. Space Force inside the U.S., obviously, one of the big pieces that they really focused on is we used to build systems from start to finish, full vertical integration, and we would pay somebody a ridiculous amount of money, a contractor, to put something together like that. What they've realized is that what they're really looking at, about 85 to 90% of all the space-based capabilities they're looking for are already commercially produced by a lot of the companies that you mentioned, as well as some of the SATCOM capabilities and beyond. So what it's doing in this space is they said, I need to focus on things that we specifically can do for military. And so that's normally in a space called the National Security Space Launch, which is where you get a lot from New Glenn rocket. You know, that's where your SpaceX, your United Launch Alliance, ULA, where these players are coming in. You're seeing new folks into this as well, Firefly, Stoke Space, Rocket Lab, that are starting to bring in, and the military is turning to these providers to be able to launch a lot of these capabilities in space. So it's providing an expansion of that, but probably in that entire, like I mentioned, $3.5 trillion market, you're about between 15 and 20% is what we're calling the defense space market, which is why we put that number at about $600 billion over the 5 years.
Wayne, I feel like I got to sell this thing. I'm just looking at it right now. Folks, this is a deep dive. And Bloomberg Intelligence, their deep dives are just that. They go really deep into a topic, this one on the defense business. They gather the analysts from around the world, and they put out these really significantly researched reports. This one's 60 pages. It tells you everything you need to know about the defense business and what to think about going forward. So just extraordinary work here. So I'm looking at, you mentioned Lockheed Martin. It's flat year to date, whereas a lot of the other defense primes are up 20 to 30%. What's going on at Lockheed Martin?
I think they're still going to do well. I think one of the big pieces there is they had to have some charges in I think it was third quarter for a classified aero program. You know, eating that much, over $1 billion in charges for that is something that, from a long-term perspective, you're still going to see them doing well. I think as especially on the hypersonics front, as you see them moving from the R&D side of the house they put up front to procurement, right? So the 2026 NDAA and projected out from that budget perspective, a lot of their hypersonic capability is going to start to be fielded. So you're now moving out of money that they've had to put into IRAD and others, and they're now starting to see where these fieldings come out. And all the different services have this, right? Lockheed doesn't run all of them, but they do run a substantial amount. So you do have programs for the Army, which is known as Dark Eagle. You have have the conventional prompt strike for the Navy platform, but it uses the same all-up round that the Army uses. Then you have the hypersonic attack cruise missile, the HACM system for the Air Force, as well as something called Arrow.
I've seen before.
Yeah, right. So I mean, so
hey, Wayne, we're gonna have to wrap it there just because of time there, but appreciate it. Wayne Sanders, Senior Defense Weapons Analyst of Bloomberg Intelligence. He's got the deep dive on air defense. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
I mean, gone are the days when just you give an athlete some cash under the table or a used car. Those days are gone. It's NIL, and now it's institutional capital coming into college sports with Utah. Brandon Williams joins us here, the U.S. sports business reporter. He joins us here in our Bloomberg Interactive Broker studio. That escalated quickly, Randall. I mean, we're getting... Talk to us about what's going on at the University of Utah.
So Utah has signed this deal with Otro Capital. Otro Capital is basically forming a holding company. It's a for-profit entity. It's not unlike anything that we have seen before, except for the fact that it is private equity. And private equity has floated around college football for many years, really since NIL came into effect. And with that in mind, this is the first deal that we've seen get done. I wouldn't have put money that it would have been the University of Utah. I would have bet that it would have been one of the larger top 25 schools or really top 15 schools that are out there. But they got a deal done, and now we're going to see what success really looks like, because what does it look like? Well, normally we see these deals happen at the professional holding companies, but now that Utah has one, it's interesting.
Yeah, I mean, could this potentially be a model for other kind of for-profit structures tied to university athletic programs, and, you know, something that could be a wave of these maybe in the coming year?
All of them are studying it, studying how it's going to pan out. Because on one side, yes, like it looks like a lot of money for the University of Utah, but also if they get this, the number out there is $500 million. It is somewhat unconfirmed as to how much the deal is actually worth. But in terms of success, what does success look like for the University of Utah? It's making the college football playoff. It's going deep into these big revenue events, such as the March Madness tournament. So going to the Final Four, Elite Eight, Sweet 16. But what if they don't? What if all of the things that are meant to drive in, you know, audiences and things like that don't pan out? Are the sponsors going to come the same way? I don't think so.
So does some of that, let's say they, part of their Big 12 TV contract, does some of that revenue go into this fund as a form of income that, like, I guess my question is, if I'm a limited partner in this fund,
sure,
how do I get a return?
That's a $1 million question.
What am I investing in?
That is the $1 million question across all of sports and private equity, which is, what does a return look like? We've only seen a couple of them over the last.
A return, if I am part of a group that buys into, takes a 10% stake of the Yankees and I sell it 10 years from now, that's my return. The difference in value there, but that's not an exit. Or that's not.
So Utah has the option to buy them out.
Oh, okay.
But again, like, who's to say Ultra wants out? Who's to say that Ultra doesn't want to stay? And who's to say that Utah wants them out? It's very, very complicated, and that's why everybody is watching and seeing how this plays out, and then I think we'll see more eventually.
All right, what's going on in Ann Arbor? I mean,
what isn't going on in Ann Arbor is a better question.
I don't think anybody saw that coming.
Absolutely not. But also, there are definitely people who did see it coming, because there have been a multitude of people with microphones who have said, oh, I've known about this since September. I've known about this since July. This was kept under wraps. But in essence, you know, Sharon Moore was fired for having an inappropriate relationship with a colleague or a coworker, and he's since been detained by police. He's still under, I think he's still in custody right now, and it's really been a dramatic fall off. It's not something that you would expect from one of really the most highly coveted jobs in all of college football.
What's the fallout been like so far? Have we seen any major sponsors pulling out, NIL relationships in limbo?
No sponsors. I would really doubt that sponsors would, just because this isn't someone like Nick Saban, who, you know, had won multiple national championships. Sharon Moore had been in the job for a couple of years and really hadn't built things up the way that he probably would have liked to, and this is really going to be the end of his term at Michigan. Now, NIL-wise, there could be a lot of transfers, because if Sharon Moore was recruiting them and now he's out, you might want to explore your possibilities. Now, Michigan has a lot of NIL money, and maybe the NIL money is enough to keep these people. We're going to see it all play out.
Right, we're getting towards college bowl season, and my Dukies are going to the Tony the Tiger Sun Bowl.
Are you going?
No, I'm not. But I remember back in the day when there wasn't 500 bowls, that was one of the bigger bowls.
Really?
Yeah, Sun Bowl was one of the bigger bowls. If you weren't like in the Rose Bowl, Cotton Bowl, it was definitely at the top of the tier 2.
Yeah.
Now there's a million of them. But a lot of people, players don't play because, you know, maybe if they're planning on going to the NFL, they just don't want to risk an injury, period.
Definitely, and it's still happening.
They're transferring, and I guess the economics of the bowls are still there, but from the player's perspective, that doesn't seem to be.
You're not incentivized to play anymore if you're not in a college football playoff. And the reason you're incentivized to play in the college football playoff is because it is a massive audience.
Yep.
So NFL scouts who aren't watching this, they might turn on the college football playoff, and now you're being viewed by millions of people. It can dramatically rise your draft stock. However, you play in one of these bowl games, you sprain an ankle, and then that ankle has a fracture in it. Now you can't go to the NFL Combine. Your career potentially could be over, which has happened for many, many people who have participated in these extra bowl games.
All right, and then 30 seconds. Notre Dame not going to a bowl. I mean, I'm Irish Catholic. I'm all in Notre Dame, but
they're throwing a temper tantrum. They're throwing a temper tantrum, and they'll be perfectly fine.
They will be. Nobody holds them down. Yeah. All right, God, we could have you in here for like 2 hours, man.
Let's have a whole show just with Randall.
Well, there is. I mean, there's the Business of Sports podcast. We got Michael Barr. We got Damian Sassauer and Scarlett Fu. They have their podcast, The Business, and they do it for like an hour.
I appreciate you all.
So that's good stuff. So, Randall, thank you so much. We appreciate that. Randall's a U.S. sports business reporter for Bloomberg News. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence begins in just moments. Christine, thank you for sitting in for Scarlett today.
My
appreciate it. Excellent, great stuff. We really appreciate getting a couple hours of your time. Looking at the market here, boy, we've just kind of rolled over. No more playing around here. The S&P down 72 points, that's 1%. The Dow is now negative, down 174 points. And the NASDAQ on the chin again, down 370 points, that's 1.6%. I think the market's trying to tell us something here. They're taking a little bit of a breather here, taking a little bit of a breather on that AI story. All right, that's it for me. More Bloomberg Radio coming up right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, coming up here, Bloomberg Surveillance and Bloomberg. We have Bloomberg coming up right now. We got more coming up in this show here today. We're going to go to Charlie Pellet and get a Bloomberg Business Flash on a day where the stocks are just rolling over. It's Christina Aquino and Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio and streaming live on YouTube as well. A lot more coming up here for the next hour of Bloomberg Intelligence radio program. We're going to go to Geetha Ranganathan. She's Bloomberg Intelligence. What is going on with Warner Brothers Discovery? Is there going to be a deal, and who's going to end up winning it? It's Friday, which means we talk about the municipal bond market. We'll do that with Shruti Singh, Bloomberg News municipal finance reporter. We've been talking a lot more about muni bonds because you get some really nice after-tax yield from the municipal bonds, particularly if you're in a high-taxed part of the country. So we got a lot going on there. Right now, let's go to Charlie Pellet and get a Bloomberg Business Flash.
Hi, thank you very much, Paul Sweeney. Stocks lower across the board. This Bloomberg Business Flash is brought to you by Harvard Business School Executive Education, a world-class learning experience for aspiring and established change makers. Prepare for the next elevation for your organization and yourself. Learn more at hbs.me/breakthrough. Stocks lower across the board. Do want to begin with the developing story. Headline right now off the Bloomberg Professional Service. Some Oracle data centers for OpenAI are going to be delayed to 2028 from 2027. That headline right now. Oracle shares down 4.8%. The Oracle delays largely due to labor and material shortages. But again, a key headline, stock down 4.8% now. Some Oracle data centers for OpenAI delayed to 2028 from 2027. Those are the headlines. Stay with Bloomberg, and we'll have more as we get later further details on this developing story. Stocks lower across the board this Friday now, with the S&P down 72, 68.28, drop there of 1.1%. Dow Industrials down 170, a decline of 0.3%. And NASDAQ lower now by 1.6%. Broadcom after earnings plunging 11.9%. Our Mag 7 index down 1.1%. The 10-year 4.18%, with the 2-year 3.53%. Gold higher, little change, just about flat on the day, up $2 the ounce, 42.83. A retreat for silver down 2.3%, 62.07 on silver. West Texas Intermediate crude down 0.7, 57.20 right now on WTI, and Bitcoin back with an $89,000 handle, 89,764 now on Bitcoin. That represents a drop of 3.4%. Well, with the Fed meeting behind us, there is lots of speculation about where Federal Reserve policymakers go from here. Cameron Dawson is Chief Investment Officer at New Edge Wealth. She was a guest last hour right here on Bloomberg Intelligence.
We think that they set themselves up to be able to deliver more cuts in 2026. If we think about the unemployment forecast that they had, they kept it at 4.4%, which would be the same as it is this year. And that suggests that it wouldn't take a lot of weakening in the labor market for them to say, hey, this is worse than what we thought, we can deliver cuts.
Cam Dawson of New Edge, interviewed right here on Bloomberg Intelligence. Again, repeating our earlier headline, some Oracle data centers for OpenAI delayed to 2028 from 2027. Oracle down now by 5.2%. A story we're watching. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Christina Aquino, Paul Sweeney, live here in our Bloomberg Interactive studio here. Scarlett Fu will be back on Monday. We're also streaming on YouTube as well. So, Christine, that might, I guess the Oracle news is because we were just musing last couple of minutes ago, what caused this market to roll over so hard? I guess it's partly on this Oracle news here.
Any negative news, especially about AI, especially about data centers, definitely catching this jittery market off guard.
Yeah, absolutely. So again, as Charlie was just reporting, we got the NASDAQ off 1.8% here. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside Christina Aquino, and we're joined by Bloomberg's Denitsa Sekova. Denitsa, what are you looking at this morning?
Let's take a look at Broadcom, which is also selling off further after the Oracle news we get. The shares are down about 11% now. The ticker is AVGO. It's, of course, coming off AI. And actually, we saw a strong earnings report, but the outlook is really shaking investors' confidence. What we heard from their CEO is that the company has a backlog of 73 billion in AI product orders. That clearly shook investors. The CEO later qualified that the figure was a minimum, but that clearly is not bringing much relief. Broadcom has been on a crazy rally this year. The stock was up more than 75%. So you can imagine that's one reason investors are punishing the company swiftly after this. The conference call come after this really big rally. Investors were seeking more clarity about what's the actual payoff from AI, and it seems like they're not very excited about the answer. Instead, they got a vague timetable. There is no AI revenue forecast for 2026, which is one reason investors may be even more worried. The report actually showed some strong numbers. Sales were about 19 billion, which is much higher than what analysts were expecting. But we can see in that world of AI, where everyone is worried about those circular deal, and Broadcom is in the center of many of those, including one with OpenAI, any type of outlook miss is punished very, very harshly.
Yeah, all right, Denitsa. We're also talking leggings and Lululemon having a good day. What's going on?
A very different topic, but Lululemon is doing great. The stock is up about 9%, and it surged about 14 in earlier tradings. It seems like the CEO of the Price Yoga Wear is about to move, and then the company boosted its food year outlook and announced that the CEO would step down after a period of sluggish growth. That's been an interesting space. We're getting so many different brands with yoga pants that are worth more than $100. We have Alo, we have Nike even having a collaboration with Skims and Kim Kardashian. So it's been a very competitive space, and Lululemon, which was once kind of the leader and the go-to market for $100 yoga pants, has been struggling. The company has been down more than 50% this year. This is really one of the best days for the company in some time. The fiscal third quarter report had a few positive numbers. Profit and comparable sales beat analyst expectations, so some relief there. And people are excited about the potential of a new CEO coming and kind of lifting the brand back to its great days.
All right, finally, Citigroup.
Citigroup shares are now flat, but they surged in earlier trading. JP Morgan raised the recommendation on the lender to overweight from neutral. Pretty big change there. Citigroup stands to benefit from a solid economy. This is just what JP Morgan is saying. At the same time, Citi should continue to benefit from further transformation, including improving its efficiency ratio, making progress on consent orders, and reducing stranded costs. So quite a bullish forecast there. The price target is $124, coming from about $107. And this is about 11% upside from here, so pretty bullish note. And we saw some upside in earlier trading, but now obviously the whole market is trading lower after the Oracle news.
Very good. Denitsa Sekova, thanks so much. Denitsa covers the equity markets for Bloomberg News. And for more conversations like this, subscribe to our Stock Movers reports. Listen for 5-minute audio reports of the biggest winners and losers in the marketplace here. So looking forward here, let's check in with Nathan Dean here, Bloomberg Intelligence Senior Policy Analyst on pot stocks, cannabis. Mr. Trump has a new view potentially of kind of how these things should be regulated. Nathan, what do you make out of some of the commentary from President Trump about the cannabis business?
Yeah, so, you know, last night there was been reports that President Trump is going to issue an executive order declaring that marijuana is not known as a Schedule I drug like other really hard narcotic drugs to something that's like Schedule III. Think of Tylenol with codeine. Now, what this does is that moving from Schedule I to Schedule III lowers the tax rates to something called 280E for a lot of marijuana businesses out there. Currently, they're around 40%. This puts it around 10 to 15%. So there's significant tax savings here. Now, the issue is that the Department of Justice and the DEA had embarked on a rulemaking process to do this. It stalled when President Trump won the election. It was actually started under the Biden administration, and there's been questions on whether President Trump would restart it. Now, according to the news reports, President Trump's going to issue an executive order to reschedule it. He can't do that unilaterally. He can't do it via executive order. But I do think that you are going to see this process continuing or restarting in the first part of next year. They're about 70% of the way. So if they want to move fast, they can reschedule the drug probably by mid-2026 and then start leaving that tax relief for those companies.
Now, Nathan, we've seen a lot of these cannabis stocks like really rise and fall along with the tide of policy here. What's different about this time around? Is there actually some kind of tangible policy benefit that, as you mentioned, could come out within the first quarter of next year?
Yeah, we like to say that these stocks have hot sauce because with any policy movement, these things go up. Lots of volatility. MSOS is up 35% just off of last night's reports. There's two ways to think about reschedulization. One is the actual impact to the businesses. Now, reschedulization does not mean legalization, does not mean in terms of increased market share or anything like that. Just provides tax relief for a lot of the mom and pops out there and potentially could increase consolidation in the market. But we would also warn is that there's a lot of retail investment in this who are just trying to buy the dip. I mean, there are other companies like the Canadian pot stocks not really impacted by this move, but they're also moving up and down with this policy decision as well. So there's a lot of retail sentiment about this as well. But again, at the end of the day, this does not bring legalization, nor does it bring the ability to get this out there at a federal level so you can start growing market share. This is all about tax relief and sentiment going into other debates in 2027 and 2028.
Are there plans to make this get a federal approval for federal legalization for cannabis?
I don't think so. In fact, we put that at a 30% chance of success before 2028. Even though you are seeing incremental steps to open up the idea of the marijuana market, plus it's legal or decriminalized in 40 states plus the District of Columbia, there's a lot of folks in the Senate who are just not on board with this idea. A couple weeks ago, there was a vote on hemp, not marijuana, but hemp. There was a related vote. And the Senate overwhelmingly voted to actually restrict more hemp regulations and actually decimated a hemp industry that was really reliant on further opening of this. So marijuana legalization at the federal level is really not going to happen, I think, anytime soon. And we'll have to see what happens in 2028 and beyond. But just you need a lot of folks in the Senate to change their mind.
All right, Nathan, thank you so much. Appreciate that. As always, Nathan Dean, Senior Policy Analyst at Bloomberg Intelligence, getting the latest update on the weed market here. Let's switch gears and go to the media space. We can do that with Geetha Ranganathan. She is the Senior Media Analyst for Bloomberg Intelligence. We've been talking a lot to Geetha about this Warner Brothers Discovery deal. It's going to be close to a $90 billion trade when it happens. Netflix is involved. Paramount is involved. And we'll get some talk there. But I'm going to start, Geetha, with Disney. Yesterday, they made a big, it seems like a pretty big announcement, making a $1 billion investment in OpenAI. What's the strategy here for the Walt Disney Company?
Seems to be, Paul, if you can't beat them, you join them, right? Disney really is realizing that AI is here to stay. User-generated content is obviously getting a lot of traction. And so they want to be able to, I think, create this blueprint so where you have, they can license their characters in a safe way. It's a brand safe way. It respects copyrights. And they also get to monetize their characters. So rather than being constantly reactive and defensive and fighting in court, they are, this is a much more proactive way for them to participate in eventual, monetization of all those, licensing of all those characters.
Yeah, well, Geetha, very interesting that you mentioned. I mean, that seems to be the key point here, right? That Disney is allowing store access to its IP, 200 plus iconic characters. That's a big step. I mean, there's a lot of kind of potential for the brand to be maybe a little diluted because of that. But what's your take on that? Is it able to protect the integrity of its franchises here?
I think it's going to try its best to do that. I mean, what was interesting about yesterday's deal was obviously they inked the deal with Sora and at the very same time sent a cease and desist letter to Google. So they're really kind of trying to draw the line around, brand safety, around copyrights, no violation of copyrights. So that's pretty clear. But you're absolutely right. I mean, this is kind of a little bit of, letting the fox into the hen house, if you will, because once you kind of allow OpenAI and Sora to get access to all of your characters. Who knows how it's going to be used? Disney, of course, is going to have a little bit of say. They are going to get a lot of those Sora content or those videos to come back to their Disney Plus platform. And I think what it really helps Disney do is, of course, get in on the moment, really kind of deepen their engagement with their younger fans, kind of build a big pipeline of new franchises, hopefully, and more importantly, really collect data in what kind of, what are fans actually looking for? Do they enjoy spending time with, all of these characters, creating videos? So it's really, so many different things that I think Disney is hoping to kind of learn from this whole exercise.
All right, Geetha, enough with that. Let's get back to the issue at hand here. Any news coming out of either the Warner camp, the Netflix camp, the Paramount camp?
So it seems now, Paul, that the ball is really in Paramount's court / in Warner Brothers Discovery's court. So Paramount, as you know, has already sent that all-cash bid. They are waiting to hear back from the Warner Brothers Discovery Board. The deadline for that is December 22nd. But there was some reporting yesterday that suggested that Paramount is looking into potentially raising its bid by about 10%. So we know right now it's $30 per share for all of Warner Brothers Discovery, potentially looking to raise that to as much as $33 per share. And remember, they do have to pay Warner Brothers Discovery, or they do have to compensate Warner Brothers Discovery for the $3 billion termination fee that Warner Brothers would have to pay Netflix in case it walks away from a deal.
Geetha, what do you think is going on in the Netflix C-suite right now? Do you think they're sitting a little bit nervously, or do you think they're still comfortable with their $27 a share offer at this point?
I think they are also looking to potentially raise it, but they're not going to do anything before. We see the first move has to be from Paramount. And I think Netflix is definitely comfortable in raising its offer. The thing that they really need to contend with is that the market is not happy with this deal. We definitely don't want to see Netflix get into this bidding war at all. There are just too many concerns from a regulatory perspective, from an integration perspective, and it really kind of, I think, muddies what was a very, very nice pure play streaming story with exposure now to legacy media. So obviously the market doesn't like it. Netflix, of course, thinks that they're playing the long game. They're kind of, positioning themselves here for the future. But getting involved in a very expensive bidding war, I don't think anybody really wants that.
I'm just looking at Warner Brothers Discovery stock just below $30 a share. So that tells me that the market is expecting a higher bid here. And that's really interesting to see how that plays out. Geetha Ranganathan, thank you so much. We appreciate that. Geetha is the U.S. Senior Media Analyst covering all the media space for Bloomberg Intelligence. He's located down in our Princeton, New Jersey office here. Netflix stock is up 1% today, up about 6-7% year to date, but it is certainly traded off in the last several weeks as speculation has grown about a bid for Warner Brothers Discovery. So again, near-term risk to what was a clean, or what is a clean streaming story at Netflix, but longer term arguably positions them to be stronger in a world where you can never have too much content that has proven that it's able to travel around the globe. So we'll have to see how that plays out. Looking at the markets, again, they're decidedly lower here with the S&P down 80 points. That's 1.1%. The NASDAQ down 420 points. That's 1.8%. Coming up, more discussions here. We're going to check in with the Miss Bond market. That's coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg, and this Bloomberg Business Flash is brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. Right now, we got shares of Oracle trading lower. Oracle has pushed back the completion dates for some of the data centers it's developing for the artificial intelligence model developer OpenAI to 2028 from 2027. That according to people familiar with the work. Oracle shares, they're down now by 5.9%. A sell-off underway this Friday. A turnaround from earlier advances with the S&P now at 6811, down 89, a drop right now of 1.3%. The Dow is down 286, a decline there of 0.6%. NASDAQ down 2%, and the Russell 2000 index of small cap shares declining by 1.3%. 10-year 4.18%, with the 2-year 3.52%. Gold down $3.50 the ounce to $42.77, a drop of just under 0.1%. While West Texas Intermediate crude down 0.5, $57.31 a barrel, and Bitcoin now down 3.1%, just above $90,000. UBS shares, they're higher on a down day for much of the market, up by 1.3%. A group of influential Swiss lawmakers proposed watering down the capital demands that the country wants to impose on UBS, sending shares to roughly a 17-year high. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
All right, Focus on Munis today is brought to you by BAM Mutual. Put America's strength to work in your portfolio with BAM insured municipal bonds. Protect your investments with an added layer of security and guaranteed income. Invest with strength. Build a stronger tomorrow with BAM Mutual. Let's get into it right now. The municipal bond market. It's Friday. That means we talk muni bonds. We do that today with Shruti Singh, municipal finance reporter for Bloomberg News, joining us from Chicago, Illinois. Shruti, as far as I understand it, 2024 was a record year for new issuance in the municipal bond market, only to be eclipsed by 2025 and another record year. What's the outlook for 2026 in terms of new issuance?
Yeah, so 2025 has already eclipsed $500 billion in terms of issuance, and that's a record already, and we still have a couple more weeks to go. And so far, strategists are saying that 2026 could be about $600 billion or more on average. There's a few that are beneath that, but it looks like it's going to also be a very busy year next year for state and local governments looking for additional debt.
So, Shruti, which types of borrowers do you think will drive that $600 billion potential surge next year?
So it's really across the board, and whether it's airports looking to renovate terminals, whether it's school districts looking to refurbish classrooms or potentially build new buildings, or it's state and local governments trying to improve highways so that we don't have potholes and things like that. It's just a variety of different reasons that state and local governments need this additional capital and this additional money. Partly it's because during the pandemic, some of this stuff was on hold. We just couldn't get it done. Another reason is that there was pandemic aid that had flowed to state and local governments that had filled our coffers, and they were able to use that for a lot of projects and a lot of expenses. Now that aid is largely winding down or has been used up. So there's pent-up demand, there's a need for cash flow from school districts, airports, state and local governments across the board.
Our good friends in Chicago are back in the news, probably not for the reasons they want to, but Chicago mayor is floating changes to his corporate head tax proposal as the city council and the mayor at an impasse about how to close a nearly $1.2 billion deficit. What's the latest coming out of Chicago?
Yeah, so we are in budget season here in Chicago, and the city is statutorily required to pass a balanced budget by the end of the year. So right now, the city council and the Mayor Johnson's administration is in negotiations about how to do that by the end of this month. And as you mentioned, they're trying to close a more than $1 billion deficit. We've been here before. Last year also, it had sort of come down to the wire, and they passed a budget in mid-December. Right now, one of the sticking points is that the administration, Mayor Johnson, has proposed what's called a head tax, which is basically a levy per employee per month. And initially, he had said he wanted $21 per employee for employers that have over 100 people in the city working most of their hours in the city. Now he's changed that to about $33 per head, and for corporations with over 500 people. So changes, but hasn't gotten the support he's looking for yet from City Council.
Wow, I mean, that's quite a big sticking point there, Shruti. How might that potential erosion of the tax base, right? Because we have business leaders warning that this could drive employers out of the city. And so if that happens, how might that change Chicago's long-term fiscal health profile?
So that is actually something that's under debate. The administration is saying that this is not going to be something that erodes the economy. They're saying that they are trying to provide services and provide help to residents, particularly those that are struggling here in Chicago. And Mayor Johnson has said since his campaign days that he wants the rich and corporations who have more means to put more skin in the game. And he's trying to lighten the burden of those that are struggling the most. And that's something that he campaigned on, and that's something that he's been talking about, particularly this budget season. His administration is saying that this is not going to impact the economy, but on the business side, business owners and civic leaders from the business community are saying that this could slow Chicago's rebound from the pandemic. It could impact the core business district and put into question sort of like whether business leaders and companies want to expand here in Chicago.
Shruti, you mentioned earlier stadiums. I seem to remember your Chicago Bears have plans for a new stadium. How's that going to be financed?
So right now, I haven't heard much recently. It's been a little bit quiet. They've been talking over the last couple of years about whether Bears want to continue to stay here in Chicago in Soldier Field, or if they want to build a stadium in suburban Arlington Heights. Most recently, they've indicated that they want to move forward with building a new stadium in Arlington Heights, but there's still some questions about property taxes and other legislation that they're counting on to move forward with those plans. So looks like they're leaning towards Arlington Heights, but nothing is a done deal yet here in Chicago.
All right, we'll keep an eye on that. I'm a big fan of Soldier Field, particularly the renovated Soldier Field. I thought they did a really good job there. Shruti Singh, a municipal finance reporter for Bloomberg News, joining us from our Chicago, Illinois bureau. The tech story, there's a couple of tech stories here. Oracle pushing out some of their plans. Broadcom putting out some numbers that the street a little bit disappointed in, so it's kind of contributing to some sell-off in some of these broader tech names. Let's break it down with Kujan Subani. He is Bloomberg Intelligence Senior Semiconductor Analyst. Let's start with Broadcom. Can you break down what's going on over there, Subjan? Kunjan?
Yeah, I mean, look, fundamentally, it was one of the great and very strong AI semis report this quarter. I could not find a lot wrong in the numbers. I mean, they upsided their AI revenue numbers by 20% above the street for next quarter. They even guided their backlog or provided their backlog, which as of today would imply an upside from street numbers for the next year, even the next 18 months. So I don't know what more better they could have done. This, by the way, backlog is like the baseline that they could continue and building to that backlog and hence moving the numbers up. As of this morning on the street, if we look at it, all the numbers up for the next year and the next 2 years have gone up, especially for the key area, which is their AI revenue. So nothing wrong fundamentally here. It just seems it's just that state in the market when it comes to AI valuations and AI sentiment that sort of no good news is good enough right now.
Yeah, well, Kunjan, a lot of attention being paid to that $73 billion backlog that you're mentioning. It seems like the market isn't really rewarding Broadcom for that, but what does that actually tell us about the demand for these products across the semiconductor supply chain?
Yeah, a couple of things. Look, one thing we are all aware of, which every AI accelerator company, whether it's NVIDIA, AMD, Broadcom, or Marvell, is enjoying is the rising capex from all the hyperscalers and the cloud guys, which is a very well-covered story. But specifically for someone like a Broadcom who does the ASIC custom accelerators for the likes of Google, Meta. Amazon also has their own chip, but that's not what they work with Marvell on that. The demand for these chips is rising much faster. So even if there were some concerns that how long can the hyperscalers keep rising their capex spending, that does not directly impact ASICs, which Broadcom supplies, because the hyperscalers are continuing to move their workload on ASICs, and this is a very small scale when you look at the entire like $500-600 billion they are going to spend here. I mean, 70 billion over next 18 months, where they're going to close to spend $1 trillion is nothing. It's change.
Kunjan, you talk to institutional investors all over the world. Has the conversation changed at all in the last 2 to 3 weeks? Perhaps a little less bullish? Are people concerned about some of these short-term sell-offs here we've seen recently?
I think the overall there has been sort of a saturation, or there's like how much can these numbers and guidances keep going up. I don't think the sentiment has changed towards bearish. I think there's much more cautious optimism now coming in. So like people are trying to be very careful. Also remember, it's that time of the year where you've sort of captured the numbers for the year mostly, right? So you're not going to get a significant upside in the remaining time. So people are just getting ready for the next year and sort of going back, looking at where they can trim exposures and where they can sort of book profits.
Yeah, well, a lot of other news out there today related to AI, Kunjan. Let's talk about this Oracle news, delays to some data center projects for OpenAI to 2028, and we're seeing the market roll over on this. What can you kind of tell us about, the state of this industry? On the one hand, a lot of promise there in the data center space, but also seems like a lot of kind of volatile sentiment related to it as well.
Yeah, I mean, look, there has been a lot of impact with the OpenAI deals, also for NVIDIA, also for Broadcom. Similar thing maybe investors didn't like, if you were trying to really find flaws last night from Broadcom's earnings, was they mentioned the OpenAI revenues for them will now start in 27, and some folks were expecting those revenues to start coming in late 26. So a lot was driven by initial hype, which these programs take many years. So it's very difficult to pinpoint 2 years ahead in time, like this is the quarter when all the build-outs will start and everyone is starting to get material revenues. As we are getting closer to that time, we are getting more clarity on whether will it be at 27, whether there will be 28. We don't see fundamental flags in this new time milestone movements. It's just we are getting more clarity, and initially it was just a lot of goodness being priced in, which is now being adjusted.
This is, in my mind, a classic overpromise and now underdeliver. You're supposed to do the exact opposite. Yeah, maybe we'll have these things around 2030, and then you look like a hero if you come in at 2028. Because Oracle's saying that the delays are due largely to labor and material shortages, not like some technological, headwind that they can't get around. So, Kunjan, is this just maybe a little bit of the market in general, your technology market, investor base just kind of taking a little maybe money off the table, just stepping back a little bit and maybe waiting for the next catalyst?
There's definitely that, and like I said, is that time of the year where taking some money off the table makes sense, right? Like, I mean, look, if you're a portfolio manager right now, you've already covered significant amount of good rewards and performance through the year. You don't want to lose that, right? Even if your underlying key fundamental convictions have not changed.
Yep, I mean, the numbers that we see being thrown around are just extraordinary. So, and the stocks have reflected that on the upside. So maybe a little profit taking here on any kind of crosswind that may come along. Kunjan Somani. Kunjan is the senior analyst covering semiconductors for Bloomberg Intelligence. He is one of our tech analysts based out there in San Francisco, right there downtown. Great office there for Bloomberg, getting the latest on Broadcom. Markets are selling off here. Let's check in with Charlie Pellet in a Bloomberg Business Flash. Charlie.
Hi, thank you very much, Paul Sweeney. Not just selling off, lows of the session right now with the Dow, the S&P, NASDAQ all in the red. And this Bloomberg Business Flash is brought to you by Harvard Business School Executive Education, a world-class learning experience for aspiring and established change makers. Prepare for the next elevation for your organization and yourself. Learn more at HBESC.com. bs.me/breakthrough. NASDAQ 100 index now tumbling by 2.1%. NASDAQ Composite Index down 2%. S&P lower by 90, a drop there of 1.3%, while the Dow is down 313, a decline there of just about 0.6%. Broadcom shares, a topic we were just discussing, down 10.9%, but the Dow, the S&P, NASDAQ all declining. The drop in AI bellwether Oracle deepened on delays to some of its data center projects. Oracle right now down by 5.6%. We've got the 10-year currently yielding 4.19%, with the 2-year 3.53%, and the 30-year 4.86%. Spot gold down 0.1%, 42.74 the ounce. West Texas Intermediate crude oil down 0.2%, 57.46, and Bitcoin now down by 3.1%, 89,970 on Bitcoin. On a down day for much of the market, shares of Lululemon Athletica are surging 11%. The stock rallied after the pricey yoga wear maker boosted its full-year outlook, but that was not the biggest news. Poonam Goyal is senior U.S. retail analyst at Bloomberg Intelligence, and she was a guest with us last hour right here on Bloomberg Intelligence.
The biggest news yesterday, quite frankly, was the announcement of Calvin McDonald stepping down as CEO and the search for a new CEO for next year. So I think investors are excited to see new strategy, new vision, to see who can run this ship back to sail, because Lululemon has lost ground in recent years.
Poonam Goyal of Bloomberg Intelligence. Again, Lululemon right now up by 11.2% after earnings. Keeping an eye on Costco. Costco lower today by 1.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Hey, Charlie Pellet, thank you so much. We appreciate that. Christina Kino sitting in for Stephanie. And we are looking forward here to get stocks trading off here. But this is the time we take a look at the big take story on Bloomberg News. These come out every day. Deep dive reported stories on some really cool topics here. This one is Golden Dome, the astronomical cost of defeating, quote, any foreign aerial attack. And it goes to building President Trump's proposed Golden Dome. And we want to get to the latest and how this might play out, because the numbers seem pretty staggering. Becca Wasser, defense lead for Bloomberg Economics, joins us here. Becca, talk to us and just let us know what this Golden Dome is and how would it ever be built?
Well, that most certainly is the right questions to be asking. So Golden Dome is envisioned to be a large-scale missile defense network that should span across all of America to deter or defend the United States from potential foreign aerial attack. And what does that mean? That largely means missiles, hypersonic weapons, and drones that would potentially be launched against the United States from Russia, China, and North Korea. And so this envisions a multi-layered defense network that is going to have things from ground-based air defense systems all the way up to space-based interceptors, including space-based capabilities that do not yet exist today. And all of this is expanding geography, it's expanding capabilities, it is creating something that has never existed before. And as you can imagine, it's got a pretty hefty price tag that goes along with it. President Trump has said that it is going to cost approximately $175 billion. We ended up doing the math, and we found out that that doesn't quite add up. Ultimately, what we found is that if we were going to actually create a network the way Golden Dome is envisioned in President Trump's executive order, it is likely going to cost $1.1 trillion, if not more, because the costs that we added up are just hardware alone. It's not also the cost of operating these systems, maintaining them, or even taking care of the personnel who are going to be using them.
Wow. So that is quite the difference between two already hefty price tags there, Becca. So if that is the true cost, according to your estimates, then like who is ultimately going to pay for this?
Ultimately, it's going to be the U.S. taxpayers. The numbers that we compiled are largely based on existing U.S. military budget documents. We took the cost of existing systems, we added them up. We did our best estimates of the capabilities that don't actually exist today, like those space-based interceptors that I talked about before. And at the end of the day, who pays for these weapons? It's the U.S. taxpayer, more and more.
When you talk to experts, military experts, A, do we need this system in a realistic sense? And B, is it even possible to create?
Well, it's possible to create a system, but is it going to work the way that it is intended? That's not entirely sure. So I think what it is again, expanding the geographic scope of what needs to be protected, expanding how the United States would be protected and with what. All of that is going to make it really difficult because it requires developing new capabilities that haven't existed before and seeing if they actually work as designed. It requires taking existing systems, existing weapons, communication networks, and trying to map them together across a broader span of geography than they've been asked to do before. And even more so, on top of all of that, it is really just trying to expand things from where they have existed in the past. So all of that is just going to make it really difficult for everything to operate as envisioned and actually come to fruition.
Now, Becca, the reporting also shows that there's been about 1,000 companies that have been tapped to submit proposals for this project, right? And so do you think that this scale of industry involvement, is that something that could potentially accelerate innovation related specifically to this, but maybe other applications?
Certainly. I think, again, the emphasis on space is a great example where I think it's trying to imbue more potential funds and research and development in some of the future space-based capabilities that the United States might want to have in order to deter some of its most capable threats. Additionally, I think we're going to see, and we're already seeing that, frankly, with the list of companies who are potentially under consideration. You know, we're seeing this mix of old and new. Some of those companies that have produced weapons for years and years, but we also see some of those startups, those neo-primes who are trying to come in and be disruptors and do things a little bit different. So I think we're going to see that also playing out with almost two different cycles of research and development. One that's going to be part of the more traditional approach where research and development is largely paid for by the taxpayer, but also, you know, new cycles of research and development where some of these companies, particularly these privately held companies, are going to be willing to put forward their own funds for research and development and to develop some of these prototype weapons and capabilities to see if they actually work.
Is there any sense of timing of how this might play out? I mean, this is a 10-year thing. Is this I don't know.
Well, President Trump has said that this is going to be a no-kidding, in-existence system by the end of his term. So that gives us less than 4 years. The reality is there's no way that this could be built the way in which it is detailed in the executive order within 4 years. The clock is already wound down, if I'm being entirely honest.
Right.
So I think we do see a much larger cycle of development for some of these capabilities. There's even just really lengthy production cycles that are required to produce some of these capabilities at scale. Already you see in places like Europe and Ukraine where there are just not enough things like air defense interceptors, air and missile defense systems, counter drone systems, and all of those would also be required for Golden Dome. So the production timelines are quite lengthy, let alone some of those research and development timelines for those next generation capabilities.
All right, Becca, thanks so much for joining us. Fascinating, fascinating story. Becca Wasser, defense lead for Bloomberg Economics. Folks, this is a big take story on the terminal. It's also a Bloomberg Business Week story. It is really deeply reported, lots of numbers, lots of analysis, lots of cool graphics, which helps me understand this story. Check this out on Bloomberg.com, Bloomberg Business Week. Check it out. It's really fascinating. We appreciate getting a few times at Becca. Coming up in just a moment, David Sachs, White House AI czar and special advisor for AI and crypto, He's going to be speaking with B-Tech anchors Ed Ludlow and Caroline Hyde. So we'll dip into that and listen to that conversation when it starts in just moments. But that kind of goes to, all right, we're all talking about AI. What's the government's role, and what is the government thinking about the development and maybe the regulation of AI? So there's going to be a big angle there.
Yeah.
Look at that.
Absolutely, Paul. I mean, yeah, because a lot of these projects that are being thrown around, right, especially when it comes to M&A and things like that, the government will play a big hand when it comes to enabling that or maybe discouraging it, depending on how big the potential mergers are, how big the potential partnerships are, and what's at stake, really.
Yep. All right. Right now, let's go over to David Sachs, White House AI czar, special advisor for AI and crypto. He's speaking with B-Tech anchors Ed Ludlow and Caroline Hyde. Let's go over that.
Who have argued local rules could stifle innovation. We're joined by David Sachs, the White House AI and crypto czar, or senior advisor. David, I think it's a really good place to start. In your work with the president in consulting and advising on the formulation of this executive order, what was the problem that you were trying to solve for? And what is it that you said to the president about why this EO was the right approach to focus on state-level laws?
Well, Ed, thanks for having me. The problem that we see is that you've got 1,000 different bills going through state legislatures right now to regulate AI, and over 100 measures have already passed. Some of these bills are contradictory, and you've got 50 different states running in 50 different directions. That type of compliance regime is going to be very hard for small companies and startups, especially innovators, to comply with. And so what we need is a single federal or national framework for AI regulation, and that's what the president has supported. And by the way, he supported this for a long time. If you go back to his July speech on AI, he called for a single national framework then. And what we've done with this EO now is to make clear that that is the administration's policy, and to task members of the administration to work with Congress to try and enact that framework through legislation, because ultimately this needs to be a law. And in the meantime, create tools that the administration can use to push back on examples of the most onerous and excessive state regulations.
David, there is, of course, some pushback, on the executive order from the states themselves, from other Republicans. As you know, I studied the July speech and strategy closely. A big part of it, was infrastructure related and about deregulation. The concern about this latest executive order is that while it addresses your concerns about many different pieces of state regulation, it does not provide for a single federal framework.
Well, at the end of the day, that single federal framework has to be enacted through law, and we need Congress to do that. And so the president has asked Congress to do that, and he's tasked members of the administration to work with Congress to produce that framework. In the meantime, what we've done here is articulate a set of principles. We've said what values are important to us. We said that we want to protect child safety. That's important. We want to respect copyright. We want to preserve the ability of local communities to choose what infrastructure is in their communities. We're not seeking to preempt the states in any of those areas. So this is an important set of principles that we have put forth. And then at the same time, the EO provides for a number of tools that can be used to push back on excessive state regulation. And let me just illustrate why I think this is so necessary. Because what we're really talking about here is regulation of AI models and algorithms. Well, think about how an AI model is developed. You can have developers in one state or multiple states writing the code. It can then be trained in a data center in another state. You then can have inference happen in another state, and the entire service is provided over the internet using national telecommunications infrastructure. So you're dealing there with at least 4 different states, and all of them can lay claim to regulating those AI models. And those regulations can be in contradiction with each other. Even Democrat governors have admitted this is a problem. So just the other day, Kathy Hochul, the governor of New York, it basically said that she might prefer to enact California's SB 53, which is a regulation that they just passed in California, rather than the bill that her own assembly gave her, the RAISE Act. Because she sees that, wait, do we really want to create this patchwork of different regulations? So even Democrat governors are realizing this is a problem, and if they all run in different directions, then we're going to end up with a patchwork or a mishmash of regulations that are impossible for companies to comply with. What the president is calling for here is just common sense. We want to get to a single national framework of compliance as opposed to 50 states running in different directions.
Meanwhile, Kathy Hochul actually is getting a bit of criticism, perhaps, for narrowing, and what some are saying is bowing down to business. David, I'm really interested in how you oppose that view, because there is anxiety in the population. AI versus jobs, AI versus energy bills. How are you giving them the sense that we haven't seen federal government and indeed now state governments just handing over the reins to big tech billionaires, as people call them?
Right. No, I understand there's a lot of fear out there about AI and job loss specifically, and a lot of those fears have been drummed up. Let me just say on the job loss question, because I think this is really important, that Yale just released a study, and it showed that in the 33 months after the launch of ChatGPT, there was no discernible disruption to the U.S. job market. None. They said no discernible disruption. And in fact, if you look right now, more jobs are being created than being lost. So this whole idea of job losses just isn't true. There was an article in the Wall Street Journal just last week talking about the construction boom that's happening, that's benefiting construction workers, like electricians, like plumbers, like workers who pour concrete or hang drywall. Their wages are up 30% because of this infrastructure boom that's happening right now. And there's actually a job shortage in many of those trades, meaning we need more workers going into those trades. So what we're seeing right now is an overall AI boom that's benefiting the economy. Okay. You know, the GDP growth rate was tracking at about 4%, and half of that, up to half of it's been attributed to AI. So I just think that this narrative about job loss has been blown out of proportion. Certainly there could be job displacement in the future, but we haven't seen any of that so far. It's been quite the opposite. It's been job gains.
David, final one on the EO, if I may. You know, what this EO allows for, is it the sort of hope that it will lead to the DOJ suing states like New York and California? And if that's the case, you know, the president and the administration's confidence that you'd win them?
Well, that is one of the tools that is in the EO, is that the DOJ has been tasked to form a litigation task force that would have the ability to push back on excessively burdensome state laws that may be unconstitutional, violate the First Amendment, things like that. By the way, the DOJ already had that power, so this is not a novel power. But what's being done here in this EO is we're marshaling all of the resources of the federal government behind the strategy of the president to create a national framework. Now, in terms of what laws we go after, that's a decision that has been made. We haven't decided whether California and New York should be targets in that way. The one that I think is probably the most excessive is this Colorado law that seeks to prohibit algorithmic discrimination.
Right.
What that basically says is that if an AI model has a disparate impact on a protected group, then that model is violating the law. Model developers, by the way, have no idea how to comply with this because they're not aware of all the downstream uses of their model. I mean, if a business decides to use an AI model in a hiring decision, for example,
right,
that business is already on the hook for discrimination. So how would the model developer know that it was being used in that way? But what Colorado is trying to do there is get their ideology inserted into the model. That's very concerning to us. We think there's a First Amendment issue there. But look, we haven't made any decisions in terms of how that litigation task force to be used.
David, briefly, all of this is set in the context of US versus China and are deemed to run forward on AI development. Meanwhile, it's been a busy week and H200s might indeed be able to get to China. How many do you think you'll do in volumes? And what do you think the appetite is of China to buy NVIDIA's more sophisticated chips?
Well, it's interesting. I just saw an article that said that China was rejecting the H200. So apparently they don't want them. And I think the reason for that is they want semiconductor independence. The same way that the United States wanted to be energy independent, they want to be semiconductor independent. So they're rejecting our chips. And that's part of the calculation that goes into the decision of what we authorize to be sold to China. The U.S. policy has always been that we don't allow the leading edge chips, and we're not. This H200 chip, it was state-of-the-art a couple of years ago, but now it's been superseded by the newer Blackwell architecture and the Rubin architecture that's coming out next year. So this is now a lagging chip, not a leading chip. But what you see is China is not taking them because they want to prop up and subsidize Huawei. They want to create a national champion. And that was part of our calculation of selling not the best, but lagging chips to China, so you can take market share away from Huawei. But I think the Chinese government's figured that out, and that's why they're not allowing them.
David Sachs, we always wish we had more time. White House AI and Crypto Czar, we thank you for joining us today.
All right, that was B-Tech anchors Ed Ludlow and Caroline Hyde speaking with David Sachs, White House AI and Crypto Czar there. Big story in the tech space today. Oracle with some news out there talking about maybe pushing back some of their rollout. It's been a little bit of a headwind for just the last several trading sessions for some of these AI names. Oracle stock off 5.8% today. Joining us is Anurag Rana, Senior Tech Analyst for Bloomberg Intelligence. Anurag, what's the latest from our friends at Oracle?
Yeah, from what I just heard is that they are having some delay in getting the data centers online. And as we know, if the data centers don't come online, the servers are not lit up, you really cannot transform that big backlog into sales. And I think that has been a big concern for everybody. This just shows that it's not going to be a linear line to go from funding to get the data centers lined up and then recognition. So I think that's a hiccup for them. In our calculations, it does impact their FY28 sales, but not the ones that, in the next, let's say, 12 months.
Now, Anurag, Paul and I were noting earlier that the delay seems to be being cited to labor and material shortages, right? And so could you just break it down a little bit for our listeners? What actually is involved in this data center build out, and why is it so subject to the potential for delays such as this?
See, it's no different than building any manufacturing factory or anything else. I mean, you'd have labor. The biggest bottleneck right now for everybody is power. So let's assume that these big vendors have figured out, they've found like somewhere in Wisconsin or somewhere in Atlanta, they found a place where they have enough power, then you got to go out and build a data center. Cooling equipment, labor, all of that stuff that has nothing to do with technology is the one that is needed for the next, let's say, 2 years to get the data centers up and running. Then you got to put the chips in there and then finally realize that revenue.
Is there backlog that they quote? Give us a sense. Is that a good number, do you think? Is that representative?
Oh, it is absolutely spectacular. That number is $500 billion. And out of that 500 billion, 300 billion, over 300 billion is from OpenAI. So if you go back a few years, this backlog was, to be honest, immaterial or not much. But what has happened is OpenAI has this absolute need to go out and build capacity so that they can do both inferencing for a lot of the workloads that are coming in, but more importantly, they can train their models so that their next generation models are better than, let's say, what Google has produced. So it's an important, you could say, strategy for them in order to get that data center up and running. And for now, they have been partnering more with Oracle than anybody else at this point.
Anurag, thanks so much. Appreciate that. Anurag Rana, Senior Technology Analyst on the technology team at Bloomberg Intelligence. Oracle stock trading off a little bit today. Going to be some delays in some of the rollouts of their products here. And that's certainly a contributor to what we're seeing sell-off in the marketplace here on this Friday morning. The S&P is off 89 points. It's 1.3%. That's pretty much at the low of the trading session. The Dow's off 300 points. The NASDAQ really taking it on the chin, off about 450 points. And that is also towards the low of the day. That's down 1.9%. So some big sell-offs in the market. The yields, 10-year Treasury yield, 4.18%. And Bitcoin's off 3% here, sitting right at $90,000 per token. For our listeners in the U.S., a reminder, you can listen to us on satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Your top stories and global business headlines are coming up right now with the S&P off 86 points. Christina Kino, thank you so much for sitting in for Tom Keene. TK will be back, or Scarlet Fu will be back Monday.
You were done an hour ago.
This is CBS News on the Hour, sponsored by Steel.
I'm Steve Kathan. Opponents of President Trump's big White House ballroom project have gone to court, as we hear from CBS's Linda Kenyon.
The first major lawsuit has been filed by the National Trust for Historic Preservation. It names President Trump and others, including Interior Secretary Doug Burgum. The lawsuit argues the administration failed to undergo legally required reviews or receive congressional authorization for the project. The president had said the ballroom would be near but not touching the White House structure, then later demolished the entire East Wing.
Democrats on the House Oversight Committee have released another batch of photos from the estate of convicted sex offender Jeffrey Epstein. CBS's Jake Rosen.
These photos show anyone from former President Bill Clinton, President Trump, former Treasury Secretary Larry Summers, filmmaker Woody Allen, in addition to Bill Gates, Richard Branson, and Prince Andrew.
Republicans on the committee accuse Democrats of cherry-picking photos. CBS's Scott McFarland.
Democrats would argue it brings a lot of value. It underscores the importance of releasing the full Jeffrey Epstein case files because it shows that Jeffrey Epstein was operating in some very powerful circles, and that maybe those case files show something the public needs to know without defining what that something is.
A federal judge has blocked ICE from re-detaining Kilmar Abrego Garcia, saying she feared they might take him into custody again hours after she ordered his release. Simon Sandoval Motionberg is his attorney.
He's heading back to Prince George's County to be with his family, with his child, with his wife, who are waiting there for him. Everyone is extremely happy about this. Obviously, everyone knows that it's not the end of the story.
Abrego Garcia faces federal human smuggling charges. Days of torrential rain in Washington state has caused historic floods, stranding people on rooftops, washing over bridges. Forecaster Jessica Birch says there's no real let-up.
Monday afternoon, more showers expected to push not only from the Pacific Northwest, but this time it's making its way all the way down to the Bay Area as we head into Tuesday morning. So wet conditions from San Francisco all the way back up into Seattle. That's already seeing so much so far. And then we're not out of the clear yet.
Earlier this week, Marie Steinberg got into her car to drive to work in Edenton, North Carolina. She spotted a man in the back seat.
He looked so cold and so scared, I thought, well, I'm not going to try and provoke him. I'm going to try and be very, very nice and pull the mother act on him.
The mother act seems to have worked. Turns out the man was an escaped inmate. He was taken into custody without incident. Checking Wall Street, right now the Dow is down 239 points. The S&P is down 77. NASDAQ down more than 400. This is CBS News. There's a warning for mushroom lovers in Northern California.
They can heal you, they can feed you, they can kill you.
Health officials are urging people not to forage for wild mushrooms after an outbreak of poisonings in the San Francisco Bay Area. They say one person died, another underwent a liver transplant. A one-year-old child was hospitalized but has since recovered. The death cap mushrooms, with a greenish yellow or off-white cap and a ring underneath, look and taste like other edible varieties, but experts say they contain amatoxins that can cause liver failure. Even after they're boiled, cooked, or dried, eating just a mouthful of the mushrooms can be fatal. Deborah Rodriguez, CBS News.
The online forum Reddit has filed a court challenge to the law that bans Australian children younger than 16 from having accounts on social media platforms. It's also been challenged by a Sydney-based digital freedom group. I'm Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
This is just the beginning. Welcome to the Friday edition as the Trump administration warns it will seize more oil tankers, as it did this week off the coast of Venezuela. The White House turns up the heat on Maduro. We're going to get the latest on this standoff in the Caribbean when we talk with Bloomberg Washington correspondent Tyler Kendall, and we're going to track the tanker's path with the help of the terminal when we sit down with Adam Farrer from Bloomberg Economics. The boat, by the way, is headed for Houston. We'll talk later with Colonel Sanders from Bloomberg Intelligence about his defense outlook for the new year, and as redistricting fails in Indiana, we'll spend some time with our political panel. Bloomberg Politics contributors Jeannie Shanzano and Rick Davis are with us. You made it to Friday, and so did Charlie Pellet. He's got the look on the markets right now, and it's not a very good one. Charlie, what's going on?
Indeed, roughly 2 hours ago, things really turned around. Actually, an hour ago, things really turned around to the downside. Got to get right to the numbers here because I'm looking at a drop right now of almost 400 points in the NASDAQ Composite Index. Right now, we've got NASDAQ down 393, a decline there of just about 1.7%. Oracle certainly helping fuel the move to the downside. Oracle down now by 5.3%. The drop in AI bellwether Oracle deepened on delays, on word of delays to some of its data center projects, a topic we have been exploring here on Bloomberg. But again, Oracle right now down by just about 5.2%. The NASDAQ 100 index down 1.8%. The composite index down 1.6%. And keeping the selling all in context, the S&P down 73 now, 68.27 on this Friday. The S&P down now by about 1.1%. The Dow lower by 218, a drop there of 0.4%. That sell-off in tech shares dragging global gauges from the brink of records. Longer-dated bond yields climbing. The 30-year 4.85%. The 2-year 3.53%. The 10-year 4.18%. Spot gold now down 0.1%, $42.74 the ounce. West Texas Intermediate crude up by about 0.2%, $57.70. And Bitcoin now down 2.8%, 90,269 has been fluctuating right above and right below that $90,000 level. Federal Reserve Bank of Chicago President Austin Goolsbee says he's projecting more interest rate cuts for 2026. He made the comment this morning on CNBC.
Not hawkish on rates for next year. I think that we make progress and that by the end of next year, if you look at the dot plot, I'm one of the most optimistic folks about how rates can go down in the coming year.
Goolsbee on CNBC, and you recall he dissented against a rate cut this week because he wanted to wait for more data on inflation. Oracle pushing back the completion dates for some of its data centers it is developing for the AI intelligence model developer OpenAI. Again, Oracle down now by just about 5.1%. We got marijuana stocks, pot stocks, they're higher. Sources tell Bloomberg President Trump is expected to direct his administration to move to reclassify marijuana as a less dangerous drug. Right now, we have got MJ. That is the marijuana ETF, the Amplify Alternative Harvest ETF. It is surging 29.3%. Tilray up 29%. Canopy Growth up by 38%. Balance of Power continues now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
Charlie, thank you. Hot sauce on the pot stocks, as our friend Nathan Dean likes to say. Look at that. This could be a story we're talking about next week when it comes to rescheduling. You made it to Friday. Welcome to the Friday edition of Balance of Power with the AI hangover on Wall Street and a holiday party hangover here in Washington. It better be Friday. On Bloomberg Radio, satellite radio, channel 121, and streaming live on YouTube. Check it out right now. Search Bloomberg Business News Live. Unless you're ahead of the game, you might have YouTube TV. Flip over Bloomberg Originals. We'll meet you in the studio as we try to get our heads around what in the world is happening with this tanker that was seized in the Caribbean. And we're learning new information about it right now. By the way, one of the coolest things, we're going to do this in a minute, the Map Go function on the terminal, you can actually track that tanker just like you can any ship that's sailing its way around the world. The president was asked about this a couple days ago now, remember? We seized the ship. What happens to the oil on board? He said, well, I guess we're going to keep it. Here's what he said.
We're interested in the seizure of this tanker. Well, what happens to the oil on that ship? Well, we keep it, I guess. Where does it go? What port does it go to? Well, you have to follow the tanker. You know, you're a good newsman. Just follow the tanker. Do you know where follow it. Get a helicopter and follow the tanker. Is it true it's going to? But we're going to, I assume we're going to keep the oil.
It's the best, I assume. Looks like we are, by the way, and I don't know that we're going to be able to burn that oil anytime soon. It looks like it's going to have to be held in escrow. We'll have more on that as we learn more. But Tyler Kendall is with us right now. We rescued her from the White House and pulled her into the Washington, D.C. Bureau with the latest on this. Tyler, the story that Eric Martin broke has evolved quite a bit, and he's saying now it's just the beginning. So this is going to be a new reality, I guess, for us.
Right, exactly. Some incredible reporting from our colleague. People familiar telling Bloomberg News that this really marks the first step in a new phase for the U.S. as it puts pressure on Venezuela, but also Maduro. And this phase has to do with trying to essentially cut off the oil revenues for Maduro in a bid to get him to relinquish control. And that's really why we're going to be watching this closely, how it could evolve, because the Treasury Department earlier this week moved to sanction additional oil companies, additional tankers, and also some close associates of Maduro. So our understanding is Venezuela is actually preparing for there to be additional seizures of ships, and that's going to be really important to watch here. In fact, our reporting goes further than that, saying that the state oil company is trying to figure out alternate routes to make sure that they can get the crude to China, which of course is going to be a big factor in this, since China is such a huge buyer of this Venezuelan oil. In fact, I pulled some of the data. About 80% of Venezuela's export revenue comes from oil, and on average, they're exporting about 750,000 barrels per day this year, with nearly half of that going to Beijing.
Incredible. So, there could be 5 or 6 more based on what we're hearing. We sanctioned 6 more ships. Reuters is reporting a little more here. This tanker is too large to enter Houston's port. They're going to have to anchor this thing way off the coast and offload the oil. This is potentially a little more complicated than we were bargaining for here.
Right, and it's a lot of oil. So this particular tanker, we've been discussing this on the program. It's part of what's known as the dark fleet that helps to support Venezuelan oil exports. This particular tanker, also Iranian oil exports, has the capacity for 2 million barrels. Reuters reporting, apparently, according to the data and the satellite imagery, there's 1.85 million barrels on this particular ship. And again, the type of crude that is on it typically does go to China. So just another wrinkle to follow here. Now, we heard President Trump saying that he thinks that we will keep it. We should note yesterday at the White House press briefing, the White House press secretary, Caroline Leavitt, did say that the U.S. does intend to seize the oil.
Fascinating stuff. Have you done MapGo? Have you seen how
it's awesome?
Like we were looking at the ships lined up at the ports coming out of COVID. Now we're following tankers that we've seized. It's all right there on the terminal. Tyler, thank you so much. We'll have more from Tyler Kendall coming up a little bit later in our second hour here on Balance of Power. Keep that in mind. If you're a terminal user, go there now, because we're going to talk this through with Adam Farrer, who pointed me to this yesterday. Our friend from Bloomberg Economics, senior geoeconomics analyst who worked in a prior White House, spending some time on this very issue. There have been a lot of questions about the legality and so forth, but also the logistics, and that's what we wanted to talk about with Adam, who joins us here in studio. Mr. Farrer, it's great to have you with us, as always, on the Friday edition. Reuters updates the news. You had suggested maybe Galveston, somewhere this ship is going. Apparently Houston is the answer, but it's too big to get it in the port. What are they going to do?
So that's not unusual. I mean, this is a VLCC vessel, as Tyler just went through, 1.8 million barrels of oil on board. I think the reality is those ships, ports aren't built for those ships to come in. Those ships stay at offshore piers, usually to load, and in this case, it will anchor off at a normal anchorage position, and that's where it will sit while a very complicated and messy legal process unfurls to determine the long-term position for the ship itself and the oil.
Wow. Do we have to hang on to the oil while this goes through the courts? The president seemed pretty nonchalant about this. He said, yeah, I assume we're going to take it and we'll burn it.
So we're missing a lot of details right now about how the Department of Justice plans to put forward their case on the seizure of the oil itself. It's interesting. Reporting now points to the closed warrant, the seizure warrant for this ship actually being based on the vessel's association with Iran, not Venezuela. And so as a result, there are just open questions as to what case they're going to put forward on the status of that Venezuelan oil, and therefore questions as to whether the U.S. really can seize it. But it will be likely held on the vessel and then pumped off and held in storage tanks until a court determines what to do with it.
Yeah, wow.
But what's also interesting is that the vessel itself, depending on legal wrangling and lots of questions about who's its actual owner, who chartered the vessel, whether the flag state was real, the flag of the vessel, who it was registered to, the vessel could return to service relatively quickly or could just sit for days, weeks, months, or years.
Well, so you just brought up a lot of questions, and if you're with us on YouTube, you can see U.S. Special Forces seizing that vessel a couple of days ago. It was pretty remarkable to see them rappelling out of this Black Hawk helicopter. And now, of course, the question is, what the heck do we do with it? And the White House is pointing us to the idea that there will be more. Is it possible in a scenario like this to confirm ownership or, in fact, where the boat was heading?
Well, so that's you're hitting in on the exact problem in the maritime industry and why we talk about these shadow fleets. It feels like in the 21st century, 2025, we could just know these things, right? We've got satellites, we're monitoring, we're tracking, but even things like the ship's AIS, or Automatic Information System, which is intended to track the vessel, provide safety of navigation, ensure ships don't hit each other, but also allow us to know where ships are headed, can be spoofed, it can be turned off, and that's how we see these ships playing games as to their ultimate destination.
And this one had its transponder off for some time, right?
That's right, and as we saw, and for those who get on the terminal to look at Map.go, you'll see that the ship all of a sudden turned its AIS on right after it was boarded by this U.S. team, and now we can track it very easily.
Was this going to Cuba? Do we know?
Well, so that's what people are saying, but I think the ultimate destination may have been much further afield.
Really?
I think China, as Tyler had mentioned, is certainly on the table, so we just don't know. And certainly, I promise you that Coast Guard team that led this this boarding is asking and interviewing every member of the crew, going through their logs and working out all those questions.
Well, if they, when they stormed the bridge, couldn't they tell based on the instruments on the ship where it was going?
Yeah, certainly. I think they'd find some correspondence with the charter, the person who hired the vessel to do this trip. But also, these are sailors on board and professional captain. They're not going to sit there and they may obfuscate a little bit to hide certain elements if they're doing something particularly illegal. But the truth on that end will likely come out. The question is just when will we know about that?
This is wild stuff. I hope when they make the Netflix movie, Adam Ferrer is featured. This is our great source of information here from Bloomberg Economics. I really appreciate it. Fascinating. How much do we learn from Adam Ferrer? Who knew when it came to shipping? Colonel Sanders is coming in next. Bloomberg Intelligence will give you a jump on next year when it comes to defense. This is Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ 100 index, Russell 2000, all in the red. Stocks are extending losses as a sell-off in tech shares drags global gauges from the brink of records. Right now, the S&P is down 62, 68.38 where we stand, down just about 0.9%. You recall we did see a record close yesterday. The Dow now down 137, drop there of 0.3%. The NASDAQ Composite Index down 339, down 1.4%. Down last hour, it was down as much as just about 400 points on NASDAQ. But again, to be sure, we've got NASDAQ down 1.4%. The 10-year, 4.18%, with the 2-year currently yielding 3.53%, and the 30-year, 4.84%. Gold up $8 the ounce, up 0.2%, 42.88. West Texas Intermediate crude 57.71 a barrel. WTI up 0.2%, and Bitcoin 90,365. Bitcoin down 2.7%. The drop in AI bellwether Oracle deepened this morning on delays to some of its data center projects. Oracle shares right now, they are down by almost 5%. Broadcom now slumping 10.2% after its sales outlook for the red-hot market failed to meet investors' lofty expectations. Broadcom is a chip company vying with NVIDIA for AI computing revenue. NVIDIA shares, they're lower as well now, down by 2%, but the real damage with Broadcom down by 10.1%. Again, recapping, stocks lower, S&P down 0.9%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, if you're going to get bad news on the markets, it better come from Charlie Pellet. He'll have more in about 20 minutes here, live from New York, as we talk politics in Washington. Thanks for joining us on the early edition of Balance of Power this Friday. Bloomberg Radio, streaming live on YouTube. We've talked a lot about the first $1 trillion defense budget. It's actually real, even though if you look at the NDAA that is making its way through Congress, you know, we talk about this as the must-pass National Defense Authorization Act every year, and it seems to get a little bit more controversial each time, but they managed to squeak it through with some things attached. In this case, though, it's just shy of $1 trillion, but remember the big, beautiful bill, that had about $150 billion in it, so we've got a lot of money to build things like the Golden Dome, to buy things like drones, unmanned aircraft, unmanned boats. They've got a big shopping list at the Pentagon. And our friend Colonel Sanders at Bloomberg Intelligence put together a fascinating look with his colleagues at the year ahead, the outlook for defense in 2026. And of course, well, maybe the biggest thing on the shopping list is something called the Golden Dome. We haven't heard President Trump talk about this for a while. He certainly did back in May when he promised its construction. Here he is.
In the campaign, I promised the American people that I would build a cutting-edge missile defense shield to protect our homeland from the threat of foreign missile attack. And that's what we're doing. Today, I'm pleased to announce that we have officially selected an architecture for this state-of-the-art system that will deploy next-generation technologies across the land, sea, and space, including space-based sensors and interceptors.
Look no further than our new big take. It's on the terminal and at Bloomberg.com right now. It's a great piece of work. Golden Dome, the astronomical cost of defeating any foreign aerial attack. Colonel Sanders has been spending a lot of time looking at this, and we wanted to spend some time with the Colonel. Bloomberg Intelligence Senior Defense Research Analyst Wayne Sanders, it's great to have you back, sir. Happy Friday, and I'm still wondering how they're going to do this, whether the Golden Dome is real, how many years it'll take, and whether it's going to work. What can you tell us about this as they try to get this project off the ground?
Yeah, Joe, thanks for having me on again. So one of the biggest pieces when you look at anything that's ballistic missile defense, right, there's a lot of programs that already do exist across the Department of Defense, Department of War. And what President Trump's really trying to do is he's trying to make all of those systems interoperable so that all the sensor to shooter that you brought up, that President Trump also brought up, if China's going to launch something, if Russia is, you name the adversary, if they're going to launch something, we need to be able to sense it in real time. We need to know where exactly it's coming from. The trajectory provides a lot of information to sensors to say where we think it's actually going. And then you have to be able to create the platform that's necessary to be able to put that in there. You look at Lockheed's Aegis system for the Navy, right? They have a lot of sensors that are out there that do this. We have some space-based sensors that pick up things like this, Northrop and L3 Harris and others for like hypersonic ballistic tracking space sensor, HBTSS, as part of the program. But they're all separated. So what President Trump's trying to do is make this an interoperable, common operational picture so that we know exactly where those things are and that we have the interceptor capability to knock those things out of the air as you go. If you look at something for hypersonic weapons like China has and Russia has, China can shoot from mainland China and reach South Korea and to Japan in 6 to 11 minutes. That's pretty amazing when you think about these things are flying at over 4,000 miles an hour. So the Golden Dome is an air, you know, he originally said 175 billion with an initial plus up of the 25 billion upfront. But, you know, our analysis is going to be a lot more money in a lot longer period. Really, you're looking at several phases. The first phase is just taking the stuff that we currently have and putting it together. But then you have to build additional pieces to it.
This wouldn't be done before President Trump's term expires. I mean, this is years of work, correct?
Yeah, you know, it's definitely, I don't think it will get done. I think that what he's really trying to push for is to have a space-based interceptor test before 2028 or into 2028 so that he can actually be able to show, look, we've been able to push a vision into this scenario. So you're going to see a lot of that interoperability capability amongst the primes, as well as some of the tech disruptors, I think is a key piece to this as well. And the National Defense Authorization Act kind of showed that. There's a lot of money to the nuclear triad to include the B-21 and the Sentinel missiles and long-range standoff as well. That strategic program perspective becomes really key. But the tech disruptors that you're seeing in this space, like Anduril and Saronic Technologies and others, are going to play, and Palantir, are going to be able to take a lot of that new, the really high-end technology and be able to add it into the industrials.
Well, okay, this is interesting. Colonel, last time you were here, we talked about not missile defense, but the need for missiles themselves. That could mean a lot of business for the Lockheeds, for the RTXs, and others here. But I'm very compelled by this new breed of defense contractor, many of which you just named, AeroVironment, Palantir. If an investor is looking at your work here, the 2026 outlook for defense, are those the kind of companies that will bring growth as opposed to the old line defense contractors, or are they all going to benefit from this?
So I actually think all are going to benefit. But I see where your point is if you look at the strategic programs like I was talking about, that's part one. But part two, you've also seen munitions production as well as the drone capability, right? There's a drone demand to push for 1 million drones inside of DoD to be able to affect that. That's not going to be your primes. Those are going to be your disruptors. You're going to see those AeroVironment, Andurils. They're going to look for what they call the Group 1 through Group 3 UASs, the uncrewed aerial systems, to be able to meet that. And most of those require some type of lattice AI technology to create that swarm, that drone swarm that everybody talks about, right? You want to be able to overwhelm an adversary's sensor capability and be able to almost hide your key long-range capabilities inside of it. So you are going to see both benefit throughout this. And with a $1 trillion budget, I think the DoD will be able to do that.
And that's something. It's pretty remarkable when you consider the work to be done. And with regard to the Golden Dome we were just talking about, that's basically every old line, so to speak, defense contractor involved, right? This isn't going to be one over another. It's going to take an enormous amount of work and contracts to multiple publicly traded companies.
Yeah, agreed. I think you're going to see a lot more on the joint venture side to be able to partner up and do this. You do see a lot of the primes actually partner together so that you look at RTX has the sensor technology where, you know, Kratos and Lockheed and all that may push further on solid rocket motors. So you are seeing a lot more in the DoD, DOW. You see them actually doing that as well. They are welcoming these partnerships for these folks. And then you bring in those AI tech disruptor pieces. Even when you look at one that came out recently that supported shipbuilding as well. This is an area where I wouldn't have expected, you know, Palantir Ship OS to be able to go into this. but it's something that's also going to help bring those industrials that normally take 160 hours, they can do something in about 15 minutes. So you are going to see a lot of that as well for these folks that are going to bring in integrated capabilities.
I love this, spending some time with the Colonel on a Friday. It's fascinating. And when you talk about the NDAA, it's going to go to the Senate next year. This was like a squeaker in the House, Colonel, 215 to 211 on the first procedural motion. What was controversial in the bill that everyone says is a must pass?
I think it was a lot of the add-ons. I think one of the key pieces too was troop lock, and that was one of the big pieces. The national security strategy came out just a few days ago from the Trump administration, which pretty much said, Europe, you need to go figure out things on your own. Which, sure, to a certain extent, from a strategic message, I know where they're trying to get that for them to build up their GDP defense spending up over 3.5% to 5% when most are sitting at 2%. So that is a shot across the bow, as President Trump has been seen to do. But Congress came back and said, we're still with you, NATO. We're still with you, Europe, because you're locking in from 86,000 troops that are in there now. The president cannot go below 75,000 troops without coming back to Congress. So that signaling to Europe is we're still going to be there. Our U.S. defense contractors are still going to be providing air defense capabilities to them through the Lockheed's PAC-3 and the THAAD, the Terminal High Altitude Air Defense System, as well as RTX's Patriot and others. But Europe is going to see this also, though, and say we still need to continue to push after domestic production, and that's going to aid those European defense primes in that same process as well.
Wow. Colonel, weren't we getting a hypersonic missile?
So hypersonic is moving from prototype into procurement. So you're starting to see this procurement in the 26 NDAA. So you are going to see what they call the Dark Eagle long-range hypersonic weapon going to the Army, and it's going to be fielded out to the multi-domain task forces. And behind that, you would actually, the same all-up round that goes in is supporting the Navy, but their conventional prop strike, you're not going to see until 2027 because their vertical launch system that they're trying to be able to put in is going on Zumwalt destroyers as well as onto their nuclear attack submarines. So you are starting to see that. In the past, I was actually at the Pentagon when, some of the tests weren't going well for HACM and Arrow and some of these other hypersonic programs. But they've gotten beyond that now, and you're actually starting to see the $12 billion of R&D that have led to this finally start to make a play in this. And in the international community, you're now going to see people try to partner with the U.S. so they don't have to throw that kind of bill behind an R&D, but they're going to want to use test infrastructure like Kratos's Mach TV, which is a hypersonic test bed for testing those capabilities.
Fascinating as ever. A deep dive with Colonel Sanders on the Friday edition of Balance of Power. Really great. You're going to want to go back to the podcast and play that over again. He could kill you with his bare hands, but he wouldn't. He's a nice guy. Colonel, thank you so much. Wayne Sanders, from the Pentagon to Bloomberg Intelligence and straight to your radio. We'll assemble our panel next. Rick and Jeannie on the way. This is Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ, all in the red. We are off session lows, but still a down Friday. As a matter of fact, we are now on track for a losing week for the S&P 500 index. On the week, that index now down by about 0.5%. Stocks, though, extending losses as a sell-off in technology shares dragged global gauges from the brink of records. Yesterday, indeed, the S&P was at a record. Right now, the S&P is down 64 at 68.36, a drop there of 0.9%. Dow Industrials down 164, down 0.3. NASDAQ down 341, a decline there of just about 1.5%. Oracle deepened its losses on delays to some of its data center projects. Oracle shares now down by 4.6%. The 10-year, 4.19%, with the 2-year, 3.53%, and the 30-year, 4.85%. Gold is up 0.3%, $42.92 the ounce. West Texas Intermediate crude oil up 0.1%, $57.66 a barrel. And Bitcoin now at 90,162. Bitcoin is down 2.9%. Darryl Cronk is Chief Investment Officer for Wealth and Investment at Wells Fargo Bank. And on surveillance this morning, he said markets are looking to Washington into the new year.
The trend lines are what we want to pay attention to, and that's, monetary stimulus, fiscal stimulus, deregulation, what we think is a CapEx super cycle, and the M&A world picking back up again. All those things have real materiality to them and play through the day-to-day noisy headlines.
Darryl Cronk of Wells Fargo interviewed on Bloomberg Surveillance. Couple of retailers after earnings. We do have Lululemon Athletica surging now by 9.5%. Costco after earnings down by 1.7%. Recapping the 10-year, 4.18%. Bitcoin down 3%. S&P down 1%. NASDAQ down 1.5%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Back, we go to Washington. Once again, your host, the Friday edition. Lots going on. Here he is, Joe Matthew.
You said it, Charlie. Many thanks. We'll have more on the markets with Charlie Pellet at the top of the hour, 1 p.m. Eastern Time, as we welcome our global television audience to the conversation. Thank you for making us part of your Friday. You made it to the threshold of the weekend. And if you're in Indiana, you might be a little worried about federal funding. Has the president found the line on redistricting? That's the big question today in Washington after the latest swing at the ball failed in Indiana. This is the latest state attempting to redraw its congressional map to try to favor Republicans in the midterm elections. We've been through this. Started in Texas, went to California. They've all been bound up in court, but I guess not the case in Indiana, because the state Senate, with 40 Republicans and 10 Democrats, decisively rejected this whole idea to refit the congressional map. We talked about this just a couple of days ago with Congressman Stutzman from Indiana. Here's what he told us.
In Indiana, I think the maps were actually very favorable to the Democrats. If we're going to play partisan politics, Indiana is a 9-0 state. And so the Republican friends in the state legislature there need to realize we're in a national battle here. This isn't just about Indiana. It's a national battle where we need to be sure that there's equal representation in Washington for Hoosiers.
Well, not so much. Let's assemble our panel for their take on it, because this is an evolving story, and it's one that we're going to be talking about probably for many more weeks to come, with other states in the mix. See what they're doing in Virginia right now, the conversations that they're having even in New York. Bloomberg Politics contributor Jeannie Shanzano is here, democracy visiting fellow at Harvard Kennedy School's Ash Center, and Rick Davis, Republican strategist and partner at Stone Court Capital. Rick, how are we looking at this? Because if you read the commentary and the tip sheets in Washington, the angle that everyone is taking is Donald Trump finally hit the wall, that his influence has been checked by a Republican legislature. Is that the fact, or is this just another stop on the road to rewriting congressional maps all over the country?
I think it's probably more one stop on the road. I mean, there's obviously a lot more going on than just Indiana. And yet, at the same time, I mean, the president and the vice president were heavily invested in flipping the state to get better, pick up 2 extra seats. And And so they kind of made it about them, right? They didn't do this discreetly. They didn't say, to the Senate pro tem, hey, Bray, why don't you pick up a couple of seats, and that would really help us out in Washington and be great for the state of Indiana. They really hit these guys hard, and for various reasons. More than 20 Republicans said no, and it wasn't just one person. It wasn't just a holdout. It was a pretty universal pushback from the Republicans there, and I think you could trace it to a lot of different reasons. One, some people just disagree with this kind of midterm redistricting. Two, a lot of people were threatened and didn't feel good about that and wanted to push back because they felt they were being treated poorly. Three, they worry about the consequences of diluting all these districts. You and I have talked about dumb redistricting. They are particularly worried about that, where you got a Trump plus 10 district and all of a sudden, you lose. So there were literally dozens of different reasons for people to vote the way they did. And yet it's certainly looking like a big rebuke to the president.
Well, it's hard to not see it that way, I guess. Jeannie, this is a 31-19 defeat in a state that Donald Trump won by almost 20 percentage points. Is there an opening here?
Yeah, and I don't think Rick heard the president, because the president said, oh, I didn't work too hard on that. I was barely involved in that. And look what happened.
Yeah.
The fact is, to Rick's point, there are a lot of reasons that people could have pushed back on this. One of them is just plain simple math. I mean, you look, Democrats are outperforming by 13% in off and special elections this year. If you take all those Republicans who are under 13% and then you say you're going to redistrict, you put people who might be safe at risk. So the math doesn't help this. But there's also the reality, if you're a Republican in Indiana and you're looking at Washington, D.C., what are you seeing for the last few weeks? Republicans pushing back on the president with absolutely no repercussions, from Epstein, Marjorie Taylor Greene, the Pete Hegseth issue, healthcare. I mean, the list goes on and on, not just taking on Donald Trump, but Mike Johnson as well. So I think there's also a little bit of freedom here as the president's poll numbers are plummeting and Republicans are feeling emboldened to say, hey, I can't just follow this guy. I've got to watch my own back. This is what happens. And so the president has to wake up to that, and there's not a lot he can do. My understanding is if they try to primary these folks, that's after the midterm. I don't know how this helps Donald Trump.
Well, a lot of questions about the fallout here. Hashtag pass the map. In a post on Twitter yesterday morning, 10:30 a.m., it's been viewed almost 7 million times. This post was made when most people thought that it was likely to pass. Heritage Action, i.e. Heritage Foundation. Rick, the post says President Trump has made it clear to Indiana leaders, if the Indiana Senate fails to pass the map, all federal funding will be stripped from the state. Roads will not be paved. Guard bases will close. Major projects will stop. These are the stakes, and every no vote will be to blame. What's Indiana in for here, Rick?
Yeah, I must say, folks who I talked to who were involved in sort of monitoring what was going on in Indiana state legislature, when that hit from the Heritage Foundation, probably 3 Republicans at least switched their vote to vote against the measure because it angered them so much. So, I mean, I think all these things have consequences. Whether the president actually follows up on that, it wasn't a direct threat by the president. He has a way of making these threats and then not living up to them. It's kind of the domestic version of Taco. And the reality is all we can do is wait and see. Indiana is a core Republican state. Last thing you want is president, sort of punishing Republicans for something that really is a non-material issue to most everyday voters.
Mm-hmm. It's another Free Taco Friday, I guess, Jeannie. So is the story the opposite of what the president said? To your point, he told reporters, I wasn't really working on that. Did he, in fact, overplay his hand?
I think he absolutely did. I think this was an unforced error on the part of the president. I think if you want to play politics, there was a way to do this rather subtly. You don't send the vice president out there to harangue people. You don't have your son going off on social media haranguing people. I'm laughing when you're talking about this heritage tweet or social media. Kevin Roberts has a lot of problems over at Heritage. But what do we think Donald Trump is going to say? Probably the same thing he said on the campaign trail about Project 2025. I don't know who these people are. I never made this threat, never heard of the Heritage Foundation or Kevin Roberts. The whole thing is an unforced error on the part of the president and his team. We've always talked about the fact that redistricting at this point is a fraught endeavor, and you have to be careful what you wish for. Donald Trump went into this assuming that if he won these districts, that he could pull them through in the midterm. That is not necessarily the case. He would be far better off focusing like a laser beam on fixing the economy and prices and inflation than he would by going out and redistricting, which seems to, at this point at least, have started to backfire on him. With the loss of Indiana, they now look like they may just break even on this thing. If other Democratic states go further, they could even lose seats in this game. So this is not a good situation for the Republicans to be in. It'll probably be a wash in the end, but it's a waste of time. He should have focused on what he promised, which was his economic agenda, and his poll numbers are falling through the floor at this point.
Jeannie points us right back to Rick's dummy mandering. If Republicans were so turned off by this yesterday, Rick, does this impact efforts in other red states?
It could. We've seen Kansas take a similar line, not really wanting to jump into this for some of the same reasons. And we've seen Democratic states. I mean, Maryland, the leadership in the state Senate there has actually sounded a lot like the leadership in Indiana. Democrats and Republicans can both feel the same way about monkeying with their districts. And so I do think there is, like the physics of politics, an opposite and equal reaction. California and Texas did their things, and now everybody else is sort of, geez, do we really have to walk the plank on this? It's really not healthy for our state politics. And so let's see. I tend to agree with Jeannie that at the end of all this, whether there's 1 or 2 seat advantage by either party is almost irrelevant to what we think is going to potentially happen in this elections. And if you listen to the Republican National Committee chairman, he's predicting a dire outcome in the midterms. And so a couple of seats are probably not going to make that much difference.
Yeah, wow. Hey, Jeannie, I'm going to throw you a curveball. You said something that got me thinking a couple of minutes ago. I believe it was Epstein. You know what nobody's talking about in Washington? That deadline to release the Epstein files that came from a discharge petition signed by the president is 1 week from today. I know that the Democrats are trickling out more pictures, more photographs today showing Bill Clinton, Woody Allen, Donald Trump. But are we going to see the files in a week?
Alan Dershowitz, the list goes on, Joe.
Steve Bannon.
Steve Bannon. It's like a really, really bad situation for the White House. I'm going to be curious to hear what the president has to say if he takes questions from reporters at, I believe it's 3 p.m. You'd know better than I do at this bill signing. If he is going to take questions, I'm certain some of these pictures that the Democrats have released today, and there's a lot more to go, are going to come up. And some of them, including some that I can't name, they don't show anything illegal, but certainly things that people will find disgusting. And so what does the president do? I believe we have the 19th, the 20th. They're going to have to make a decision. And of course, we have a law that he must release, or the DOJ must release. My suspicion all along has been they will try to hide under an active investigation, but I'm not so certain that's going to be palatable at this point.
Just 30 seconds, Rick. Should Americans prepare to see these files unveiled next week?
Yeah, I get the impression it's kind of fallen off the front page to most Americans, but obviously the run-up to this on Friday of next week will start to get more and more intensity around it, maybe even after today's presser with the President 3. So, yeah, I think that there are a lot of people, especially in MAGA, who want to see the truth.
Well, there you have it. That means everyone's going to be listening at 3. We'll see if the president's on time. Rick Davis and Jeannie Shanzano are always on time, and they'll be back in our second hour of Balance of Power with much more to talk about. Live from Washington, I'm Joe Matthew. This is Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew.
The drumbeat gets louder over war powers in Washington. Welcome to the Friday edition of Balance of Power. As members of Congress demand a say in the administration's military actions in the Caribbean, we're going to talk with the author of a war powers bill that's set to hit the floor coming up when we're joined by Democratic Congressman Jim McGovern of Massachusetts. He is with us in studio today, and we'll tackle the health care debate with our political panel after dueling health care bills failed yesterday in the Senate, setting us up to go over the cliff. Later, our conversation with the CEO of Anchorage Digital, the first federally chartered crypto bank. All after a look at Wall Street. It's not been fun so far. Charlie Pellet has the latest from World Headquarters in New York. What's going on, Charlie?
Right now, we are lower across the board. Joe Matthew, the key takeaway perhaps at this hour, we are off session lows, but still looking at a loss of almost 1% in the S&P 500 index, down 63 now at 68.37. The real damage, though, being done among tech names. Case in point, Oracle, the stock down again today, tumbling 4.2%. Broadcom, after earnings, down 10.8%. NASDAQ down 1.4%. The NASDAQ 100 index down 1.7%. Keeping it all in context, S&P 500 index lower by 64, down 0.9, while the Dow is down 151, a decline of 0.3%. So stocks are extending losses, a sell-off in technology, dragging global gauges from the brink of records. The 10-year, 4.18%, the 2-year, 3.53%, and the 30-year, 4.85%. Gold at $42.92 the ounce. Spot gold up 0.3%. Silver down 3%, $61.67 the ounce. West Texas Intermediate crude, we'll call that flat on the day now, $57.62 a barrel. And Bitcoin down almost 3%, 90,161 on a Bitcoin. President Trump says Thailand and Cambodia have agreed to stop fighting after he spoke with their leaders to urge them to end, quote, the very unfortunate reawakening of their long-running war. Recapping, S&P down 65, down 0.9%. Right now, balance of power continues. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, we thank you. 20 minutes from now, we'll check in the markets one more time with Charlie Pellet as we make our way through a bumpy Friday here on Wall Street. Here in Washington, it's matters of war and peace making news today, and we just got a string of headlines from the White House after the president took to Truth Social to let us know about a call that he had a short time ago. Again, matters of war and peace. Trump says he had a good conversation with the prime ministers of both Cambodia and Thailand, knowing that he helped these two countries end a conflict recently. He talks about it frequently as he dials up the number of wars that he says he helped to stop. In this case, Thailand, Cambodia will go back to their original peace accord. Both agreed to cease all shooting. A ceasefire will be effective this evening, according to the President of the United States. We still have a lot of questions, though, about Ukraine. With the headline on the terminal, Trump says U.S. would help with Ukraine's security in a peace deal here. And this is a bit of an update based on what we have seen and heard from the president most recently. President talking as well about this idea of potentially going to Europe as soon as this weekend for peace talks. He's not planning to. Here's what the president said.
We'll see whether or not we attend the meeting. We said we'll attend the meeting if we think there's a good chance. If they want me to attend, they want us to attend. And we'll be attending the meeting on Saturday in Europe if we think there's a good chance. And we don't want to waste a lot of time. We think it's negative. We want it to get settled. As you know, in the past, we spent, could be $350 billion, giving it to Ukraine. We got nothing in return. But we gave it to Ukraine. I ended up getting rare earth in return, even though I didn't spend money. And we are now selling weapons to NATO. We're not selling it to Ukraine. We're selling weapons at full price to NATO, as you know. They distribute those weapons probably to Ukraine for the most part.
All right, so it doesn't sound like we're going to the meeting on Saturday. But the president again says the U.S. would be willing to contribute assistance to Ukraine as part of a security agreement to end the war. And this really could be seen as progress. Bloomberg Washington correspondent Tyler Kendall's been tracking it for us, having just come back from the White House. Tyler, are we talking about assistance militarily, financially, or both?
Well, it could be both, Joe, though we haven't gotten those exact details from the White House yet. But you're exactly right. It is significant that President Trump is speaking openly about this when it comes to any potential security guarantees for Ukraine, because this has long been a sticking point that Ukraine and our European allies have been pushing this White House to commit to. Because as you well know, for months, we often heard from U.S. officials that any sort of guarantees would be implicit guarantees because the U.S. would have a vested economic interest in Ukraine after inking signing that critical minerals deal earlier this year. Then the tone started to shift, and we know that the U.S. had committed to things like intelligence sharing and air cover defenses in that way. But we know what Ukraine really wants is something a little more similar to NATO's Article 5 mutual defense clause, and it has yet to be clear whether or not the U.S. would go that far to make such a commitment. But we know that really what the U.S. wants to do is see some forward progress when it comes to these ongoing peace discussions. And while it is unclear and at this point doesn't seem like the U.S. is going to take part in these talks over the weekend, it is worth mentioning, Joe, that the Ukrainian President Zelensky did have a phone call earlier this week with Secretary of State Marco Rubio, with Special Envoy Steve Witkoff, and it is becoming very clear that the U.S. is pushing European allies and pushing Ukraine to get on board when it comes to this peace proposal that's been evolving.
Hey, Tyler, we're going to be talking in a moment with Congressman Jim McGovern about a War Powers Act following the activity that we have seen in the Caribbean. We just seized an oil tanker, as you and I have been discussing. There are big questions about the legality surrounding all of this and exactly what we're going to do. But the White House is signaling that there will be more where this came from. What can you tell us?
Right, and that confirms some pretty incredible reporting from our colleagues at Bloomberg News. People familiar telling us that the U.S. has now entered a new phase when it comes to their strategy with Venezuela amid the seizure of the oil tanker, but also additional sanctions this week from the Treasury Department against oil companies, oil tankers, and close associates of Maduro. This is designed to block off Maduro's access to these critical oil revenues in a bid to get him to relinquish power. Keep in mind, about 80% of Venezuela's export revenue is tied to oil. So our understanding is Venezuela right now is preparing potentially for the U.S. to go further and seize additional oil tankers. And this is going to be really critical, one, to their economy, but also as we look at those broader geopolitical relations. And we know that so much of Venezuela's oil ultimately makes its way to China. So it's something that we're going to be watching very closely here. Now, this specific tanker that we are discussing, as you and I discussed last hour on Balanced Power, it's now heading for Houston. The White House Press Secretary Caroline Leavitt confirmed yesterday that the U.S. does have intent to seize the oil on board. According to satellite imagery, we're tracking about 1.85 million barrels of Venezuelan crude on that tanker.
Wow. Yeah, map go on your terminal. Tyler, thank you so much for the update. Speaking of the terminal, this headline just went red. States to sue Trump over $100,000 H-1B visa application fee. This has been a pretty controversial idea, and it looks like it's going to court. Let's stick with Venezuela for a moment, though, knowing that this boat has been seized. And look, we've got another 6 tankers that have been sanctioned. So we could soon have our own shadow fleet, it sounds like. The president talked about this yesterday at the White House. Listen.
It's about a lot of things, but one of the things it's about is the fact that they've allowed millions of people to come into our country from their prisons, from gangs, from drug dealers, and from mental institutions, probably proportionately more than anybody else. So it has to do with a lot of things. They've treated us badly, and I guess now we're not treating them so good.
That's where we start our conversation with the gentleman from Massachusetts who has authored a War Powers Act that could soon hit the floor. Unless, of course, the speaker doesn't want to see that happen. This is a conversation that Democrats and Republicans are having here in Washington. Jim McGovern, Democrat from Massachusetts, ranking member on the House Rules Committee, with us in studio right now. It's really great to see you.
Happy to be with you.
Thanks for coming in, Congressman.
My pleasure.
You've introduced this War Powers resolution some time ago. Will it hit the floor soon?
Yeah, I expect to force a vote on it next week. It'll be ripe to be considered on Wednesday or Thursday of next week. We have Republican co-sponsors, Representative Massey and Representative Bacon, and Marjorie Taylor Greene are on board on this resolution as well. Again, this is not a Democratic initiative. I mean, this is a bipartisan effort by those of us who actually believe the Constitution means something, and Congress has a role to play. And we don't want this president going into a war without a debate and without a vote and authorization by Congress.
Would this be specific to Venezuela or more broad?
It would be specific to Venezuela because that's the conflict we seem to be getting sucked into. Yeah. Although the clip you just showed of the president, he went on to further threaten Colombia, where he might do further action. But look, wars are easy to get into; they're hard as hell to get out of. And we have a history of talking tough, of getting sucked into these wars that cost, billions and billions of dollars, and then we find ourselves in a quagmire that we can't get out of.
Now, I know for a fact that you understand the politics of the Caribbean better than most on Capitol Hill. You helped to begin normalizing relations with Cuba in the Obama administration. You've spent a lot of time in the region. So what do you think the president's aim is here? Is it regime change or something else?
Yeah, I think it's oil, quite frankly.
Yeah?
I think this president is not about promoting human rights. He doesn't give a damn about democracy. And this is not about drugs. I mean, he pardoned the former president of Honduras, who's one of the biggest narco traffickers in the world.
Hundreds of tons of cocaine.
So I think, there must be some financial interest in pursuing this policy for the president, because that's all he really cares about, making money for his family and money for those who are close to him. Look, our history in Latin America has been one of arrogance, has been one of putting profits ahead of human rights. And by the way, this administration doesn't give a damn about human rights. They just issued their national security strategy, and this is the first administration that has removed the word human rights from the strategy. So this is about Donald Trump's ego, and it's about, I think, oil. I think that's, at the end of the day, I think that's what it's about.
Is that why we're seizing tankers?
Again, it would be nice if we had a functioning Congress that would call his administration up and ask these questions, like, why are we doing this? Why now? Again, this is not about drugs. More drugs are coming from Mexico and China than from Venezuela. So what is the strategy here? And the president's threatening, action on the ground in Venezuela. Now, that's war. He's threatening to cut off, air traffic.
He says we're going to do the land.
Right. So
do you think that he would actually strike with ground targets in Venezuela?
Well, if he does, that's an act of war. Yeah. That's an act of war.
Is blowing up drug boats not an act of war?
Well, I think it is. We have some of my colleagues are debating that issue. But we're not only blowing up drug boats. It appears that we are guilty of serious human rights crimes by actually bombing survivors who are begging for help. Congress ought to be demanding a clearly defined mission in terms of what he is doing in Venezuela. And up to this point, there have been very few questions, and he's provided very few answers.
You said something interesting, a functioning Congress. Just back off what we're talking about here for a minute. We are in a world now where it does seem that discharge petitions and reconciliation bills are the only way to get anything done in the Congress. Do you feel that way?
Yeah,
You're on the Rules Committee. You know how this works.
Yeah, this Congress under Republican leadership does not function. It is not working. It is a terrible disservice to the American people. This is a place where trivial issues are getting debated passionately and important ones not at all. We have a healthcare crisis right now. People are seeing their healthcare premiums skyrocket. People are deciding to go without health insurance next year because the costs are so high. We need to be talking about extending the ACA tax credits so that people can afford their health insurance. And we're not doing that. We're talking about stupid stuff, stuff that is probably not even going to even be considered by the Senate, that is going nowhere. Again, Congress, a functioning Congress means that we do the work of the American people. And I'd like to think, no matter what your politics may be, making sure that we are addressing issues of affordability, which includes the cost of health care, are front and center. If the Republicans have a plan, then bring the plan to us. Let's debate it and vote on it.
Yeah.
They've got nothing.
Well, let's talk about health care, because Republicans put up a bill in the Senate yesterday. It failed. Then the Democratic plan failed. The Democratic plan, of course, would extend Obamacare subsidies. The Republican plan, produced by Bill Cassidy, would have health savings accounts. Congressman, I spoke with Nicole Malliotakis yesterday, who has signed on to a bipartisan effort in the House, D's and R's, that would extend the subsidies, would add some eligibility controls as well, because someone like Nicole Malliotakis is not a fan of the Affordable Care Act, as she told us yesterday. Let's listen.
There's so much fraud here, which is why we think we have the proper balance. And this gives us enough time, by the way, to then work over the next year or two to be able to come up with something that can truly replace the Affordable Care Act and bring costs down. Now, what the Speaker and leadership are saying is that we're going to take up a health savings account measure, which will help people certainly with their medical costs, and I support that initiative, but it doesn't go far enough.
Okay, but this is unlikely to see the floor unless the discharge petition makes that happen.
And even if we do the discharge petition route, we won't be able to get to it until probably in early January.
Sure.
My question to Representative Malliotakis is, like, where the hell have you been? I mean, you're a Republican. Your party's in charge. We've been talking about this issue for months. This is not something
Since before the shutdown.
Right, since before the shutdown, well before. We've been talking about it during reconciliation, right? So we go back months and months and months. And we've been saying we got to focus on this. And all we've been hearing from Republicans is like, oh, yeah, we'll get to it. And now we're out of time. People are going to lose their health insurance. Healthcare ought to be considered a fundamental human right for everybody in this country. You know, I mean, you need healthcare. If you don't have healthcare, you end up in an emergency room.
Right.
You know, I mean, this is crazy. So look, there are a number of discharge petitions that have been introduced with various approaches to helping people afford their health insurance. I mean, let's figure out what the best one is and let's move on it. But the stalling and the excuses and the finger pointing, it has to end. You know, we want to debate this issue. We want to vote on this issue. We want to help the millions of people in this country who are about to get screwed.
What's the conversation in Worcester, Massachusetts right now? If you stop in Kelly Square and ask somebody about their health insurance, are they seeing these increases and dropping off the rolls? Or are they saying, I can't afford it anyway, so to your point, I'm going to go to the emergency room when I got to go?
So, I mean, we're hearing some really terrible stories of people basically saying, I can't afford my health insurance. Our office is getting inundated with calls. Look, people in Worcester just want us to do our job. And they get it. There are differences between Democrats and Republicans. But at the end of the day, they want us to get something done. You don't have to agree on everything to agree on something. But whatever that something is, it has to be about improving the quality of life for the people who live in Worcester and all around the country. And the problem with what the Senate did on the Republican side is the stuff that they're proposing, you know, it doesn't mean anything in anybody's life. I mean, you know, saying I'm fixing healthcare, but in reality not fixing healthcare, not making it more affordable, well, that doesn't help anybody, right? You know, we ought to have a larger discussion on how we fix our entire healthcare system because it's a mess. It's too for-profit oriented.
Yeah, okay.
But we're not going to do that in a week or two, right? Right now, we need to extend these tax credits so that millions of people don't see their premiums skyrocket and millions don't lose their health insurance.
We've only got about a minute left here. A terminal user just wrote us while we're talking. Ask the congressman why the ACA failed that they designed. Maybe I can reframe that a bit. A lot of Republicans come on the air and they say this thing was never affordable. Obamacare itself has raised premiums. Is this plan broken?
No, look at it. I think it's not perfect.
Yeah.
But it is better than the alternative, which is no ACA, right? I mean, the bottom line is millions and millions of people have coverage because of the Affordable Care Act. You know, if we extended the tax credits, it's affordable. But as I said, we need to have a bigger conversation. Look, if it was up to me, we would have a Medicare for All system. When I was the chairman of the Rules Committee, we were the first committee, either the House or Senate, to do a hearing on Medicare for All. And I'll tell you, it was a very, very powerful hearing. But, you know, to fix healthcare holistically, you know, it's going to take some time. In the meantime, let's extend those tax credits. Let's help people afford their health insurance.
Let's talk when the War Powers Act hits the floor. We've got a lot more to talk about, Congressman. Let's do this next time at Coney Island.
All right, I'm with you.
Onions or no?
Yeah, with onions.
With onions. It's the only way to do it.
Best hot dogs in the world.
They really are, too. I'm Joe Matthew in Washington. Congressman Jim McGovern of Massachusetts. This is Bloomberg.
It's 1:21 on Wall Street. We do check markets all day long here at Bloomberg. Techs are tumbling. We are off session lows. The Dow, the S&P, NASDAQ all in the red. S&P on track for a loss this week. S&P right now down 55 to 68.46. That is a decline of 0.8%. Yesterday, the S&P closed at a record. The Dow down 156 now, down 0.3%. NASDAQ down 292 for NASDAQ. The composite index down 1.2%. The NASDAQ 100 index down 1.5%. 10-year 4.18%, with the 2-year currently yielding 3.53%. The 30-year 4.85%. Gold is up 0.4%, 42.99 the ounce. West Texas Intermediate crude flat on the day at 52.61 a barrel. And Bitcoin now down 2.7%, 90,356 on Bitcoin. Sources tell Bloomberg Oracle has pushed back the completion dates for some of the data centers it's developing for the AI model developer OpenAI to 2028 from 2027. Oracle shares, they're down right now by just about 2.6%. After earnings, Broadcom shares, they're plunging 10.4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. Balance of Power continues now. Once again, your host here is Joe Matthew.
All right, Charlie, thank you. Not a very fun ride today on Wall Street, and we'll check back in for more on the markets in just about 20 minutes here on Balance of Power. Thanks for being with us on the Friday edition here on Bloomberg TV and radio. The question of states' rights being debated fiercely here in Washington when it comes to AI regulations. This is not a new issue, but it's one the president decided to step into. Signing an executive order just yesterday, it happened late in the day, to essentially make it impossible for states to have their own AI regulations. This is a nationwide blanket, as the president says, to help companies cut through the red tape and continue growth to compete with China. We talked about this earlier today. A fascinating conversation on Bloomberg TV and radio with the president's crypto and AI czar, David Sachs. Let's listen.
The problem that we see is that you've got 1,000 different bills going through state legislatures right now to regulate AI, and over 100 measures have already passed. Some of these bills are contradictory, and you've got 50 different states running in 50 different directions. That type of compliance regime is going to be very hard for small companies and startups, especially innovators, to comply with. And so what we need is a single federal or national framework for AI regulation, and in the meantime, create tools that the administration can use to push back on examples of the most onerous and excessive state regulations.
So what does this do? This order directs the U.S. Attorney General to establish what they're calling an AI litigation task force to challenge state AI laws that they feel are inconsistent with the policy. It also directs in this case, Howard Lutnick, the Commerce Secretary, to publish an evaluation of existing state AI laws and issue a notice specifying which ones can stay and which ones need to go. Let's play it to the panel. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano are with us. Rick is our Republican strategist and partner at Stone Court Capital. Jeannie is Democracy Visiting Fellow at Harvard Kennedy School's Ash Center, our Democratic analyst. Rick, have Republicans turned away from states' rights?
Oh, that's a legitimate question. Certainly this president doesn't think much about them. He's railed against state actions a lot, and he's obviously used the full power of the federal government to institute things like law and order in states against their interests. So, yeah, I think that this president is creating a new dynamic within the Republican Party that basically treads on the states' rights issues pretty well. Although, that being said, there are a number of Republican governors who have also opposed this effort by the president to have a blanket AI regulation usurping the states' rights. And so I don't think this debate is over.
This is, again, not new. In fact, there's been legislation. Senator Ted Cruz has tried to push this over the line a couple of times here, Jeannie. So what's going to happen? Are we going to have 50 lawsuits to track here?
Probably more than 50, Joe. We also had Steve Scalise, who also had a bill. They've been unable to push those through, and I think that that is absolutely where our attention should be. Donald Trump is not wrong to say we need federal policy regarding AI. The problem is just what you were talking to Representative McGovern about. We have an inept Congress, a do-nothing Congress. You can't turn to Congress and say, why don't you get on top of this? I mean, we all know, for instance, we have a huge privacy problem in this country. For years, we have yet to have federal regulation of privacy rights. What do we have? 50 states doing 50 different things, same thing in AI. It is a problem. So on that, the president's instincts are right here. The problem is doing it through an EO, of course. And then the other part of the problem is the fact that the president is so cozy with all of the big people who are in charge of AI in this country. I mean, I'm just reflecting on Time Magazine's cover of, the person of the year this year is the architects of AI. They're all sitting like on that bridge building the new century. That's a problem when AI is threatening young people graduating from colleges who can't get jobs. That's a problem when you have a president who has so much himself personally and his businesses invested in this. And they are all surrounding him at the inauguration and coming in and out of the White House. So on the one hand, Trump is right. We do need federal policy and regulation. We don't need it this way. It is the job of Congress, and yet we can't turn to them on this or much else these days.
So it sounds like Jeannie has a bit of a bad taste in her mouth when it comes to these relationships. Rick, she's right. Everyone's sitting on that girder on the cover of Time Magazine's been spending time in the Oval Office recently. But I'm struck by something that Scott Bessent said. He uses this line a lot. It's pass-fail versus China. We have the lead. We've got to maintain it. There's no second place in the AI race. Is that something that Americans need to start getting their heads around?
Yeah, look, I don't think it's insignificant what Secretary Bessent says. It is a race against time for technology that'll transform our economies. And just like the Industrial Revolution bolted the United States into a prime spot in the global economic sphere, so will AI. And so I tend to agree with Jeannie on this idea that you do need a general plan for the country related to that. And I doubt if Bessent disagrees, because that's basically what Trump is saying. But like, the place to have that debate is in Congress. Congress is the only body that can pass a law that usurps state law. And so an EO can be thrown away in the garbage the minute a new president steps in. And I would remind Jeannie, all these guys who are now for Trump were all for Biden 4 years ago. And so I think it's a good thing that industry is cooperating with the government. I think if it were the opposite, we would really have significant problems. So yeah, let's win the race. Let's improve our own economy by having this kind of productivity.
Well, Jeannie, if everybody's going to court over AI, looks like they're going to court over the president's new visa plan. This is a story that broke after we came to air. A group of states here announcing that they will be suing the administration to block this $100,000 fee for new H-1B visa applications, which allow employers to hire what they call skilled foreign workers. This is a different program than some you might see for agriculture, et cetera. These H-1Bs are specific to the companies we're actually talking about. Jensen Huang was asked about it. He seemed to indicate, Jeannie, that $100,000 was worth it based on the incredible amount of work that they have to perform here in the United States when it comes to AI and other emerging technologies. How's this going to pan out when it comes to the H-1B?
So, Joe, if I can just circle back to Scott Bessent for a moment, can you please ask him if that's the case and there's no second place, why then are we selling NVIDIA chips to China? I just have to ask that. Going back to the H-1B visas, I think the problem is that we want to use what has long been our most important strength, and that is the fact that so many of us are either immigrants or the children or the grandchildren of immigrants. And when you say it is going to cost $100,000 to come in on one of these visas, that is a whole scale switch from where we've been in multitudes that I can't even count because I'm no mathematician, but it's a lot of money. So yes, if companies want to pay that on behalf of workers, great. But you should not make our system one in which you can only come in if you are wealthy or beholden to wealthy people. We should be bringing in and supporting the best and the brightest in the world, if indeed we want to win this competition against China and other parts of the world that Scott Besson is talking about. So many of these things just don't seem to add up if you're talking about competing with China. You know who's welcoming people without this kind of cost? China. So we should be doing the same.
Really interesting point, Jeannie. This case is being led, by the way, from Massachusetts Attorney General Andrea Campbell and California AG Rob Bonta, who put out a statement, Rick, that says, as the world's fourth largest economy, California knows that when skilled talent from around the world joins our workforce, it drives our state forward. The Trump administration thinks it can raise costs on a whim, but the law says otherwise. Can the president do this?
It's a little sketchy. Again, executive action doesn't have the impact if they actually ran a bill through Congress where they amended the H-1B visa program and made it a statute. It'd be ironclad. Again, I think we're just tripping over ourselves as a party by not really instilling these ideas into some kind of, hard legislative agenda that will become the rule of law rather than the whim of the presidency. And look, I mean, remember, nobody gets in on an H-1B visa who isn't sponsored by a company that's going to already have them hired and put them to work. Right. It's not like you just wander into the United States and go looking for a job if you're a computer engineer. And so, it's a little more structured than I think Jeannie wants to portray. But at the end of the day, it does limit the people who can pay for this to the Jensen Huangs, because not everybody can afford an extra $100,000 on top of what they're already going to pay somebody like this. So I do think it's an unfair advantage for very wealthy trillion-dollar companies when you talk about the distribution of this kind of talent into the United States.
You could just buy a Trump gold card, Jeannie. We didn't talk about this. The administration debuted the website Wednesday. It's online right now, opening up applications for the gold card, which is basically an expedited visa here. If you pay $1 million, makes $100,000 sound pretty cheap, doesn't it?
It absolutely does. Again, you're going to make the talent coming in here be beholden to the wealthiest billionaires, and the president, of course, as the polls show, he's comfortable there. That's where he lives. He doesn't understand why people feel like they're suffering economically. But the reality is not that for most people in the United States and certainly around the world. And no, I'm not thinking that people are wandering into the country, but the reality is you want to make companies who are building not have to spend $100,000 to bring talent in.
Great analysis, as always, from our signature panel. Jeannie Shanzano, Rick Davis. They'll be back on the late edition of Balance of Power. Thank you both. I'm Joe Matthew in Washington. This is Bloomberg.
1:40 on Wall Street. We do check markets all day long here at Bloomberg. Stocks are lower across the board. Techs are tumbling. We begin with NASDAQ down 287 points right now, down 1.2%. The NASDAQ 100 index down 1.4%. S&P extending losses down 54, down 0.8%. Yesterday, you recall, the S&P had been at a record. Today, the Dow down 158, a drop of 0.3%. The Mag 7 index down 0.5%. The 10-year 4.18%. The 2-year 3.52%. And right now the 30-year 4.85%. Gold at $42.98 the ounce. Spot gold up 0.4%. A retreat for silver down 2.5%. $61.94 the ounce. West Texas Intermediate crude oil down 0.1%. WTI $57.53 a barrel. And Bitcoin down 2.5%. $90,600 on Bitcoin. Among retailers with earnings out last night, we did hear from Lululemon Athletica. The stock today up by 10%. Also reporting last night was Costco. Costco shares down now by 1.2%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Balance of Power continues right now. The Friday edition, wrapping up the week. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie Pellet, thank you so much. And pass the hot sauce. As Nathan Dean likes to say at Bloomberg Intelligence, there's hot sauce on the pot stocks today. And if you've been listening to Charlie, you know why. A report in the Washington Post getting us back around this idea of President Trump warming up to weed. Must have gotten a call from Roger Stone. Trump seeks to cut restrictions on marijuana through planned order. This is rescheduling we're talking about here, and it's something that a lot of folks expected during the campaign. Maybe not so much after the president took office. This is, by the way, an idea that was pursued by the Biden administration. Never ended up happening, as the president now is expected to direct agencies to reclassify marijuana as a Schedule III drug, similar to common painkillers. It is currently in the same class as heroin. And this would not legalize marijuana, but it would allow cannabis companies to see the light of day and potentially use a bank. Would also mean a different tax status, and that's why we're seeing these stocks take off. We thought we'd dial up Nathan Dean to get his take on this. Of course, at Bloomberg Intelligence, our senior U.S. policy analyst who's fielding calls on this all the time because, as you can tell us, Nathan, welcome back. Cannabis investors are passionate and very active, and they have been waiting for good news for a long time. But Lucy keeps pulling the football. Is this actually going to happen?
You know, that's the number one question we got this morning from the clients is this for real now? And what we're telling our clients is that, look, you know, yes, these equities have hot sauce, lots of volatility. MSOS is up 38%. But really, I think what we need to do is see what happens with this order, because the president does not have the authority to unilaterally reclassify it from Schedule 1 to Schedule 3. What I think the order is going to say is that it's going to direct the Department of Justice and the DEA to restart this process of rulemaking change. Now, they're about 70% of the way through, so, I mean, obviously it's not going to be that long. But if the DOJ comes out and says, right, we're going to do this on a speedier method, meaning we're going to forego a hearing, we're just going to move straight to the rulemaking process, they can get this done by the first half of next year. The question, though, is what is going to be in that order? Because obviously, if that order just says, I'm going to deem it valid and therefore it's Schedule 3 today, then that's going to have court challenges and uncertainty still reigns.
What's the DEA think about this? Because I thought the tension was coming from within the administration last time we spoke.
Yeah, and it still is. I mean, so obviously we've heard anecdotally that the DEA is not, the staff there is not really on board with this idea. That was prevalent during the Biden administration. We saw no reason why it would change under the Trump administration. In fact, the administrator of the DEA, Terrence Cole, has a 30-year history of fighting marijuana, and he didn't really seem to be that on board with the idea. You know, the Washington Post report even talks about how Speaker Johnson tried to rebut some of President Trump's arguments here. So what we're telling our clients is that, look, even if reschedulization goes forward, it's not legalization. It doesn't lead to increased market share for these companies. What it does is it changes the tax code, something called 280E. So rather than paying a 40% tax rate, you're down to around 10 to 15%. So that's obviously good for those companies. But this resistance still remains, and that's why we're at a 30% chance of legalization, and that is what would prohibit market share growth, organic growth, everything like that. This is really just about tax.
Okay, this is good to understand and not to conflate with the Safe Banking Act, right? Was I correct about that, or these companies would still not be able to use banking services?
That's correct. I mean, under the Safer Banking Act, banks would be able to service marijuana businesses. But our theory on that is until it's legislatively changed at the federal level, meaning until the drug is federally legalized, banks, especially the big banks, the publicly traded banks, they're not going to touch marijuana because you're going to be afraid of running into the Bank Secrecy Act or anti-money laundering. And honestly, the revenues just isn't there for the risk. So for these companies, there's two things for market participants to keep in mind. One is the tax issue, and the second is there's a lot of retail sentiment in this hot sauce right now. If you look at the Canadian pot equities, they're also up 30%, and this largely doesn't apply to them. So there's a lot of folks out here saying, you know what, this is good, but just keep in mind there's a lot of retail sentiment here as well.
Well, and that's important because you pointed out MSOS, that's the Advisor Shares Pure U.S. Cannabis ETF, because a lot of these other ETFs fold in, to your point, Canadian companies, right, or tobacco companies, a lot of different grow companies. I think you find a lot of different stuff that you might not expect, for instance, in the MJ ETF. Is this what your clients are looking at? Is this what our audience should be tracking?
Yeah, I mean, honestly, what the reschedulization does is that it really opens up the mom and pop aspect for marijuana. So think of like the mom and pop farms in Oklahoma and Colorado and so forth. Those are the businesses that this is really geared towards. Now, the reason why it's positive for the bigger companies is because we do anticipate that there's going to be significant consolidation in this industry as incrementally things get better and better and better in terms of the legality of the drug. This is not an easy business to be in right now. And so as you get more of a regulatory framework, usually it's the big players that gobble up the smaller players, and then they are the ones that have the technology spend, the compliance spend, the legal spend that can deal with these regulations. So if President Trump does reclassify this, let's just say middle of next year, the tax relief will be there for the 2026 tax season in 2027. And then you will start to see, I think, some consolidation amongst the bigger players gobbling up the smaller players. But again, it doesn't really change the idea in terms of organic market share growth or anything like that. It just really just changes the finances of the system.
All right, makes a lot of sense. MSOS is the ticker as we spend time with Nathan Dean, backed by his iconic image of Stumpy at the Tidal Basin in Washington. There's got to be some connection here for a plant that grows freely from the earth, Nathan Dean. I want to ask you while you're with us about crypto, because you're out with the 2026 Outlook, U.S. Crypto Policy on Bloomberg Intelligence. To what extent will this industry and this investment class evolve in the new year?
So 2026 is going to be a tremendous year for crypto, and there's really three things to keep in mind. One is stablecoins. Now, the FDIC and the Fed, they're expected to release a proposal almost, I think, within the next week or so, implementing the Genius Act. This is the first of two proposals we think are coming. This is more about applications and registration, not all that exciting, but at the end of the year, stablecoin issuers are going to have a regulatory framework. You have the SEC and the CFTC moving forward with Project Crypto, taking off the enforcement risk, allowing these companies to innovate without the fear of that regulatory albatross hanging around their neck. And then you have the House and Senate discussions for this broader crypto market structure bill. Yes, there was a little bit of hiccup this week, but I do stand by our call that we do think that there's a 70% chance of this passing in the first half of next year, which would then give additional regulatory clarity for companies like Coinbase and Robinhood.
Pretty big deal. Watching crypto today, a little bit lower. We're down 2.5% on Bitcoin. Nathan, thank you so much. Have a great weekend. Nathan Dean at Bloomberg Intelligence with smart analysis on weed and crypto. We'll pursue the latter now with an important conversation that I've been looking forward to. Nathan McCauley. We go from one Nathan to another. The CEO and co-founder of Anchorage Digital, which you may not have heard of, but you should know about. Anchorage is the first federally regulated crypto bank in the country. Nathan, welcome. It's great to have you as part of our conversation on Bloomberg TV and radio. Are you getting what you need from Washington? And what do you expect in the new year?
Listen, first of all, it's wonderful to be here. Thanks so much for having me on the show. We are absolutely getting what we need from Washington. Genius Act passed earlier this year, which created the federal regulatory framework for stablecoins. Since then, we have announced 4 partnerships with stablecoin issuers, including the stablecoin giant Tether that is going to be working with us to issue their U.S. version of their stablecoin. So the Genius Act has just been incredible. Really excited for market structure, which is coming next, which will lay the groundwork for how to think about trading, securities, and the whole landscape across the digital asset ecosystem.
Well, this is really interesting. To what extent has this changed the crypto landscape as we see stablecoin usage increase dramatically following the legislation that's passed? And some have suggested that it has turned investors away from Bitcoin, from Ethereum, from other tokens. Do you see that happening?
No, I see quite the opposite. I see that among institutional investors that are looking at the digital asset ecosystem, their conviction in Bitcoin as a store of value is only growing. We're seeing an incredible amount of inflows into our custody system from institutional investors looking to invest in digital assets. In fact, now all of the large ETFs in the country are now utilizing Anchorage Digital as a custodian, listed on all of their S1s. But even further than that, what we're seeing is as stablecoins grow, stablecoins are not going to be competitive with the blockchains. In fact, they are going to be using blockchains. And so I think one of the biggest benefactors of the stablecoin trend is going to be the chains themselves. Ethereum, Solana, and the other chains where these stablecoins settle and live are going to see a lot more growth there. So I think it's an accelerant both for the stablecoin ecosystem and for the entire ecosystem at large.
Well, that's really interesting, and I appreciate you describing that at a time, of course, where we've seen some real volatility in crypto, and specifically, my gosh, what we've seen in Bitcoin and Ethereum specifically over the past couple of weeks has prompted a lot of concern. And we've had people on this program, Nathan, suggest that we could be going into another crypto winter. What would you say to them?
The way that I think about it is that these are assets that are best measured in decades in terms of their investment thesis. Thinking about your entry price for assets can definitely be something to think about. But as Bitcoin grows as a store of value on a global basis, as we have smart contract languages like Ethereum and Solana that have a kind of a long run track record here, I think what we see among our institutional investors is that long-term time horizon, 10, 20, 30 years, being the thing that matters, and a little bit less focus on, say, the cyclical sine wave that is the crypto bear and bull cycles.
Talk to me about security, secure usage, ensuring the fact that these assets are not used for criminal enterprise, as Senator Elizabeth Warren frequently warns. We hear this conversation a lot in hearings in Washington, D.C. What do you have to think?
Sure. So I think there's a couple ways to think about that. The first one is software security considerations. Can you hold the assets and keep them secure and safe? My company, Anchorage Digital, operates a national bank where we hold assets for institutional investors. And the primary thing we provide to them is security, safekeeping of their assets. And so we've developed a ton of security procedures, and that's really well appreciated and is really central to any investment thesis in the crypto assets, is thinking about the security of your assets. The second part of your question is around, what do we think about how stable coins and other assets are used on a global scale? As I mentioned, we operate as a national bank, so we completely comply with all federal regulations around BSA, AML, sanctions, and all of that. And so I think in many ways we have proven that it is possible to operate like that and to operate crypto asset businesses fully and completely within the regulatory perimeter of the laws and regulations of the United States.
Well, in our remaining moment, Nathan, what does your charter mean for the rest of the industry? Will we see more banks like yours and create a new class of banking?
I hope so. So we are the first and as yet only operational federally chartered digital asset bank. But I expect that we are the first of many. The way I like to say it is that there used to be such a thing as internet companies. Now that is just called a company. And we are a crypto bank, and I think there one day will come in the U.S. where every bank will be a crypto bank. And so we are one of one at this point, but I look forward to being one of 4,000, and we look to help enable all the rest of the banks to come into this space. And so looking forward to even more adoption there within the banking industry.
I appreciate your being with us. He's the co-founder, CEO of Anchorage Digital. Nathan McCauley with us on Bloomberg. Thank you, sir, for the insights. I'll meet you back here on the late edition of Balance of Power. And we could have news from the White House as the president is set to tangle with reporters about an hour from now. Much more to follow as Bloomberg Business Week Daily kicks off here. We'll have a look at the market straight ahead, and I'll meet you back here at 5 p.m. This is Bloomberg.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
All right. right, everybody. Yes, indeed. It is TGIF Friday, December 12th. Why do I have December 11th in the script? Why am I always a day off?
I can't.
Do you know what's up with that?
That's above my pay grade.
Man.
I'm not qualified to make that assessment.
All right, can we get the doctors on that? Because there's something going on, I think.
Well, it's the 12th. It's better than Friday the 13th, Carol. And that's where we are.
Triskaidekaphobia.
Yeah, well, look at this. The NASDAQ 100 off its worst levels today, but still down 1.7%.
Maybe it's Friday the 13th in the NASDAQ trade.
Okay. Well, there is a rebalance later today, so.
Maybe.
You know. The S&P 500 down 1%. We're going to have much more from Charlie Pellet in just a minute. He's going to give us all the details.
Yes, indeed. We're going to get off. No. We're going to get to that in just a moment.
We will.
We're going to get into that sell-off when it comes to, it feels like, AI winners, because that is dragging down the overall trade. Hey, we also did get that disappointing sales outlook from chipmaker Broadcom that's weighing on rivals, fueling some of those investor anxieties about that AI bet. And then we also have some mixed messaging from Fed officials. So, yeah, you know what that means? Michael McKee's sitting right next to me because we got to, pressure's on you, Mike, in just a moment.
All right, we're going to get to Mike in just a minute. In the meantime, what to take note of when it comes to the Fed speak and, of course, Broadcom's results as well.
Yeah, let's not forget, too, we're going to get a read on the C-suite. We've also got Stephanie Gill, Chief Investment Officer at Robinhood Market. She's going to talk about flows, volume. And on that vantage point from the C-suite, we've got the CFO of UiPath. That stock has been on a tear this year. So we see what they have to say. He's got an AI angle as well.
All right, looking forward to that over the next hour. First up, though, a check of the day's trade and top business stories. Here he is, Charlie Pellet.
Thank you very much. Indeed, got to begin with Oracle. Stock is down 3.9% right now. Earlier, we reported that Oracle had pushed back the completion dates for some data centers that it is developing for OpenAI to 2028 from 2027. That, according to sources. But right now, we have got an Oracle spokesperson providing an update saying the company remains confident in its ability to meet its obligations and future expansion plans, and that there have been no delays to any sites required to meet its contractual commitments. Again, Oracle shares trading lower now by 3.8%. We're looking at a down Friday right now, on track for a losing week on the S&P 500 index, the Dow, the S&P, NASDAQ, they're all in the red. S&P 500 index trading lower by 1%, 68 points lower at 68.32. Yesterday, you recall the S&P was at a record. The Dow down 220 now, down 0.5. NASDAQ down 1.5%. NASDAQ 100 index after Broadcom earnings down 1.7%. Broadcom, by the way, down 11.2%. 10-year 4.18%, with the 2-year 3.52%, and the 30-year 4.85%. Gold up $11 the ounce now, 42.91, up by about 0.3%. West Texas Intermediate crude oil down 0.1%, 57.52 a barrel, and Bitcoin just above $90,000, but Bitcoin today down now by just about 2.9%. Keeping an eye on those pot stocks right now. We have got shares of a number of those companies advancing, surging right now. Let's begin with the ETF, MJ on the ticker, the Amplify Alternative Harvest ETF. It is up now by just about 37%. Tilray up 39%, and Canopy Growth up by 51% right now. Sources tell Bloomberg President Trump is expected to direct his administration to move to reclassify marijuana as a less dangerous drug. Recapping, S&P down 70, drop there of 1%. And for on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, got it, Charlie. Thank you so much. We're going to talk more about Oracle in our next block. In the meantime, we want to get to, we're still thinking about Fed because it's definitely playing out in the trade today. Fed officials, including 2 who will become voting members next year, offered strongly opposing views earlier today on what to do with interest rates, Tim, continuing a debate that will grip the U.S. Central Bank into the new year. I am imagining that it's going to be a spirited conversation around the table there at the U.S. Central Bank.
Holiday dinner.
Yeah.
I like that.
Yeah.
With us on all things Fed and more, Bloomberg TV and radio international economics and policy correspondent Michael McKee joins us here in the Bloomberg Business Week studio. So Goolsbee cites the need for more data in a dissenting vote. Hammack says she prefers slightly more restrictive rates. Schmid cites too high inflation as reason for dissent. We're hearing from some of the dissenters. What's the collective voice that we got today?
A collective voice was dissent. These were mostly the people who opposed the idea of cutting rates farther. The interesting thing about Jeff Schmidt, the Kansas City Fed Bank president, and Austin Goolsbee from Chicago, was they both tied it to visiting their constituents.
So the anecdotes.
The anecdotes being out in the districts and having people tell them that prices are their major issue and that they are really concerned about inflation. And as Goolsbee put it, we just can't assume that inflation is going to be transitory.
Okay, so you make a really good point about consumer behavior and inflation expectations. What does it mean for the way a consumer behaves if they're worried about inflation?
Well, in theory, you would spend more money today, but that's not necessarily what's happening. It's more that people's decision-making will be affected by the idea that they think prices are going to be higher. So they may or may not spend, and the economy slows down, and the Fed, if inflation is higher, is going to be raising interest rates, not cutting interest rates. Now, there's still a minority on the Fed, but it's a growing minority. And as you mentioned, Beth Hammack is going to be a voter next year. Now, Goolsbee and Schmidt they're done voting for this round, but Beth Hammack is going to be voting next year, and she's definitely in the hawk camp.
Mike, we've done some reporting. Bloomberg News has put out some stories about K-shaped economy, but really talking about which consumer matters most to the U.S. economy, and they tend to point to the higher end consumer. So are they feeling the inflationary pinch as well?
No, not really. I mean, I thought the most important consumer was you, but
don't tell my husband.
When you go shopping, yeah. No, the people who have enough money spend just on what you would call discretionary. They're not worried about grocery prices and things like that. And those people are the ones that are holding up. Those people are the ones that are going to the luxury brands and still spending a lot of money. But the lowest quintile and maybe the lowest two quintiles, they're the ones who are clipping coupons or cutting back or switching from. Everybody switched away from steak to chicken, but they're switching to other products that are cheaper because they're having trouble making ends meet. Jay Powell made a point that is not incorrect. It's not so much that inflation is accelerating too much. It's only at about 3%, but that people are just used to, they're comparing to what we saw before the pandemic, and prices are high now, and they're not feeling that their wages kept up.
I guess my point is, like, there's a social conversation. We've had it many times that this is not an economy where everyone benefits equally, right? And we know that. But I guess what I'm trying to say, if we just put on the economic hats, as you do so well, is it that the higher end consumer in terms of the U.S. economy is a lot more important, so that we care from an economic perspective what they are doing, that's more important.
Well,
again, I'm not. I'm taking my heart out of the equation.
Yeah, there are fewer people in the highest quintile or in the highest decile, and so if the rest of America decides to pack it in and the economy goes into recession, then everybody loses. And of course, if companies think things are going bad and they start firing people, then that spreads. And as you see today, the stock market's going down. We've been talking for weeks about, are we in a bubble? Is this going to be it? And maybe this is it, maybe it's not. But at some point, the stock market goes down, and then even the wealthy people stop spending. They've got the money, but it's the wealth effect, the idea that I'm going to have the money to pay this bill when it comes in the door.
Before we let you go, just pushing ahead to next week, we get some data, housing starts, new home sales on Monday, November payrolls on Tuesday jobs day.
Tuesday jobs day.
What are you expecting? What are we expecting?
Very confusing jobs report.
Yeah, well, first of all, the fact that it's on a Tuesday, you think you have trouble with the date today?
It's already confusing.
Well, we're going to get this all the way into the new year. It's going to be 2026 everywhere except the Bureau of Labor Statistics. They are combining the October and November numbers, but the October numbers will only have jobs created, and it may not have the entire data set.
So do we just throw it out?
We won't get an unemployment report. No, they couldn't collect it.
Oh, okay.
So we don't get the household side, which tells you what the unemployment rate is and things like that. And then we get the November numbers, which will get both sides of the report, but it may not be complete It may not be a 100% or close to 100% participation rate because they had to start late. So the Fed's going to look at this and say, this is interesting and it's good news, but the real issue is wait for the December numbers that come out January 9th.
Yeah, just it's like crazy, right? Until everything gets reset and back on track.
Yeah.
And that'll be hopefully in the new year.
When will that be?
I don't know. But we'll certainly be continuing to lean on you. Mike, thank you so much. Michael McKee, Bloomberg TV and Radio, international economics and policy correspondent right here in studio. Let's broaden out a little bit and let's get into maybe investors, how they've been reacting since we got that Fed decision and what we are seeing with investment flows and what's going on in terms of activity.
For that, we turn to Stephanie Gill, Chief Investment Officer over at Robinhood Markets. She joins us here in the Bloomberg Business Week studio. Stephanie, I wanted to start with what's happening on the Robinhood platform because you certainly have a certain segment of the investing population. What are you seeing on Robinhood right now?
We're seeing still net buying, but it's been more muted, I'd say, than it was before. And it's been in some of the things that have been going down or had, like Netflix, for example. You've also seen where there's been sales, it's been more in the AI-oriented names.
Okay.
So I've kind of shared this before, but our customers tend to hold core positions and trade around them, meaning they buy when they go down and sell when they go up. But we're seeing a little bit differently where there seem to be like being more subjective about what they're investing in. And that's why I say like it was kind of interesting to see NVIDIA being sold and, you know, things that are kind of under pressure.
So selling rather than selling as they have gone up a lot and taking some profits, they're selling as they're going down.
Yeah, but they probably have embedded profits because they've held them all year. So I think that's like kind of giving up a little bit on the AI trade for now.
Well, like I totally get it. Like, you know, Tim and I were talking about Oracle. Like it is still up almost 14% year to date, but we've seen a more than 40% decline from some of the, when it hit a record back in September, excuse me. So, I mean, how much can you dig deeper into the data in terms of what you're seeing? Is it Mag 7 names that people are getting out of? Is it all tech? Is it just AI related? Like, what are you seeing?
It's just the AI related that I've seen, and then some of the like CoreWeave, you know, those kind of names that are
the
like
neo cloud
yeah,
names.
Exactly. You've also seen some buying in just broad-based ETFs and some T-bill oriented ones that like kind of make me feel like diversification, you know, kind of parking things rather than trying to pick.
So less playing the market and more like long-term diversified index funds?
I think for now,
Wow.
usually we see that activity when there's a big dip, like they go into ETFs first and then they play the differences in names.
How are they playing this? I don't want to call it a crypto winter yet, but we're down another 3% on Bitcoin, hovering around $90,000 per Bitcoin right now. How has that played out over the last couple of weeks?
In the stocks, I've seen actually some buying in like the MicroStrategy names, but on the crypto side, I've actually seen more selling than buying.
Interesting.
Yeah.
So instead of actually holding the patterns that you're seeing, instead of actually holding the cryptocurrency, people are instead putting money into the proxies or the hoarders.
Yeah.
Okay.
I mean, if you can make that relationship, I kind of look at two different dashboards, like crypto versus, but I did think it was interesting to see buying into the equity related.
Yeah, because certainly strategy has had its own set of challenges.
Yeah.
Okay, so let's back out a little bit and talk big macro picture right now. We haven't had a chance to speak to you in a few weeks, and given what we heard from Jay Powell, what we just heard from Mike McKee about different views of the economy coming from different people, where do you sit?
I think the economy is okay, actually. Like, I think when this is totally anecdotal, but my feeling is that like New York City is busy, travel is a lot. Like, I actually think the consumer is generally okay. That being said, the lower end consumer is still not doing well, and I don't think they've been doing well for a while. So I do think things got overvalued market wise. So I do, and I also think that the Fed is caught between a rock and a hard place because you do have this explosive growth in the AI trade, growth in credit markets, and so they have to kind of worry about that being overblown and that creating increased inflation. Obviously, we don't know what's going to happen with tariffs, but that's creating an issue for them too. Then you do have the lower end consumer that is still struggling. So it makes me think of like Europe post 2008 when they had to worry about like Spain versus Germany. And so that's why I think there's so much of a debate within the Fed. And, you know, Powell did say, like, don't even look at the data that's going to come out next week.
Do you agree with him?
Who doesn't? Yeah.
I'm like, and I worry about the quality of it too, like in general. So
I want to ask you about, I'm looking, we're almost at the end of the year, so we can look at the S&P 500, the major industry groups, and see what really did well or didn't do. I mean, communication services names, 31% higher, information tech, 23%. So even though, I mean, the Mag 7, even if we start to see, pullbacks on some of these names or the AI trade, still outperforming. Industrials up almost 20%, financials up 13%. I'm looking at the S&P Composite Pharmaceuticals Index. It's up almost 21%.
Finally now, yeah.
Yeah, finally, exactly. So I'm just curious, what else can you dig deeper in a year where we've talked so much about AI, we've talked about rare earths, we have seen some, M&A activity going on. What is it that you have also seen that are interesting, and you can get an idea of what investors are interested in and what they are not interested in?
I've been bottom fishing. Like we've been, I sorted like the Russell 1000 into, top and bottom players. And it just felt like there was a rotation that started on October 29th, which was when we had that like 6% pullback. And a lot of those names, like of the top 100, the ones that are up the most, 100 most this year, 41 of them are in a negative return since October 29th. So we've been kind of looking around being like, where is there still growth? And I actually think like the other thing we've been doing this year is investing in alignment to fiscal policy, because we do think like what the Trump administration is doing is important to understand. And I think the consumer is going to be more important for them this year, or coming into next year, I should say. And so we've been looking more in like the retail space of players that are interesting. And so
retailers, which have been reported,
and brand names in retail, like On Holding, Lululemon, like they're down, they're down double digits this year, or maybe not On after yesterday, but
Lulu is for
Lulu,
sure.
yes, there is down 50%. It's up 10% or so today, and so we just think like there is value to be found there while we wait to see what happens in the tech world.
But on a Lulu, for example, doesn't a lot of that depend on who the next CEO of the company is, and they don't even know who that's going to be yet.
There is execution risk there now for the CEO, with obviously the change in the CEO, but I think it lost some shine on its brand, and I think they have done a lot to try to turn that around. And you've seen that in Gap this year, which is also like, I think they're further into that journey. But I think it actually creates an opportunity.
Yeah, Gap's been doing really well of late.
Yeah, it's now up about 11% year to date. But your point is, right, that if the consumer feels better and is out there spending, if we get more juice in terms of the way of stimulus, whether you believe it's the right strategy or not, if there's more money in the pocket of consumers...
Try not to invest with my heart.
I know. It's going to go somewhere. Yeah. And so there are names that will certainly benefit. Great stuff. Love digging deep into your platform. Stephanie Gill, she's Chief Investment Officer at Robinhood Markets, joining us right here on Bloomberg Business Week Daily. On a day where we are seeing, Tim, stocks under pressure, down 1.8% on that NASDAQ 100.
Yeah, but off our worst levels of the day. The S&P 500 down 1% right now. The Dow down just 0.5 percentage point.
All right, when we come back, we've got a couple of tech stories we want to dig a little bit deeper into, including Oracle pushing back on AI data centers. Or are they? Because they're pushing back.
They're pushing back on the pushback.
They are.
Also, Broadcom taking the stocks with it. Our tech roundup, that's coming up next on Bloomberg Business Week Daily.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We are looking at losses right now for the Dow, the S&P, and NASDAQ, with the S&P 500 index down 75, now at 68.25. That is a drop of 1.1%. Dow Industrials down 252, down 0.5%. NASDAQ down 377, drop there of 1.6%. The NASDAQ 100 index down 1.8%. Oracle down 4.6%. Broadcom after earnings down now by 11.5%. We've got the 10-year currently yielding 4.18%, with the 2-year 3.52%, the 30-year 4.85%. Gold up $15 the ounce, $42.95, up by about 0.4%. West Texas Intermediate crude oil flat on the day, $57.58 a barrel, and Bitcoin now down 2.8%. Of Bitcoin is at 90,250. After earnings, shares of Lululemon Athletica, they're up by 10.5%. Shares of Costco after earnings down 0.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar along with Tim Stanovic live here in our Bloomberg New York studio. Hey, we're keeping a watch on Oracle. Stock lost about 11% in yesterday's trade, down another 4.6% in today's trade. We did have a redhead crossing the Bloomberg earlier today, and that headline talked about Oracle pushing back the completion dates for some of the company's data centers that it's developing for the artificial intelligence model developer OpenAI, pushing it back to 2028 from 2027, according to people familiar with the work. At the same time, Oracle has come out, though, and they're pushing back on that. So we wanted to get into it with Bloomberg News technology reporter Brody Ford. He's joining us here in studio. First of all, we know Oracle has commented on this, and they're saying they're pushing back. Tell us, though, what you guys found out, what you found out.
Right. Yeah, Oracle is saying that we have a huge contract with OpenAI. That's, 4.5 gigawatts. They're on the hook to develop data centers larger than have ever been done and in a shorter time frame. They're saying that we're going to be able to deliver on our contracts and deliver on our expansions, right? What we reported today is that it's hard to build data centers. They're already seeing some delays, right? Yeah. And we're seeing this across the industry, that companies that are very good at software are getting involved in this business of standing up big data centers, but finding that there are some physical issues, right? You can't find enough labor. You can't find enough electricians in Texas. You can't find enough electrical infrastructure. So what we're seeing is that the company is on the hook to do some very big things with infrastructure, and it's, going to be maybe a little tougher than it seemed at first.
So it has nothing to do with demand or changes in demand. It has all to do with supply and challenges with all the supply that you talked about.
By all metrics today, demand is insatiable, right? I mean, if you went to OpenAI and said, hey, we have 100 of the largest data centers and we'll sell them to you right now, they'll probably sign the paper, right? So today, the demand for AI compute is through the roof. What a lot of folks on Wall Street are getting a little more anxious about is that in the long term, how much does this stick around? You know?
So let's broaden this conversation out a little bit, because you have a big takeout today, just crossed for Bloomberg Business Week. It's written along with Drake Bennett, and it dives into a question that Carol and I have really been talking about for, gosh, I think probably 3 months at this point.
At least,
since that last Oracle earnings report.
You can't forget it.
Yeah, you can't forget that one. Yeah. And that's why Oracle has turned into this poster child for whatever some investors are calling could be some sort of bubble with AI. Why is Oracle in that position?
To put it simply, because they're so levered.
It's all about that.
Oracle is one of the world's great cash-creating machines. Its database software it's fueling this room, it's fueling many corporate rooms, and Oracle said that, hey, we see this AI moment coming, and we're willing to throw all of our cash and then some at becoming the AI infrastructure provider. Where the jury is still out is that a good business to be in?
So, when we talk about AI, the spend, for such a long time, Brody, it was about NVIDIA and their chips. Yeah. Where is Oracle exactly? Like, what is it that they are providing and what they are doing?
Yep, good question. So they buy a ton of NVIDIA chips, rent out some data centers, put the two together, and then sell that capacity to somebody like OpenAI. And that's making it sound simpler than it is, because there's a lot of logistical work that goes in there, but they're effectively a project manager. They're the quarterback of getting all this stuff together between the real estate developers, the chip makers, and the customer.
So why do people want to work with them, and rather than just do it on their own directly? Because we do know, right?
Yeah.
Some of the hyperscalers, a lot of them are just kind of doing it on their own, right? Or are they not?
Well, Oracle is effectively trying to become a hyperscaler. They're trying to become, Microsoft built its own AI and they build the data centers. Oracle has kind of emerged as a specialty player for AI infra. They wouldn't put it that way. They want to serve all types of workloads, but where's the opportunity right now? It's in AI.
There was a period in September where Oracle shares surged 47%. In just a matter of a couple of days, thanks to a robust earnings report, a robust outlook, and then announcing some big deals. Since then, it's down about 42%. What was the catalyst that got investors to think differently and then also price these credit default swaps the way they've been priced?
Oracle has been trying to get into the cloud infrastructure game for years, and for a long time, they were kind of made fun of. They weren't taken seriously. Yeah. What's changed so much lately is they got this massive booking with OpenAI, $300 billion in commitments. And so that's when in September we saw the stock go crazy. But what happened after that is OpenAI went around town and kept signing commitments with everybody else. And it led investors to say, okay, can they actually pay these bills?
What is a commitment? What does that mean?
A commitment is...
But that's what investors were questioning. Well, if OpenAI is making all these commitments, can they actually follow through?
Can they actually follow through
with these commitments?
Is Oracle going to get the $300 billion, or is... Right.
Yeah. I feel like this reminds me of like the Amazon spend, and investors were, they weren't profitable, blah, blah, blah. And then all of a sudden it was like AWS came out of nowhere and they just owned market. Brody, don't go anywhere. I want to bring in our own Ian King. He's Bloomberg News U.S. semiconductor reporter, because there's a lot going on, but one of the other things in today's tech trade is we've been looking at what's going on with shares of Broadcom specifically, because we've seen this stock really take a big beating. I just want to pull it up on my Bloomberg here, and you've got shares of Broadcom. They're down almost 12% in today's session, so hovering near their lows of the session. It's a company, a chip, a company, I guess that you could say, that is really vying with NVIDIA when it comes to AI computing revenue. I want to bring in Ian. He's out there in our San Francisco bureau. Ian, the stock's getting really beat up. Having said that, if I look at the year to date, the stock is up almost 55%. So the quarter, what we got from Broadcom, not so bad, but was it just expectations are so high right now?
I mean, the numbers were fantastic, obviously, compared to where they were a year ago. They're doing really well, but that's kind of the case for all of these AI companies. If there's a through line between, Broadcom and Oracle the day before, it's that where is all of this coming from, right? Yesterday, Broadcom talked about huge orders from Anthropic. There was also some confusion about what kind of business it's doing with OpenAI, like Oracle. So I think, any uncertainty, anything that isn't, fantastic and immediately supportable is creating concern amongst investors right now, and that's really what's happening.
Ian, in the past few months, we've also talked about this idea that Google's got a chip that it's had for a decade that can kind of hold a candle in some cases when it comes to inference, at least to what NVIDIA is doing. And we saw shares of Alphabet move higher as a result of that. Remind us of the relationship Broadcom has with the companies that are trying to take on NVIDIA.
Yeah, it's complicated. I mean, you have to think of Broadcom as like an architect. It's like you've got a lot of money, Tim. You want a flash new house. You go to an architect. The architect basically creates the blueprint that then you take to the builder, which in this case would be TSMC, and they create the chip. So anybody that's wanting to make their own chip that would be potentially a rival for NVIDIA's GPUs tends to go through Broadcom and say, "Hey, help me out with the blueprints here," and that's what they're doing. So they're taken as like a benchmark for how well these efforts that these companies like Google, like Microsoft, like AWS are in terms of their roadmap towards competing directly and replacing what NVIDIA does.
So it makes sense that Alphabet, Apple, and Meta Platforms are among the biggest customers of Broadcom.
It totally makes sense. Ian, I feel like, we've had this conversation with you about Intel, once the chip king, and no more. NVIDIA, the chip king, although it looks like even there has been a little pecking away at some of the narrative around that company. I mean, Is there enough to go around, or are we likely to see some things maybe change, even in the fortunes of a company like NVIDIA? Or does it look like what you're hearing in terms of orders and the AI build, that it's still going to be a company that everybody's going after?
I mean, back to what I think Brody just said, which is right now there is no evidence of a slowdown. There's no evidence that, you know, things that we're overbuilding, that there isn't a fundamental demand to support all of this investment. That doesn't mean that we won't get there or get there soon. When that will happen, we don't seem to know right now. What is, I think, a growing uncertainty is that who is paying for it? You know, even though these companies have got fantastic growth in terms of viewer numbers, is that reflected in revenue? Is that reflected in profitability? And I think for this to have a continuing surge along the same lines that we're seeing, we have to see more of that coming in. We have to see more profit dollars being shown to the world rather than just profit dollars of those who are basically being paid to build the systems.
That's a big thing I heard a lot too when thinking about Oracle's success, because effectively for Oracle to be successful, OpenAI has to be, and for OpenAI to be successful, it can't just be ChatGPT. It can't just be a couple of hit AI products. All of this spending is premised on something that's truly transformational, that really redefines a lot of industries, saves a ton of money, and it's like the level, that like the internet level, right? And we are just not, we don't have a line of sight there yet.
Right, that's exactly what we're trying to figure out. And if that is the promise, then there are some serious structural issues with the way the economy is laid out right now. I mean, so many unknowns, Brody, that people are concerned about. And we even look at the what David Sachs said earlier today on Bloomberg TV with Ed and Caroline, that there are a lot of people who are concerned about losing jobs as a result of AI. But he cited a Yale study that he said, this is David Sachs, that said, you know, we haven't seen a loss in jobs correlate with the introduction of ChatGPT. So it's not, he argues that it's not materializing right now.
Yeah, I mean, I think that's true. I think we've all used these tools, right? They're good, they're not great. I think, you know, they've been around long enough that we've seen the booster cycles. And 2 years ago, there were a lot of promises made that haven't happened yet. Now they're good tools. They're used a lot, and they are transforming some industries. But for all this to pay off, it needs to go further.
30 seconds to you, Ian. Hock Tan saying he didn't give an annual AI revenue forecast, saying it was a moving target. He'd rather not give guidance on what is going on in 2026. Are you comfortable with that? Is that him being very honest and just, it's not bad, it's just a moving target? Or is it a little bit of being cautious?
The problem is, you know, Wall Street is not comfortable with that. In the past, we like Hock and his directness. There were a lot of questions and a lot of seeking clarity yesterday, and people came away with that not entirely sure when this money is going to come in.
And that's why you're seeing the price really tank in today's session. Gentlemen, thank you so much. Bloomberg News U.S. semiconductor reporter Ian King, and of course, our own tech reporter, Brody Ford, joining us right here in studio. All right, coming up, a view from the C-suite.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. That rotation out of tech stocks gaining momentum this afternoon after disappointing earnings from Broadcom and anxiety about Oracle's data centers with news worries about the AI trade. Right now, we got Oracle down 4.5%. Broadcom after earnings down 11.4%. Bottom line here, tech stocks selling off. NASDAQ 100 index down 1.8%. NASDAQ Composite Index down 1.6%. S&P keeping it all in context. That is down 1%. Dow Industrials down 0.5%. 10-year 4.19%. We do have spot gold right now trading higher, up 0.4%. 42.96 the ounce. West Texas Intermediate crude 57.44 a barrel, down 0.3%. Bitcoin down 2.9%. 90,221 on a Bitcoin. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, RBC Capital Markets, among the analysts that raised its price target on UiPath following recent earnings. In one note from RBC, they said the company is set to continue recent trends like net new annual recurring revenue, also known as NNARR, for those keeping track. They also cited stabilization and improved profitability despite debate around its role in an increasingly agentic automation world. That is something we're going to dig into with our next guest.
We got Ashim Gupta with us, CFO and COO of the $9.4 billion market cap company UiPath. The share's up close to 40% so far this year. 12% of the float is shorted. Also with us here in the Bloomberg Business Week studio, Nina Tretman, Bloomberg News senior editor. She writes the CFO Briefing newsletter. You should subscribe to it at bloomberg.com/CFO briefing. Ashim, good to have you on the program. An application software company, robotics, automation software. Remind everybody and introduce people who don't know exactly where you play in the industry. Who are your customers and where do you fit?
Yeah, thanks so much for having me. For those who don't know UiPath, UiPath is an AI-powered platform that helps businesses and enterprises transform their enterprise processes and organizations to yield productivity and ROI. We do so by emulating what humans do through both deterministic, rules-based automation and agentic automation, using agents and AI to automate a lot of those tasks. You know, we own more than half of the Fortune 500 companies in the world. We have 10,800 customers that span industries from financial services to healthcare to the U.S. federal government, and we operate in over 100 countries. The reason for that breadth is because we are very relevant to what every enterprise of almost any scale does in terms of taking away mundane work to yield for a more productive workforce.
So wait, so do me a favor, just because I'm stupid and it's Friday. So tell me, I'm okay, I'm really okay with it. Give me just in 30 seconds a quick example of a company that you work with and what you do for them.
Yeah, so Carol, Voya Financial, just as an example, is a large-scale bank in the United States. We're working with them to automate their everything from HR operations, such as employee onboarding, to financial processes. If you step back and look at almost any enterprise that's there, think about something as mundane as procure to pay, where you're receiving invoices, entering them into systems, then moving that data that you're entering into systems, doing reconciliations. That work can be done by software and does not need to be done for the hours that people are putting into it. You take something like that as a simple example, but then you can go and you look at a Fortune 10 healthcare company that we work with. All of their claims processing gets touched by our software. Entering data, analyzing and understanding data, and with agentic, providing reasoning to allow for decisions to be made. Those are two examples.
Just wondering, Ashim, in your finance organization, are you using it there too?
Huge. You know, when you look at UiPath has scaled from almost zero revenue in 2017 to over $1.8 billion of ARR to where we are today. Within our finance department, but across our enterprises, we employ our own software. So we have not had to add people net to our company in many years. We've been able to achieve that scale both geographically as well as from a revenue perspective using automation. And that's not unique to us. That is something that a lot of our customers benefit from.
Okay, so we all sat up, Ashim, a little bit straighter because there is so much of a narrative and conversation going around AI and what it's going to do to the labor market. It sounds like you haven't had to hire people. Reality check, are a lot of companies going to be able to not hire people or even let people go because of what AI or agentic AI is going to be able to do for them?
Yeah, let me make a small nuance here.
Okay.
We've hired people just in the places that provide higher return in terms of revenue or higher paces of innovation. So in our minds, companies should be hiring and people will continuing to work, but it's going to be working in higher skilled areas and areas that have a higher return to the enterprise, whether that is working interactively with customers or whether that is on pace for designing the next feat of innovation to bring to the market over the next couple of years. So this isn't about hiring less, it's about hiring where you want to. And all of that translates to ROI.
Ashim, just wondering, we've seen a lot of concerns in recent weeks, specifically in November, among investors around AI and whether what we're currently seeing is leading us into a bubble at some point. If you look at your bookings for next year, like what does that look like? And what's the feedback that you're getting from clients if they're thinking about their spending plans for next year?
Yeah, look, I think what our customers feel is they feel a variable macroeconomic environment, I think like all of us do. And, you know, a lot of times what we all discuss in our various forums, whether that's formal or informal, what I can tell you is what's encouraging is customers want to spend. The key area is they're not going to spend unless they see ROI. So as we're looking at our demand funnel, we launched our agentic platform, bringing agents and AI-infused automations to enterprises earlier this year. You know, if you go back to maybe 2016, 2017, 2018, there were innovation funds that you could go and say, hey, let me go and spend $2 million and just experiment. I think experimental funds are moving down. But there's a lot of funds available that for projects and areas that yield ROI. So once we launched our platform, the demand for proof of concepts and pilots really we're super encouraged by. Even in the first 5 to 6 months, more than 700 of our 10,800 customers, these companies are going and building agents on our platform and figuring out where are the highest ROI areas. So there's a lot of activity. And I think funding will follow activity so long as that there is ROI that is there. And that's what gives us a lot of confidence and optimism as we look into the years ahead for UiPath.
Ashim, very briefly, very interested in the work that you do for governments in the U.S. and around the world. How do you characterize that work? Like, what do you do for them? And also, how big of a business is that for UiPath?
Yeah, so the public sector is it's greater than 10% of our revenue base just globally. You know, that was as of 2 years ago. We haven't disclosed figures since then, but it's, you know, I would imagine it's in a similar vein here. I can represent that. When you look at the U.S. government, it's everything from, you know, from areas of agencies that are in high paper network. They use our software to actually scan, read, and extract data so they can process things fast. There are partners that we work with the government that are taking papers that are sitting in caves and in parking lots, trailers and trailers of them, and digitizing them as a part of their digital transformation. Getting audit compliance across the government, which involves retrieving documents and processing different areas for auditors and business teams, that is a key area that we can look at. But we're across every agency that is there. What I'd say is we've gotten super close to the government over these last years. We've continued to have a great relationship with them. And just like enterprises, what's encouraging is they're looking for high ROI, high impact, transformative areas to deploy our software.
All right, well, super interesting, and I hope you'll stay in touch so we can continue this conversation. Ashim Gupta, CFO and COO of UiPath, joining us from afar, and of course, right here in studio, Nina Tretman, Bloomberg News senior editor. She writes the CFO Briefing newsletter, which you can subscribe to at bloomberg.com/CFO Briefing. You get a new one every Sunday. Nina, thanks.
And Ashim will be featured in an upcoming edition of the Bloomberg CFO Briefing newsletter. Also, for more coverage of CFOs, you got to check out Chief Future Officer, the series from Bloomberg. The newest episode premieres next week. It features the CFO and COO of Hasbro. That's Gina Getter. Watch next Wednesday at 9:30 New York time. This is Bloomberg Business Week Daily.